Hi guys, PK sir over here. So this is to welcome you to this particular revision video on the most important chapter in your entire syllabus of CA Final FR, that is financial instruments. Now recently only in one or two exams I think the number of marks has tad bit it has come down, but the problem with financial instruments is you cannot see the number of marks in its isolation, because to understand a lot of other indes and lot of other chapters you need the knowledge of financial instruments. So in that case we can't really weigh it, when it comes to weightage. And this particular financial instruments revision session is very exhaustive in nature. Now, usually when it comes to YouTube, you will find around 3 hours sessions, 4 hours session, max 5 hours session. Now, this session will go nearly 10 hours. Now, you might be thinking why I need to spend that much time when it comes to revision. You will understand the kind of depth and the kind of problems that we have covered in this particular revision session along with logics. And the good news is, whatever the power notes that you see here is available for you to download along with this particular revision session. You can just go to this website caprasannakumar.com. Over here in that free downloads column will be there. From that free downloads column you can download the entire power notes of financial instruments. Both part 1 and part 2 will be there. You can download that. Now if you can see the way this power notes is designed, you guys will love it. Just go through the session, you will understand how much I've simplified it along with the logic. I don't want you guys to by heart this. Enjoy the entire session. I can guarantee you that this will be the best session on financial instruments that you would have ever watched. So look at the notes, you just go through the definitions, the way it has been conceived. I'm 100% sure that you guys will love it. So just stay with me with this entire session. Okay, I gave you certain hacks on how to understand this financial instrument. You guys will love it. I can just promise you that. Okay, just go through the entire so-called session, Nana. Okay, just go through the notes once. Just browse through the notes. You will understand what I'm trying to say, and you guys will love the way it has been covered, the way it has been simplified. For example, if you can see here, contracts entered on non-financial assets, to be executed in future, we call it as NFAs, right? You can see how I've covered it. First I gave you an idea. After that, case by cases I've covered. Case 1 example, from that what we need to understand. Case 2, that is nothing but example, from that what we need to understand. Case 3 example, what we need to understand. Case 4 example, what we need to understand. Case 5 example, what we need to understand. Case 6 example, what we need to understand. Case 7 example, what we need to understand. Case 8, case 9, case 10. Now you can understand why it goes all the way to 10 hours. Why? Because every single case is a reverse engineering of a problem that we have already done. So that problem, whatever the concept that has been tested in that particular problem, has been reverse engineered, converted that into a case. So every time you do a case, it's as if you have done a problem. You understand the point? And it has been simplified as well. And finally, there is a summary as well. So for all the cases that we have seen, this is a single point summary, so that the day before the exam, you can easily revise it. So that's the way everything has been covered. Contracts to be settled by entities' own equity instruments. You have the segments over here. And then again, it will be covered case by case. You can see case 1, example. So every case that you see here is a reflection of a reverse engineering of a problem that has been given by your ICA, whether it is in study material or RTP or MTP or whatever it is, previous examination question, whatever it is. If I find a question on financial instrument, if it is a good question related to a particular topic, it has been taken over there, reverse engineering is done, and then it has been included as a case over here. Clear? I think you guys will love it. Don't look at the number of hours and arrive at a conclusion that it has been too much. If time permits for me, I'll be coming up with various revision videos on 110, 103, leases, and even 115 for that matter. All the tough in days I'll cover. Stay tuned. At the same time, I want you guys to go through it. Just thinking that you will save 3 hours or 4 hours, don't think that. You will get value addition for sure. That's my promise. And definitely comment what is the next revision session that you guys want. Okay, after this particular video, whether you want leases first or 115 first or 110, 103 or even Ind AS 12. Certain people are specifically asking me that. Now I will go through the comments. I'll reply each and every comment. Okay, and whichever comment, whoever students, whichever Ind AS is commented more naturally, that will be the first revision session that I'll come after this. Okay, if majority of the people has commented 115, I'll come up with 115 revision session. And trust me, it will be a banger of a session. That's my promise. Okay, so that's it. Enjoy the session, and I'll be looking at your comments. Let's see. Hi guys, welcome to my channel CA Prasanna Kumar. This is PK sir over here. Now this is going to be a brief intro session before we actually start the main session of revision of the most important chapter of your entire syllabus when it comes to CA Final FR, that is financial instruments. Okay. Now thanks for all your love. We have actually launched our CA Final FR EVO as well as regular batch a few days back, and the response was good. Okay, and many people are especially appreciating the clarity of the sessions as well as the power notes that we have written. Hopefully, I expect the same from you guys through this particular revision session. So what we'll be doing is that this is a revision session. Please keep this in mind because in usual regular class, this goes beyond 40 hours, the only chapter which goes beyond 40 hours. Okay. So therefore, you can just imagine we are trying to bring it down less than 1/4. I mean, probably like 15 to 20% of the actual time. In that case, you guys can understand how far we need to string things. So therefore the session will be fast, and there will be certain things that we actually discuss in regular class or evo batch in detail. We will not be doing the same over here, and this is not for people who try to watch this particular session for the first time. Okay, it will be tad bit difficult for you to understand. Then in that case, the only thing that you guys can do is that just watch it repeatedly. And whatever the power notes that I'm using over here, this will be available in caprasannakumar.com website. You can see the website over here, right? In that website, there will be a free downloads column. You can just go over there and you can download it from there. I'll try to put the link in the description as well. And for others, if you want to have an idea of how this will be, the same revision session will be taken in a regular class, you can just watch those videos also. It's available in my channel, Financial Instruments Concept Part 1, Part 2, Part 3. I think as of now, 3 parts has already been uploaded, somewhere around 8 hours of session. Okay, so you guys can just watch that and you can understand in what pace it actually goes in a normal class. Okay, but this is going to be the revision session, so it's gonna be pretty fast. So fasten your seat belts, and the session is going to be wonderful for sure. And one more thing, many of you guys known me as a SEMP faculty, CA Final SEMP or costing as PK sir before the subject was removed, and then I went into the other sides of kind of other businesses and stock market and stuff like that. Many people have been asking me to put a video on my UPSC journey because some of you have come to know that I've got selected for UPSC interview and all that. Uh, Apart from that, some people are also asking me to put some videos on stock market. Okay, especially because I do options trading. I also do Bitcoin and forex, the gold. So that also I'll try to do, but for me the time is the major constraint as of now. So therefore just give me some time, because right now my focus is completely on FR. Once this is done, my focus will shift to CA Final AFM as well as CMA Final, and once that is done, then I'll be going on with all these other things. Okay, so time is the biggest constraint over here, so I'll try to do my best. Okay, chalo, let's start with the session, guys. So the chapter that we're going to see is financial instruments. Now obviously you know that this includes 3 Ind AS, Ind AS 32, Ind AS 109 and Ind AS 107. All right, now many of the students are asking me, what's the specialty of your power notes? See, in our power notes, it's completely handwritten. Every page has been written by me, yes, myself. It has not been typed. Second, I give a lot of importance. Those who have already taken costing classes from me, you people know about me. So I always prefer logics over memory. Okay, because I don't like people by hearting things and then trying to revise it many a times. Rather, I'll prefer understanding a concept with the logic, so that once it get digested, automatically it will be remembered for a longer period of time, thereby requiring lesser number of revisions, thereby eventually saving your time. People don't get it actually, unfortunately. Rather than they go for shortcuts, they tend to buy hard things and then they keep on revising again and again, again and again, again and again. So in this process, your time also gets wasted. At the same time, you'll not be enjoying the subject as well. You will do it as if like some sort of a duty or a job, okay, which really affects the the way you live. So therefore, you understand the concepts, you understand the logics, then subject becomes really sweet, it becomes enjoyable. At the same time, your memory gets convinced, and you will remember things for a longer time. That doesn't mean that it doesn't require revision. It requires revision, but fewer revisions. Say for example, 1 or 2 should be enough, unlike you go for 3, 4 or 5 revisions usually. Okay, having said that, now coming on to financial instruments, this is the most important chapter in your entire syllabus, because it comes on an average for 20 to 25 marks, okay, every single attempt. It has got 3 Ind AS 32, 109 and 107. 32 is just about definitions. It talks about the presentation of financial instruments. Okay, it's all about core theory and all the definitions will be there. It is not important from your examination perspective, but without knowing this, you will not be able to understand Ind AS 109. Now, Ind AS 109 talks about the recognition and measurement of the so-called financial instruments. So this is what the chapter is all about. Okay, so it's all about financial instruments. I mean, the financial instruments is all about Ind AS 109. And Ind AS 107, not that important. It's just about disclosures. So not so important from examination point of view. Got it? Chalo, straight away, let's start with Ind AS 32. So the way our session progresses is like this. First, we'll start with Ind AS 32. Okay, we'll finish off Ind AS 32 completely. Then we'll go for Ind AS 109. And that's how it's gonna happen. Okay, chalo. First, let's try to understand what is a financial instrument. First, the core word is it is a contract. Whenever we talk about something called financial instrument, you guys need to understand that it is a contract, which is there are two parties involved whenever we use a word called contract, right? So for one party, it becomes a financial asset. For another party, it becomes either a financial liability or equity. This is very important. Okay. For one party, it becomes a financial asset. For another party, it becomes a financial liability or equity. So such a kind of a contract is called as financial instrument. Got it? Now, immediately a question will arise. What do you mean by financial asset? What do you mean by financial liability? And what do you mean by equity as well? That's what we're going to learn right now. So once we learn that, then you apply that over here to this particular definition, you'll get much better clarity. Okay. Right. Moving on to financial asset now. Let's start. Now coming on to definition of financial asset. Now it's pretty easy to remember. So just focus on the points. Any asset, look at the word, it is any, which means literally it covers everything, which satisfies the following conditions. Cash and bank balance is by default a financial asset. Easy to remember. Okay. Contractual right to receive cash, that is also a financial asset. Cash and bank balance, contractual right to receive cash. Now here focus on the point contractual right. So contractual right is different from legal or statutory right. So when it involves legal or statutory right to receive cash, then that will not be called as a financial asset. It has to be a contractual right. You guys know what is a contract, right? Now, equity instrument of another entity. Obviously, you have invested in equity of another entity, then that becomes a financial asset. Contractual right to receive equity instrument of another entity, that is also a financial asset. Easy to remember. Okay. After that, we have these 2 points. Let's focus on this. Contractual right to receive any other financial asset. Here we were specifically talking about equity instruments, which is an asset obviously. Other than that, if there is any other asset as well, okay. So in that case also, it satisfies the definition of financial asset. Right. Now, last one is pretty important. This is where many people they get confused with. Derivative contracts, in essence, contract to exchange financial asset or financial liability with another entity that are potentially favorable to your entity. The derivative contracts means by this time, because we are into revision classes, so straight away I'll come to the point. You have forwards, you have futures, you have options, you have call option, put option. So when it comes to all this, these are all kind of betting, right? It's a kind of betting. We can put it that way. Now, when you bet something, like for example, you are expecting dollar price to appreciate in next 6 months. Therefore, you go on a long position. Long position means you agree to buy dollar. Okay, you enter into an agreement today. After 6 months at so and so price, you fix it today itself, thinking that tomorrow I'll buy it that particular price after 6 months, and eventually I'll sell it into the market at a higher price. You understand the point? Now, when this 6 months is going on, you will see that whether the kind of position that you have entered into is going in your favor or is going against. So depending upon if it goes in your favor, then that derivative becomes a financial asset for you. If it goes against you, then it becomes a financial liability. You understand the point? That's what this part of the definition covers. So you get into any sort of derivative contracts, in a way, it's a kind of a betting. Eventually, if you are winning that particular betting, so whatever the expectation that you have got, you have a share on that, you have purchased a call option. You understand the point? Which is nothing but a right to buy a share, and then it goes in your favor. The share price increases, and then your call option value also increases. Then in that case, it's a kind of a financial asset for you, because you are getting benefited. It is favorable. Suppose it is going against your way. You took a long position, which means you think that the price of the so-called share or gold or foreign currency dollar is going to increase, whereas it is going down in opposite direction. In that case, what will happen? You'll be facing loss. When you'll be facing loss, eventually what happens? That becomes a financial liability. So that will be covered under financial liability definition. You understand the point? So this last part is pretty easy. I don't know why people tend to get confused over here. It's pretty easy. All you need to understand is that I've taken a betting. That betting is going in my favor or it's going against me. If it goes in my favor, I get a gain naturally. If I get a gain, it becomes financial asset for me. If it goes against me, then it's a loss. Then naturally it becomes financial liability. The opposite of it. You got it? Although we did not go to the financial liability definition, but that's the way it is. Okay. Now let's look at some examples. Sale of goods. Once you sell your goods, okay, and you will create debtors, so you'll have a right, contractual right to receive cash from them. satisfies this particular point and it becomes a financial asset. Debtors, same stuff. Bills receivable, contractual right to receive cash, purchased debentures. You have invested in debentures, right? So you have a contractual right to receive interest, and after that redemption will happen, correct? So is it a financial asset? Yes, it satisfies the definition. Investment in preference shares, you'll be getting preference dividend at one particular point of time. If it is compulsory redeemable preference shares, you'll be getting redemption money as well. So you have a contractual right to receive money. In that case, it satisfies the definition. It is a financial asset. Loan issued, you have a contractual right to get interest as well as the principal repayment. Yes, financial asset. You got it. Investment in convertible preference shares or debentures of any equity. So when you have invested into a convertible debenture, say for example, what does it mean? After some point of time, when the redemption is going to happen, it might get converted into what? Unless it is mandatory conversion. If it is optional, it might get converted into equity shares. Then you'll be getting the equity shares of that particular, other, whatever the kind of company that you have invested in. In that case, you have a contractual right to receive equity instruments of the other entity. So it satisfies the definition. It becomes a financial asset. So the summary is pretty simple, Nana. When it comes to financial asset, first it is cash and bank balance. You remember just the way I tell you, okay? Cash and bank balance, next. Contractual right to receive cash, next. You have invested in equity instrument of some other entity, right? And then contractual right to receive equity instruments. Then continuous, contractual right to receive any other financial asset as well. And finally, you have a derivative where you have done some sort of a betting and it is going in your favor. Then it becomes a financial asset. Easy peasy to remember. Got it, everybody? Now, one more important thing that I would like to tell you guys here, the way I'm teaching you, the wording, the sentences or all that, it is in line with your ICA wording. You got the point. If you don't write these kind of words, if you don't use the keywords, then even though your answer is going to be correct, ICA is not going to give you marks. You understand the point? That is also very important. If I want, I can simplify this a lot. You got it? That will be like a, what can I say? It's a short-term solution for you. In long run, it will not work, especially in examination. So this also keep in mind. Many people, because many students, they feel that I don't have time. Therefore, let me search for shortcuts. Therefore, I'll go for concise material, concise material, concise material. Okay. As a result, what faculties also do is that, I see, at the end of the day, we'll be thinking like this. Whatever students want, let's give them. Because if we give advice, many a times they're not in a position to listen. You got it? So eventually, we also go for it. And eventually, what will happen? You go for the shortcut. You don't learn the keywords. You don't write the sentences in the way it has to be presented for ICA exam purpose. Then therefore your answer is correct, but still you'll not get marks. Eventually you'll not pass. And then you get into some sort of a depression thinking that I've written correctly. Then why did I not get marks? There is a problem with the correction. That is not the thing. You need to understand how a paper is going to get evaluated. This is not just true even in CA exams, Nana. This is true in all the exams. When I was writing civils exam, that was the same situation that I've faced. So when I write an exam, even in civils for that matter, so I have to write an analytical, exam, especially the mains. Okay, prelims is all about MCQs. Now, when I write an analytical answer, so for a particular question, if I give a socio-economic answer, whatever it is, if I give an answer and I also take some contemporary real life examples into the answer, and if I draw some diagram, the point is I should present the answer in such a way that the professors who are going to correct my paper should be in a position to appreciate that. You understand the point? So I can't write an answer which overrides their intelligence as well, which also happens. And I can't write an answer which goes beyond their intelligence level where they will not appreciate and they'll not give you marks. So for every exam, especially when human being is involved in correcting, unless I'm talking about, I'm not talking about MCQ kind of an exams where human being is involved, you get the point, and then they are correcting, you have to understand what they are doing. Eventually you have to write the exam. This is a prerequisite. No sir, I don't know sir means that's, it doesn't work that way. Keep that in mind. Are we done with this? Right. Chalo. So all these examples in regular class we'll see here. We don't have time when it comes to revision. Okay. But anyway, you can have a basic idea. We have already seen this. Here I gave you examples. Okay. Chalo. Financial liability. This is also easy. It's any liability. Again, the word is important. Any liability that satisfies these four conditions. Okay. Now, what is that? In financial asset, we had a right, contractual right to receive cash, contractual right to receive equity instrument of another entity. Here it's exactly opposite. Obligation becomes a financial liability. Always remember, obligation becomes a financial liability. Okay. Contractual obligation to pay cash, contractual obligation to deliver other financial asset. You got the point? Contract to deliver your own equity instrument, but of course in variable number. This is very important. Why is it important? Later we'll see. If it is fixed number, things will change. Okay. It is variable number. Got it? If it is fixed number, then it will not be a liability. Why is that? We'll learn fixed to fixed test. There you'll understand. Right now you'll not understand. Just keep this in mind. Okay. Then finally, this one already we know. It's a derivative contract where you bet on increasing share price, you bet on increasing gold, you bet on increasing currency of dollar, and then it goes against you and you end up in loss. See, it is not loss realized, but there is unrealized loss as well. In, say, for example, forward contract is for 6 months. Still 6 months did not get completed, but in meanwhile also you'll be having what? Unrealized gains or loss, na? You understand what I'm trying to say, right? See, today you bought an option, na? Option contract will expire after 1 month, say for example, but every single day its price will vary, right? So if you have taken an option on a Reliance share thinking that Reliance share price will increase, you have purchased a call option. You got the point? And then if it is increasing, then it's fine. It's in your favor. So your option price will keep on increasing. So you need not wait till the expiry date. You need not wait till the settlement date. Immediately you can sell it in the market and you can gain out of it. You understand what I'm trying to say? So therefore, if it is going in your favor, the kind of a derivative, the betting, it becomes a financial asset. If it goes against you, you purchased a Reliance share, a call option on a Reliance share, and then it goes against you. In that case, what happens? You are facing a loss. You got it? Then it becomes a financial liability. Clear? Easy peasy. Now, okay, say along with me. So what is financial liability? Easy. First of all, you need to remember obligation. Okay. Financial asset means you need to remember right. Okay. Obligation for what? To pay cash. Okay. Obligation to do anything else? Yes. To give any other financial asset. Obligation to even deliver your own equity shares. But not in fixed number, but in variable number. Then only it becomes liability. If it is fixed number, it will not become a liability. Why is that? We'll see later. That's up for discussion. And finally, the betting, the derivative contracts where it is unfavorable to you, which means you're eventually facing loss. It may not be a real loss at the end of the day. What is that? You'll understand when I go to derivative accounting. Till that point, you'll not understand. Right now, just understand that you have taken a betting and it is going against you. Right? It becomes a financial liability. Fantastic. Are we done with this? Let's look at the examples. You have purchased goods, Nana, on credit. So you have a contractual obligation to pay cash, satisfies the definition, financial liability. Trade payables, you have a contractual obligation to pay cash. Loans, you have a contractual obligation to pay interest as well as principal repayment. Redeemable debentures or preference shares, you have a contractual obligation as a company. I have issued preference shares, I have issued debentures. So tomorrow I have to pay back. So I've got a contractual obligation to pay back, financial liability. Bills payable, I have a contractual obligation to pay that, financial liability. You got the point? Easy to remember. Chalo. Now we'll see some special cases. Let's try to apply the concept that we have learned. Now that we know what is a financial asset, what is a financial liability, now let's recollect the definition of financial instrument. What is the definition of financial instrument? Where two parties will be involved, and for one party it becomes a financial asset, for the other party it becomes a financial liability or equity. So we have already seen financial asset and financial liability definition. We'll see equity as well shortly so that you will understand the definition of financial instrument. Now, before that, we'll see some special cases. Let's say there is a debenture, okay, which you have issued. So we are talking this from issuer's point of view, not the holder's point of view or investor's point of view. Okay, issuer means usually it will be a company. Company only will issue debentures, right? Now, suppose if it is redeemable debentures, where compulsory you have to redeem it. All the interest payment, is it a contractual obligation to pay cash? Yes, satisfies the definition of financial liability, therefore financial liability. Compulsorily, if you have to redeem, then you will redeem it in cash. So principal repayment, it is also contractual obligation to pay cash. That's also financial liability. Clear? Coming on to suppose if these debentures are convertible debentures, that too mandatory convertible debentures. Convertible into what? Equity shares. Okay. Okay. Even in this case also, first of all, will you pay interest? Yes. Is it a contractual obligation to pay cash? Yes. Is it a financial liability then? Yes. What about the conversion? Is it optional conversion or mandatory conversion? No, mandatory, which means 100% you will not redeem. No, I will not redeem. I will not redeem means I will pay cash? No. Is there a contractual obligation to pay cash? No, because I'm not going to redeem in cash. Then what I'm going to do? I'm going to convert that into equity shares. Okay. Okay. Then the kind of equity shares what you're going to give, is there any obligation in that particular part? No, I don't have any contractual obligation to pay cash. I don't have any contractual obligation to give any financial asset. You understand the point? I do have a contractual obligation to issue equity shares, which satisfies the definition of financial liability, your own equity shares. But in variable number, then it becomes financial liability. Here, let's presume that the number is fixed. Let's presume that the number is fixed. Right now, just remember fixed variable. Okay, if it is variable, it becomes a liability. If the number of equity shares that you have an obligation to give is fixed in number, it becomes equity. Got the point? Why is it? We'll see that later. The logics and all, we'll see that later. Right now, our focus is only on this. Clear? So here, the conversion is going to happen into equity shares and it's going to be fixed in number. and as a result you don't have an obligation, therefore it becomes an equity. Still we haven't studied the definition of equity instrument, so till that time just wait. Okay, now so in one single instrument over here, it is just one single convertible debentures, but it has got two characteristics. It has got a financial liability inside and it has got an equity inside. So we call this as a hybrid instrument. In future we'll be seeing something called embedded derivatives also. That will also be a kind of hybrid instrument. There are two types of instruments. One is embedded derivatives, which we'll see in in future, where there will be two things inside. Here also, when it comes to convertible, mandatorily convertible debentures, we have two things inside. The interest payment will be classified as financial liability, and the so-called principal payment, where you'll be issuing your own equity shares in fixed number, will be classified as equity. So because it has got two things inside, we call this as compound financial instrument, which we'll be studying lately separately, but right now this is the basic idea. Got it? Chalo, moving on. Preference shares also, the concept remains the same. Suppose you have redeemable preference shares. We are looking at this from issuer's point of view, okay, from company's point of view. You have to pay dividend. Now tell me, is that dividend payment? See, when it comes to interest, we need not discuss, because discretionary interest is very rare. Mostly it will be mandatory interest payment. Therefore, straight away we said it is a financial liability. But when it comes to dividend, we don't know that it will be discretionary or mandatory. If it is mandatory, then you have a contractual obligation to pay cash. It becomes a financial liability. Simple. That's it. But if the dividend is discretionary, then it's at your choice. If you want, you can pay. If you don't want, you need not pay. You understand the point? In that case, definitely, only if profit is there, you will pay. If profit is not there, you will not pay. This sounds like a equity dividend. Na? Equity dividend also same thing happens. If you have sufficient profit, you'll pay. Otherwise, you'll not pay. You don't have an obligation. Then it becomes equity. Whenever you don't have an obligation, it becomes an equity. Got the point? Right, moving on. Of course, we are still yet to cover equity instrument definition, but till that time, just wait. Okay, here we are still discussing about debentures and preference shares. Okay, coming on to convertible, mandatorily convertible preference shares, which means you don't redeem preference shares in the form of cash. Rather, you convert that into equity shares. In that case, again, the topic is the same. It will be divided into dividend and principal. Dividend, is it mandatory? Yes, then financial liability. Got it? If it is discretionary, again, it becomes what? Equity. Got it? Right. When it comes to principal, now again, you have to mandatorily convert that into equity shares. Presuming that the conversion into equity shares is fixed in number, in that case, it becomes what? Equity. Then because there are two things inside one instrument, it becomes compound financial instrument. That's the simplest way we can do things. Okay. Now, before we get to equity instrument definition, this is the biggest hack of this particular financial instruments chapter. The importance of this sentence right now you might not understand, but hereafter when we discuss future concepts, every time I'll try to recollect this sentence so that you'll understand its importance. So this is my hack on this entire financial instruments. What is that hack? This standard is not about what usually happens. It's about what can happen. So what is the importance of this sentence? This standard gives preference to not the most likely thing that's going to happen. For example, you say, sir, there is a 90% probability of this happening. Okay, standard does not look into that. Standard also takes into consideration something which has got 1% probability of happening. Standard also takes into consideration something which has got 2% probability of happening. You understand the point? The only question you need to ask yourself is, can this happen? If this can happen, then immediately this standard considers that, takes into consideration. Are you able to understand? This is a very deep point. You will not be able to appreciate it right now, but once we start learning the future concepts, for every concept you try to apply the point which I've told you, then you will understand that the whole standard or the whole financial instruments chapter is dependent on this particular sentence. Okay, so this standard is not about what usually happens, what most likely happens, which has got highest probability. No, this standard is about what can happen. Even though the probability of that happening is as low as 1%, still standard will consider that. Clear? Chala, fantastic. Now let's come to the definition of equity instrument. Now, coming on to the definition of equity instrument, okay, you can call it as equity or equity instrument. The right word is equity instrument, okay. So what is equity instrument? Any contract. Now we know that even for financial asset or financial liability, for financial instrument as such per se, it has to be a contract, normal contract. It should not be statutory. It should not be what? Legal. You understand the point? Right. Now, any contract that evidences residual interest in the net assets of the entity. Residual interest means the last preference. You just try to recollect what you have learned in CA Inter, especially financial management. Whenever a company earns profit, so what happens? First it goes for interest, then it pays taxes, then it pays preference dividend. at last you'll have earnings available to equity shareholders, which we call it as EAS, correct? So which means that's what we call kind of residual interest, okay, where you'll be last in the line. So because you're last in the line, naturally your risk will be higher. You feel that you will have higher risk because you have less probability of getting something, right? Therefore, you feel your risk is higher. Therefore, your return expectation also will be higher. Your return expectation as an equity shareholder will be the cost for the company. That's why KE is the costliest form of income for the company. Sorry, costliest source of finance for the company. If company wants to raise money, the costliest way of raising money is through equity. The cheapest source of raising money is debt. Okay, keep that in mind. Anyways, now, so any contract that evidences residual interest in the net assets of the company, we call it as equity instrument. Okay. Other one is contract to issue issuer's own equity instruments in fixed number and no contractual obligation whatsoever, because the moment there is a contractual obligation, it becomes a financial liability. So to become an equity instrument, first of all, no contractual obligation whatsoever. First rule. Second rule, you issue equity shares, it becomes equity, but it has to be fixed in number. What if equity shares are there and it is variable in number? Then it satisfies the definition of financial liability. If there is a contractual obligation for you to issue your own equity instruments but in variable number, it becomes financial liability. Very important. What is there, sir? I'm issuing my equity instruments na, equity shares only na. That's obviously what equity for me. No. If you're issuing variable number, then it satisfies the definition of financial liability, becomes financial liability. If it is fixed in number, then only it satisfies the definition of equity instrument, it becomes equity. Am I clear? Right, fantastic. And another important point is there should be no contractual obligation whatsoever. The moment you see contractual obligation, it satisfies the definition of financial liability, it becomes financial liability. No contractual obligation, then equity. Fixed number of equity shares, equity. Variable number of equity shares, financial liability. Clear? Right. I gave further explanation. You can just see it over here. It means a financial instrument, okay, that gives the holder ownership rights in the entity. That is what we are talking about, residual interest over there, and does not create any contractual obligation on the part of the issuer who is issuing equity shares. On his part, there should not be any contractual obligation getting created to deliver cash or any other financial asset, whatever it is, no contractual obligation whatsoever. Then only we can call it as what? An equity instruments. So this is the key characteristics, Nana, of an equity instrument. No obligation to deliver cash. If there is, it becomes financial liability. No obligation to deliver any other financial asset. If there is, it becomes what? Financial liability. Exchange financial asset or financial liability under potentially unfavorable conditions. You don't have obligation for this. If it is, then it comes under the derivative definition and becomes financial liability. Okay. Represents ownership interest like shares. That's what we call it as equity. Returns to holders like dividends are discretionary and not contractual. So if you are an equity shareholder, whatever the kind of returns that you get from the company is not fixed, na, and that too it is in the hands of the company, which is completely discretionary. There is no mandatory stuff, right? So therefore, whatever the kind of returns that you get in the form of equity dividend or share price appreciation, it's totally uncertain. There is no fixed, there is no contractual obligation on behalf of the company to give you dividend, equity dividend every single year mandatorily. So because there is no contractual obligation, it satisfies the definition of equity instrument. Got it? Important. Chalo. Now, to just give you clarity, I gave you a few additional sentences. Now see here. Now suppose there is a company called PK Limited. It issues what? Redeemable preference shares. Okay. After 5 years with fixed dividend. Fine. These may be classified as financial liability and not equity because the company has got a contractual obligation to repay and pay dividends. So suppose there is a mandatory dividend payment that you have to do. If it is mandatory dividend payment, there is a contractual obligation for you to pay cash. It becomes financial liability. And if there is a redemption, mandatory redemption, you have a contractual obligation to pay cash. Again, it becomes financial liability. It will never be equity. However, if there is irredeemable preference shares, in life you will not redeem. Got it? And the discretionary dividend, which means what? If you want, you can pay dividend, otherwise you don't want to. So is there a contractual obligation on your part to pay compulsory dividend? No. In that case, it becomes what? Equity instrument. Why? In this whole instrument, there is no contractual obligation whatsoever. So even though it sounds like preference shares, so this is what we call substance over form concept. The entire index is based on that. Substance over form means form is nothing but name. Substance is nothing but the reality. Okay. What is the name? Preference shares. What is the reality? Equity. The name is preference shares, reality equity. Irredeemable preference shares, you don't have any contractual obligation to redeem. Fine. At least with respect to dividend, do you have any contractual obligation? No, that is also discretionary. So which means in this entire instrument, there is no contractual obligation whatsoever. Satisfies the definition of equity instrument, becomes equity instrument. Simple, that's all. So substance over form. Substance is equity instrument. Form, preference shares. Got the point? So it gets classified under equity only in the balance sheet as well. So that's what is something new for you to learn. debentures with life of 5 years which are converted into equity shares at the end of 5th year. Okay, it is getting converted into equity shares, so it sounds like equity if it satisfies the rule. What is that? Fixed number of equity shares, because that's what we have seen in the definition. So if it is fixed, it becomes equity. If it is variable, it becomes financial liability. We have seen this in both the definitions. However, what is the logic behind this? That we will see later. That's why I put a question mark over here. Students also will have a question mark, but you have to wait for that. Got it? Chalo. Now, all right, guys. Now, so far what we have seen the definition of financial instrument, we have seen the definition of financial asset, we have seen the definition of financial liability, we have also seen the definition of equity instrument, correct? We have seen some special cases. After that, we have also seen some examples. Okay, that's what we have seen so far. Right, now let's get back to the main concept of Ind AS 32. Still we are in Ind AS 32 only. Okay, contracts entered on non-financial assets to be executed in future. Now tell me one thing, the name itself tells you that it is non-financial asset, which means it is other than financial asset, right? So if it is a financial asset, then it is automatically covered under these sections, right? I mean, why am I talking about sections? These Ind AS, right? Ind AS 32, Ind AS 109. Okay. Now here, the name itself, we are saying specifically that it is a non-financial asset, correct? So obviously by default, the understanding is that it will not be covered. Now the next question, what do you mean by non-financial assets other than financial assets, which does not satisfy the definition of financial assets? What is the definition of financial asset? Easy to remember, cash and bank balance, then contractual right to receive cash, then what? Exactly, investment in equity instruments, contractual right to receive equity instruments, correct? And contractual right to receive any other financial asset. And then of course derivatives, where you do betting, where it is in your favor. So this is nothing but the definition of financial asset. As I told you, easy to remember. Just remember the way I taught you. Now the point is, tell me one thing. If it is a non-financial asset, it means it did not satisfy the definition of financial asset, correct? In that case, automatically it will not be covered under the so-called Ind AS 32, correct? But still, in some cases, it will be covered. Now, what is that? Okay, first let's try to understand what do you mean by non-financial asset. Gold, okay, non-financial asset, goods, non-financial asset. Because gold, if you see, it does not satisfy the definition. What is gold? Is it a cash? No. Is it bank balance? No. Is it contractual right to receive cash? No. Is it contractual right to receive any other financial asset? No. Is it contractual right to receive any equity instrument? No. Is it any derivative where it is something favorable to you? No. It does not satisfy any of the definition. Therefore, gold, we can call it as a non-financial asset because it does not fit into the definition of financial asset. You got the point? Fantastic. Now, so these are all the examples, Nana. Goods, any commodities for that matter, land, gold, PP assets and all those things. All these, they don't fit into the definition of financial asset. Okay, so therefore we call it as non-financial asset. Now, what is the topic that we are discussing right now? Contracts entered on non-financial asset to be executed in future. In short form, we'll call it as NFA. Non-financial asset means let's call it as NFA. Now, by default, what you have to understand is that these so-called contracts entered on non-financial assets to be executed in future is not covered under Ind AS 32. However, there are certain special cases, special scenarios where it will be covered under Ind AS 32. So by default, it is not covered, but in some cases it will be covered. In what cases it will be covered, that's what we are going to learn. So before we get to that, let's see a normal example. Suppose ABC Limited agreed to buy 100 tons of cocoa beans from XYZ Limited in 12 months. In 12 months means it is to be executed in future, naturally. What are you buying? Non-financial asset. What is non-financial asset? Cocoa beans, obviously, correct? So it is a contract of non-financial asset to be executed in future. So obviously it will not be covered under Ind AS by default. Right, at how much? At 1000 rupee per ton. Fine. Now tell me, is this a typical case of a non-financial asset to be executed in future? Yes. Is it covered under Ind AS 32? No. Now let's look at case 1. ABC Limited entered into a contract to buy cocoa beans, okay, same cocoa beans, to meet his own consumption requirement in business. And this contract will be closed by physical delivery of cocoa beans in 12 months. Now tell me one thing. So he has entered into a contract to buy those beans in future, such that beans become raw material for him. When we say own consumption requirement, it means he's going to use them as a raw material and convert them into some other finished goods. Now here you tell me, is there any speculative intent in this? No. You understand the point? Therefore, automatically it will be out of scope of Ind AS 109. So we call this as an executory contract, means no accounting done initially. After 12 months, I mean for a 12-month period, accounting will be done only on delivery, which means when you buy the cocoa beans, at that time you will pass the normal entries. It's like you're purchasing your raw materials. That usual entry you will do. Okay. This exemption from Ind AS 109 is called own use exemption. Anything that I've underlined in power notes like this, these are all keywords which you need to use in the examination while writing your answers. Very, 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 very important. You got the point? So what is the word that you'll use? Own use exemption. Own use exemption means what? If you are entering into a non-financial asset contract to be executed in future, like in this case, you're going to buy cocoa beans and you're going to use those cocoa beans for your own consumption in your own factory to convert that into some other finished goods eventually. In this kind of scenario, there is no speculation involved. Therefore, automatically it will be scoped out of Ind AS 109. It is not covered under financial instruments. Clear? This is typical non-normal case. Executory contract means when the contract gets executed, at that time you'll pass the entry. Got it? Right. Now, are we done with this? All right, guys. Now, yeah, executory contract means I just told you in a simplest way, Nana. Okay, I can understand your doubt. The point is, it's like neither party has fully, performed their obligation. Got it? Or both have performed equally. That kind of situation, we call it as an executory contract. Here, neither of them has, performed their, parts fully, right? Because they're going to perform after 12 months. One is going to pay money, the other is going to give the cocoa beans. So therefore, we call it as an executory contract. So because none of them has performed their duties at the beginning, therefore, you will not pass any entry. When they perform their duties, where one will pay money, the other one will buy the cocoa beans. Okay, the other one will deliver the cocoa beans, the other one will buy money. Will pay money for the same. At that time, they'll pass the entry. Okay. Right. Anyways, so this we call it as own use exemption. This is pretty important. Chalo, now let's move on to case 2. In case 2, ABC Limited entered into a contract to buy cocoa beans, same, to meet his own speculation needs. Here, in question itself, it's very clear that he's talking about speculation. Speculation means what? It is kind of a betting only. It's kind of a betting only. Okay. And this contract will be closed by net cash settlement. They are not even taking physical delivery. If you want to have own use exemption, you need to take physical delivery. Only then the raw materials you'll be using for your own manufacturing in your own factory, correct? You're not even taking physical delivery. You're just going with net cash settlement, and you're pretty clear that your intention is speculation. In that case, obviously, it will be covered under Ind AS 109. The exemption will not come. So it will be covered under Ind AS 109. Obviously, because it is speculative intent, it will be recorded using FVTPL kind of accounting. What is FVTPL? We'll see when we go to Ind AS 109. Still, we are in Ind AS 32 itself. Okay. Right. FVTPL means fair value through profit and loss, where you'll be remeasuring the value of your contract, and any change in the fair value will be transferred to P&L account. Okay. In depth, we'll try to understand what this is later. Right now, just focus on the concept right now here. Next, case 3, example 3. The contract has to be closed only by way of physical delivery. That's fine, which means it proves the authenticity, right, of own use exemption. But ABC Limited is not in cocoa beans business. Then how will he use it for his own consumption? And not only that, cocoa beans is highly marketable, which means just like that you can sell. Even though you're not using it for your own consumption, it is highly marketable means you can just sell it. Gold is highly marketable. You can just sell it. You understand the point? Unlike the other metals. So Ind AS 109 says, I caught you. So now you can't cheat me. Now I can understand that this is for your speculation purpose, for betting purpose you're doing this. So it is not for your own use exemption. Therefore, own use exemption is not available, and this will be covered under Ind AS 109, which means you have to do accounting as we say. Got it? Chalo, next example. ABC Limited. See, all these examples are real life questions, not real life questions from your ICA sources, which I've picked and I've gave it as an example. So therefore, every single example that we cover, it's like you're solving an illustration. Keep that in mind and look at this seriously. ABC Limited has the option of taking physical delivery of cocoa beans or doing net cash settlement. Both options are available. Now what? Okay, we need to check past history of settlements of ABC Limited in similar contacts and check current intention of ABC Limited. Because we are getting confused whether this guy is genuine or trying to speculate, because he has got both the options in the contract open, which is net cash settlement as well as physical delivery. In that case, we'll check the history, and if it is established from the history, once we see the history, we understand that based on past transaction, that the objective of this particular company is to get physical delivery to meet his own consumption. That's what is established by analyzing the past transactions. You got the point? In that case, we'll give him own use exemption, which means you're out of scope of Ind AS 109. You got the point? Even in some cases, there is small cash settlements made, but prima facie, his intention is pure, genuine, and he's gonna use this as a physical delivery means and use it for his own consumption. In that case, exemption will be given. You will be scoped out of Ind AS 109, which means you need not do any accounting whatsoever as per Ind AS 109, and you can treat this as an executory contract, where anyway you will not do any accounting unless you take the delivery and pay the money. Got it? Chalo. Suppose if the intention changes, that is from physical delivery to cash settlement in the middle of the contract period, then automatically the moment your intention changes, Ind AS 109 will apply, because it says I caught you, now you're doing fraud, I can catch you. So let's apply Ind AS 109. It's not kind of a fraud, it's like I just caught you, that's all. Okay, now example number 5, case 5. Now, contract is readily convertible into cash, that is actively traded on the market or exchange regardless of the intent to settle physically. So in this kind of a case, even if physical delivery is possible, market tradability means it can be settled net, and hence automatically it becomes financial instrument and covered under Ind AS 109. So there are certain goods or certain kind of items which are highly tradable in the market. They are like hot, they will sell like hotcakes. Okay, so in these kind of situations, even though you have a pure intention, you enter into a non-financial asset contract which has to be executed in future, where you want to buy it and you want to take physical delivery for your own consumption only. It ticks each and every box to get it exempted from Ind AS 109. However, just because it is highly marketable, automatically it gets covered under Ind AS 109. That's what you need to understand. Because Ind AS 109 says, I don't trust you, buddy, because maybe 10 times you'll purchase, only 5 times there is a requirement for you to have it for your own consumption. 5 times because it is highly marketable, you might be selling it for speculative profit. So I can't check each and every time whether you're really taking it into your factory and you're using it for your own consumption purpose. I don't have all those headaches. So by default, because it is highly marketable, automatically I'll say that it is covered under Ind AS 109. Apply FVTPL account, then ends the matter. That's all. You got the point? Moving on. Option contracts on non-financial item. ABC Limited buys call option. Call option means whenever you buy a call option, understand that you're bullish. You expect the prices to increase. Clear? Later we'll see these so-called concepts in detail. ABC Limited buys call option to buy copper at a fixed price in 2 months, right? Okay. ABC plans. So this copper is non-financial asset. Okay, you have taken a call option, so it's like a derivative on a non-financial asset at a fixed price in 2 months. ABC plans to settle in cash to gain from favorable price movements. Obviously, you're doing betting. It will be covered under Ind AS 109. Simple. So there is no own use exemption. There is no own use exemption. This is keyword. You have to use it in the exam while writing the answers. Next, case 7. Embedded derivatives in contracts for non-financial assets. Say for example, Bangladesh enters into contract with India's Adani to buy electricity in dollars. Their real life they're doing now. That's why I've taken this example. Okay, in dollars, right? And includes a clause where the price adjusts based on foreign exchange rate, that is dollar rupee. If dollar rupee fluctuates, then your electricity price that you have to pay per unit also will change. Like that, there is a clause. Although delivery is in Bangla, whatever the currency it's going to be. So the forex component is an embedded derivative which must be accounted as per Ind AS 109. What is embedded derivative? You don't know right now. Okay, so let's not discuss too much about it. When we go to the embedded derivatives concept, you'll understand. Right now, all you got to understand is that, okay, the particular price depends upon the dollar rupee exchange rate. If this increases or decreases, this will also increase or decrease. So therefore, there is a kind of a derivative element over here. So automatically it gets covered under Ind AS 109. That's all. Let's not discuss about embedded derivative right now. It's a complicated concept. You'll understand it. It takes separate time to discuss, at least 15 to 20 minutes. Got it? So we'll discuss that in future, in this chapter only. Next, case 8. Partial physical delivery plus net settlement for the balance. A contract to deliver 1,000 tons of coal, which is a non-financial asset, allows the buyer to take half physically and half in cash. So in this case, what we have to do? Should we exempt from 109 or it will be covered under 109? Very simple. So unless historically used only for full delivery, so which means historically in all the cases he has taken full delivery, physical delivery. Only in this case he's asking for 50% physical delivery, 50% net cash settlement. If that is the case, we will give exemption. If that is not the case, historical also so many times he has done the same 50-50 stuff, it gets covered under Ind AS 109. Okay. Got it? Yes, moving on to next one. Case 9. Designation of contract at inception as held for trading. Very easy. Inception means at the beginning of the contract itself, he's clearly saying that I'm holding it for trading. Trading means speculative purpose. Automatically it will be covered under what? Ind AS 109. So Ind AS 109 applies. Pretty simple. Next, contract settled by delivery but has derivative pricing. Again, so a steel company signs a contract to buy iron ore, non-financial asset, okay, where the price is linked to LME, London Metal Exchange. So if London Metal Exchange price increases, this will also increase. If this decreases, this will also decrease, which means you have a derivative element. So contract should be bifurcated into host contract and under normal accounting and embedded derivative as per Ind AS 109. Again, just like that, this forex component over here, in case of Bangladesh buying electricity from Adani example, here also you got to understand that even though you're actually buying iron ore, which is the main contract, which we call it as a host contract, it has a embedded derivative element in that, and that keeps on fluctuating. Therefore, it gets covered under Ind AS 109. Sir, what is embedded derivative? You need to wait, Nana. Got the point? So this is like a deadlock, Nana. I have to finish this concept. After that only I can go for all the accounting of Ind AS 109. But to finish this concept, I have to give you all the possibilities, all the case scenarios, all the examples, all the illustrations, right? That has been given by your ICA. But to do that, automatically you'll be getting embedded derivatives kind of examples as well, which we haven't discussed. At the same time, I cannot skip this. Therefore, to whatever extent I can explain, I have explained. So tomorrow in the session, I mean to say, in the further discussion, after 3 hours or 4 hours or 5 hours, whatever it is, how much time this financial instrument is going to take. After that, once you know what is embedded derivatives, then you can just come back and you can just revise it, Nana, because anyway in YouTube, how many times you can watch? You can watch. Are we done with this? Chalo, that's it. This summary table, the purpose, what I've prepared, I mean, the purpose behind this is so that this will be helpful for you the day before the exam to revise. That is the reason I've prepared this summary table. You see, all that we have discussed so far, I've just put it into simple table. So the moment you see non-financial assets, kind of a contract concept, okay, where you have a contract of non-financial asset which has to be settled in future, and you have a doubt whether it will be covered under Ind AS 109 or not, you see this table and it is done and dusted. That's all. Your revision is done. Chalo, moving on. All right, guys, let's continue. So now we're done with so-called NFA contracts, okay, which are to be settled in future. So this is done, non-financial assets, okay. You can just download the power notes and then go through the revision of this part, Nana, the entire summary that I've written, okay, because it's a revision session. I have to go with the new concept, otherwise it will take too much of time, okay. I hope you guys can understand that. Chalo, next concept is contracts to be settled by entity's own equity instruments. Entity's own equity instruments in the sense, either the entity, the company, will give its own equity instruments to somebody else, or from somebody else it will receive its own equity instruments. Ultimately, either you are giving or you are receiving, the total contract is getting settled by entity's own equity instruments. In some cases, entity may give and settle the contract. In some cases, entity may receive its own equity instruments and settle the contract. Either way, ultimately the contract is getting settled by entity's own equity instrument. That is the concept. So now, why are we studying this particular concept? Well, the answer is very simple. When a contract is getting settled in entity's own equity instruments, the key question is, should it be classified as equity or financial liability? Always understand, if you recollect the definition of financial instrument, which I've told you, it is a contract where for one entity it becomes a financial asset, for another entity it becomes a financial liability or equity. You got the point? So when it comes to financial asset, it's clear. Okay, for one entity only it can be a financial asset, but for another entity always there will be a fight between, should I classify this as a financial liability or should I classify this as a equity? That fight will be there throughout this particular chapter. You got the point? So that is why here also, when entity either settles the contract by paying, by delivering its own equity instruments, or by receiving its own equity instruments from somebody else, either way, when that is happening, should I classify it as a financial liability or should I classify it as a equity? Now, don't get this doubt and ask me silly doubt saying that, sir, obviously you are either delivering or getting equity instruments only now, sir. So obviously it should be classified as equity only now. No, because already we know the definition of financial liability and equity instrument as well. We have gone through that, and you know that if you are settling your whatever the kind of contractual obligation in equity instruments, but the number is variable in nature, it comes under financial liability. And if the number is fixed in nature, then only it comes under equity instrument definition. So therefore, we have already seen that it can be an equity instrument, but because of variable and fixed in number, it can be a financial liability, it can be an equity as well. So therefore, apply that logic over here. So even though we are settling with the equity instrument, it can become equity or it can become a financial liability depending upon the circumstances, whether the number is variable or fixed. So we are eventually gonna find that out. So this whole concept, I'll be dividing them into two broad segments. One, where entity has to deliver its own equity. Two, where entity receives its own equity from others. Okay, from others, it will buy its own equity like that, or it will get its own equity. Let's put it that way. Now, first we will cover this one, where entity has to deliver its own equity. Okay, in that first we'll cover compound financial instruments. Then we will cover fixed to fixed test. Then we will cover contingent settlement provisions. Then where entity receives its own equity, we'll cover treasury shares under that. and written put options on own equity, and then buyback. So we'll see these two separately. Okay. Now, all these examples we'll see later. Straight away, let's get to the concept. First, we will start with the most important one, that is fixed to fixed test. Let's start with that. You guys are ready? This is very, very, very important, Nana. All right, now coming on to fixed test, this is very important, Nana. Okay, it comes in a lot of problems. Okay, so therefore I want you guys to focus fully here. So what is the ultimate purpose of fixed to fixed test? Pretty simple. This test checks whether a derivative or a contract, whatever the situation you are in, which has been settled by giving entity's own equity instrument or by getting entity's own equity instrument, should be classified as equity or liability. That is the point. Mostly here we are talking about delivering entity's own equity instruments only from the entity's point of view. Okay, that's why it comes under here. Na? So obviously we are talking about delivery of the entity's own equity instrument by the entity to somebody else. Okay. Now, so when I'm giving equity instruments of mine to somebody else to settle a particular contract or a derivative for that matter, is it going to be classified as financial liability or equity? That's what we're going to discuss. Okay. So let's start with the definition of fixed to fixed test. A contract is classified as equity instruments only if it will be settled by delivering a fixed number of entities' own equity instruments in exchange for fixed amount of cash or another financial asset. Very, very, very important. I've highlighted the key points over here. So this is like two sides of the coin. So the trick is to understand that there are two sides of the coin. One side of the coin, it has to be fixed number of entities' own equity instruments. The other side of the coin, you have to receive a fixed amount of cash or some other financial asset. So both the sides, it has to be fixed. That's why it is called fixed to fixed test. If this test is satisfied, then we call it as an equity instrument. If this set is not satisfied, if this test is not satisfied, then we classify that as a liability, financial liability, obviously. Okay. Now, which means simply what you have to understand is I gave you my hack. So PK's hack is here. Is the deal simply I give you X number of shares and you give me Y rupees of money no matter what. This is very powerful. You'll understand when we start solving sums how powerful this particular hack is. I give you X number of shares. So when I give you, you should count the numbers. And from the other side, when he gives me something, the other party, then I have to count the amount of rupees. So from my side, it's not about the amount. It's about the number of shares that has to be fixed. From the other side, it's about the amount. Got the point? So from my side, fixed number of shares, X number of shares. Remember this. On the other side, Y amount of rupees. That also needs to be fixed. In that case, fixed to fixed test is satisfied. In that case, you will be classifying that as an equity instrument. Otherwise, you will be classifying the same as a financial liability. Clear? And that financial liability can be anything. It can be normal financial liability or derivative financial liability. You got it? Because under financial liability definition, you get derivative as well, right? So other than remaining, if there is a derivative, then it becomes derivative financial liability. Simple logic. Okay. Are we done with this? Now moving on. So what is the logic behind this test? First of all, we know that equity means ownership, correct? So it should not create any sort of obligation. That's what we have seen the definition as well. What is the definition of equity instrument? No contractual obligation whatsoever. Of course, you'll have a residual interest in the net assets of the company, but no contractual obligation. If there is a situation where you settle a particular contract with your own equity instruments, it has to be fixed number. That's the definition of equity instrument, right? But the most important point that you have to focus here is there should be no contractual obligation whatsoever. That's the point. So if the company might need to pay any cash or deliver more or less number of shares based on future events, which is nothing but variable number of shares. Got the point? In that case, it is not true ownership. It's like a financial debt or a derivative obligation. So which means ultimately it is not an equity instrument. It can be a normal financial liability or it can be a derivative financial liability. So the point is your number of shares that you are going to deliver should be fixed. If it is variable, which means it is varying based on something else. When it is varying based on something else, automatically it acts like a currency. Your shares itself will act like a currency. In that case, you cannot call it as an equity instrument. You have to classify that as a financial liability. That is the logic. Chalo. Ind AS 32 says, if both the number of shares, that is X number of shares, I give you X number of shares, and price are fixed, you give me Y rupees of money. This sentence keep on repeating in your mind so that while solving sums, you will not be confused. I give you X number of shares, you will give me Y rupees of money. Keep on repeating this. That's why I gave you this hack. It will be easy for you to solve sums. So Ind AS 32 says, if I give you X number of shares and you give me Y amount of money, then only call it as equity. Otherwise, you're going to call it as financial liability. It can be a normal financial liability or derivative financial liability. Financial liability means obviously it's like a cash deal, na? Because in financial liability, you have a contractual obligation to pay cash. right? So therefore it's kind of a cash deal. That's what I've written here. So this is the final summary, Nana. The consideration that you receive, that is what you receive from the other party, and what I give, X number of shares, Y amount of rupees, both should be fixed. Then only it will be classified as a equity instrument. If any of these changes, which means if the consideration is variable, which means you are not giving me Y amount of rupees, it's not fixed, it's variable, then it's not an equity instrument. If both are variable, anyway it is not an equity instrument. If one is variable, then also it is not an equity instrument. So if both the conditions are satisfied, X number of shares, Y amount of rupees, then only it is classified as equity instrument. If any one is variable, it will be classified as a financial liability. It can be normal financial liability, it can be derivative also. That depends upon the situation. Got it? Okay. Now, as you can see, we have lot of examples over here. Case 1, case 2, case 3, case 4, case 5, case 6, case 7. I think 7 cases we have got. Yeah. Then we'll go to compound financial instrument. Each case is a problem. You got it? Each case is a problem. So this is what we are doing. Indirectly, we are covering sums as well. So I want you guys to focus, right? Company A issues a contract where investor prepays 1 lakh today. Okay. Investor prepays 1 lakh today. Investor is paying to whom? To company. So I received Y amount of rupees. Raised money through debentures for 1 lakh. Okay. After 6 months, company will issue exactly 1000 shares. I issue X number of shares. X number is 1000. I got Y amount of rupees, 1 lakh. So both fixed to fixed test is satisfied? Yes. So which means, is it an equity instrument? Yes. Got the point? Because there is no variability, there is no future cash flows, just a delayed share issue. That's all. There is no contractual obligation whatsoever. Therefore, it will be classified as equity. Got it, Nana? Now let's take an example. Now suppose after 6 months, market price of the company A share is like this. It can be anything. Now the market price will change. But ultimately, I will issue only 1000 shares. My number which I'm going to issue is fixed. So therefore, if you look at the value of the market, value of those 1000 shares for the guy who has got the shares from me, it keeps on changing. So which means his return is not protected. His return can be anything. And that's what should happen in case of an equity. To classify something as an equity, see, if you're an equity shareholder of a company, your return is protected. Your return can be anything. It keeps on fluctuating depending upon the market price, depending upon the situation, correct? So your return should not be protected. Then only you'll be classified as an equity. Suppose you take debenture holder, for example, you're getting interest, your return is protected. Irrespective of any situation, you'll be getting the same amount of interest. I'm giving you the conceptual logic. Try to get this. Are you able to understand? Chalo. So see here. So the holder of the shares takes risk just like equity shareholder of company A by getting himself exposed to 1000 shares variable returns. His return can be 1,20,000. I'm not talking about percentage terms, value of the shares. 1,20,000, or it can be 1,10,000, it can be 1 lakh, it can be 90,000. Depending upon what the market price on that particular day is going to be. But this risk is not being taken by the company. So company has got no risk. I'm going to issue 1000 shares. That's all. Who is actually bearing the risk? The other party. So company should not have any risk. I'm going to give you 1000 shares. That's all. How much that 1000 shares will value to you, that depends upon you. So that risk is borne by you. You got the point? That's what will be classified as an equity, right? So in issuer's books, that is in company's books, it will be classified as equity because company is not facing any risk whatsoever. I just gonna issue fixed number of shares. You're gonna give me fixed amount of money. There ends the matter. Got the point? So case 1 is an example where it satisfies the fixed to fixed test. Case 2. Investor agrees to pay 1 lakh in 6 months or raised 1 lakh worth debentures. Okay. On settlement, company will issue shares equal to the then current market value of 1 lakh. What do you mean by that? Company says, I have to give you 1 lakh, right? So on that day where I'll be liable to give you 1 lakh, I'll see what the market price of my share is going to be. Market price per share. And then I'll divide it with 1 lakh. How many shares will come? That many shares I'll issue. Now tell me, in this case, am I issuing X number of shares? No. The number of shares is not fixed. It can be anything. It can increase, it can decrease depending upon the market price on that day. So this seems like a situation where I'm paying you currency. I'm paying your liability in the form of currency. Only case where the currency is not normal currency, it is number of shares. You understand the point? In that case, it will be a financial liability. It can't be called as an equity. You get it? Now tell me, in this case, did I issue X number of shares? No, obviously. You understand the point? So the risk is with the company only, na? So I don't know how many shares I have to issue. It can be more, it can be less. So I am bearing the risk. You understand the point? So therefore, the fixed to fixed test is not satisfied. I don't know how many shares I'm going to give. So if X number of shares condition is not satisfied, of course, on that side, why amount of rupees is satisfied? Because I'm getting only 1 lakh. Amount is fixed, but from my side, because both the things has to be fixed. That's why it is called fixed to fixed test. Even if one is not satisfied, if one is variable, then it will not work. It will not be satisfying fixed to fixed test, which means it will not be classified as an equity instrument. Obviously, it will be classified as a financial liability in this case. So fixed cash, yes. Variable shares, yes, it depends upon the future price, not fixed number of shares. So is fixed to fixed test is passed? Nope. Company must adjust number of shares to match the value. This is no longer equity. So I say it's like paying debt using shares as currency. This I've already explained you. The company has to satisfy a financial obligation, therefore it will be classified as a financial liability, where that financial obligation which you have taken 1 lakh, you have to repay that 1 lakh. How are you repaying that 1 lakh? By giving currency, not the actual currency, but by giving shares as a currency, because you don't know how many shares you are going to issue. You understand the point? You get it? That's why it will be classified as a financial liability. Now moving on to case 3. Now come to case 3, Nana. Now moving on to case 3. Okay. Nana, this is not like other revision sessions, Nana. This will not be within 3 hours or 3.5 hours, because as you can see, in fixed to fixed test only, I'm covering all the cases, which means indirectly I'm covering those many problems. So you keep this in mind while listening to the class. So don't expect this to be a very short revision session. This is not like that. Now, okay, company PK Limited raised 10 lakhs through debentures, which will be converted into 1000 equity shares after 3 years. Okay, 1000 equity shares, X number, it is fixed. I've also raised 10 lakhs, which means I've got 10 lakhs. That is also fixed. Y amount of rupees. However, okay, what is the condition? It contains anti-dilution clause. There comes the twist. What do you mean by anti-dilution clause? If the company issues bonus shares or share split in future, in between this gap, within this 3 years, between the issue of debentures where the company has got 10 lakh rupees from the investors, and after 3 years, it's going to give 1000 shares. Between this time gap, if the company goes for bonus shares or share split, the shares promised to debenture holders shall be increased proportionately. You understand the point? Because the value of shares will drop, logically speaking. Therefore, okay, now the biggest question is, in this kind of a scenario, is fixed to fixed test is passed. Now, common sense will tell you that, sir, what is there, sir? Obviously, it has failed. Why? Because the shares has to be increased proportionately. It is clearly there in the question only, na? Obviously, it's going to be variable, so it will increase in case if the bonus or share split is going to happen. So as a result, what can happen is what we need to consider when it comes to this whole chapter. You only have told me. As a result, it has failed a fixed to fixed test. That's what your conclusion is going to be. That's what pretty much majority of the people, they do it. But there is a lot of depth to this, so I want you guys to listen carefully. There are 2 types of anti-dilution clause. Sir, in anti-dilution clause, there are 2 types. Yes. What is that? You will try to understand. See here. Here, increase in number of shares will happen if the company goes for bonus shares or share split in between that 3 years point of time, right? But what is the purpose of this increase in number of shares? That you need to focus. The purpose is what? Is it to protect the return of the shareholder or the rights of the shareholder? That is the difference. If the purpose of increasing the number of shares is to protect the return of the shareholder, in that case, the fixed to fixed test is failed. But if the purpose of increase in number of shares is to protect the rights of the shareholder so that his ownership share remains the same, in that case, still, even though you're issuing more number of shares, still fixed to fixed test is passed. Increase in number of shares is to protect the rights of the instrument holder, in this case, if you're going for bonus or share split, but not to protect their return. Okay, therefore, it preserves the original ownership percentage. Because if you don't increase the shares proportionately, right now, once you have promised these 1000 shares to that particular investor, then he feels that, okay, these many total shares are there. Say, for example, total shares is 1 lakh. You're issuing 1000 shares, which means my ownership, percentage will be what? 1%. So he'll be of that opinion. Now, in between, if you go for bonus shares or share split, then the number of shares will increase. Then his percentage of ownership will reduce from that 1% to something else, right? He doesn't want that to happen. So his voting rights, that influence, everything will get reduced. So therefore, to protect that, if you increase his number of shares such that his 1%, that ownership share remains the same, in that case, even though you are issuing more number of equity shares, still it will be presumed that fixed to fixed test is passed. However, there is a twist. Right? So we are talking about shares split as well as bonus shares. In this kind of situation, fixed to fixed test is passed because you are protecting the ownership rights. You are protecting the original ownership percentage. but you're not protecting the return. Because the share price can be anything, na? At the end of the day, you understand what I'm trying to say? However, if you issue new shares in between this time, in this 3 years time, at lower price in future, I promise that I'll give you 1000 shares, Ray. Are you able to understand? And after I've promised, I have 3 years na before I can issue 1000 shares. In that 3 years time gap, I start issuing new shares at a lesser price. Then in that case, on an average, what will happen to your overall 1000 shares value? It will also fall down, na? Because company themselves have issued new shares at a lower price. So in this kind of a situation, what the company promises is that I will also increase your number of shares such that ultimately whatever the return that you're expecting, that will be protected. In that case, if I'm issuing share, more number of shares where you will be getting more number of shares with an intention that your return as a shareholder is going to get protected. Return as a shareholder is going to get protected. In that case, fixed to fixed test is not satisfied. In that case, it will be classified as a financial liability. So this concept is also called future down round pricing. So what you guys need to understand from case 3 is that in a question, you'll come across anti-dilution clause. Now, whenever there is an anti-dilution clause, obviously your number of shares will be increased. Now, you need to ask yourself, what is the purpose of increasing the number of shares? In case of bonus shares or share split or something like this, the number of shares is increased is not to protect the return of the investor, but to protect his ownership rights, ownership percentage. In that case, fixed to fixed test is passed. It will be classified as an equity instrument. But in certain cases where you try to issue new shares at a lower price, in that case, whoever you have promised to give 1000 shares, he'll get hurt because you have issued new shares at a lower price. So his value of the shares that he's going to receive is gonna get come down. So therefore, to compensate that, you try to issue more number of shares such that his return is getting protected. In that case, it will be classified as financial liability. Fixed to fixed test is not passed. This concept is called as future down round pricing. It has got a specific name. Keep that in mind. There are two types of anti-dilution clause. One satisfies the fixed to fixed test. Other does not satisfy the fixed to fixed test. The test is you see whether the return of the shareholder is getting protected or the ownership rights percentage of the shareholder is getting protected. Got the point? Chalo. Come to case 4. PK Limited writes a call option towards AK Limited on its own shares, 1000 number of shares in 3 months. Okay. Now, first of all, call option means it's a derivative. Options means in that there will be two people, one who buys the option, the other who sells the option. You should have this basic understanding, Nana. I can't go through the basics. This is a revision session. Okay. I can't teach you all what is option, what is forward, what is future and all that. Okay. You should have a basic idea. So call option means basically it's a right to buy. Whoever buys the call option, he will have a right to buy a particular share, say for example. Okay. Now, here you did not buy a call option. You have written a call option. So in any option, there will be two parties. Okay. One will be buyer of the option. The other one will be seller of the option. Buyer of the option can also be called as holder. Seller of the option can also be called as writer. Okay. So here, this company has written a call option. It means the company has actually sold the call option. Now, whoever buys the call option is said to be in a bullish view because he expects the price to increase. Whoever sells the call option will have an exactly opposite view, which means bearish view. That's the first point. Second, whoever buys the call option will have a right to buy something. Okay. Whoever sells the call option will have an obligation to sell. You got the point? One person will have the right, the other person will have the obligation. Now tell me one thing, PK Limited has sold the call option, correct? Which means PK Limited has got obligation to sell. To sell what? It has sold the call option towards AK Limited on its own equity shares of 1000 numbers in 3 months. So PK Limited has basically written a call option, which means it has sold a call option to some other company saying that I'll have an obligation to sell my own equity shares of how many numbers? 1000 numbers in 3 months. Okay. Now the problem is when you have sold the option, which means PK Limited has sold the call option, which means AK Limited has bought the call option. So AK Limited will have right to buy, PK Limited will have obligation to sell. Now in AK Limited has got right to buy, he can exercise that right to buy or he may not exercise that right to buy. Okay. So that's why I've written case 1 and case 2. Now case 1, suppose if exercise price is fixed, which means PK Limited tells AK Limited that you have a right to purchase my share in 3 months at a price of 40. Got the point? PK Limited tells AK Limited that after 3 months, you will have a right to buy my share, each share, at a fixed exercise price of 40 rupees, irrespective of whatever the price in the market is going to be. Got the point? Now, what AK Limited will do, because he has purchased the call option, he will have a right to buy. So after 3 months, he will look into the market. In market, if the share price is 50, he will feel that, okay, fine. Anyway, I have right to buy this at 40. I'll buy this share at 40 from PK Limited, and then I'll sell it to the market at 50 rupees and I'll make a profit. You understand the point? Now, so in this case, what happens is that this derivative will be classified as an equity. Why? Because your exercise price is fixed. Your exercise price is fixed. You got it? So when your exercise price is fixed at the end of the day, it's fine. Now this is a little bit difficult to understand, so focus carefully. Many students get confused over here. If the exercise price is not fixed, if the understanding is that if market price is so much, your exercise price will be so much. If market price is so much, your exercise price will be so much. If this kind of a setup is there, then indirectly what the company is doing is that if market price increases, proportionately exercise price also will increase, so that this gap is what you will get as a return. For whom? AK Limited, because AK Limited has got a right to buy, correct? If market price of my share reduces, then exercise price also I'll reduce, such that this gap will be sustained and your return also will be sustained. So here again, you try to recollect what I've already told you. Is PK Limited here is trying to protect the return of the AK Limited, because AK Limited is going to buy your shares, right? Which means AK Limited is going to be your shareholder. Now tell me, are you trying to protect the return of the equity shareholder in this case too? Yes, because if market price increases, I'm also increasing the exercise price, thereby this gap remains constant. If market price reduces, I'm also reducing the exercise price, which means the gap remains constant. So you are trying to protect the return of the equity shareholder, therefore fixed to fixed test is failed, and as a result you should classify this as a financial liability. This is a derivative because it's an option, call option, so it's a derivative. It will be called as a derivative financial liability, because understand one thing, derivative can be a financial asset, derivative can be a financial liability, derivative can be an equity instrument as well. Derivative as such, it does not have any independence. The name itself is derivative, Nana. It derives its value from something else. You got the point? Right. Now, but in this case, what is happening? You have fixed the exercise price as 40. So tomorrow, irrespective of the market price, anything it's going to be. Suppose your market price can fall below 40 also. In that case, AK Limited will not get any return. First of all, he will not exercise the option also. Suppose if your market price can be 50 also, in that case AK Limited will exercise the option of right to buy. He will buy at 40, he will sell at 50. In that case, he'll get profit. Now tell me one thing, is his return is getting exposed in this case? Yes, it is getting exposed. Just like an equity shareholder, he might get profit, he might not get profit. That's what the characteristic of equity is going to be. You are exposed to variable returns. If you are exposed to variable returns, it should be classified as an equity. In this case, AK Limited is not exposed to variable returns. His return is getting protected because of the variability of the exercise price along with the market price. Therefore, here it will be classified as financial liability. Here it will be classified as an equity. Clear? Chalo. Moving on to case 5. Now look at the next example, case 5. ABC Limited, okay, what is actually happening is that XYZ Limited, for XYZ Limited, ABC Limited said that it will issue 1500 own equity shares, which means X number of equity shares fixed. XYZ Limited, what it will do, it has to give consideration for the same, right? So when it issues own equity shares, for what it is issuing, ABC Limited will buy 1000 shares of XYZ Limited. Now tell me, after 3 months, this is what is going to happen. So this will be the consideration. This is a very tricky case, Nana. Many people get confused over here, so observe carefully. So basically, they're exchanging shares here. ABC will sell its own shares, 1500, to XYZ. In return, ABC will buy 1000 shares from XYZ. You got the point? In other words, XYZ is selling shares. So ABC is getting 1000 shares of XYZ and ABC is giving 1500 shares of ABC. So now you tell me, sir, fixed to fixed test is satisfied, sir? Yes. Many students are saying the same thing. Yes, because I am giving fixed number of equity shares, I'm also receiving fixed number of equity shares of some other company. F to F test is passed. So classify this as an equity. No, this is where PK sir's hack comes into picture. What was my hack? What did I tell you? I give you X number of shares. You give me Y rupees of money. Did I say you give me Y number of shares? Did I tell you that? I said I give you X number of shares, you give me Y rupees. Right, now tell me, apply it over here. I give you X number of shares, fixed. I give you 1500 of my own shares. That is satisfied. One side of the coin. Other side of the coin. You give me Y amount of rupees. You are not giving me Y amount of rupees. Here you are giving me 1000 shares of your company. And that 1000 shares consideration, I don't know, it can be anything. You have to multiply that with the market price on that particular day. So it can be anything. So am I receiving Y amount of rupees? No. Am I giving X number of shares? Yes. So fixed to fixed test. X number of shares satisfied. Y amount of rupees not satisfied. I'm getting Y number of shares. That is not the rule. Y amount of rupees I should get. That is the rule. You got the point. Therefore, fixed to fixed test is not satisfied because value of consideration is not fixed. I get 1000 shares from XYZ. That 1000 shares value I don't know. So consideration value is not fixed. Therefore, fixed to fixed test is failed. Therefore, it will be classified as a financial liability. These are all the tricky questions. Okay. Case 6. ABC Limited raises 10 lakhs through 10,000 debentures at 100 each that are convertible into equity shares. Okay. How are they converted into equity shares, Nana? 1:2 at the end of year 2. Okay. 1:3 at the end of year 3. Okay. 1:4 at the end of year 4. Okay. So is it satisfying fixed to fixed test? First of all, consideration is fixed. I'm getting Y amount of rupees. How much? 10 lakhs. Okay. Am I giving X number of shares? No, 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 sir. At the end of year 2, you're giving 1:2. Which means for 10,000 debentures, you'll be giving 20,000 shares. At the end of year 3, you're giving 30,000. At the end of year 4, you're giving 40,000. No, 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 it's not like that. It is variable with respect to time. Any one only is possible. So either you convert at the end of year 2, or you convert at the end of year 3, or you convert at the end of year 4. You understand the point? Any one will happen. Either this will happen, or this will happen, or this will happen. So you see them as independent situations. In that case, your number of shares is fixed. This is an independent situation, 20,000 shares fixed. This is an independent situation, 30,000 shares fixed. This is an independent situation, 40,000 shares fixed. They are variable with respect to time. You understand the point? But if you look at independent situations, they are fixed. Are you able to understand? So they are not going to protect the return of the equity shareholder. Therefore, is fixed to fixed test is satisfied? Yes. Yes. In that case, it will be classified as equity instrument. Got the point? Debenture holders may exercise conversion at the end of second year or third year or fourth year, Nana. But whenever they exercise it, ultimately the number of shares is fixed. Therefore, fixed to fixed test is satisfied. Suppose they exercise at the end of year 2. Okay, they'll be getting 20,000 shares. At that time, market price can be anything. So are their return is getting protected? No. Suppose if they exercise at the end of year 3, already it is fixed that they'll be getting 30,000. And that 30,000 shares market value can be anything. Is their return is getting protected? No. In that case, it should be classified as an equity instrument. Simple. Moving on. Case 7. Now here you see conversion ratio depending on conditions. So PK Limited issued call option. It writes call option. Writes call option means I sell call option. I sell call option means I've got obligation to sell something. You got the point. The other guy will be buying call option. He'll have right to buy. I'll have obligation to sell. So PK Limited issued rights call option. So I sell call option. I've got obligation to sell. Sell what? My own equity shares. At what price? At 50. Okay. But the condition is I'll be going for 100 shares if profit in year 1 is greater than 10 crore. Okay. It will be 200 shares if profit in year 2 is greater than 30 crore. Okay. It will be 300 shares if profit in year 3 is greater than 40 crore. Okay. Right. Now tell me, these are all different conditions. Okay. They are dependent on each other or independent of each other. Now, getting profit greater than 10 crore in year 1, is it dependent on year 2? No. Let me put it this way. Is getting profit greater than 30 crore in year 2, is it dependent on year 1? No. Is getting profit of greater than 40 crore, is it dependent on year 2? No. So each of these are independent of each other. So when they are independent of each other, you see them as 3 separate contracts, just like here. When you see them as 3 separate contracts, in each contract, the number of shares is fixed. So when number of shares is fixed, because you are looking this as an independent situation, then fixed to fixed test is satisfied. If fixed to fixed test is satisfied, then this will be classified as equity. Sir, what is this, sir? I'm having doubts, sir. Wait. Keep that doubt like that. Automatically, it will get clarified. Now look at B point. PK Limited issued rights call option where it has got obligation to sell its own shares at a fixed exercise price of 50. Okay. 100 shares if profit in year 1 is greater than 10 crore. 200 shares if profit in year 1 only greater than 30 crore. 300 shares if profit in year 1 is greater than 40 crore. Now tell me one thing. If you touch 40 crore, that is possible only when you cross 30 crore. 30 crore crossing is possible only when you cross 10 crore. So which means crossing 30 crore is dependent on whether you have already crossed 10 crore or not. Crossing 40 crore is dependent on whether you have already crossed 30 crore or not, because all these are happening in year one itself. So therefore, crossing 30 crore is dependent on 10, crossing 40 crore is dependent on 30, which means all these conditions are dependent on each other, which means you should see them as one single independent contract where the number of shares is not fixed. Therefore, fixed to fixed condition is not satisfied. Therefore, you classify this as a financial liability. So finally, the main hack is, they have written note also, all above examples or questions from ICA sources. Okay. For consideration, value should be fixed. That is, I should be getting Y amount of rupees. For shares, number should be fixed. I should be giving X number of shares. So this is the ultimate hack. If you apply this hack, I give X number of shares, you give me Y amount of rupees, you will be easily cracking all the fixed to fixed test cases. Some unique cases are there that I've already explained you over here. So it is not a problem. Correct? Chalo. Are we done with this? So we are done with a very important concept, fixed to fixed test. Chalo Nana. Right. So let's continue with the session, guys. The revision session which we have started. So I think till here we have done fixed to fixed test is finished. Okay, let's start with compound financial instruments. Now you people tell me, already we have discussed about compound financial instrument. We had a small idea, right? So it is a kind of a hybrid instrument where a single instrument has got two things. One is a financial liability, the other one is a equity. So you'll have a financial liability portion as well as what? Equity portion. Chalo. That's why it is called a hybrid instrument. Hereafter we'll be getting one more hybrid instrument, which is embedded derivatives, that we'll see later. Okay. Now, is it something new for us? No, in Ind AS 102 already we have seen ESOPs with a cash alternative. Okay, ESOPs with a cash alternative. This is the entry that we'll be passing now. Employee compensation debit to SBP reserve as well as SBP liability. You understand the point? Do you guys remember? So here also it's a kind of hybrid instrument only, na? Because ESOPs with a cash alternative, you'll be having two things over here. Liability portion as well as the equity portion. For equity portion only, we'll be creating SBP reserve. For liability portion, we'll be creating SBP liability, right? So that's why I've written this, because in this power notes, you guys know that in our syllabus, we have finished Ind AS 102. After that only we have come to financial instruments. Therefore, I just wanted you guys to remember, and I know that you guys mostly won't remember, whoever is listening to the classes. Anyway, this is a revision session, so things are different. Chalo. Anyway, let's continue. So let's go with examples and let's try to understand what is the challenge with respect to compound financial instruments. Okay. One thing is that you guys know that it is not like any other financial instrument, because it has got two parts. It's a kind of hybrid instrument where you have a liability part as well as what? Equity part. Now, let's start with first example. As usual, you guys know that these examples, they represent questions from your ICA sources. Okay, so don't take it in a lighter sense. Now, ABC Limited issued redeemable preference shares. Okay, fine. With a discretionary dividend. So redeemable preference shares means you have an obligation, contractual obligation to pay back, right? The principal. So whenever you have a contractual obligation to pay, obviously it becomes what? A liability. So this is liability part. With the discretionary dividend means there is no obligation on your part to pay dividend, right? So whenever there is no contractual obligation, it satisfies the definition of equity instrument. So therefore this becomes equity part. So you have equity part as well as you have liability part in a single instrument. That's why we call it as what? Hybrid instrument. The official name is compound financial instrument. Got it? Chalo. Another important thing that you guys need to understand is that whenever in the question, if he says that the preference shares or cumulative or non-cumulative preference shares, mostly we should consider dividend as discretionary. You got the point? Preference shares with mandatory dividend clause, then the dividend is mandatory. So if it is mandatory, he'll specifically mention that it is mandatory. So only then we'll consider dividend as mandatory, because whether it is mandatory or discretionary is very important for us to decide whether it's a liability or equity. Got the point? So if it is discretionary, it becomes equity. If it is mandatory, it becomes a liability. Got the point? So therefore, first we need to understand when dividend will be mandatory, when it will be discretionary, right? For that, we have to closely observe the question. In the question, if it is cumulative or non-cumulative, in that case, we'll consider the dividend as discretionary, because cumulative means, see, sometimes it's a debatable topic actually, to be very honest, because some people, they say that even if it is cumulative dividend, it means at the end of the day, ultimately you can't escape paying dividend, right? You can escape the timing of paying dividend, but you can't escape paying dividend as such, per se, right? For example, this year, 2025, okay, you have to pay dividend. You don't have money, so you don't pay dividend, right? But when it is cumulative, what will happen next year? Whatever the dividend that you have to pay, preference dividend, this dividend also will come and it will add. That's what you call cumulative, right? So at the end of the day, next year you have to pay. Next year also, if you don't have sufficient profit, you don't want to pay, then it goes to third year. And in third year, first year plus second year plus third year gets cumulated, and then eventually you have to pay that. So in a way, one side people say that because you don't have an obligation to pay, right? Because you can skip dividend payment, therefore there is no obligation, therefore I'll call it as a discretionary dividend. In a way, some people they say that no, even though you are escaping the timing of paying dividend, but at the end of the day you can't escape the money. One day or other, whether it is second year or third year or fourth year, one day or other you have to eventually make the payment, and therefore I'll rather consider this as a obligation. So it's a kind of debatable topic, that's okay, but as of now we'll consider this as a discretionary, right? Non-cumulative preferences, there's nothing much to debate over here. It's not cumulative, so you have money, you pay dividend. You don't have money, it will not count, you'll go to next year, and only that year's dividend only you have to pay. In that case, it is purely discretionary, so it will be classified as equity. Mandatory means it's mandatory, obviously there will be an obligation, there is nothing much to debate. So non-cumulative preference shares, always discretionary. Mandatory dividend, always mandatory, so it becomes a liability. Only cumulative dividend, I mean cumulative preferences, there's a kind of debate, that's okay. This is the thing. Now all right, let's move on to case 2. Now one thing you guys need to understand is that now this cumulative, I'm telling you, it depends upon the question the ICA has framed. Now I've also gone through some resources. There is an ICA expert advisory committee suggestion where they say that this cumulative preference shares, where there is cumulative preferences and the dividend is discretionary, they actually classify this, okay, as financial liability. But I also have seen certain questions from your ICA sources only, where in the question it was specifically mentioned that the preference shares is cumulative, but yet the dividend was taken as discretionary. So therefore, this is a kind of thing where it depends upon the question that we solve, okay? But if you ask me my personal opinion, when it comes to cumulative preference shares, the dividend is not discretionary. It's a kind of you are just postponing the payment. At the end of the day, you have to make the payment. At the end of the day, when you have to make the payment and you can't escape, so it's a kind of an obligation which satisfies the definition of financial liability. So if you ask me, I would rather personally classify this as a first financial liability. That's the point. Anyways, let's move on. Case 2. Irredeemable debentures issued. Perpetual bonds. Irredeemable means you never pay back the principal, okay, with mandatory interest, obviously. Mandatory interest, contractual obligation to pay, satisfies the definition of financial liability, so it's a financial liability. Irredeemable debentures means you never ever pay back the principal, which means you don't have a contractual obligation to pay, which means that principal amount satisfies the definition of equity. So therefore, you have equity with respect to principal amount, you have financial liability with respect to interest. Therefore, it becomes a compound financial instrument. It has got two. So we call it as a hybrid instrument, correct? Chalo. Case 3. Compulsory convertible preference shares at the ratio of 1:3 with mandatory dividend. The moment you see the word mandatory dividend, you know that it's an obligation, therefore it is financial liability. Okay. Compulsory convertible preference shares. All right. Compulsory convertible preference shares means it will be converted into what? Equity shares only. Okay. At the ratio of 1:3. Is the number of shares fixed here? Yes, it is fixed. Fixed to fixed test is passed? Yes, it is passed. Then it will be classified as equity. Now, however, there is one thing. Suppose if this number of shares is not fixed, sir, then what is the situation? If the equity number of shares that you're going to give is going to be variable, then naturally this part becomes liability, na, sir. If this part becomes liability, this is already liability, then in that case, the entire instrument will become financial liability, na, sir. No. Still, it can be compound financial instrument. How, sir? How, sir? How, sir? That's what we're going to see in case 4. It's very interesting. Many people don't get the logic. I'll explain you with the logic. Don't worry. You need not by heart anything. So as of now, what you need to understand is that, okay, fine. If there is a convertible option and if the number of equity shares is fixed, automatically it becomes equity. Already, you have to pay mandatory dividend, which is a financial liability. So you have financial liability and equity in a single instrument. So it is hybrid and it is compound financial instrument. That's it. Now coming on to case 4. Now this is the interesting case. So I want you guys to listen carefully. Ready? Yeah? Now coming on to this unique case 4, okay, if you can see here, it's a convertible debenture obviously with mandatory interest, okay, but the question is convertible option is given to whom? To whom? You have two options over here. One is conversion at the option of the holder or investor, which means to the other party, presuming that I'm the company. Okay. Other one is conversion at the option of the issuer, that is myself. Okay. If I'm the company. Now, let's look at this case because it's quite interesting. This is normal. If conversion is at the option of the holder or investor, which means I gave the ball is in the other guy's court, not in the court of my company, right? Not in the court of the company. In that case, what happens is that, first of all, it's a mandatory interest. So one thing is quite clear, you have to pay interest for sure. So it's a contractual obligation for you to pay interest. So it's a financial liability, everybody knows that. But coming on to the principal part, so you do accounting today, right? At the inception, at the beginning. Let's say this debenture is going to be for 5 years. So after 5 years or at the end of 5 years, as of today, I cannot estimate or I cannot guess what the holder is going to do. Is he going to ask for the conversion option or is he going to ask for the redemption option? So if it is redemption, then I have to pay money. If it is conversion, I have to give him equity shares. That at the inception, I don't know. So how would I do accounting? That's the biggest question. Okay, but one thing is quite clear, that issuer, that is myself, the company, can I avoid paying cash on my own? No, I can't, because now the ball is in his court, right? So can I avoid? No, I can't. In that case, I told you at the beginning itself. So it's not about what usually happens, it's about what can happen. That's what the standard is all about. So we cannot come with a probability saying that, okay, there is a 90% probability that the issuer, that the holder will go for conversion option, or there is 90% probability that the holder will go for redemption option. Like that, we cannot go for most likely scenario and then do the accounting part. It doesn't work that way. The question is, what can happen? So what can happen means, is there a chance that holder can ask you to pay? Then company has to pay. So is there a probability that company or the issuer can 100% avoid paying cash? No. Even if there is 1% probability also, if the holder asks for redemption, then I have to pay cash, that's all. In that case, can I avoid paying cash? No, I can't. In that case, it becomes a financial liability. So now don't come to a conclusion that, okay, this is financial liability, this is financial liability, therefore at the end of the day, the entire instrument is financial liability. No, still it is a compound financial instrument. Still it is a compound financial instrument. Now that's what I told you, it's a unique case, right? So that is the reason I've kept this over here. How? Please try to explain us. Okay, we'll see that. Now see here. So the logic behind that is, you got to understand, you have to go for the substance, not the form. Let's say investor wants 18% for any company. Okay, company PK Limited issued debentures, these debentures on the same day, so that you can see the difference between one and the other. Let's say investor wants 18% because he feels that PK Limited as a company, the risk is in such a way that I need at least 18%. Okay, fine. I issue redeemable debentures for 18%, let's say for a period of 10 years. In that case, investor is happy because he wants 18%. I'm also giving him debentures at 18% interest. He's happy. He's getting interest of 18%. Fine. But I give him another option on the same day. I say to the investor that you want 18%, right, for a debenture, but then let me give you another option. I'll give you redeemable debentures at 15%, where there will be a compulsorily convertible option to 10,000 equity shares at the end of year 10, because this debentures I'm going to issue for 10 years. After 10 years, I'm going to give you compulsorily convertible option of equity shares. In that case, investor says, okay, fine. In that case, I'll accept a lower interest rate as well, because I'm going to get equity shares now. And in equity shares, what will happen in this 10-year time period? Definitely, when compared to the market price of the equity shares of the company right now, it's going to increase like anything. Obviously, because you're going to invest in a sound financial company only, right? So as a result, he will be accepting a lesser rate of interest because of this compulsory convertible option. You got the point? Right. I'll give third option as well, where the convertibility into so-called equity shares will be given to the investor himself. You understand the point? That's even more advantage, right? So he can wait for 10 years. After 10 years, he can see whether redemption is better for him, he's giving more returns, or whether conversion into equity shares is giving him more returns. Accordingly, he'll choose whichever option he wants. In that case, it's like greater advantage for him. So he will settle for even less interest. Like for example, 13% in this case. So what you guys need to understand is that here, when you give conversion option into the hands of the investor, whatever the interest that you are paying, it is already corrupted. You are paying lesser interest when compared to a pure debenture without any conversion option. In that case, the difference in interest is there, na? That is nothing but an invisible equity component. That invisible equity component along with visible liability component makes it a compound financial instrument. This is what you need to understand. Okay. Now see here. There is a practical example also. We'll see that illustration 3. Okay. Now see here. Because of equity share option, that is convertible option, interest got reduced all the way from 18% to 15%. And because of option in the hands of the holder, you are giving him more choice. So there is no free lunch, which means everything has got a cost. Because of that choice, I further reduce the interest by 2%. Okay. Interest got further reduced from 15% to 13%. So this is a compound financial instrument. That's why I've classified this as a compound financial instrument, because you have an invisible equity portion. That's the point. Chalo. Next one, conversion at the option of the issuer, which means conversion is at the option of the company itself. First of all, you are paying mandatory interest, so that will be classified as financial liability, and conversion is in my hands, which means obviously I don't have any contractual obligation to pay any cash, so I'll classify that as an equity. As simple as that. So it's a compound financial instrument. It's a simple case. This is a simple case. Okay, right. Now let's move on to the next one. Contingent settlement provisions. Now moving on to next thing, that is contingent settlement provisions. Okay, so let's try to get to the definition, what it is first, and then we'll get to the concept. And mind you, we are already done with compound financial instruments, but if you could concentrate, I've just taught you what is CFA, that's all. Did I teach you the accounting part? No, because still we are in Ind AS 32. Let me make it very clear. So this is not the end of CFI, because still we have to look into the accounting part. That we'll be doing once we go to Ind AS 109. So right now, as long as Ind AS 32 is concerned, as long as we are in this particular Ind AS, it's all about definitions. It's all about what is what. We're not going to focus on the accounting part. Did we discuss accounting part of financial assets? No. Financial liability? No. Equity instruments? No. So all those will be covered once we get to Ind AS 109. So right now we are still in Ind AS 32. Let me make that very clear. Otherwise you guys will get doubt. He did not cover all those things and stuff like that. Am I making myself clear? Fantastic. Now, contingent settlement provisions. So we are still on the left side of the topics that we are discussing. If you could remember, what do I mean by left side? That is this one. So where entity has to deliver its own equity. We did cover fixed to fixed test. We did cover compound financial instruments, and we are about to cover contingent settlement provisions. Once we are done with this, we'll come to the right part where entity receives its own equity. In that case, we'll be covering treasury shares and return put options on own equity, and of course buyback. Right. Now let's continue with contingent settlement provisions. A financial instrument may contain a provision that requires the issuer to deliver cash or another financial asset to settle the basically instrument, okay, only on the occurrence or non-occurrence of a future uncertain event, which is nothing but contingency that is beyond the control of both the issuer and the holder. So here the keyword is, whenever we talk about contingency, obviously it is dependent on occurrence or non-occurrence of a particular future uncertain event. Another important thing that you guys need to understand is that it should be out of the control of both the issuer and the holder. So if these two conditions are satisfied, then only it satisfies the definition of contingent settlement provisions as per Ind AS 32. This is very, very, very important. It should be out of the control of both the issuer and the holder. I make myself very clear in that. Yes. Now what we need to find is that whether this so-called contingent settlement provisions, okay, is gonna be a liability or equity. That's what our struggle is going to be. Okay. Now ask yourself, is the issuer obligated to settle in cash or financial asset? Which means, is the issuer has got some sort of a obligation? Okay. Yes, sir, there is obligation. Okay, even if it is under certain condition, that is contingent. So there is no 100% certainty. Despite that, it will be classified as financial liability. Again, what is the reason, sir? I told you, what is the key for this entire standard? It's not about what usually happens. It's about what can happen. Is there any slight chance of happening something? This so-called contingent incident is also, it's not like 100%, right? So there is a slight chance of that happening. Even that is there. The question is, what can happen? Can it happen? Yes. Is there a chance of happening? Yes. No matter how slight the chance is going to be, it's going to be classified as financial liability, right? Now, if the settlement is only optional, you got the point, which means there is no obligation whatsoever, or in the issuer's own equity, you're going to settle it with fixed number of shares. The shares are not variable in number. You can settle it. You have an understanding where either it is completely at your option, which means if you want, you can, or otherwise you can avoid, which means there is no obligation. At the same time, even if you're gonna settle it with your own equity shares, that too fixed in number, which means it satisfies the fixed to fixed test. Eventually in that case it will be classified as an equity. So pretty simple here. You just need to ask yourself from the issuer's point of view, okay, is there any obligation or not? Don't look at the probability of that happening, because anyway it's a contingent event. Is there an obligation or not? The answer is yes, it's a liability. No obligation, it's completely your choice. Or you are settling that so-called contingent obligation with the help of fixed number of equity shares. In that case it will be classified as equity. There ends the matter. Moving on. So what is the logic of this particular standard? Very simple, substance over form. In fact, all the Ind AS, it follows the same logic. Even if the instrument, the so-called financial instrument, appears to be equity, if in substance the issuer might have to settle in cash, then it is a liability, even though the name is equity. But in substance, if you have to eventually pay some sort of a cash or something like that, it's a liability. At the same time, another logic of the standard is that it want to protect the investors. What do you mean by that? Contingent settlement provisions is not what usually happens, it's about what can happen. So even if there is a slight hint or possibility of cash outflow outside the company's control, because here itself we have seen in the definition that it is beyond the control of both the issuer as well as the holder. That's what I told you, that sentence is key. So if it is outside the company's control, then it should be classified as financial liability. Only in that case your so-called financial statements are showing true and fair view, because there is a contingent liability. You have to show it as a financial liability in case if you have a obligation, financial obligation. You got it? Right. Chalo. Now moving on. Let's look at the examples of contingent settlement provisions. Okay. X Limited has issued debentures for 5 years on the following terms. Okay. Case 1. Debentures are converted into equity shares in the ratio of 10:1. All right. So every 10 debentures you'll have one equity share. Fine. If the fair market value of the share crosses 100. Now tell me, this condition, fair market value of the share crosses 100. Isn't it a contingent? Yes. It may or it may not cross. Otherwise, it will be redeemed in cash. So if the fair market value does not cross 100, it will be redeemed in cash. Got it? Now, will this be classified as financial liability? Yes, because although there is a slight chance that it will not cross 100 and it will be redeemed in cash, is there a chance of that happening? If there is a chance of that happening where you have an obligation to pay cash, automatically it becomes financial liability. This will be classified as financial liability. Any expectation about future market price of the share is irrelevant for the classification today, because there is a chance. The question is, what can happen? Can this happen? Yes, there is a chance. Automatically it will be classified as financial liability. Simple. Moving on. The debentures are converted into 10 equity shares if market price is greater than 100. Otherwise, it will be converted into 15 shares. All right. So it can be either 10 or 15. So here you need to understand that you might be thinking that, okay, it's an equity, but that's not the case. Why? Because even though the settlement will happen only by issue of shares, the debenture cannot be classified as equity because fixed to fixed test is not satisfied. The number of equity shares is not fixed. It can be 10 or it can be 15 depending upon that so-called uncertain event. So it is variable in number. It's just like you're using shares as a currency. So therefore, it will be classified as a financial liability, not equity. Next, third case. The debenture will be converted into equity shares at 5:1 only when the market price of the share is greater than 100. Okay. Right. The debenture issued will be classified as equity instrument since there is no possibility of making any cash payment. What you need to understand is that, what is the difference between these two, Nana? Case 1 and case 3. In case 1 also, I'll be converting that into equity shares. If the fair market value of the share is greater than 100, there will be a time limit for that. In this example, I did not give you. Otherwise, it will be redeemed in cash. Correct? Do you find any otherwise over here? The debentures will be converted into equity shares at 5:1 only when market price is greater than 100, which is similar to the case 1. But do you find any other one here? Otherwise, it will be redeemed in cash. Otherwise, the number of shares will be different. Something like that? Nothing. So which means there is only one condition. Market price of the share should cross 100. In that case, I'll be issuing fixed number of equity shares. There ends the matter. So when that will cross, whether in 2 years or 3 years or 5 years or 6 years, that's all. Once it crosses, I'll be doing this. You understand the point? Otherwise is not there in this particular case. Therefore, you don't have any contractual obligation either in payment of, either in the form of cash or in the form of variable number of equity shares, where shares are used as a currency to make your payment for the obligation. So therefore, this will be classified as what? Equity instrument. Clear? Right. One more example you see here. This will be, I think there is one question based on this. Anyways, now see here. Preference shares redeemable in equity shares. Okay. which means convertible preference shares, obviously. But if war breaks out, it will be settled in cash. Okay, so war breaking out is a contingent settlement provision. That's what I've written here. The war trigger is a contingent settlement provision. Now the question is, sir, what can happen, sir? So war can happen. Therefore, let me classify this as a financial liability. Nope. Why? Because war is a unique situation where it rarely happens for some countries. If, in fact, for some countries it never happened. For some countries, the probability of that happening is pretty high. You understand the point? You take all these Nordic countries like Norway, Denmark, and you have Switzerland, you have Poland, lots of countries over there where pretty much what did not happen, right? So in those kind of countries, if you're doing a business over there and you look at this sort of a contingent settlement provision, then obviously you'll be of the opinion that, it's pretty rare, almost like 100% pretty much it won't happen. You understand the point? In that case, what you will do? It's a stable country, so let me classify that as an equity. You got it? Right, because the war happening is not possible. Only if war happens, only you'll be settling in cash. But let's talk about India, for example, or Pakistan, for example, or Israel, for example, or the Badawala, USA, for example. Obviously, there is a probability of, kisi na kisi war is going to break out for sure. You understand the point? In that case, it will be classified as a financial liability. That's the point. Got it? Chalo. Now, let's come back to the next concept, that is buyback. Alright guys, coming on to this concept called buyback. Now it's pretty simple, Nana. Buyback means you're just repurchasing your own shares, okay, as a company. Now always feel that you're the company over here. So when a company buys its own equity shares from the shareholders, usually what company does is that whenever it buys back its own shares, usually it is cancelled. So I'm not saying 100% of the cases. There are cases where it will not cancel it. It will keep its own shares as an investment, and then when the price rises, it will be selling it. Although it's not available in India, that's what we call it as treasury shares. That we'll see it later. But right now the point is, when it comes to buyback, usually you buy back your own shares, okay, from your equity shareholders, and you eventually cancel it, thereby reducing your outstanding share capital. Okay. So now Ind AS 32 says that, still we are in Ind AS 32, keep that in mind. When an entity purchases its own equity instrument, those instruments are deducted from equity, obviously, because you purchased it from your equity shareholders, so it no longer exists, and moreover you cancel it, so obviously it will go out of its existence. It will be removed eventually from your balance sheet. But Ind AS 32 specifically says that no gain or loss shall be recognized in P&L whenever you do this. Usually whenever buyback happens, generally what happens is that companies, most probably they pay premium and then they buy back. So most of the situation there will be loss, but still Ind AS 32 says that, see, forget about whether it is loss or gain, it doesn't matter. Ultimately it will never touch the P&L. Okay, if at all you want all the adjustments, you make it in other equity. Other equity means retained earnings, general reserve, and you have of course securities premium standing over there. You can use that and pay the premium on buyback. You understand the point? Whatever the extra that you're going to pay to your shareholders, and eventually try to, purchase your shares and eventually cancel it out. Got it? Now there are two questions for us. First question is, okay, why is that the gain or loss of the buyback of the equity shares when a company does should not go to P&L? This is first question. Second question, what's the purpose behind buyback? Why would any company do that? Well, for that the answer is pretty simple. There are two reasons. So many reasons are there. Just I thought two reasons are enough. One is to increase your EPS. How will you calculate your EPS? Your earnings your earnings available to shareholders divided by number of outstanding shares, right? Now, by buying back and cancelling them, you're reducing the number of outstanding shares. Automatically, your EPS will become very much good, right? It will increase. You got it? So financially, your the so-called fundamentals of your company looks very strong, attractive to the investors. Probably market price of your share will increase because of that. That's one thing. Second thing is, you also want to return your surplus cash to the shareholders. So I have so much, I've done a great business, I want to give it back to my shareholders. What do you do? Are shareholders, you have got shares now. Let me pay you money. I'll pay you premium also. Give me back my shares so that you get the money. You deserve it, like that. Okay, there are two reasons why a company does a buyback. Okay, now the second question is, why is that Ind AS 32 specifically says that you should never ever transfer any sort of gain or loss to the P&L account whenever you buy back your own equity shares from your shareholders? Well, the answer is, first of all, your own equity shares are not your assets, where whenever you sell them, eventually you try to transfer the profit or loss to your P&L account. You got it? Either directly or through OCA, whatever it is. Next, when company buys back its equity shares, it is not an expense. Is it an expense when you buy back your own equity shares? It's never an expenditure for the company, right? Next, buyback reduces equity, specifically share capital, and possibly retained earnings or general reserve will be eventually adjusted. Therefore, it will not go to P&L account. All the adjustments will happen in other equity. In other equity, what do you have? Retained earnings or general reserve or securities premium. From there, you adjust. There ends the matter. Okay. So what is the entry? Easy peasy. Whenever you buy back, what you will do eventually? You cancel your outstanding shares, right? They'll be at great balance. You debit it to cancel it out, right? Suppose your equity share capital face value is 10. You purchased from your shareholders by paying 15. In that case, from your bank, 15 goes out. So two bank account, obviously. And the difference of 5 rupees, whatever the premium that you have paid on buyback of your shares will be adjusted against other equity. It can be anything. It can be securities premium or retained earnings or general reserve. Got this? Right. Now, okay, why are we studying this right now from India's point of view? Again, the same question. The fight is always between equity and financial liability, Nana. Financial asset will never come into picture. So it's easy to understand. Always the fight will be between financial liability and equity. That's where the confusion is. Because the concept is so confusing that you're always looking at substance over form. So the form, the name can be anything. The name may sound like equity, but the substance can be a liability. The name may sound like a liability where it is debentures, but the substance can be equity. You understand the point? That's why so much of discussion is happening when it comes to Index 32. That's why we have to focus on all this, so-called definitions and concepts of each and every item. You got the point? So again, what is the problem here? When you buy back your equity shares, that so-called thing should be classified as equity or financial liability. Now, don't tell me this kind of, sir, what kind of stupid question is this, sir? Obviously, you're buying back your equity shares only, na? Obviously, it's going to be equity only, na? What is this question, sir? That's where the problem comes. Substance over form. What is that, sir? See here. Does the company has an obligation to deliver cash or financial asset to the shareholders to buy back their shares? Is it an obligation? Is it a commitment? Compulsorily, I'll pay you cash and I'll buy back. If it is yes, obviously financial liability satisfies the definition of financial liability. If it is no, it's completely at the company's choice, at company's discretion. If company wants, it will do buyback. Otherwise, it will just stay quiet. So company does not have any obligation whatsoever. Satisfies the definition of equity instrument, then it will be classified as equity. Got it? So if the company has a contractual obligation to buy back its own shares at a fixed amount, then that obligation is financial liability, even though the shares that you're buying is equity. Substance over form. Clear? Right. Let's look at an example so that you'll have 100% clarity. With respect to accounting also, we'll cover here itself. You guys are ready? Now, only problem with this example is that we haven't gone to Ind AS 109. So therefore, you guys have got no idea with respect to accounting. But then bear with me because this example has to be covered here itself, because we'll be covering 2 points in this example. We'll be covering another concept called where a company writes on its own put option to buy its own shares. That is one thing. The other one is we'll also be covering the buyback as well. So therefore, this example has to be covered here itself. So bear with me. Okay, anyway, it's a revision session. I hope you guys can cope up. Now, company sold a put option on own equity shares. Again, never get confused whenever you get options like this. So first of all, put option means what? Right to sell. Call option means right to buy. Right to sell, right to buy applies for those who have bought the put option. Now here, did he buy the put option? No, he has sold the put option. So it's exactly, it will be opposite. So if you buy a put option, you have right to sell. You have right to sell to other guy, which means other guy will have exactly what is the situation. His situation will be he has to buy. Now when you have right to sell, if you exercise that right, the other guy has to buy, na? So he'll buy, but he'll not have a right, he'll have an obligation to buy. So therefore, company sold put option on own equity shares, which means the company has got obligation to buy its own equity shares at an exercise price in a future, that is at 65. For that, the company is receiving option premium of 5 rupees. So one who buys the option will pay the option premium. One who sells the option will receive the option premium. So that option premium is the revenue for you for accepting that obligation. And for buying the right, that is the option premium that he has to pay. Right does not come cheap, or right does not come free. Okay, one has got the right, one has got the obligation. Naturally, one has got the right has to pay the money to the somebody who is going to give you the equivalent obligation. Okay, now, so Ind AS 32 says if an entity has an obligation to buy its own equity instruments, okay, for cash only, na, here, obviously you're going to pay 65 and you're going to buy. You have an obligation to do that. You can't say I don't want to buy. No, the right will have in the other guy's hands. You have received the premium, so you have to face the obligation. Okay, so for cash or another financial asset, then this gives rise to financial liability. Why? Because company has to deliver cash and that's a financial liability. Got it? Right. And also we know that when it comes to equity, there should be no contractual obligation whatsoever. Then only we can call it as an equity. If there is an obligation to deliver cash, it is a financial liability. We know this already. Okay. Now let's account this. Pretty simple. From company's point of view, you have to account, right? So company has sold the put option, which means it has received option premium of 5 rupees. When it receives money, obviously you have to debit the bank account, and you should not touch P&L because we are dealing with equity over here. So it will go to retained earnings, and retained earnings gets credited, which means it will increase. After that, you have to recognize the financial liability on day one. Why financial liability? Because you have sold the put option. Selling the put option means company has got an obligation to buy its own equity share. Although there is no 100% chance that this will happen. You understand the point? But we know the concept. What can happen? That's what you need to consider. So is there a mild chance of you eventually having an obligation to buy? Because if the other party exercises his right to sell, you have to buy. You don't have a choice. You got it? So therefore, recognize that as a financial liability. How to recognize that as a financial liability? Very simple. In future, you have to pay this much, 65. That is in future, right? After 6 months. Today, what will be its value? Discount it. Okay, let's say the discount rate is 10%. You discount it, 65 into present value factor, you will get the present value of the financial liability as 59. You got the point? And this money, where you will get it from? From retained earnings only. Therefore, retained earnings will be debited. From there only, you'll bring the money. In case tomorrow you have to pay this financial liability. So that's your entry. Although shares not yet bought, because after 6 months only, if the other guy exercises his right to sell, then only you will buy the shares. Today that's not happening, but today on day one I'm passing this entry. Okay, although shares are not yet bought, the company has potential cash obligation. Potential, it's not 100%, right? Logic behind the entry is very simple. Fair value of the obligation is recognized as a liability with corresponding reduction in equity. That's why we have debited retained earnings, because from there only we are going to get the money and pay this financial liability. For simple logic. Got it? Right. Actually, we are following amortized cost method here, but what is that you don't know because we haven't gone to Ind AS 109. Bear with me. Okay. Okay. After that, what will happen? We'll be doing unwinding of discount, which means you have already discounted it and found the present value. Na? This is on day one. That is 6 months before. Now 6 months has happened. After 6 months, what you have to do for this 6 months time value of money, you have to add now, right? So you add the 10%. Automatically, what will happen? This becomes 6. Eventually, it touches 65 because 65 is gonna be your liability after 6 months. Correct? This is what we call unwinding of discount. Unwinding means reversing what you have done already. What did you do already? From 65, you bought it down to 59. Na? Reverse what you have done. From 59, you again bring it back to 65. I hope this is clear. Right now, so after 6 months, eventually what will happen? Here, one more interesting point. When you again add back the interest to make the financial liability 65, where you do unwinding of discount, here I've debited interest cost. But ultimately, this will also go to retained earnings only. You got the point? This 6 rupees also you'll bring it from retained earnings. So next entry will be retained earnings to interest cost. Thereby interest cost 6 and 6 gets cancelled because you have debited and credited, it's gone, and retained earnings eventually will be debited. So that's what I've written here. This effectively goes to debit retained earnings only. Keep that in mind. And also keep in mind that retained earnings is a credit balance. So whenever you debit it, you are actually reducing it. Why are you reducing it? You are bringing money from there. Simple logic. Now, you have two choices over there. You don't have the choice. The other guy will do. Okay. So two things can happen. Because you are the company, you have sold the put option, you don't have the choice. You just need to react to what the other guy does. So the other guy who has purchased the put option, he has got two choices. If he feels that it is favorable, the option is in the money. What is in the money? All those things we'll see later. In the money means option is in his favor. He will get profit. Okay. So if it is in the money, he will exercise the option. If he exercises the option, then what will happen? We have an obligation to buy. So which means we need to pay excise price, which is 65, and buy our own equity share. So if you have to pay 65, what you will do? To bank, simple, right? And then you buy your own equity share. There ends the matter. Which means whatever the financial liability that you have created so far, it's gone now. It's extinguished. It's gone, right? Because you have paid the money, na? No more liability. So cancel off the liability and remove it. Therefore, you debit the liability and it is gone. Now the next thing is, okay, now that you have paid 64, you have got your share. Now this share has to be cancelled. Now that's what you do in buyback. Usually cancel it. To cancel the equity share, what you have to do? You have to debit it. Okay, debit the equity share. At what value? At face value. You got the point? Face value is 50. It is given in the question. Now the biggest question is what you will credit. You will credit retained earnings. Why retained earnings I have to credit? Usually what you will credit? Huh? What you will credit? You will be normally creating financial liability, right? Or bank, for example. You got it? Why you'll credit bank? Because that's where you'll bring money from. Now you have got money from where? Retained earnings. Therefore, create retained earnings. You bought money from retained earnings. With that only you have purchased your equity shares. Now, therefore, create retained earnings. As simple as that. Now, the next question is, why did you credit by 50? because the face value of equity share capital is 50. That's the easiest way of understanding. Therefore, I've created retained earnings by 50. No, give me a better explanation. Yeah, I'll give you. Suppose if you do normal buyback without this put option, writing, selling put option, all these things. If you do normal buyback, what is the entry? You purchased your equity shares worth face value of 50. So to that extent, equity share capital will be debited 50. Done. How much did you pay to buy that? 60. Hello? No, sir. We have paid 65 to buy that, na, sir. No. Actually, we did not pay 65. Okay. Even though, okay, let me put it this way. Even though we actually paid 65, but we have received an option premium of 5 rupees, na. So our net cost is 60 only. Okay, let's put it this way. Today you are paid 65 only. Okay, I accept. But then you have received 5 rupees at the beginning, na, 6 months back. So your net cost is 60. How much eventually went out of your bank? Here you have debited your bank for 5, na. Here you have created your bank by 65. So what is the net credit? 60 only. So ultimately 60 left your bank, correct? To the extent of 60 only you have to put. That's why I put 60. Okay. Your face value is 50. The balance premium extra 10 rupees that you have paid, where it will go? It will go to retained earnings only. So which means ultimately your retained earnings should be debited to the extent of 10 only, correct? But what did you do with respect to retained earnings? Here you have created by 5. So this is minus 5. Credit means minus 5. Here you have debited by 59 plus 59 minus 5 plus 59. Here again debit of 6 minus 5 plus 59 plus 6. Correct? So minus 5 plus 59 plus 6, total you have debited to the extent of 60. Whereas according to our entry, you should debit it only to the extent of 10 only. So you have debited nearly 50 more. So to compensate that, now you credit by 50, it gets cancelled out. Ultimately, you have debited retained earnings to the extent of 10 rupees. This is another way of looking at it. Whichever way you want, you can follow. Got it? If holder lapses the put option, lapses means he will not exercise his right to sell. When he will do that, if he finds that there is no benefit in doing this, therefore I will not exercise my option. In that case, what will happen? Whatever you have created so far, cancel it. Cancel it means reverse it. Reverse it means there is no more financial liability. So debit it. And all this financial liability, to create that, you have taken the money from retained earnings only. Na? By taking the money from retained earnings, you have debited it so that you have reduced it. Now again increase it back. So credit it. You got 65. There ends the matter. Done? Chalo, moving on to the next concept, treasury shares. Now coming on to treasury shares, it's not that important in India, Nana, because it's not permitted in India. I already told you, na, it's just like a buyback. But the thing is, you will buy your own shares and you will not cancel it. Okay, you will hold your own shares as an investment. Now just understand why it is not permitted in India, because if this is allowed, what will happen? The company guys will have the first hand information, right? So they know that if they are going to launch any new product which is going to really work, or if their financials are going to be really good, or if they're going to start up a major branch or something like that, they will just buy back their shares and keep it as an investment. Ultimately, they'll get benefited out of it. So therefore, this is not allowed. But in some countries, it is allowed. So you cannot show this as an investment in balance sheet and can't call it as a financial asset as well. Accounting is done by adjusting retained earnings. So you'll pull the money from retained earnings and you'll pay it to the bank and you'll purchase your own shares, just like in buyback. But the only thing is, in buyback, you'll also cancel the shares, but here you don't do it. You just keep it like that. And tomorrow, like an investment, your own shares, okay, your own company shares, you will keep it as an investment. Tomorrow, once it increases in its price, the market price increases, you will again sell it. You'll get the money. So therefore, bank account will be debited to retained earnings. That's it. Right. Next, transaction cost and all these things we will see once we get to Ind AS 109. There we will see how the accounting and all those things will be done. Right now, it's not the right time to discuss that. Okay. Chalo, accounting for equity instruments also, let's see in Ind AS 109. There again, we'll be discussing the same. Okay. So right now, let's focus on this treatment of interest and dividends. Very easy, Nana. Financial asset, whenever you buy a financial asset, for example, you have invested in debentures, which means you bought debentures, you bought preference shares. Eventually, what will happen? You will be getting interest or dividend. So obviously, it is income for you. You will recognize that in P&L. Pretty simple. If you have issued debentures, then it's a liability for you, and interest and dividends will be expense for you. So you'll recognize that also in the P&L. However, there is one student down which I want to discuss over here. In case of preference dividend, if the dividend is mandatory, you may call it as dividend, but because it is mandatory, it is in the kind of nature of interest. And as a result, it will also be recognized in P&L account. Mostly people don't get it, because the moment they hear the word dividend, even though it's a preference dividend, they feel that it never touches the P&L. That's not the case, because when it comes to mandatory dividend, especially in case of preference shares, if the dividend is mandatory, it's just like interest. Only the name is called dividend. So again, substance over form concept. In substance, it is just like an interest. So therefore, you will take it to P&L account. That is one point you have to keep it in mind. Now, coming on to equity instruments, whatever, say for example, it's ordinary equity shares, you are paying dividend. Naturally, it will be debited to retained earnings or general reserve. Everybody knows that. It goes to other equity, right? From there only, eventually, what you'll be doing? You'll be paying the dividend. That we know. Preference shares with discretionary dividend also. Look at the name. The name is preference shares. But because it is with discretionary dividend, we know that we will be classifying this as an equity instrument, even though the name is preference shares. And that sort of a discretionary dividend also, just like equity dividend, will go and adjust with retained earnings or general reserve. This is what you have to remember. Compulsory convertible debentures. Just imagine, the word is debentures. Debentures is synonymous with debt. Even in that case, if you have a compulsory convertible debentures, which will be eventually converted into equity shares, and you have a discretionary interest along with it, when you pay this so-called discretionary interest, that also will be adjusted with retained earnings or general reserve, because it is in the form of an equity. You got the point? And don't step into this and don't get confused that, अरे यार ये तो debentures है, ये तो interest है, obviously it has to go in P&L account. No. If it is discretionary, go and adjust that with retained earnings or general reserve. Preference dividend, if it is discretionary, go and adjust that with retained earnings or general reserve. The same preference dividend, if it is mandatory, go and adjust that in P&L. The same preference dividend, if it is discretionary, go and adjust that with retained earnings or general reserve. This clarity you should have, especially while solving sums. Okay. All these reasons we have already discussed, nothing special. Okay, this is clear. So again, I repeat, substance over form, substance over form, substance over form. Name doesn't matter. The substance matters. Got it? Here also name is preference dividend. Here also name is preference dividend. But here the substance is in the nature of interest. So it will be adjusted in P&L. Here the substance is in the nature of what? Equity dividend. Therefore, it will be adjusted with retained earnings or general reserve. That's the difference. Got it? Chalo. Now, next concept is offsetting of financial asset and financial liability. It is just for presentation purpose, Nana. It's not from perspective of accounting, but it is there in your syllabus. Therefore, let's learn this. Okay. Now, this is not just that important, Nana. So we'll just fatafat, we'll cover it up. In balance sheet, any asset or liability cannot be presented on net basis unless, so by default, you can't net it off. That is the first rule you need to understand. Unless specifically it has been permitted by any Ind AS. For example, Ind AS 37 permits you that provision can be presented net of reimbursement. Got the point? Ind AS 20 tells you government grants, government related expenditure and government grant which you receive. For getting that money, you will incur some expenditure that can be netted off. So if any Ind AS specifically tells that, yes, you can net it off. Otherwise, any asset and liability cannot be presented by netting off in your balance sheet, right? So when can I net it off? That's the next question, right? When can I offset? The answer is an entity shall offset a financial asset and financial liability only when both the following conditions are met. The word is both, not either of them. Okay, both the conditions should be satisfied. First one is it should be a legally enforceable right. The other one is you should have the intention to settle net, which means the parties involved. Okay, right. Let's take a real life example so that you'll understand things better. Now, HDFC Bank enters into a derivative contract like interest rate swaps, okay, or currency forwards. It can be anything. What are they in detail? We will learn in future, okay. Interest rate swap means one sort of interest you will be swapping with another sort of interest, okay, with other financial institutions, say for example, ICICI Bank, okay. So basically they entered into a derivative contract. Who? HDFC with ICICI Bank. That much is necessary for you to understand. These contracts result in, now you guys know, whenever two people enter into a derivative contract, one guy should be gaining, the other guy should be losing. Because I told you so many times, derivatives are like a zero-sum game. Zero-sum game in the sense, if one guy is earning 10 rupees, if I am going to earn 10 rupees, you should lose 10 rupees. That's the way it works. Unlike investing where wealth gets created and everybody makes money. So in investing, when wealth gets created, when market price of the share increases because of the performance of the company, wealth gets created. So you earn money without, causing loss to somebody else. But when it comes to derivatives, that's not the case. Forward contracts, future contracts, options, whatever it is, any derivative for that matter, it's a zero-sum game, which means if you're earning something, somebody else has to lose the same amount. You got the point? So similarly here, when HDFC and ICICI Bank has entered into a derivative contract, obviously if HDFC is gaining, then ICICI will lose the equivalent amount. In that case, ICICI has to pay to HDFC. Similarly, if ICICI is gaining, HDFC will lose equally the same amount and HDFC has to pay to ICICI. Got the point? So therefore, these derivative contracts, they'll enter into multiple derivative contracts, not just one. So in some contracts, HDFC will have receivables, which means HDFC would have gained in those derivative contracts. It would have won the bet and as a result ICACA has to pay to HDFC. So therefore HDFC will have receivables from ICACA. Similarly, in some contracts, if HDFC has lost it, then HDFC has to pay to ICACA, so it will have payables as well. Multiple derivative contracts between HDFC and ICACA. Got the point? I'm taking real life example. It happens in real life. Okay. In the money, out of the money means in the money means ultimately I've got gain, right? Out of the money means I've got loss. That's all. Simple. If you're in loss, out of the money. If you're in gain, in the money. Now suppose HDFC has receivable of 500 CR from ICACA, which means HDFC has won these many bets where ICACA has to give money to HDFC. Similarly, HDFC also has to pay 450 CR to ICACA because it has lost so many bets. So multiple derivative contracts will be there. In some HDFC has won, in some HDFC has lost. So in whatever the cases HDFC has won, ICACA has to pay 500 to HDFC. And in whatever the cases HDFC has lost, HDFC has to pay 450 to ICACA. So what they have done, these two banks have legally enforceable master netting agreement like ISDA. ISDA is nothing but International Swaps and Derivatives Association. Okay. So this is legally enforceable and both these banks intend to settle. Anyway, you have to pay me 500. I have to pay you 450. Let's set it off. What is there in that? So HDFC might net it off and it can show 50 CR receivable from ICACA. There ends a matter because anyway I have to get 500. I have to pay you 450. Let's net it off. Net you pay me 50. There ends a matter. You got the point? This is what we call offsetting. So if you want to do offsetting, rule number 1, you can't do it by default. You can't offset assets with liabilities. What you have to do is that if any Ind AS specifically says, then you follow. If no Ind AS is specifically saying, if Ind AS is silent, then also you can offset when there is a legally enforceable contract. Okay. And the second one is intention of the parties to settle net. Now in this case, obviously whenever derivative is won, it becomes a financial asset. Whenever derivative is lost, which means you have lost money, it becomes a financial liability. So here also you're setting a asset with liability only. But how are you setting? Because these two conditions are satisfied. One is legally enforceable contract. The other one is what? Intention to settle net. There ends the matter. Got it? Remember, Nana, still we haven't gone to derivatives. We'll see that in Ind AS 109. In derivatives, if you won the betting, it becomes a financial asset. In derivatives, if you have lost the betting, it becomes a financial liability. Derivative can be financial asset. Derivative can be financial liability. Derivative can be equity instrument as well. Keep that in mind. Are we done with this? Chalo. Next, foreign currency convertible bond. Ind AS 32 is all about definitions, Nana, learning concepts. That's all. We are not going to look into the accounting aspect. That we will see when we go to Ind AS 109. Keep that in mind. That's why continuously we are getting concepts. Now, what is this foreign currency convertible bond? Okay. Very simple. A bond issued in foreign currency, USD, US dollars or euros, whatever it is, issued by whom? Indian companies to foreign investors. Okay. So Indian company wants to raise money. So it wants investment from the outsiders, that is foreign investors. Obviously, it raises the bond in foreign currency so that they'll be interested. Simple logic. It pays interest like just normal bond. Okay. It also gives the bondholder the option to convert the bond into equity shares. It can be convertible bonds as well, issuing the company at a later date at a fixed price. So anything can happen, just like a normal bond. The only difference is normal bond, you give it in Indian rupees to the Indian investors. Here, when it comes to foreign currency convertible bond, you raise the bond, you give it to the foreign investors in foreign currency. Mostly it will be in US dollars or euro. Now, let's take an example how this works. A company has issued a convertible debenture in foreign currency. Okay. Foreign currency convertible debenture where face value is equal to $1. That particular debenture face value is $1. Fine. Let's take two cases and see what happens. On 10th year, let's say it is a debenture issued for 10 years. It's a convertible debentures where debenture will be converted into equity shares. Okay. Where it is said that one equity share will be equals to $0.25, which is issue price of the equity share. Okay. In that case, because you know that face value of the bond is $1, you know that for one bond which is valued at $1, and you know that one share is valued at $0.25. So obviously for one bond, you should be giving 4 shares. Easy. So therefore, is the number of shares issued is fixed in number? Yes. So I give you X number of shares, which is fixed. 4 shares for every bond, that is fixed. At the same time, the kind of money that I got from you initially, that is also fixed only, na? While raising the bond itself, I would have received money, which is a fixed money. So fixed to fixed test is passed. This will be classified as an equity in case 1. Okay. However, let's look at the case 2. Now see here. 10th year, it says that these debentures, that is bonds, will be converted into equity shares at rupees 20 per share. Okay. At rupees 20 per share. Here I'm not sharing equity share value in dollars. Here I'm saying equity share value in rupee per share. Okay, then how many shares are you going to issue? Here, both of them are represented in dollars, so it was very easy for me. $1 divided by $0.25. It was 4 shares. F to F test is passed. But here, that's not the case, because here I'm saying one share value is 20 rupees, whereas one bond value is $1. So one bond value is in dollars and share value is in rupees. Now that creates a confusion. How many shares has to be issued per one single bond? Then what I have to do? Convert this bond into rupees. So $1 is equal into that dollar is how much rupees on that particular date. You multiply with that, then you'll get the bond value in rupees. You got it? And then bond value in rupees divided by one share is 20 rupees. Therefore, if you divide it with 20 rupees per share, you'll be getting number of shares to be issued. Now, let's say your dollar value is 80. Then $1 into 80 divided by 20, you'll be giving 4 shares. Suppose dollar value is 100. Then $1 into 100 divided by 20, you'll be giving 5 shares. Suppose dollar value is 60. $1 into 60 divided by 20, you'll be giving 3 shares, which means variable number of shares. Therefore, fixed to fixed test is failed. In that case, can you call it as equity? No. However, we got a carve out point over here, which means our Indian ICA says, hum to alag hai. We are different. IIS 32, that is International Accounting Standard, says it is a financial liability because fixed to fixed test is failed. Why it is failed? Because you're going with variable number of shares. Now, however, Ind AS 32 says it is equity because issue price is fixed. It's because issue price is fixed. It is fixed only, but at the end of the day, what is the result? You are giving variable number of equity shares. It can be 4, per bond, or 5 shares per bond, or 3 shares per bond. So obviously it is variable. So it has to be a financial liability, but we did a carve out. Obviously, this was my reaction. Seriously? Then I thought, what could be the reason? Our people are not this stupid, right? Then I thought, okay, some big business people will be there, some big business companies, and they would have raised money. They would have raised their bonds in foreign currency. They would have got a lot of foreign currency convertible bonds. They don't want to show it in their balance sheet as a liability. They want to show it as an equity. Your financial statement looks good that way. So therefore, they would have influenced. Therefore, our guys did the carve out point. Typically, India being India. I hope you are getting what I'm trying to say. Anyways, we are done with this. Let's move on. Next one is puttable financial instruments. Okay, now what is this concept of puttable financial instruments? Many people don't get clarity with respect to this. It's an easy concept only, Nana. See, name itself tells you puttable financial instruments. There are certain financial instruments which you can put it back. Now, which you can put it back means just think from investor's point of view. It will be very easy for you to understand. See, I'm a company. I want money. So I raise money by giving bonds or debentures or puttable financial instruments. Let's say I raise money with the help of puttable financial instruments, not bonds, not debentures. See, usually if I raise money with the help of bonds, what happens? I give you bonds, the kind of documents, I get money, and based on the conditions of the bonds, I pay you interest every single year, and then I redeem it after 5 years or 6 years or 7 years, either at par or at premium, or I convert that into equity shares, whatever it is. Depends upon the conditions of the case, as the case may be. Now, when it comes to puttable financial instruments, what happens is that I raise money through something called puttable financial instruments, where I give the holder, which means the one who is buying, which means like you, okay, or it can be any company, or it can be any financial institutions, ultimately the holder or the investor who gives the company money. So I give you an option where, suppose you are in need of money at any given point of time, you can put that instrument back and get the money from me. Sir, what do you mean by that, sir? Pretty simple, Nana. See, a piece of paper. Okay. Let me take this. See, say for example, this is a puttable financial instrument. Okay, let's put it this way. We'll just cut it off short. Now, I'm giving this paper to you. It's a puttable financial instrument, and I'm raising, you are giving money to me. Okay, you are the investor, you are the holder. I'm the company. I'm raising money. Okay, fine. But there is a special condition in this piece of paper. The condition is that whenever you need money tomorrow, you can just give this paper back to me, and again I'll give you money. What? Before redemption, before official redemption. It's just imagine where there is a bond. Let's say this is a debenture. I gave you the debenture paper, you gave me money. I'm paying you interest. You have to wait till the redemption. You don't have any other choice, right? But what if third year, say for example, the debenture is usually redeemable for 5 years, let's say, and third year you are in need of money as an investor. You have an option to sell that debenture in the secondary market. That anyway is there. But apart from that, you also have an option where you can give this instrument back to the company, the so-called debenture, and you can get your money back. What if this is there? Now that is what we call it as puttable financial instrument. So which means from company's point of view, think, I gave you a piece of paper called puttable financial instrument. I put a condition saying that whenever you want, you can just put it back and get your money, right? And I gave it to you. And let's say this is having a period of 5 years or 10 years, whatever it is. Let's just understand for ease of understanding purpose. And I've raised the money, I'm doing my business. Now I know that at any given point of time, anybody of you can come back and put this instrument back and ask money. So in that case, do I have a contractual obligation to pay you money whenever you give this paper back to me? The so-called puttable financial instrument, right? So when I have an obligation to pay you back money, whenever you ask money from me, isn't it a contractual obligation for me to pay cash? Then it should be classified as a financial liability. This is what the basic understanding is, correct? According to the concept of or definition of financial liability, right? However, Ind AS 32 provides an exception saying that certain puttable financial instrument can be classified as equity despite having the repayment obligation. Even though there is a contractual obligation to pay cash, even though it satisfies the definition of financial instrument, specifically Ind AS 32 gives an exception saying that still puttable financial instruments can be classified as equity. Now the question is why? Why is this exception required? Let's try to understand. See, normally any financial instrument redeemable at the option of the holder is a financial liability, correct? Because you don't know what he will do. He may ask you to redeem or he may ask you to convert. So therefore, there is always a chance of redemption. So he'll ask you for money. Therefore, I have an obligation to pay money. Therefore, it's a financial liability. But in certain cases, like mutual funds, cooperative societies, which means I'm not talking about normal companies. I'm not talking about normal companies. I'm talking about special organizations like mutual funds, cooperative societies, partnerships. The residual interest means what? In normal company, equity shareholders will have the residual interest in the net assets of the company. That is last preference. Residual interest in the entity is often structured as puttable instruments in these kind of companies. I'm not talking about usual organization, usual companies. I'm talking about these kind of special organizations like mutual funds, cooperative societies, and partnerships. Mostly it will be mutual funds, Nana. Actually, this concept is created because of mutual funds now. So the residual interest here, whoever has got residual interest in a mutual fund will be referred as puttable instruments, not equity shares, okay? Because these entities do not have traditional share capital like a company, ownership interest or redeemable on demand, but they still represent residual interest in net assets. We know that anything that represents residual interest in net assets according to the definition of equity instrument should be classified as equity, correct? Here also puttable financial instrument actually satisfies the definition of an equity instrument, because just like equity instruments, they also have a residual interest in the net asset. Having a residual interest in the net asset is just like an equity instrument. So to avoid misclassification of such ownership interest as liabilities, Ind AS 32 gives a specific exception saying that even though you have a contractual obligation to pay cash for the puttable financial instrument, whenever that guy comes back, the holder comes back and puts the instrument back, because they have a residual interest in the net assets of the company in case of special organizations like mutual funds, partnerships, and the so-called cooperative societies, let's classify this as a equity instrument. Of course, there are certain conditions for this exception. Remember this as a memory trick, Nana. Mnemonics, just like pick me in college now. Pick me in college now. So P M I N as well. Then you have C as well as N. So P M I C N. What are they? First condition: pro rata share of net assets. Pro rata share of net assets means obviously residual interest in the net assets at last. Most subordinated. Most subordinated means you should be having the least value. Now suppose suddenly winding up happens of a company, official death of a company happens, right? In that case, eventually what happens? First, money will be paid to financial institutions, the loans, the stuff like that, and after that government, then after that preference shareholders, after that anything is left out, then only for equity shareholders something will be given. So which means you are at the bottom of the table, correct? That's what we call most subordinated. Subordinated means you are at the bottom, right? Next, identical terms for all holders, okay? 1,000 people are having puttable financial instrument. Same conditions for all. Same terms for all. No other obligation to pay. First of all, there should be no obligation to classify that as an equity. If you have an obligation other than this, so there is only one obligation right now. What is that? Whenever the investor or the holder of the puttable financial instrument puts the instrument back, then of course you have to pay back cash. That obligation is already considered. Apart from this obligation, no other obligation should be there, because one more obligation is there, then it takes the character of financial liability. Then we cannot call it as a equity instrument, because now you are giving an exception despite having one obligation. Considering that obligation despite being a financial liability, Ind AS 32 provides an exception. Ask them to call that as an equity. Got it? Already one obligation is there where you can put the instrument back and get the money. Besides that, in addition to that, one more obligation should not be there. Next, cash flow dependent on the performance. Okay, fine. No other instrument restricts returns. Okay. So if these conditions are satisfied, which means the so-called puttable financial instruments are like equity, right? So no other instrument should be restricting the returns of the puttable financial instruments. In that case, if these conditions are satisfied, then you will be given an exception as per Ind AS 32. Even though you have an obligation to pay cash, whenever the holder of the instrument puts the instrument back and asks for cash, the company has got the obligation to pay it back. Despite that, it will be classified as an equity and not financial liability. That is a summary. Got it? Chalo, rest of the things are fine. That much is enough when it comes to revision session. Okay. Now we have the last concept, share swap arrangement. Once we are done with this, we are done with Ind AS 32. After that, we'll go to Ind AS 109. Okay. Let's look at this share swap arrangement. Share swap. Swap is nothing but exchange, Nana. I give you this, you give me something else. That's what we call it as swap. Interest rate swap means I give you fixed rate interest, you give me floating rate interest. I give you floating rate interest, you give me fixed rate interest. It is a swap. Swap means exchange. So share swap arrangement means you are exchanging the shares. A share swap is when two parties exchange shares instead of cash. I already gave you one example for fixed to fixed test. I don't know whether you remember or not. I try to sell my shares to you, and in return I buy your shares from me. Sorry, I buy your shares from you. Okay, so there are two companies. Okay, I am giving my shares to you, so which means I'm selling. If I sell, you have to give me consideration, right? Your consideration is your shares to me. So it's like a share swap. So PK Limited acquires SK Limited. Instead of paying money, PK Limited gives its own equity shares to the shareholders of SK Limited. We'll see this in business combination also, right? So Ind AS 32 logic is, in this kind of a scenario, is it a financial liability or equity instrument? That is the question. Always the fight is between financial liability and equity instrument. So many times we have seen so far. Okay. Now, suppose if shares issued by the acquirer means here who is acquiring whom? PK Limited is acquiring SK Limited. So from PK Limited's point of view, PK Limited is issuing shares, right? And if those shares which is issued by PK Limited to the shareholders of SK Limited gives residual interest in net assets, that's the quality of an equity share, right? Has no contractual obligation to deliver any other cash or other financial asset. Only issuing equity shares is the only thing, nothing else, no other obligation. And it is non-redeemable at holder's option. You can't redeem it. You understand the point? Once I give you, that's it, there ends the matter. So if these conditions are satisfied, then it will be classified as an equity instrument. The share swap arrangement, where I, PK Limited, give my shares as a consideration to the shareholders of your company, because shareholders of your company are the owners. So I'm basically buying your company. If I buy the company, I should buy it from whom? Owners. Who are the owners? Shareholders. So I'm giving consideration. By what? By my shares. So my shares as a currency. So I am buying your company. So if I need to buy your company, I need to buy from owners. Who are the owners of your company? Shareholders. So I have to give money to your shareholders, correct? How am I giving money? I'm not giving cash. Instead, I'm giving shares. Got it? Now, if I give shares like this to acquire your company, you understand the point, right? So in that case, I'm buying your shares also indirectly. So I'm owning your company, which means I'm buying your shares. That's how I own your company, correct? By buying your shares. I'm not giving cash. Instead, I'm giving shares of my company. So that's where share swap is happening. In this kind of a situation, the shares that I've issued to own your company, will it be classified as equity instrument or financial instrument? That's the question. It will be classified as equity instrument provided, except the shares that I gave you, no other contractual obligation exists for me. And the kind of shares that I've given will give residual interest in the net assets of my company to your shareholders, to whom I'm giving my shares. Got the point? And no other redeemable option, nothing is given. So there is no obligation to pay cash. In that case, it will be classified as equity instrument. Otherwise, if it is redeemable at the option of the holder, which means holder means what? Shareholders of your company. Got it? Or mandatorily after some time, or it involves some sort of fixed return, then it satisfies the definition of financial liability. Then those shares, even though the name is equity shares, it will be classified as equity. it will be classified as financial liability. I'll give you an example. See here. PK Limited acquires SK Limited. Okay, right. Instead of paying money, that is cash, PK Limited gives its own redeemable preference shares worth 10 crore. You got it? Not even equity shares, preference shares, redeemable preference shares. How much? 10 crores worth. These shares are redeemable after 5 years at a fixed amount, which means I'll pay back the money. Now tell me, suppose, so company PK Limited has contractual obligation to pay cash? Yes, because it is redeemable after 5 years. When the redemption happens, I have to pay cash. So therefore, these preference shares are not equity. They'll be classified as financial liability because you have a contractual obligation to pay cash because you have given redeemable preference shares. However, suppose PK Limited issued normal equity shares which are not redeemable. There is no fixed dividend, discretionary dividend. You understand the point? So if it is discretionary dividend, I don't have any contractual obligation, which means I satisfy all the conditions of an equity instrument. Then it will be classified as an equity instrument. Got the point? Again, the logic by PK sir, it's pretty simple, Nana. Form of the instrument called share is not enough, which means the name, just because you're calling it a share, doesn't mean that it should be classified as equity instrument. What matters is substance. Does it create an obligation to pay? In that case, even though it is called as a share, it will be classified as a financial liability. Suppose if it does not create any obligation to pay, then it will be classified as an equity instrument. Substance over form is what we have discussed so far. So with this, we are done with Ind AS 32 revision. Okay. In the next session, we'll go with Ind AS 109. Right? This is the major, most important part. Okay. But then, if you want to understand this in a perfect way, definitely we have to learn Ind AS 32 perfectly. Right? That's the foundation, and this is where we're gonna build a building. Okay. Right. Thank you, guys. All right, guys. Let's continue with the revision. So we are done with Ind AS 32. Now let's go with Ind AS 109. Now, Ind AS 109, typically it means your actual financial instruments chapter. Although we are done with Ind AS 32, that too we have covered a lot. But still, if somebody says financial instruments as a chapter, they by default mean Ind AS 109. Not Ind AS 32, not Ind AS 107. So that's the thing over here. All right, now let's start going. Different methods of accounting for financial instruments. Now, first of all, you know that Ind AS 109 is all about recognition and measurement. Now that we are already done with Ind AS 32, we know what is a financial instrument. We know what is a financial asset. We know what is a financial liability. We know what is an equity instrument. We know what is a compound financial instrument. So we basically know everything. We know buyback, so we pretty much know the definition what is puttable financial instrument, what is a, share swap arrangement. We have read lot of theory. Okay, we have covered a lot of theory. Now, so all the theory is done. Now it's time for us to actually recognize all these financial assets or financial liabilities or, okay, per se financial instruments and measure them as well. So recognize them means you guys know, okay, when you have to take it into your balance sheet and stuff, and measuring means at what value you have to take. That's what we're going to see. Now, different methods of accounting for financial instrument. What are they? Financial instruments, we know that typically we classify them into financial asset and financial liability. Now I can ask, what about equity instruments? That we will see later. Now, when it comes to financial asset, with respect to recognition and measurement, we have three methods: ACM, FVTPL, FVTOCI. Amortized cost method, fair value through profit and loss, fair value through other comprehensive income, right? And when it comes to financial liability, we have only two, ACM and FVTPL. You don't have FVTOCI here. Got the point? And that too, once we go to financial liability, you will see that 95% of the cases anyway will go with ACM by default. Only there will be certain special cases which we'll learn specifically. Only in those cases we'll be measuring the financial liability using FVTPL. Otherwise, by default, it goes with ACM. So when it comes to financial liability, it's pretty easy. By default, it's going to be ACM most of the times. Okay, nothing much to discuss over there. But when it comes to financial asset, that's not the case. It can be ACM, it can be FVTPL, it can be FVTOCI. This will be a lot more interesting. Therefore, we'll be spending a lot of time learning this not that much. By the time we finish this off, you'll be well versed with respect to all these methods. Then this will be a cakewalk, literally. Okay, of course, in this we'll be spending good amount of time to learn the special cases where your financial liability will be measured using FVTPL instead of ACM. That's it, right? Having said that, now let's see the methods first. Okay, see, there are different ways of covering this. Usually what people do is that straight away they discuss when it comes to financial asset, in what cases you'll measure it under ACM, in what cases you'll measure it under FVTPL, in what cases you'll measure it under FVTOCI. After that, they'll try to learn what is ACM, what is FVTPL, what is FVTOCI. But then what I feel is that first you need to learn the methods. What is ACM? What is FVTPL? What is FVTOCI? And then if we try to learn why you have to use ACM for financial asset measurement in a particular scenario, you'll be able to link it better, because now that you know what is ACM, you'll be able to understand it better instead of by hearting. So this is the right way of going through things. That's what I felt, and that's how we're gonna go in this revision session. Okay, chalo. Let's start with the first one. So what is the first one? We have amortized cost method. So what is this amortized cost method? All right, guys. The first thing is initial recognition. Okay, initial recognition when it comes to ACM method is always done at fair value. But the important point is transaction cost will be adjusted with fair value. So whatever the transaction cost that you have got, incidental expenses, it will be adjusted with fair value. Keep this in mind. Next, interest income or expenditure is measured using EIR. So why interest income or expenditure? It depends, because ACM method gets applied both in case of financial asset as well as financial liability. So depending upon whether it is financial asset or liability, it can be either interest income or interest expense. Therefore, whether it is interest income or interest expense, both the cases, ultimately it will be measured using effective interest rate. Is it something new for us? No, we have already seen it in Ind AS 23. I've already gave you an example and I've explained you over there. But since it's a revision session, you guys would not have an idea. But anyway, at a later point of time, we'll see. But at the end of the day, just have this idea. Effective interest rate means that is the real interest, what you're actually paying in case of financial liability, or what you're actually earning in case of financial asset. It has got nothing to do with the actual contractual cash flows. See, when it comes to each and every financial asset or financial liability, there will be two things. One will be the coupon rate of interest, which is like 10% debentures, 8% debentures, stuff like that. That is the contractual cash flows that you get. Either you get or you pay, whatever it is. That will be one. Apart from the coupon rate of interest, there will be something called the real interest that you either earn in case of financial asset or you pay in case of financial liability. That real interest, what you calculate, is nothing but effective interest rate. You got the point? What is that in detail? We'll try to learn. Right now, this much of understanding is enough. Right. So interest income or expense is measured using effective interest rate. Okay, measurement is covered here. Accounting is already covered in Ind AS 32. But anyway, we're going to discuss the whole thing here itself. Now, this is very important. No subsequent fair valuation on each balance sheet date. Why? Because the logic is very simple. Look at the name. What is the name? Amortized cost method. The name is cost, not fair value. So if it is fair value, yes, at each balance sheet date, at each reporting date, on every 31st, we'll be doing fair value remeasurement. And if there is any gain or loss, we'll be taking to P&L account or OCA, as the case may be. But here, the name itself says you that it is a cost method. Therefore, you will not be doing any fair valuation. You will not be doing any revaluation at each balance sheet date or each reporting date. So which means during initial recognition, first time you will calculate fair value. That's it. Now, the next question is how to calculate fair value. All these things we'll see. There is time for that. Right now, just remember. Step by step, we will learn. Okay, right now what you guys need to remember when it comes to ACM method, very simple. First of all, initial recognition will be done at fair value. Transaction cost will be adjusted with the fair value. First point. Second point, interest income or expenditure, as the case may be, depending upon financial asset or financial liability, it will be measured using EIR. What is that EIR? All those things we'll see. Already I gave you an idea. Next, no subsequent fair valuation whatsoever. Only one time you will do fair valuation. That is during day one, initial recognition. That's all. After that, you will not do any fair valuation. Why, sir? Because look at the name, sir. It is cost method, sir, not fair value. Clear? Now moving on to FVTPL. So what is FVTPL? Fair value through profit and loss. Here also, initial recognition will be done at fair value. Fantastic. What about transaction cost? Now this is very unique. This is very unique, and it is unique only to FVTPL. The transaction cost will not be adjusted with initial recognition of fair value. Instead, it will be taken to P&L account. Got it? Next, interest income or expenditure, as the case may be here also, because FVTPL comes for financial asset as well as for financial liability. Okay. Therefore, I've written interest income or expense is recognized directly in P&L at the coupon rate. EIR method need not be applied. In this case, there is no question of effective interest rate. Got it? Coupon rate means what? 10% debentures means that 10% is the coupon rate. You understand the point? That 10% is nothing but interest income or expenditure, as the case may be, depending upon financial asset or financial liability. Directly it will be taken to P&L. Unlike ACM method, you will not be calculating effective interest rate. Got it? Next. On balance sheet date, financial asset or financial liability, as the case may be fair valued, and the change in fair value which results in gain or loss will be transferred to P&L account. That's why the name is fair value through profit and loss. Got it? Okay. Again, it's pretty simple. First point, initial recognition will be done at fair value. Same like ACM method. But in ACM method, once you do initial recognition at fair value, transaction cost will be adjusted with the same. But here we won't be doing that. You got the point? Instead, the transaction cost will be transferred to P&L account. This is point number one. Point number two, whatever the interest income or expenditure that you're going to recognize directly in P&L will be the coupon rate, not the effective interest rate. Here we'll be going through effective interest rate. Okay, keep that in mind. Next, every balance sheet date, every reporting date, you'll be doing remeasurement at fair valuation, whether it is financial asset or financial liability, and any change in value will be directly taken to P&L. Why? Because the name itself is fair value through profit and loss. So any change in that will be taken to P&L account. There ends the matter. Got it? Right now, just know the procedure. That's all. Later, logics and all the other things we'll learn later. Okay, step by step we'll learn. At the beginning itself, we'll not be learning everything. Okay. Next, FVTOCI, fair value through other comprehensive income. Now, here it applies only for financial asset because already we have seen in case of financial liability, this does not come into picture, right? What is OCI? You guys know that statement of P&L has got two parts. One is P&L, the other one is OCI. Correct? This OCI basically accounts for all the unrealized gain or loss. It will go to OCI. Will not be considered for EPS valuation. This is basic idea which we know already. Now, initial recognition here also is done with fair value and it will be adjusted with transaction cost, which means this is exactly similar to ACM method. Correct? Next. In FVTOCI also, which applies only in case of financial assets, interest income, here there is no question of expenditure. Why? Because financial liability will not come. Interest income is measured using EIR as if ACM method is applied. So in other words, FVTOCI is a little bit of mix of your ACM as well as FVTPL. Okay. Where fair value will be in common with FVTPL, fair valuation, and ACM method will be in common with ACM. So which means when it comes to interest income measurement in case of FVTOCI, you will do exactly the way you will do as if ACM method is applied. In ACM method, what you will do? You will apply effective interest rate. Here also you will be doing the same. On balance sheet date, just like FVTPL, here also your financial asset will be fair valued and any change in fair value, gain or loss will be transferred to OCI. Exactly. Right? The accumulated gain or loss in OCI reserve may or may not be recycled to P&L account. It depends upon individual cases. May or may not recycled means whatever the so-called accumulated gain or loss that is there in OCI, again it will be recycled back to P&L in some cases. In some cases, you will not do it. In what cases you will do, in what cases you will not do, that we will see later. Okay, that's it. Now we'll see an example to understand what is EIR and all that. But before we get to that, let's summarize. Now, ACM method, initial recognition at fair value adjusted with transaction cost. Okay, all your interest income or expenditure depending upon financial asset or financial liability will be measured at EIR. What is EIR? Effective interest rate. Done. Then at each reporting date or balance sheet date, fair value measurement will not be done. Why? Because the name is cost. Next, FVTPL. In FVTPL also initial recognition will be done at fair value, of course, but transaction cost will be transferred to P&L account directly. Here, when it comes to interest income or expenditure recognition, it will be calculated using coupon rate, not EIR, and straight away that will be recognized in P&L account. Next, every balance sheet date on each reporting date, fair valuation will be done with respect to your financial asset or financial liability, and the change in fair value will be transferred to P&L account. Done. Coming on to last one, FVTOCI. Here name itself tells you that it applies only in case of financial asset, not financial liability. Okay. Here also initial recognition will be done at fair value and it will be adjusted with transaction cost. Fantastic. Here interest income only. There is no question of expenditure because this applies only for financial asset. Interest income will be measured using EIR as if ACM method is applied, which is amortized cost method. Clear? And at each balance sheet date, of course, fair valuation will be done on all changes in fair value, whether it is gain or loss, will be transferred to OCI. And from OCI, whatever the unrealized gain or loss that you have got may or may not be recycled back to P&L. In some cases, it will be. In some cases, it will not be. That's it. Are we done with this? Moving on. Let's look at the example so that you'll have an idea. All right, guys. Now, anyway, some of you are already wondering what is this effective interest rate. Let's have clarity now itself. A Limited issued 9% debentures of, so this is 100 each, that's fine, face value at 5% discount, okay. These debentures are redeemable after 3 years at par value, right, 3 years debentures. Show the accounting in the books of A Limited applying amortized cost method. Now, first thing you tell me, A Limited has issued debentures. Issued debentures means what? It has raised money. Tomorrow it has to pay. It has got a contractual obligation to pay interest, which is 9%, as well as it has to redeem after 3 years, which means in A Limited books, it's a financial asset or financial liability. It's a financial liability for sure. Right. Now, the next question is, when it comes to financial liability, you can measure it using ACM or FVTPL, correct? Here, specifically, it has been asked to follow ACM. So, we'll be following ACM, amortized cost method. Now, How to do this ACM? Pretty simple. Now observe carefully. Initially, they have issued 9% debentures at a face value of 100 but 5% discount, which means once they're given 5% discount, they'll be receiving money of how much? 95 only. So you received 95 rupees. Fine. Every year you have to pay 9%. This 9% is the coupon rate on the face value, which is 100 into 9%, 999. This will be cash outflow because it's a liability for you, contractual obligation to pay cash. We call this as contractual cash flows. We call this as contractual cash flows. And of course, at the end of third year, you have to redeem at pay value. You have to redeem at par value, which means you have to pay it back. Par value means 100 will be redeemed by 100 only, right? So 100 will be the cash outflow. So all these are, if you can see, especially this 999, these are all contractual cash flows. Hereafter, you'll be using this term only. These are all key terms. You have to use exactly these words only. That's how ICA also is using this kind of terms. So that's how you get good marks in exam. So please be careful. Don't use any words that you like to, So contractual cash flows, contractual cash flows, contractual cash flows. And this is coupon rate. Clear? Now, if you could observe, A Limited thinks that from his point, okay, from that company's point, the cost of raising this money is 9% for me because every year I pay 9% interest. But actually the cost is not 9% because you did not raise 100 rupees. You have raised only 95. You got the point? You did not get 100. Suppose you would have got 100. There is no discount. You have received 100, and on 100, if you are paying 9%, 9%, 9% every year, then in that case, your actual interest is also 9%. Fine. But did you get 100 rupees at the beginning? No, I've got 95 only. I've received 95 indirectly. So on 95, I'm paying 9% interest. Indirectly, the percentage is worked on 100, not on 95. So indirectly, I'm paying 9 rupees on 95, right? So which means the percentage of payment that I'm paying is more than 9%. The actual cost for me is more than 9%. It is not 9% because I did not get 100 rupees. I got only 95 rupees, whereas I'm paying 9% on 100. But in reality, I did not get 100. So my actual cost is more than 9%. What is that actual cost for you? That is nothing but effective interest rate. 99% of the cases, it will be given in the question. Okay, so need not worry about how to calculate all those things. Of course, it is just like your internal rate of return. Okay, what you have calculated in your CA Inter or CMA Inter, financial management. So it is similar to that. Okay, when the time comes, we will also do calculation. But right now, just understand that it will be anyway given in the question. Concept, I already explained you. That is the actual interest cost for you. The reason being, this 5 rupees, what you have lost here, this is also cost only enough for you. Because you did not get 100, you got only 95. That 5 rupees is also covered and converted into percentage and averaged for 3 years. That's how you've got the actual percentage as 11.048%, which is much higher than 9%. So even though your coupon rate, your contractual cash flow is 9%, your actual interest rate is how much, Nana? 11.048%, which will be given in the question. So don't worry. All right. Now let's coming on to accounting part. ACM method, we already know. Now recollect, just now we have studied. ACM method means initial recognition will be done at fair value. Fantastic. Now the question is, what will be your fair value? We'll look at that. How much did you receive, Nana? Money? At 5% discount, I have received only 95. So when you receive 95 on day one, what you will do? Bank account will be debited because I've got 95 rupees. Now this 95, is it free money for you? No, I have to pay it back. So it's a financial liability. Therefore, bank account debit to financial liability 95. Clear? All right. So this is your fair value as of today. Now what you have to do is that tomorrow when you repay after 3 years, you're not going to repay 95. You're actually going to repay how much? Par value, which is 100. So, but today you have recognized financial liability as 95 only. So what I have to do? Slowly I have to increase that 95 and ensure that it reaches 100. You understand the point? So that after 3 years, exactly I'll be paying 100 and my liability also in my book should show 100. Clear? How to do that? Very simple. First, you will recognize your actual interest. What is your actual interest? 11.048%. Okay, so what interest will do with respect to your liability? It will increase your liability because you are liable to pay interest. Therefore, debit interest expenses and increase your liability. How to increase your liability? Credit that. How will I get this 10.5? Very simple, 11.048% into multiply with that, you'll be getting. Got it? Where is my calci? Yeah, here it is. So 11.048% into 95. 10.49, 0.56, 10.5. Okay, this 95 into this percentage, you'll be getting your interest. So you've increased your liability, fine. Now you have actually paid cash. How much? 9%. 9% means 9 rupees you have paid. Once you have paid, to that extent your contractual obligation has got reduced, which means to that extent your liability should be reduced. How to reduce the liability? Debited. So financial liability debited because you have made payment to bank. This is your contractual cash flows. Are you able to understand? Like this, you will do for how many years? 3 years. except that initial recognition entry will not come, but these two entries will come for second year as well as third year. If you can see, carefully observe here, you have increased your financial liability by 10.5, whereas you have reduced your financial liability by 1. There is a net increase of 1.5, correct? Which means eventually the closing balance will be 96.5 at the end of first year. Like that, in second year also same thing will happen. Your effective interest rate 11.048% will increase your liability, and your contractual cash flows of 9% will reduce your liability. There will be a net increase again. And again in third year there will be a net increase, such that slowly this will become 100, and at the end of third year you will be paying back 100. So once you are paying back 100, your financial liability also in your book should show 100, right? That's why we are doing this. You understand the point? Now you should be able to understand why we have two things: effective interest rate percentage as well as coupon rate. This is for contractual cash flows. This is your actual interest rate. According to you, you know that this is your cost. Got it, Nana? Chalo. Now, this particular, the so-called ledger account will give you 100% clarity. Now, listen carefully. In the books of A Limited, obviously, financial liability, debentures, which method? ACM method. This is only for your understanding. While solving actual sums, we'll be preparing ACM table. We'll not be opening up ledger accounts, okay? It's a financial liability, so obviously we'll start on the credit side. Initially, you received 95 rupees. Bank, obviously, by bank 95. Now, effective interest rate of 11.048%, you'll be increasing your liability. So multiply with that, you get 10.5. Your liability has got increased. Then you actually pay cash. Once you pay cash, your liability should reduce. Therefore, you debit to the extent of cash that you paid. You got your closing balance, which has got slightly increased when compared to opening balance, 95 and 96.5. Now, this will again become opening balance. Again, increase it by 11.048%. Reduce it by 9%. Again, slightly when compared to opening balance, the closing balance will increase. Again, this will become opening balance of the last year. Again, increase it by 11.048% and decrease it by 9% along with the redeemable value, which is 100. Ultimately, it should tally. That's it. So usually what we'll do, this is only for your understanding. That's why I prepared the ledger account. This is what we will do while solving sums. So this is what you need to write in the exam. What is this? ACM table. Now, when it comes to ACM table, it's pretty simple. Your opening balance of the financial liability is 95. That much you have received. You add interest to the extent of EIR 11.048%. You add 9%. You reduce. You get your closing balance. Again, next year, same 11.048% add 9% less. 11.048% add 9% less than. Of course, in the last year, in addition to 9%, you'll be redeeming as well. That also will be added. That 100 rupees. Finally, it should automatically become 0. All right. So now that you know how this ACM methodology works, we have seen the entries as well. But here, for some problems, I'll just teach you some tricks. So you guys, let's focus on this. Now see here. Each year closing balance. This one is closing balance. Okay, first year closing balance. This is closing balance of second year. This is, of course, third year, you'll not have any closing balance. Each year closing balance represents discount or present value of remaining cash flows. Okay, what does it mean? For example, let's start with 96.5. This is the closing balance of first year, right? This represents present value of future cash flows. What are the future cash flows? 9 in the second year, 109, that is 9 plus 100 in third year. If you discount these two, it should match with 96.5. Similarly, the closing balance of second year, which is 98.16, is present value of future cash flow, which is 109. Similarly, first year, initially you can also count 95. Generally for 95, we will not be using it, but it's okay. 95, what are the future cash flows? You have 9 in this year itself. Then you have 9 in the second year. Then you have 9 plus 100 in the third year. All these three, if you discount, you'll be getting 95. Got the point? Anyways. So 95 represents present value of three remaining future cash flows, 99109. 96.5 basically represents present value of two remaining future cash flows, which is 9 and 109. 98.16 represents present value of one remaining cash flows, that is 109. I've already explained. Sir, why are you discussing this unnecessarily? There is a logic behind that. The closing balance of a financial asset or financial liability under ACM represents present value of future cash flows discounted at effective interest rate. This is very, very important while solving problems. Why, sir? Because there are certain problems. Here it is 3 years, so easily you have calculated 3 years by, building ACM table. But just imagine problems having 15 years, 20 years, 25 years. What you will do? In that, he'll specifically ask you, let's say, for example, if it is 15 years, he'll ask you last 2 years, last 3 years. What you will do? You'll prepare ACM table right from first year. That much time will not be available. That's where we'll be applying this trick. Okay, any year closing balance is equal to future cash flows. How much is there? You see, discount it at EIR, you'll get this value. Easy peasy. Got it? This trick really help you in solving sums. Are we done with this? Let's move on to the next question. Next example. Okay, now coming on to example 2. In example 1, we have seen financial liability, correct? In example 2, we'll be going with financial asset most probably. A Limited has advanced an amount of 1 lakh to B Limited. On 1st April, it has collected processing charges of 10,000. Okay. On the same day from B Limited, this loan carries an interest rate of 10%. This is your coupon rate. Contractual cash flows. Okay. The loan is repayable after 3 years at a premium of 5%. So show the accounting in the books of A Limited for all 3 years using ACM method. Now, first of all, it's a financial asset because I have a right, contractual right to receive cash flows, both interest as well as principal repayment. Now here you guys need to understand is that even though the contractual cash flows what you receive is 10% every single year on 1 lakh, which means basically 10,000, 10,000, 10,000. This is just the coupon rate, contractual cash flows. But the real interest is much higher than 10% what you're receiving. Why? Because initially you have eventually paid 1 lakh to him. So you think your cash outflows is 1 lakh, but no, because you have collected a processing fee from him of 10,000, which means your real cash outflow is only 90,000 because you have received 10,000, right? So on 90,000, he is paying you 10,000 interest. This is one thing, which means obviously it is greater than 10%. Not only that, after 3 years, he is not going to give you back just 1 lakh. He's going to give you back 1 lakh plus 5%. So you're getting extra 5% over here. On day 1, you have got extra 10% over here. Let's put it as 10,000, not convert that into percentage. So this 10,000 what you have got extra, plus this 5% what you are going to get extra, in addition to this 10% what you are getting every single year, put together, you convert that into percentage on an average for all the 3 years, it gets to 15.87%. This is what we call EIR, effective interest rate. Clear? Right. Now, how to do accounting? Very simple. First of all, your initial recognition will be what, Nana? 90,000 is the outflow. So therefore, to bank, 90,000, and you have to recognize financial asset, 90,000. There ends the matter. That's all. This is what you'll do at the beginning, correct? Chalo. After that, what will happen? Every year, 2 entries, Nana. One will be EIR entry, one will be contractual cash flows entry. EIR entry will be what? It means you need to receive 15.87% interest. You got to recognize interest income. So when you recognize interest income, your financial asset value should increase. So financial asset debit to interest income, correct? 15.87% into 90,000. Done. After that, what you will do? You'll be actually receiving contractual cash flows. Once you receive the cash flows, to that extent, your financial asset value should be reduced. Why? Because any asset represents future economic benefits. Once you realize the benefits, your asset value has to be reduced. Therefore, asset has to be created. Once you receive money, bank account will be debited. So bank account debit to financial asset. Got it? How much? 10,000, because that's what the coupon rate is. These two set of entries, you'll pass every single year for 3 years. Got it? Chalo. Now let's look at the books of A Limited, how this works. Loan receivable, obviously financial asset. We are applying ACM method. Opening balance 90,000, financial asset debit to bank. So financial asset debit to bank 90,000. Clear? Now you will increase it by 15.87%. You will reduce it by 10%. You'll get your closing balance. Again, increase it by 15.87%. Reduce it by 10,000. Because it is asset, increase will go on the debit side, reduction will come on the credit side. Exactly opposite to financial liability. Last year also, you'll increase it by 15.87%. You'll reduce it by 10% plus 1,05,000, which is principal repayment along with 5% premium. Done? So this is how your ACM table looks like. Same stuff only. 90,000, increase it by 15.87%, reduce it by 10%. Again, closing balance will become opening balance, increase it by 15.87%, reduce it by 10%. Increase it by 15.87%, reduce it by 10% plus 1,05,000, which is 1 lakh plus 5% premium. Automatically, it will become nil. Got this? Remember, your actual interest income or interest expense recognition, what you'll be putting using effective interest rate EIR is your actual interest according to you, the calculation. But the coupon rate will be the contractual cash flows. Got it? So always call coupon rate as contractual cash flows only. Always call EIR as interest income or interest expense depending upon whether it is financial asset or financial liability. Clear? Keep this in mind. Now this we already know. Closing balance under ACM method will always represent present value of future cash flows discounted at EIR. This already we have learnt in the earlier sum. Correct? All right. Now, if you look at the logic behind EIR, why did we take 15.87%? Yes, you see this. This is 15.87% plus 15. I told you this is the real interest. Okay, not the coupon rate. 15.87 plus 15.87 plus 15.87. 3 years, if you put together, total it comes around 45,000. Did you really receive 45,000? Yes. How? 10,000, 10,000, 10,000, 30,000 for 3 years. In addition to that, initially at the beginning process, we have received 10,000 at the beginning plus Premium of 5,000 I've received at the end of the year. So total put together exactly it will tally with 45,000. That is why even though he is formally paying you 10% interest, in reality you're getting 15.87% because your total benefit is not 10,000, 10,000, 10,000, 30,000 for 3 years. It is much more than that. That's why I gave you this proof so that you'll understand the logic. It is 45,000. How did I get this? 10,000 for 3 years plus I received 10,000 at the beginning. Processing fee, that is also income only, na? Because I charged him, I got the money. Plus 5,000 extra I'm getting. Here also 15,000 benefit. 10,000 plus 5,000 extra and 30,000 in the form of interest. Total benefit is 45,000. So if you exactly total this 15.87% for 3 years, it is 45,000. So we average it out and that's how we calculate this percentage. I hope now you should have an idea with respect to how EIR will be calculated. Okay, now we are done with examples, problems with respect to ACM method for financial liability and financial asset. Now let's go and learn FVTPL and FVTOCI in a single sum. You guys are ready? Now. On 1st May 2016, A Limited has purchased investment in shares of X Limited of rupees 40,000. Fine. Investment in shares you have purchased, which means you have invested. So it's a financial asset, right? The transaction cost paid is 2,000. Okay. The fair value of the shares on different days is as under. So 3 days. Why fair value is given? Because we need to measure at fair value. Obviously, you need fair value. 3 different days it's given. Okay. Show the accounting of investment account, which is a financial asset account. Financial asset account under FVTPL as well as FVTOCI. First, let's start with FVTPL. Now, tell me one thing. You have purchased investment in shares worth 40,000. What will be your entry? In FVTPL, we know that the transaction cost will directly go to P&L account. In FVTPL, the transaction cost will directly go to P&L account, which means it will not come inside the financial asset account. So therefore, your entry will be financial asset debit. How much? 40,000 to bank 40,000 only. And then separately, you will be writing transaction cost to bank 2,000 and then P&L account to transaction cost 2,000. So it will go to P&L account eventually. Got it? Right. So this is investment in shares, financial asset account, to bank 40,000. You got to bank 40,000. Here I've specifically written 2,000 will directly go to P&L account. Okay. After that, what will happen? Pretty simple. You need to remeasure the fair value at the end of each balance sheet date. How much is the fair value? 48,000. What is your asset value right now? 40,000. So you should increase it by 8,000. And that gain will be transferred to what? P&L account. Therefore, to P&L account 8,000. Your asset value is increased from 40 to 48 and that will be your closing value. Got it? Next. This closing balance will become opening balance. And again, you'll remeasure in the next year ending where your fair value is 45,000. If your fair value is 45,000, then you have got a loss and that loss also will go to P&L account. So by P&L account, which is loss on fair value 3,000, now your closing balance is 45,000. Again, next year opening balance will be 45,000. Next year closing balance should be 38,000. Again, fair value measurement. Again, there is a loss. The difference of 7,000 will go to P&L account. So by P&L account, within brackets, loss will go to, loss on fair value, it will go to P&L account. Anyways, got it? So it's pretty easy. You just recognize it at the beginning. Every year you do the fair valuation. If it is gain, then to P&L in case of financial asset. If it is loss, then by P&L. That's all. You take it to P&L account. That's all. As simple as that. Now, in case of FVTOCI, it's pretty much the same stuff except for the transaction cost treatment. So what you'll do initially, financial asset debit to bank, you'll be writing 42,000 and here you'll be recognizing the asset at 42,000 because when it comes to FVTOCI, your initial recognition will be done at fair value adjusted with transaction cost. Only in case of FVTPL, it will be taken to P&L account. This we have already seen. Just now I've taught you, right? Therefore, it is 42,000 instead of 40,000. After that, 42,000 is your value. Your fair valuation at the end of first year is 48,000. There is a gain and this gain will be transferred to OCA. So to OCA, that's it. Fair value gain. Now your new value is 48,000. Whereas in the second year ending, your fair value is 45,000. There is a loss which will be transferred to OCA reserve by OCA reserve. So in the place of P&L, it will be substituted by OCA. That's all. Everything else is same. Except for another difference. That is the first one, transaction cost treatment. Got it? Only two differences, transaction cost treatment and every year whatever the changes in fair value in FVTPL will be transferred to P&L account. In FVTOCI, it will be transferred to OCA reserve. Simple. Rest of the things are same. Got it? Okay. Now that we have learned what is ACM, what is FVTPL, what is FVTOCI and how to do it, how to account it as well, right? We have seen all the examples. Now, let's try to understand. First, we'll start with accounting for financial asset. It will take a lot of time. After that, we'll go and see accounting for financial liability. Accounting for financial asset only will take a lot of time. Because as I told you already, when it comes to accounting for financial liability, there are only two methods, ACM and FVTPL. And I told you 99% of the cases we by default will go with ACM. Only in some special cases we'll go for FVTPL measurement. Therefore, it will not take much of a time. But accounting for financial assets will take lot of time. That's what we're gonna see right now. Ready? Yeah. This will be very interesting. I want you guys 100% focus here. Now, accounting for financial asset, I'm gonna classify this into two broad categories. Okay, investment in equity. This particular financial asset will treat it separately, and all other financial assets will come under this particular section. Sir, what is special when it comes to investment in equity? I'll tell you. Always by default standard says you apply FVTPL. Why? Because when you invest in equity, it is just like you have invested in shares, right? And shares, there will be a lot of fluctuations. Every day it will fluctuate. Every month it will fluctuate. So standard thinks that it's better all these changes in fair value fluctuation should go to P&L account. Then only it will effectively show what is correctly happening. That's why standard by default recommends FVTPL. But however, sometimes certain companies, they invest in equity for a long term reason. For example, for 4 years, 5 years from now. In that 4 years or 5 years time, they don't want to, sell it. In that case, they feel that if this is my intention, FETPL method does not suit me because I don't want all these fluctuations to get into P&L account because I'm not doing trading, I'm doing investing. Therefore, I would rather prefer FVTOCI such that all the changes in fair value should go to OCI and it should not impact my P&L. In that case, standard gives you choice. You can choose to go for FVTOCI, but what standard says is that it is an irrevocable option, which means once you choose to go for FVTOCI, there is no going back. There is no going back. Is that clear? And tomorrow, if you feel that no, I'll try to again get back whatever the unrealized gain or loss that is there in OCA reserve, I'll try to get it back to P&L account by recycling. That is also not allowed. Logically only, because by default standard already allowed you FVTPL. You voluntarily said that I don't want FVTPL. I wanted to go for FVTOCA. Now after some time again, if you say that whatever that is there in OCA, the unrealized gain or loss, I want to recycle it to P&L account. Why would standard allow it? It will say no because it was your choice. You have chosen to go for it. Got it? So this is one thing, keep that in mind. All other financial assets will apply a different logic. Equity instruments is different. Okay, sorry, it's not equity instruments, investment in equity. Okay, now all other financial assets, purchase debentures, that's a financial asset. Loans given, you'll have a contractual right to receive interest and principal repayment, it's a financial asset. Bonds, trade receivables, fixed deposits, government securities, in all these cases, you have to apply two tests to decide which method you need to apply to measure these financial assets, because you have three choices: ACM, FVTPL, FVTOCI. So I'll make this very simple, so listen carefully. There are two tests for you. One is business model test, which means what is the purpose of having a financial asset. Second one is SPPI test. SPPI test means sole payments of principal and interest. Got it? So first let's start with business model test. Here in business model test, if you feel that so the purpose of the financial asset that I'm having, say for example, I've purchased debentures. Why did I purchase debentures? I want to keep these debentures with me for 5 years. Every single year I'll collect the interest, and after 5 years anyway he will redeem it. I'll take the redemption money and then I'll go. This is my intention, which means I will hold it till maturity. My purpose is to hold to collect the interest as well as principal repayment. If this is your intention, plus if you satisfy SPPA test, which means in addition to this, okay, your business model test is hold till maturity. Plus, if you satisfy SPPA test, means from this particular financial asset, I'm talking about debentures, sole payments of principal and interest should be there. Which means except interest and principal, nothing else should be there. No other cash flow should be there. Now tell me, in case of debentures, what I'm talking about, do I have interest? Yes. Do I have principal repayment? Yes. Other than these two, do I have anything else? No. So therefore, SPPA test is passed. At the same time, your business model test is hold to collect, which means hold till maturity. If these two tests are passed, you will apply ACM method. That is the first thing you need to understand. It's logical only because in ACM method, you don't need to revalue at fair value, right? And you don't need to do that in this case, because why would I measure it at fair value at each balance sheet date? Because my intention is to hold it till maturity. The purpose of having this financial asset, that is investment in debentures, is only to collect interest and principal repayment. That's all. It makes sense. Now, coming on to second one. Suppose your business model is hold to collect only. You want to collect interest, but you also say that in case if I get a good value for my debentures, then I'll sell it off. I don't have intention to sell it off, but in case if I get a good opportunity, I'll sell it off. Or if my financial position suddenly goes bad after 2 or 3 years and I'm in a liquidity crisis and I want money, in that case also I'll sell it off. So there is a chance of me selling off, although that's not my primary intention. Okay, then plus now you do SPPA test. That is satisfied. Okay, SPPA test is passed. but your primary intention is to hold it till maturity. But in case there is a need, I will sell also. In that case, apply FVTOCI. So this plus this, you will apply FVTOCI. This plus this, you will apply ACM. Apart from these two, no sir, my intention is trading purpose, speculation, and SPPI test is also not passed, sir. So which means whatever the cash flows that I get from this particular financial asset is not just principal and interest, I may get anything else as well. In that case, apply FVTPL. So if I have to simplify this, very easy. See, remember, hold to collect till maturity plus SPPI test, ACM. Hold to collect and you may say plus SPPI test, FVTOCI. Got it? Clear? Okay. So trading or speculative purpose, SPPI test is failed, sir. FVTPL. Right? Okay. Another important thing is, in this case, if you are applying FVTOCI, if there is any accumulated gain or loss which is unrealized, you can again recycle that to P&L account on derecognition of financial asset. Here you can do, which means whatever that is there in OCI reserve, that fair value changes, the gain or loss, you would have transferred to OCI reserve, if you apply FVTOCI. From there, you can again transfer it back to P&L account. You can recycle that back. You can reclassify that back. You understand the point? In this case, you can do that. Okay? Whereas here you can't do. In case of investment in equity, you can't do, because by default, India says that you go for FVTPL, but you have intentionally wanted to go for FVTOCI. Here you can't reclassify your so-called unrealized gain or loss or accumulated gain or loss that is there in OCI reserve. You can't reclassify it back to what? P&L account. Here it is not allowed because of the logical reason, obviously. Here it is allowed. Got it? Chalo. Next. Alright guys, let's continue with the revision session. In the earlier session, we have completed till here, right? We have seen, the different methods for measuring and recognizing your financial asset. We started with investment in equity separately. We discussed that by default, it will be FVTPL. If not the case, you have an irrevocable choice as per Ind AS 109 to go for FVTOCI. But once you do that, you can't come back. And moreover, you can't recycle the unrealized income, the gains or losses that has been, accumulated over a period of time in your OCA, right? After that, for all the other financial assets, we have seen that you have to do two tests. One is business model test and the other one is SPPI test, which is also called as contractual cash flow test. So in business model test, if you're going to hold till maturity plus you satisfy SPPI test, we'll go with the ACM. Hold till maturity plus if at all, if there is any necessity, you will sell it. Plus if you satisfy SPPI test, then we'll go for FVTOCI. If you are holding that particular financial asset for trading purpose or speculative purpose and eventually you don't satisfy the SPPI test, then we're going to go for FVTPL. That's what we have seen. A simplest way to remember that. Now, we're going to look into certain special cases. Now, each of these special cases typically comes as an adjustment with respect to the problems that we're going to solve in our ICA sources. Okay, right. So therefore, look at these as problems. Now, let's start with case 1. Case 1 is a stress case scenario. So what do you mean by stress case scenario? It is a scenario where, see, we are talking about accounting of financial asset right now. So financial asset means obviously investor has invested in it, right? He has invested his money in it and he has got a financial asset. Now here, let's try to understand what this story is all about. Stress case scenario. Say for example, there is an institutional investor, mutual fund. He holds corporate bonds. Okay, his intention is to hold it till maturity and also SPPI test is satisfied. Obviously, he'll be applying which method? ACM method. However, all of a sudden, there is a there is a liquidity crisis. Now, why this liquidity crisis has come into picture? There might be so many reasons, but let me put it this way, because the example that we have taken is mutual funds. I can tell you like this. Say, for example, in mutual funds, we'll have something called puttable financial instruments. And let's say there is some sort of a wrong news went into the economy that economy is going to slow down or something else, some wrong rumor with respect to the so-called mutual fund company. And as a result, all the so-called puttable financial instrument holders, whoever is there, majority of them has come back and started putting their instruments back. And it is the duty of the mutual fund to give them money, right? And that triggered a liquidity crisis, because for how many people all of a sudden you're gonna give your money back, because anyway it will be invested, right? So therefore, because of that liquidity crisis, they were forced to sell the so-called financial asset that they have initially purchased with an intention to hold it till maturity purely for the purpose of interest as well as principal repayment at the time of maturity. Now the question is, once they are about to sell this raises a red flag according to Ind AS 109. And there is a risk of Ind AS 109 asking you to reclassify this from ACM method to FVTPL or FVTOCI, because now that you have an intention to sell. However, The question that you need to ask yourself is it a one-time situation? Only this time because of the emergency of the so-called liquidity crisis, which is a stress case scenario, or are you trying to sell it? If it is just a one case scenario, one time scenario, that's okay. Ind AS 109 gives you exemption. You can just continue with your ACM. We will not be asking you to, shift from ACM to FVTOCI or FVTPL as the case may be. However, if there is a situation that you have been doing this frequently, but see, stress case scenario frequently will not happen, right? Mostly it will be a one case scenario. In that case, just disclose the reason, okay? And you can just continue with your ACM model. But if you have frequent or pattern of sales where many a times, even in the past also, you buy a financial asset, you say that you're going to hold it till maturity, you satisfy the SPPI test, then all of a sudden you'll tell some other reason and then you eventually try to sell it. If that sort of a frequent or pattern is there in the past, okay, where you are selling your financial asset, in that case, Ind AS 109 says you better reassess the business model. It doesn't seem like hold till maturity. And the remaining bonds that you have got, which you have sold right now, anyway, it is sold, so you must de-recognize, keep it aside. Other than this, other bonds are there, na? The other financial assets which you have got. You assess that and you probably shift it from ACM to FVTPL or FVTOCI as the case may be. Got the point? Right. So this is your first case. Moving on to second. If the risk of the investee has got increased, which means I have purchased debentures from a particular company. While I was purchasing the debentures, that particular company has got a market risk rate of, let's say 15%. So it was giving debentures at 15%. So I accepted 15% and I invested. I purchased the debentures. Now, after 2 years, all of a sudden, the risk of the so-called company whose debentures that I've purchased has got increased. Now, once the risk has got increased, what does it mean? It means that whatever the return that it has committed to pay, that 15%, is no more, sufficient for me, correct? And moreover, when the risk increases, naturally, the market value, the market price of the so-called bonds in the external market will eventually fall down. As a result, what this particular company does is that they sold their investment. Now, once you have sold their investment, then immediately you cannot come out with an argument saying that initially you said that you will be holding it till maturity, and also because SPPI test is satisfied, that is the reason we allowed ACM method. Now all of a sudden you are trying to sell, therefore it is something wrong like that and all. You can't say. Standard says there is no problem because it is not a contradiction of business model. Because the investor's risk has got increased, there is no meaning in holding it till maturity because eventually you'll be facing loss. Okay. So there is no logic in holding something knowing that you're gonna eventually face loss. So it's a correct thing to what? Sell it off. And that doesn't mean that your business model has got changed. Your business model, your thought process did not change. The one whose so-called debentures that you have purchased, in the sense we are talking about the investee, his so-called financial position has got deteriorated, and as a result you are forced to sell that. And that's how you do business. You don't do business thinking that no, I can't change my business model. Even though I'm going to face loss, I'll keep it like that. Like that, nobody does business. Got it? That's case 2. Case 3. Every year, you're selling insignificant number of bonds. Say, for example, you've got 1 lakh bonds. Some 100, you'll be selling every single year. Why? Only to prove that there is liquidity with respect to the so-called bond that you're holding as an investment. To prove the liquidity, you're just selling some 100 units, 50 units out of 1 lakh units that you've got. In that case, that selling is not wrong. To prove that your investment has got liquidity, there is nothing wrong in that. So it is not a violation of business model. So all these things, what you are trying to understand each and every case, so far we have seen 3 cases, is all about whether you are violating the business model or not. Anyway, SPPI test is satisfied. Business model, whenever you have chosen ACM method, it means that you're gonna hold it till maturity. In all these 3 cases, in first case also you are about to sell it, you have sold it eventually. Second case also you have sold it. Third case also you have sold it. But for that, the reasons are really genuine. In first case, it was a stress case scenario, so you're forced to sell. Otherwise, you can't survive. In second case, the risk of the investee company from whom you have purchased the debentures, their risk has got increased. As a result, your market value of the bond or debenture will fall down. As a result, you are forced to sell. Here also, there is no, your mistake is not there. In third case also, you're just selling some insignificant, like 1% of your debentures, only to prove that the so-called investment that you're holding, the financial asset, is liquid enough. Here also, there is nothing wrong. So therefore, in all these 3 cases, your Ind AS 109 says that there is no problem here. Still, your business model test is clear. No problem. If the business model test is failed, then Ind AS 109 will force you to reclassify. There is a concept called reclassification of financial asset as well. We'll see that later. Reclassification means whatever the existing business model that you've got is no more holding good because you have lied about your business model, or eventually your business model has got changed, and as a result you will be forced to reclassify from ACM to FVTPL or FVTOCI. Got it? Chalo. 3 cases are done. Now let's come to case number 4. Now looking on to case 4, Nana. Okay, now see here. We have already told that to decide which model we need to apply, which method we need to apply when it comes to financial asset, whether it is FVTPL or FVTOCI or ACM, we have to do 2 tests. One is business model test and the other one is SPPI test. In that, SPPI means what? Sole payments of principal and interest. Now here you need to understand one thing. Sole payment of principal and interest means, say for example, if I buy debenture of a particular company as an investor, then why would I buy anything? Provided if my risk expectation and the return what that particular company is offering me in the form of interest from that so-called debenture, if it matches, then only I will buy. Simple logic, correct? My return and the risk has to match, right? Now, here, basically this interest, whatever you are paying, say for example, I'm just taking an example of debentures, will actually compensate 2 things. Okay, one is time value of money, the other one is compensation for the risk taken. Time value of money means it's a risk-free rate. Risk-free rate is nothing but, let us put it this way, because it's a long discussion actually. But to put it in a simple way, any investment that you do in this particular country where there is zero risk, then minimum you should get risk-free rate of return. Got it? Generally, RBI bonds will have that. Sometimes it will be 4%, sometimes it will be 5%, sometimes it will be 6%. Let's, for example purpose, let's say risk-free rate of return is 6%. Then you invest in any company, okay, minimum it should pay 6%, provided if its risk is 0. But you guys know that no company's risk is 0. Got it? Let's say their risk is 10%. Then in that case, for this 10% risk, they have to provide you 10% return, plus base return is risk-free return, 6% they have to provide. Totally, they have to provide you 16%. This much of understanding is enough right now. Once I start discussing this, it alone will take at least 15 to 20 minutes. Since it's a revision session, we don't have that sort of luxury. Okay, so all you need to understand is that always the so-called interest that we get when we invest in debentures or bonds has to compensate 2 factors. One is minimum risk-free rate of return plus risk premium. Risk premium is nothing but I'm taking additional risk by investing in your company when compared to RBI bonds, where in RBI bonds I'll be having 0 risk. Still RBI bonds is paying me 6%, whereas in your company that is not the case. You are having more risk when compared to the RBI bonds. So pay me minimum what RBI bonds pays me, plus in addition to RBI bonds, how much is the extra risk your company is carrying? To that extent, give me additional compensation as well. For additional risk, the additional compensation that I get is nothing but risk premium. Got it? Now, let's say there is a company called PK Limited. Its risk appetite is 18%, which means if it gives 18%, I'll be ready to invest in that particular company. That is the logic. So AK gave loan to so-called PK Limited at 15% itself. How is that possible when the risk appetite is 18%? Why would somebody give at a lesser rate of interest? It doesn't make any sense. There is a logic for that. What is that logic? He gave loan at 15%, which is less than the bare minimum risk appetite of this particular company. Why? Because eventually it will be converted into 1000 equity shares. So AK thought, whatever that I'm losing here, the so-called 3%, I'll be compensating myself by way of equity shares. You understand the point? Now tell me one thing, in this kind of a situation, AK is the investor. So therefore, AK has got the financial asset because it gave loan to PK Limited. So it will have contractual right to receive cash flows, right? So AK has got financial asset, which is nothing but loan given to PK Limited. Now tell me, this so-called loan, does it satisfy SPPI test? No. SPPI test means sole payment of principal and interest. So you should be getting interest from PK Limited. You should be getting principal repayment from PPA Limited. That's all. But here, in addition to that, you're getting equity shares as well. So which means something in addition to SPPI you're getting. You got it? Which means SPPI test is failed. Once SPPI test is failed, automatically ACM method will not work. FVTOCI also will not work. You have only one choice, FVTPL, you got to apply. You got it? So loan at 15% to PK Limited at the end of year 3 have option to choose either 1 lakh redemption or 1000 shares. Therefore, SPPI test is failed. Why? Because in SPPI test, it should be only interest and principal repayment and nothing else should be there in addition to these two. But here, obviously, you have equity shares. So therefore, FVTPL will apply because once SPPI test is failed, automatically your ACM is gone, automatically your FVTOCI is also gone. Because for ACM, it has to be holding till maturity plus SPPI test. For so-called FVTOCI, it is hold till maturity or may sell plus SPPI test. So whether it is ACM or FVTOCI, the common point is SPPI test should be satisfied. The only case where SPPI test failed means you have only one option, that is you have to go for FVTPL method to recognize and measure your so-called financial asset. So here you have extra equity shares, right? Also interest of 15% is tainted low interest, which I call it as corrupted interest. Okay, it's not genuine interest, which should actually compensate the risk appetite of the so-called company. Due to equity shares conversion option only, you have agreed for lower rate of interest. Got the point? Therefore SPPI test is failed, and as a result you have to, so it is like an invisible equity option over here, right? Even though invisible, I mean whatever that is visible is only interest as well as loan, repayment, but then invisible option is there. Invisible equity element is what we call this, and as a result your so-called SPPI test failed, and as a result FVTPL will apply. Now moving on to case 5. Here loan is being given to PK Limited, okay, where PK Limited agreed to pay 3% of EBIT to investor, which means 3% of EBIT if you are paying to investor, which means your investor is getting something other than interest as well as principal repayment, correct? Which means SPPI test is failed. SPPI test is failed, you have only one option, you have to go for FVTPL, because you can't apply FVTOCI, you can't apply ACM. Moving on to case 6. Loan to PK Limited, okay, where PK Limited agreed to pay variable interest based on LIBOR plus 4%. That's fine, because LIBOR plus 4% based on that paying interest is a common practice. In fact, that is the right practice actually, especially when there is a floating rate of interest. You got the point? London interbank, exchange rate, that is. Anyways, if 4% is good compensation for the additional risk, then SPPI test is passed. There is no problem. Okay, interest can be either fixed or it can be floating rate. Okay, so absolutely fine, there is no problem over here. So your SPPI test is passed, which means either you can apply ACM or you can apply FVTOCI depending upon your business model, whether it is hold till maturity or hold till maturity plus you may sell. Moving on to case 7. Loan to PK Limited, okay, where PK Limited pays interest based on inflation rate. This is also fine. Interest normally should be paid based on inflation rate only, right? You get it? So that's obvious. SPPI test is passed in this case as well. No worries. Coming on to case 8. Now to understand this case 8, first of all, you should know what is securitization. I'll try to, explain this in a very short way so that whatever that's necessary for us right now, we'll try to understand. And after that only you'll be able to understand what I'm trying to explain here, the context. Okay, right. Now moving on with this, first try to understand how securitization works. There is a housing finance, company like ICA here. What it usually does is that it gives house loans, okay? And obviously, if housing loans are given to customers, you'll be having housing loan receivables asset in your balance sheet. But the problem is, you guys know that housing loan, it takes like 15 years, 20 years, 25 years, 30 years and stuff like that. So obviously, this particular so-called ICICI Housing Finance wants to convert this into liquid, in the sense it just wants cash, okay, upfront cash. So then what it does is that it finds somebody called SPV, a special purpose vehicle, who is experts in dealing with these kind of things, and it gives this pool of loans, okay, to this particular SPV. The intention behind giving this to SPV is to convert that into cash, that's all, which means in return SPV will pay cash. Now the biggest question is how SPV will get money all of a sudden to pay cash. What SPV does is that based on these pool of loans as a base, upon this SPV will issue bonds to cash rich companies. There are certain companies called cash rich companies like insurance company, mutual funds, provident fund, pension funds. These guys will have lot of idle cash. So this SPV will issue bonds which is backed by these so-called loan assets, loan receivable assets, saying that you invest in these bonds, I'll give you so much of return. Naturally, these guys will give money, and immediately that money will be paid to the so-called ICICI Housing Finance. And as a result, ICICI Housing Finance, work is done. It has got upfront cash. Usually this ICICI Housing Finance will also be referred as originator, because that's where everything starts, right? And then what will happen? These customers will pay the installment amount to SPV hereafter. And from that SPV will receive money, something it will keep, and rest will be given to so-called investors who have invested in bonds on SPV. This is how the whole thing works. I just try to simplify this as much as possible. Beyond this, that's not necessary right now. So now, in what way that is related to the financial assets that we are discussing right now is that, let's look at the books of ICICI. In ICICI books, The so-called loan receivables, all these are financial assets, right? Yes, financial assets. Now, when you have financial assets, you need to find a suitable method to recognize and measure it. Yes. How many options are available? You have FVTPL, FVTOCI, ACM. Now here, what is the intention? As long as the loan receivables are there in the books of ICICI, what is the intention of ICICI? It wants to sell it. So it wants to sell it, then in that case, it has to be measured at FVTPL because your intention is to sell it. Got it? Right. Now, what about books of SPV? Once it is sold, then these loan will come to the books of SPV. What is the intention of SPV? SPV will hold the so-called loan receivables till the end of its term. If the housing loan term is, say, for example, 15 years, it will hold till 15 years. It will keep on collecting the installments from the customers. You got the point? Which means in SPV books, the same housing loan receivables should be measured using what method? ACM, naturally. Why? Because his business model is hold till maturity. Are you able to understand? To understand this only, we try to understand what securitization is. So in the books of originator, you have to recognize the so-called housing loan receivables following FVTPL, whereas in the till it is sold only you have to recognize. Once it is transferred, then after that nothing is there here to recognize also. After that, once it is sold to SPV, in SPV's books, the same housing loan receivables will be recorded using ACM because it satisfies the business model test of hold till maturity. Done. Now, in some case, let's say this ICICI and SPV, the special purpose vehicle, both these guys are a single group like parent and subsidiary. In that case, from group point of view, you can apply ACM method. Why? Because within the group, you are selling to somebody else, right? It is not going outside the group. In that case, your actual intention is hold till maturity from group point of view. From group point of view. And as a result, you can apply ACM from group point of view in those financial statements, group financial statements. Okay. Chalo. Moving on to case 9. An entity can hold different financial assets with different objectives. Obviously, loan given to employees, generally your business model will be hold till maturity. Why? You have given loan to employees at a concessional rate, not the market rate of interest, until they pay. You will just keep it like that. You will not be selling those to somebody else, right? So therefore, hold till maturity, you'll apply ACM. Investment in bonds, generally your intention whenever you invest in bonds is that, okay, I've invested in bonds, I'll get interest whenever in the market, if there is a good price for the bonds, then I'll try to sell. In that case, you have an objective to sell, plus you want to hold it till maturity, you can apply FVTOCI. Got it? Or if it is highly liquid bonds and you have purchased it purely for trading or speculative purpose, you can apply FVTPL as well. So different financial assets can satisfy different business model test and SPPI test. Accordingly, you can apply FVTOCI or FVTPL or ACM method. This is what you need to understand from case 9. Now coming on to most important case from problems perspective, that is staff loans, that is loans given to your employees. Now this is very, very, very important, Nana. Okay. Okay, Nana. Now coming on to staff loans, this is very important, so listen carefully. Often these staff loans are provided at concessional interest rates or sometimes even zero, which means, let's say in market the interest rate usually for a 1 lakh loan is suppose 10%. What the companies will do is that I have to give some sort of benefit to my employee. So usually what they do is that I'll give it to you at 5% interest or 4% or sometimes 0% interest as well. Okay. Which means interest is charged below the market rate, obviously. So this makes them a financial asset below market terms and therefore special accounting treatment is required. Suppose you gave a staff loan to your employee at just the market rate, then no problem. First of all, special accounting treatment is not at all needed. Why this need arises? Basically because you are giving them some sort of benefit by way of giving the so-called loans at corrupted interest rate. Corrupted interest rate means I mean to say it is not a market interest rate, as simple as that. So because of this, there are certain challenges. What are they? Let's try to understand from this example. Suppose PK Limited gave loan of 1 lakh to their employee for 3 years, okay, at how much? 2% per annum. Whereas in market, usually that 1 lakh is given at 10% per annum. Okay, in this case, what happens is that initially, obviously, we will be doing all these things from company's point of view, not from employee's perspective, obviously, right? So from company's point of view, there is an outflow of 1 lakh because I gave a loan on year 0. 2% he will pay, which means 2000, 2000, 2000 he'll pay. After, at the end of third year, he'll be paying my loan back. That is principal amount, which is how much? 1 lakh. Everything sounds fine. But the problem is, because the market interest rate is 10% and you have a corrupted interest rate of 2%, you cannot show your financial asset as 1 lakh. Why? Because in reality, you did not give 1 lakh at 10% interest rate. You gave 1 lakh at 2% interest rate. So I cannot show this 1 lakh as my asset, financial asset, which is wrong. So indirectly you'll not be showing your financial statements at true and fair view. Okay, your financial statements will not be reflecting true and fair view either way. So now the point is, what Ind AS 109 says is that, these are all the cash flows, contractual cash flows that you're getting. So you discount these cash flows at market interest rate. Now the question is, why did Ind AS 109 ask you to discount these cash flows at market interest rate, which is 10%? Only if you discount at 10%, then as if you have given some amount of loan at 10%, then how much you'll be getting, it's kind of a reverse working. So if you discount these contractual cash flows at 10%, you'll get some number. In this case, we got 80,105. This 80,105, what does it represent? In real terms, if I gave 80,000 rupees of loan to my employee at 10% interest, then this is what will happen. You understand the point? In reality, did I give 80,000 loan? No, I gave 1 lakh loan, but I gave it at a tainted interest rate or corrupted interest rate. So therefore, if I give 1 lakh loan at a corrupted interest rate of 2%, I cannot show in my balance sheet saying that I have a contractual cash flows, I have a financial asset at 1 lakh. Wrong, because your 1 lakh financial asset is given at a tainted interest rate. I want that particular amount which is at market interest rate. So the answer is not 1 lakh, it is 80,000. Now can I show 80,000 as my financial asset? Yes, I can, because that 80,000 is at market interest rate, which is 10%. Are you able to understand? Therefore, whenever you give staff loans at a corrupted or tainted interest rate, you need to discount it at market interest rate. What you have to discount? The so-called contractual cash flows. Contractual cash flows means you already have an idea. You discount it at market interest rate, then you'll find a number. That is the real amount that you can show in your balance sheet. Because you can't show an amount which you have given at a corrupted interest rate. You understand the point? If you allow this, then everybody will start doing like this. On the back door, they'll have something. You understand what I'm trying to say? That's why Ind AS comes with these kind of rules. Anyways. So what do you do here? 2000, 2000, 2000. It's annuity, obviously. You multiply that with present value annuity factor or cumulative discount rate for 3 years. That is nothing but 1 divided by 1.10 equals to grand total. Correct? And then in the last year, obviously, you'll be getting principal repayment 1 lakh. This is third year interest rate. So 1 divided by 1.10 equals to. That's all. Automatically, you'll be getting 0.75131. You get your number. Got it? Chalo. That's it. Now, here there are 2 points you have to remember. Scenario and accounting treatment. If you gave loan to your staff with 0 conditions, then the difference between the so-called fair value of the loan, which means the real value of the loan, what it should be, versus the actual value, what you have given, the contractual cash outflow, the difference between these two should be immediately recognized in P&L account as expense. What expense? Employee benefit expense, because you gave it as a benefit to employee only. So employee benefit expense is the name, simple. Which one? The difference between fair value of the loan and the actual contractual cash outflow, which is 1 lakh. Got it? Whereas, suppose you gave the loan to your staff with a condition saying that, here you gave a loan for 3 years. You told your staff that I gave a loan to you at a concessional interest rate for 3 years. So you better stay in my company for 3 years. If you leave the company and go in the middle, then you have to repay the loan immediately on the spot. Then in that case, you gave a loan with a future service condition, correct? In that case, the difference between the fair value of the loan and the actual contractual cash outflow of the loan which you have given will be treated as an asset. What asset? Prepaid staff cost asset, which will be amortized over the period of the loan using SLM method. Got the point? Sir, why it is treated as an asset, sir? What is the logic behind that? You will try to understand. See, if you just apply your common sense, you'll be able to understand that indirectly this is the benefit that we are giving to the employee, right? Actually, I should be giving loan at 10% in percentage terms, whereas I gave the loan at 2%. In other words, I should be giving only 80,000 loan to the employee, but I gave 1 lakh loan to the employee. Giving 80,000 loan at 10% is equal to giving 1 lakh loan at 2%. Again, I repeat, giving 80,000 loan at 10% is equal to giving 1 lakh loan at 2%. You understand the point? That's the way it works. So actually, I should be giving only 80,000 loan to my employee at 10%. Whereas I gave 1 lakh loan to the employee, which means that 20,000 is a kind of employee cost for me. But because in scenario 2, the employee will be doing service in future, because that's a condition that I've inserted, indirectly it's like an asset for me. So this benefit I'm giving to the employee, in return employee will be giving me service as well. So I treat it as an asset. As and when I get the service, 1 year service is done. Okay, to that extent, out of this particular asset, 1/3 will be taken to the P&L account as an expenditure. Second year, employee has stayed in the company and given the service. Then that particular portion will be taken to P&L account from this prepaid staff cost asset. Third year also, that portion will be taken to P&L account. You understand the point? That's the way it works. Right. So the entry will be pretty simple. Staff loan account debit. It's a financial asset at fair value, obviously. To bank, the contractual cash outflow, what you have paid actually. The difference between these two, depending upon whether it is scenario 1 or scenario 2, will be either treated as an expenditure, which will be recognized in the P&L account on the first year itself, or it will be treated as prepaid staff cost, which is an asset and will be amortized over the remaining, whatever the loan term period is going to be. In this case, it is 3 years. So divided by 3, that's all. SLM basis. Every year, equivalent amount will be taken to the P&L account. That's what we call it as amortization. Okay. But understand one thing, 90% of the question, 95% of the question will be based on this only, where the difference will be treated as prepaid staff cost in the form of an asset. Got it? Chalo. Okay. Okay, Nana, here I have put this in a specific box. Okay. Why is that? Is because one student has asked me a doubt. For him, I have made this much of content actually. Okay, all credit goes to the student. So the doubt that he has asked is, he got confused with respect to the counterparty. What do you mean by that, sir? Whatever that we are studying right now, especially we are in case 10, right? Here, the counterparty, see, one party is obviously the company, the other party is employee, correct? But if the counterparty is not employee, then the situation will be different. This particular box is about that particular situation. If you can see here, this applies when counterparty is market participant and not employee. Clear? Okay, and I've written here specifically something called day one difference. What is day one difference? It's the difference between the fair value as well as the contractual cash outflow. For example, here you see, what is the fair value? 80,105. What is the contractual cash outflow of the loan? 1 lakh. Correct? Huh? The difference between these two is nothing but day one difference, because on day one only, you'll pass this entry. This is day one difference. Okay. The day one difference with respect to employees, you will treat it in a different way. The same day one difference, if the other party is not employee and if it is a market participant, then you will treat it in a different way. A little bit of difference in treatment will come. So between these two counterparties, you should not get confused. Whatever that we are discussing so far is only when the counterparty whom the company is dealing with is an employee. If the counterparty is not an employee and he is a market participant other than employee, then this is what you will do. What is that I'll do, sir? Very simple. The transaction price, that is price agreed between the parties, differs from the fair value, that is determined independently by using level 1 inputs as per Ind AS 113 fair value measurement. Okay, that difference is nothing but day one difference, correct? Here also this 19,895 is day one difference. Okay, what you will do with day one difference is, if the counterparty is employee, we have already discussed what to do with the day one difference. If the loan is given with no condition, you will immediately recognize that in P&L account as employee benefit expenses in the first year itself. If the loan is tied up to some future service, mostly it will be what? Time period. Okay, service period. Another 3 years, another 5 years, another 7 years, something like that. In that case, you will treat it as a prepaid staff cost, which is an asset, and the asset will be amortized using SLM method over a period of the loan term, correct? Whereas, if the counterparty is a market participant, then what you will do with the day one difference? Again, the day one difference concept is the same. It's the difference between fair value versus the actual transaction value. Here also transaction value is 1 lakh only, na? In the transaction, you actually paid 1 lakh, whereas the fair value of that 1 lakh is 80,105. Got the point? Same stuff here as well. Now the question is, how did you calculate that fair value? That is a basic question. Sir, I've calculated fair value as per level 1 inputs as per Ind AS 113, which is mostly quoted market price of the asset. If that is the case, then it means your fair value is highly trustworthy, which means whatever the fair value that you have calculated is the best fair value. In that case, Ind AS 109 says that I trust that fair value a lot. Therefore, the difference between fair value and the transaction value, in our case, it is 19,895. You just straight away take it to P&L account because I trust the fair value a lot. Why? Because it is calculated based on level 1 input as per Ind AS 113, which is fair value measurement Ind AS. However, if level 1 input is not, there are so many inputs now, level 2, level 3 as well. As and when you go down, the trustworthiness on the fair value will come down. Okay. So if no level 1 input is used, then recognize the difference as an asset if appropriate, or else transfer to P&L immediately. So here in this case, if the day one difference is based on level 1 input, which usually is quoted market price of the asset, in that case immediately recognize that in P&L. If that is not the case, and if the fair value is calculated based on level 2 or level 3 input, in that case treat the difference as an asset. If that is not possible, then only transfer it to P&L account. Got it? In the above staff loan case, the fair value of 80,105 is not based on level 1 input here also, correct? And therefore, the gap of 19,895 may be recognized as prepaid staff cost and will be expensed out in the form of amortization over a period of the loan. Got the point? Of course, if there is no future condition with respect to the loan, in that case, you will immediately recognize that in P&L account. Got it? Chalo. Now, so this is your first entry, day one entry. After that, what you will do? Simple stuff. Because anyway, you will be applying ACM method, na? Amortized cost method. So what you will do? Very simple. First, you will recognize the interest. Here it's a financial asset, so we'll recognize interest income. What interest income? Based on market rate of interest, not the corrupted rate of interest. Okay, market rate of interest is how much? 10%. So to that 10%, recognize the interest income. So once you recognize the interest income, automatically your financial asset value should increase. Therefore, debit the staff loan account to interest income at 10%. So 80,105 into 10%. You got this? So increase the value of the financial asset. After that, anyway, you'll be receiving the actual contractual cash flows, which is nothing but interest you'll receive now, which is 2%. Once you receive the interest, to that extent, your financial asset value has to come down. Because always remember, asset represents future economic benefits. When you start realizing those benefits, asset value will come down. Okay. Now, so to the extent of 2000, you have to credit the asset because asset value has to come down, and you'll be debiting what? Bank account, because you're receiving money, obviously. Besides these two entries, which is common entries when it comes to ACM, you will have one additional entry, which is nothing but amortization of staff cost. What is that amortization? Already prepaid staff cost is there, na, which is an asset. This asset value has to be reduced now because you want to amortize and on straight line basis, because in this case it is for 3 years. Therefore 19,895 divided by 3. Each year 1/3 will be taken to what? P&L account, correct? Hello, yes, everybody. All right. So 19,895 divided by 3. How much you get? 6632. That much will be taken to P&L account. So what will be your entry naturally? You have to reduce the asset value. So two prepaid staff cost, and you need to debit staff cost. Sir, why staff cost, sir? You should be taking to P&L account. Now, yes, the name of that expenditure is staff cost. From there, it will be taken to P&L account only. Next entry will be P&L account debit to staff cost. P&L account debit to staff cost. Got it? Right. Now, so first year entry will be like this, Nanasir. Your opening balance of the financial asset will be 80,105. For that, you will add 8,011, which is nothing but the so-called imaginary interest, right? Which is 10%. And then you will reduce the receipt of contractual cash flows. Got it? This has got nothing to do with your balance of the financial asset. Okay. So you'll be getting 86,116, and this will become again opening balance 86,116. Again, you will add 10%, you'll reduce 2%. Again, you'll get next number. Again, you will add 10%, you'll reduce 2%. Plus, you will also be getting your principal back. Automatically, it will become 0. So this is just an additional entry only in case of staff loan. Because when it comes to ACM method, you already know that there will be two types of interest. One will be the actual interest, the real interest according to our calculation. The other one will be the contractual cash flow interest or coupon rate, correct? So apart from these two entries, obviously you will have one additional entry only in case of staff loan. That way, if you remember, it will be very easy for you, okay? Which is nothing but amortization of prepaid staff cost. Are we done with this? Chalo, moving on. Right now, moving on. So now that we are done with the so-called staff loans, okay, we have also seen how to pass the entry, how to do the accounting as well. Logically speaking, instead of this, you can also prepare ACM table. That way also it will work. Except that in ACM table, this will not come. Amortization of staff cost will not come. You already have an idea, right? We have already seen that accounting. In ACM table, what will happen? Say, for example, how many years we have got? 3 years. So let me put it this way, 1, 2, and 3. First, you'll be starting with opening balance of your financial asset, which will be 80,000 something in this particular question. You will add 10% with respect to interest income so that your financial asset value will increase, and you'll be reducing 2% to the extent of contractual cash flows of interest which you have received. You'll be getting your closing balance, and this will become opening balance, and again add 10% minus 2%, and again you'll have closing balance which will become opening balance. Eventually you'll do the same here. You not only you will get 2% interest, which is contractual cash flows, plus you will be getting the loan principal repayment. Therefore automatically it will become nil. Of course there will be a little bit of approximation difference that we can manage. Moving on, now the next concept that we have is security deposit. Now when it comes to security deposit, we need to think this from whose point of view? From lessee's point of view. From lessee's point of view, usually what happens is that whenever you take machinery on lease, let's say in this example you have taken 4 years, okay, machinery on lease. So initially you will give a security deposit. Let's say you have given, in this case, I think 10 lakhs. Yeah, 10 lakhs. Who has given to whom? Lessee has given to lessor. And then you'll be getting, you'll be paying lease rentals. And once the entire lease rent period is done with, then lessor will pay back your security deposit without any interest. Exactly the same amount will come back. So 10 lakhs will be recovered from lessor. You got the point? Now, so it is a kind of refundable deposit. Now, the first question is, why would you pay something called 10 lakhs to the lessor? Very simple. You are taking a big costly machine for lease, correct? So therefore, lessor has always a fear that you might not use it in a right way. You might cause some sort of a damage. These are all machines that will cost in crores, okay? So therefore, for safety purpose, he will take the security deposit, so that if you do some sort of a damage because of your ignorance or carelessness, whatever it is, then lessor will recover that cost from the security deposit. So it is interest-free deposit, okay? Just think of it like a fixed deposit, okay? Think of it like a fixed deposit. And only thing in this case is that you'll not be getting any interest. So we are thinking this from lessee's point of view, okay? Now, what the Ind AS 109 says is that, okay, fine, you have deposited, which means you paid lessor virtually 10 lakhs, and then lessor is going to give back the 10 lakhs after 4 years. Now, what Ind AS 109 says is that I'm going to consider this 10 lakhs at its fair value, because this is interest free. Now, I'm not going to accept it. Suppose in the market, if somebody pays something at 10%, because the market interest rate is 10%, say for example, let's discount the so-called cash flows which you're going to receive after 4 years, which is 10 lakhs obviously, at 10%, which means the fair value of the deposit is only 6,80,000. Approximately, I'm saying it's actually 6,83,013, approximately 6,80,000. Let's put it that way. So Ind AS 109 says that I will consider as if you have given 6,83,000 to the lessor at 10% interest, such that after 4 years he's gonna pay back 10 lakhs. Now you can ask me, why is that standard is forcing this upon you? Because in reality you have given 10 lakhs na, interest free. Why is the standard is saying I'll not recognize that, I'll not accept that, even though you have actually given 10 lakhs as security deposit to the lessor? I will consider that your financial asset is only 6,83,000. That's what you will show in your books. You will not show 10 lakhs. You will show only 6,80,000 in your books. Why? Because standard feels that if I don't do this, and if I allow 10 lakhs to be shown as financial asset in the books of the so-called lessee books, then standard feels that there might be a chance of misuse. What is the chance of misuse? This lessee and lessor might collude together and say that let's reduce this lease rentals, okay, so that we'll have the advantage, and let's increase this security deposit such that you can show good asset value, and I will use it from some other purpose. Indirectly, by increasing the security deposit, by using this for some other purpose by lessor, he might feel that some of the lease rent is collected through security deposit. You understand the point? Like that, they can collude and they can misuse things. To avoid that only, what standard says is that, okay, no, I'll not allow. Even though you have given it interest free, it doesn't matter. I'll consider it as if you have given 6,80,000 and odd at 10% interest to the lessor, and then he'll be paying back you 10 lakhs. That's all. So therefore, what will be your entry? Discount it at the market interest rate. You'll get your fair value. That will be the financial asset fair value, which is what you will recognize. Whereas actually the outflow is 10 lakhs. So to bank, it will be 10 lakhs. And the day one difference between these two will be called as prepaid lease rent. Got the point? Day one difference between these two will be referred as prepaid lease rent. All right, guys, let's continue. Okay, anyways, one student has asked me a doubt. Sir, why do we take prepaid lease rent as an asset? Okay, you need to understand that here we consider this as an asset. And what we'll do is that we'll amortize this over a period of the lease term using SLM method. For example, this here it is 4 years now, divided by 4. Every year, 1/4 of this prepaid lease rent, just like prepaid staff cost. Okay, there also we treat it as an asset, na? So it will be taken into P&L account every single year. That's the treatment, first of all. Now, the logic behind that is that, see, generally it's a revision session, Anna, so I don't have time to explain logic. But anyway, because a specific student have asked this doubt, I have to clarify it. You guys need to understand one thing over here, that how Ind AS 109 perceives what you are doing. You are actually giving 10 lakhs to the lessor, saying that it's an interest-free loan. Are you able to understand? Ind AS 109 says that I don't trust this. I don't trust this because I feel as if you should have given 6,80,000 loan at 10% interest, because that's what happens in the market. If you give this much of money, it works at a 10% rate. You should have given 6,80,000 at 10% rate. Whereas you have given 10 lakhs, which means you have given nearly some 3,16,000 extra, right? This 3,60,000, what you have given extra, Ind AS 109 says that I consider this as an advance of lease. I don't consider this as a so-called security deposit. I consider this as an advance of lease, because I have a doubt that because you gave this much extra, are you able to understand? Sir, you can ask me, sir, how did you come to a conclusion? How did you arrive at a conclusion that he has given 3,16,000 extra? Very simple. In the market, 10% runs. So if you discount what he has given at 10%, he should have given, logically speaking, 6,83,000 at 10% interest. But he has given 10 lakhs, which means he has given this much extra, 3,16,000. So Ind AS 109 says that I feel this as if you have given extra bit of advance of lease rent. Okay. So because you have given this much of extra, I consider this as an advanced lease rent, because if I don't consider this, then most probably you guys will collude and you will give an additional, the so-called security deposit. And as a result, this guy will reduce what? The lease rentals, and that it will mess up everything. And you guys can just, mislead, your accounting and stuff like that. You understand the point? So to catch you guys, Ind AS 109 says that I consider this as a advanced lease rent. That's the reason it has been considered as prepaid lease rent. And that's the way you have to book it in your books, rather than taking the entire 10 lakhs as what? Financial asset. If Ind AS 109 doesn't say this, what you guys will do? You will take entire 10 lakhs and you'll show this as a financial asset, right? Your books will look much, much, much better. You understand what I'm trying to tell you? So Ind AS 109 is pretty smart. It's not pretty smart actually. Internationally people have done these kind of things, and then they have caught it, and accordingly they have built what? Rules. Okay, that's the way it works. Now moving on. I hope this is clear. Moving on to demand deposit. Now, a demand deposit is very easy, Nana. Look at the name, demand deposit, which means whenever I demand, you have to give the deposit back. In that case here, there is no concept of time value of money. There is no concept of interest rate accounting. There is no concept of discount. Okay, whatever the real transaction value will be there, na. Say for example, suppose in this example itself, suppose the so-called lessee has given 10 lakhs of demand deposit to lessor, saying that, okay, I'm giving you this much of advance. Whenever I demand, you have to give it back. If that were to be the case, just imagine, it will not happen usually, but I'm just telling you to understand, to explain you the concept. If that were to happen, then we will not be doing all this discounting part. We will be recording the so-called security deposit, in other words, demand deposit at 10 lakhs only, which is nothing but the transaction value. You understand the point? Because when you don't know when I'll demand it back, and whenever I demand, you have to give it back, time value of money concept will not come. Interest rate accounting will not come. Amortized cost method will not come. It doesn't make any sense, because at any given point of time, you can ask and I have to give you back. You understand the point? So whenever there is a demand deposit kind of situation, same rule applies. In the upcoming session, after some time, we'll be talking about the so-called holding company or parent company giving demand loans to subsidiary, where the parent company will say that whenever I need money, I'll ask you, then you have to pay back. There also will be doing same sort of accounting. So therefore, this is not something irrelevant concept. Keep that in mind. Since the deposit is recoverable on demand, it will be accounted at transaction value. Transaction value is nothing but 10 lakhs in this case. Okay, there is no need to apply ACM method, no need to do any interest accounting, as there is no interest first of all. Okay, for demand loans or deposit. Whereas in security deposit, we did that. Why? Because security deposit is not demand deposit. Security deposit is like fixed deposit. So it is different from demand deposit, which means once you give the so-called 10 lakhs to the lessor, till 4 years, you can't ask the lessor back. Why 4 years? Because in this case, lease term is 4 years. Suppose lease term is 6 years. Then till 6 years, you can't ask back. You understand what I'm trying to say? I hope you're getting it. Chala, fantastic. Now let's move on. Trade receivables. Trade receivables in the sense, we're going to talk about debtors. Okay. Trade receivables, debtors. Now, tell me one thing. Usually, whenever we sell goods, what is the entry? 2 sales. Let's say 1 lakh worth of goods I've sold. You will, if immediately money is given, you will write cash or bank account. If immediately money is not given, what you will do? Okay, debtors. You will debit debtors to sales. There ends the matter. You will wait for 2 months or 3 months, whatever it is. After 2 months or 3 months, once you receive cash, you will debit cash and 2 debtors and you will cancel the debtors out. Correct? Right. Now, tell me one thing. Normally, this is what will happen. Whatever the actual sales that you have made, suppose your sales is 1 lakh. At 1 lakh, which is nothing but transaction value, at transaction value only you'll record. However, in some cases, for certain so-called debtors, an extended credit period will be given, which means it's not the normal credit period. Like usually, let's say 90 days is the credit period, or let's say 30 days is the credit period. That's not the case. In some cases, 2 years, 3 years, like the deferred credit period will be given. When this sort of deferred credit period will be given, we cannot allow the so-called company to pass normal entry saying that debtors to sales. Why? Because in those cases, because of the extended credit period, sales would have been inflated. Sales would have been inflated means because of the interest element. For example, usually let's say if the credit period is 30 days, I sell you, say for example, one particular equipment. Usually I'll sell to you at 1 lakh. But because you're asking an extended credit period for a period of 3 years, what I'll do as a company, normally I'll get that money back within 2 or 3 months from normal debtors. But in your case, you're asking for 2 years. In that case, I know that I'm going to get money late. If I'm going to get money late, that's going to cost me time well of money, isn't it? So what I'll do, okay, because you're asking for 2 years credit period, I can't sell it to you at 1 lakh. Rather, I'll sell it to you at 1,20,000. You understand the point? Now, what you need to understand in this case is that 1,20,000, that additional 20,000 is what? None of finance cost. It's an interest element. You got the point? So therefore, can I show the entire 1,20,000 as sales? Then that will be wrong. That's not showing true and fair view of the transaction. Correct? Only 1 lakh is your actual sales. The remaining 20,000 is an interest element. You understand the point? That is what we're gonna do right now. So we're gonna deal with special cases where deferred credit term is allowed, extended credit period is allowed when compared to the usual credit period, what is normally being allowed. Right. Debtors and other receivables or initial recorded at transaction value. Everybody knows that. However, if extended credit period is provided, the amortized cost method will be applicable. Why? Because interest element kicks in. Whenever interest element kicks in, automatically ACM comes. Got the point? Now let's say 16,100 worth of goods you have sold. Okay, on credit basis, what will be your entry? 2 sales, debtors. In case if the credit period is only 3 months. 3 months means 3 months is, don't ask that, sir, even in 3 months also there will be time value of money, na, sir. No. What you need to understand is that in general scenarios, in normally acceptable trade practices, we call it as, okay, acceptable trade practices in that particular market, in that particular good scenario, usually 3 months of credit period is given. You understand the point? It can be 3 months, it can be 1 month, it can be 2 months, depending upon the business what they're doing. We call it as generally accepted trade principles. Okay. In that case, they will not be working out on time value of money even for that short duration as well. You understand the point? They'll ignore it generally. Okay. However, in this case, you gave the deferred time period of how much? 3 years. So which is not normal. So obviously, can I pass this entry? I can pass this entry provided if this is the case where the credit period is only 3 months. But that's not the case over here. The credit period is how much, Nana? 3 years. In that case, can I pass this entry? I can't. Then what I have to do? Very simple. After 3 years, you're going to pay 16,100, right? So bring it to cash price. Cash price in the sense today's value. Got it? So you found out the market interest rate or discount rate. Okay, market interest rate usually it will be discounted. And then if you discount it, let's say the cash price is 11,200. You should not be calling this as fair value. The right term is, actually it's similar to fair value only, but the right term is cash price. Okay, cash equivalent of debtors, which means today if you would have sold it on cash, if the good has been sold on cash rather than being sold on credit basis, what would have been the price? That is nothing but cash price. So the right term to use is cash. Right. Anyway, cash price equivalent is how much? 11,200. Okay. At this you should record. Then what you will do? Usual stuff only. ACM method, na? Unwinding of discount. What do you mean by unwinding of discount? For 3 years, you got 16,100 to 11,200 by discounting at, say for example, 10%, just for example purpose. Again, don't put the 10%, calculate the number and check that, sir, your answer is wrong. Just for example purpose, I'm saying. Okay. Then what you will do? You'll keep on adding back 10% and we will take it back to 16,100. That's all. Simple. You understand the point? Right. That's what we call unwinding of discount. Doing what you have done, you will do the reverse. Here you have discounted by using 10% and brought it down to 11,200. Now you'll add back 10%. That's all. Moving on. Let's look at this example so that you'll get clarity. Now, look at this example. A Limited sold goods for rupees 50,000, okay, to B Limited on 3 years credit. That's where the problem is, extended credit period. Obviously the normal credit period offered is only 30 days and the sale would have been 40,000, which means cash price has been given already. So the cash price would have been how much, Nana? 40,000. Okay, whereas you have sold at 50,000. Why is that inflation in sale price? Pretty simple, because I gave you 3 years credit. Show the accounting in books of A Limited. Pretty simple. For 3 years the price is 50,000, cash price is 40,000. He himself gave you cash price. Then what is that we need to do? Very simple. We need to find the discount rate that is missing, na? Okay, only then we can do unwinding of discount, right? Okay, so sales are recorded at 40,000 and debtor will be your financial asset because you have a contractual right to receive cash. Now, so we know the future value, which is 50,000. We know the present value, which is 40,000. So we know that future value is equal to present value into 1 plus r whole to the power of n. Basic formula from your CA, CMA, Inter. Right, 50,000 is equal to 40,000 into 1 plus r whole to the power of 3. 1 plus r is equal to 50 by 40 into whole to the power of 3. This side it goes 1 divided by 3, and obviously 1.25 whole to the power of 1 by 3 minus 1. So r is equal to, if you apply this particular formula over here, which we'll do it in AFM, okay, press 1.25, then square root 15 times, then minus 1 into 1 by 3, okay, that's par, and plus 1 is into equals to 15 times. You do this, obviously you'll be getting 1.0772 minus 1, you get this much of rate. So this is your discount rate eventually. What you will do, unwinding of discount. What is unwinding of discount? Pretty simple. Once the sales has happened, what you'll be doing? Debtors, okay, obviously a financial asset, to what, Nana? Sales, obviously. How much? 40,000. At cash price only you will record, correct? Then what you have to do, slowly over a period of 3 years, you need to increase this 40,000 to how much, Nana? 50,000. That's what you're going to do, which we call it as unwinding of discount, right? How will you increase? Every year you will add 7.72%. So you multiply 7.72% into 40,000. Slowly what will happen? Financial asset value has to be increased. So how will you increase your asset value? Debit the asset, debtors to interest income. Really, are you getting any interest? No, this is like imaginary interest. You got the point. Imaginary interest, you are not getting it. But the logic is, if I'm charging 10,000 more because I'm giving you 3 years of time to pay the money, naturally I'm charging you interest. Even though real contractual cash flows is not happening, that's what we call substance over form. Form is nothing but real contractual cash flows. In reality, cash flows are not happening over here, but in substance, that's what it is. You got the point. That's what the entire index is going with this particular logic. So 3,088, okay. There will be no contractual cash flows of interest. We know that. So therefore, there will be nothing. Another entry will not be there. So only one entry, and you'll have a closing balance. So you will add 7.72%. Closing balance, again add 7.72%. Closing balance, again add that. Ultimately, it will match with 50,000. At the end of the day, after 3 years, what will happen? You will be receiving 50,000 cash. So obviously, bank account debit 50,000, and you need to close your debtors. Two debtors, 50,000. There ends the matter. That's it. Chalo. Now moving on to next concept, loans within the group. You know that group includes parent as well as subsidiary, right? So here what I've done is that whenever loans are happening within the group in the sense parent gives loan to subsidiary or subsidiary gives loan to parent, I've divided this concept into 3 categories predominantly: loan repayable on demand, loan repayable on specific date. Next one is loan repayable whenever funds are available. So basically questions has been categorized into 3. Okay. Based on these 3 topics only, you'll get questions. Most probably questions will be based on loan repayable on specific date only. There are few questions which are based on loan repayable when funds are available as well. Anyways, but we need to learn all the concepts, correct? Chalo. Now let's start with the first one. You guys are ready? Now, coming on to loans repayable on demand, this is just like a demand deposit. Quite a bit earlier only we have seen what we have to do when it comes to demand deposit, right? So there is no question of discounting, there is no question of interest rate accounting, there is no question of amortized cost method, right? So it's just you'll record it at transaction value and there ends the point. That's all. Here also same stuff. The lender can ask for repayment at any time and the borrower must repay immediately irrespective of the original expected loan duration. Okay, so in this case the entries are pretty much simple. If parent give loans to subsidy, what you will do? First of all, in the parent books, you have given loan to subsidy. So it's a financial asset because you have a contractual right to receive cash. So loan to subsidy, financial asset debit. You will be doing it at fair value only. But in this case, fair value is nothing but transaction value. There is no difference because there is no question of discounting. There is no time value of money involved. Okay. To bank. Why? Because you have given loan. Obviously, money goes out of your bank, right? And in subsidiaries books, what you will do? Subsidiary will receive the money. So therefore, bank account debit to what? Loan from the parent. As simple as that. It's a financial liability in books of subsidiary because subsidiary has got contractual obligation to pay cash. Simple. Next, suppose if subsidiary give loan to parent, then what will happen? Exactly reverse. In parent books, parent will receive money from the subsidiary, so bank account debit to loan from subsidiary, which is a financial liability, because parent will have contractual obligation to pay cash back to the subsidiary. In subsidiaries books, what will happen? So you have given loan to parent, it's a financial asset for you because you have a contractual right to receive cash. So therefore, financial asset debit to bank, because you gave money, obviously money moves out of your bank. So this is your entry at the beginning. Then once the repayment happens, because it's a kind of a demand deposit, so whenever the other party demands, you have to repay. In that case, exactly reverse entry will happen. Whatever the entry that you passed initially right now, exactly opposite entry will happen and it will close. That's all. There is no question of unwinding of discount. There is no question of interest rate accounting. There is no question of time value of money. Nothing is there. Simple, plain vanilla case. Got it? That's why it is not important from examination perspective as well. Now coming on to the second part. What is second part, Nana? Loan repayable on specific date. Now this is important. Okay, let's try to understand this. PK Limited gave loan to SK Limited of 10 lakhs for 3 years at no interest. Fantastic. Obviously, one is parent, PK Limited, okay, SK Limited subsidiary. Parent gave loan to subsidiary of 10 lakhs for 3 years at no interest. Would we consider that? Obviously not, because it's a tainted interest, or we can also call it as corrupted interest. Whereas market interest rate is 10%. So what we have to do, even though you gave 10 lakhs loan, I would rather find out the fair value of the loan. How will I find out? Very simple. Discount it at market rate of interest. So fair value of loan today is equal to 10 lakhs. You discount it at what, Nana? 10% for 3 years. You got the point? Pretty simple. Anyway, there is no interest, na? So therefore, you'll be getting 10 lakhs after 3 years. So 10 lakhs after 3 years means 1 divided by 1.10 equals to you'll be getting discount rate for third year. You multiply with 10 lakhs, you get 7,51,310. So which means I consider as if you gave 7,51,310 at 10% interest for a period of 3 years. So you can show financial asset to the extent of 7,51,310. That's all. Right. Actual amount given is how much? 10 lakhs. So what will be the difference? Excess amount given today. The difference. This is nothing but we call it as day one difference, right? Now, what is the logic here? Fair value reflects what an independent third party would pay or receive considering the time value of money and risk involved, obviously. Now, this difference, the so-called day one difference, how should we treat it? That is the biggest question. In case of staff loans, we treat it as a prepaid staff cost, correct? In case of lease rent, we treat that as a prepaid lease rent, correct? And then eventually we amortize that. Now here, the so-called day one difference between the fair value and the actual amount given, how will you treat that? That is the biggest question. Now that treatment of the day one difference depends upon who gave loan to whom. Clear? For example, if parent has given loan to subsidiary, then this difference will be treated as additional investment in subsidiary. Why? Because indirectly this difference is nothing but cost you are bearing, right? You understand the point? Because you gave interest free loan, in that case indirectly this much is the cost that is borne by the parent. So therefore parent will feel as if this is the investment that I've made in my subsidiary. That's how they'll feel, because it's a cost for them. So therefore day one difference will be treated as investment in subsidiary if parent give loans to subsidiary. Got it? And in subsidiary books, subsidiary will receive it as capital contribution from the parent. Now suppose subsidiary gave loan to parent. If subsidiary has given loan to parent and there is a day one difference, which means subsidiary is bearing a cost, then what subsidiary will feel? So parent has invested a lot in me, so therefore now I am giving a loan at a less interest rate, concessional interest rate, or no interest, for example, whatever the case may be, and that cost will be borne by the subsidiary. So how will subsidiary treat that in its books? Very simple. It will treat it as dividend. You got the point? It will be treated as dividend distribution, okay, in the subsidiaries books. In parent books, parent will treat it as it, I've invested a lot into subsidiary, so therefore I'm receiving the dividend. You got the point? Chalo, next. Subsidiary to subsidiary, one subsidiary to another subsidiary, not that important. It will be often recorded as equity contribution. Got it? Chalo, anyways, let's see these scenarios one by one. Okay, we are still in the second part. What is second part? Loan repayable on a specific date. Let's start with the first one. Parent gave loan to subsidiary. PK Limited is a parent, SK Limited is a subsidiary. Let us see how the accounting process will be done. Ready? Now look at the parent books. Parent gave loan to subsidiary. Naturally, what will happen? Loan to subsidiary will be a financial asset in parent books, so you'll debit that. Then to bank, whatever the actual money that you have given as a loan to the subsidiary, that you will write to bank, and there will be difference obviously, because either you'll get it at less interest or you'll give it at no interest, right? Either you'll give it at less interest or no interest. So that will be treated as, in case parent gave loan to subsidiary at concessional rate of interest, we will treat the day one difference as investment in subsidiary. Similarly, in subsidiary's book, subsidiary will record that as capital contribution from parent. Is that clear? So in subsidiary's book, obviously you'll be receiving money, bank account debit to what? Loan from parent, which is a financial liability, because tomorrow you'll have a contractual obligation to pay back the loan, and to capital contribution from parent for the difference. Done. Moving on to second one. Subsidiary gave loan to parent. Very simple. In parent's books, what will happen? I'll get the money from the subsidiary, so bank account debit to. Obviously, you have to recognize financial liability to the extent of what? Fair value of the loan, which is nothing but loan from subsidiary. And the difference, as I told you, if subsidiary is bearing the cost, subsidiary in its books will account that as dividend paid to parent for all the investment parent has done in the subsidiary. Okay. Similarly, what parent will do in his books is that, okay, fine, I've invested a lot in the subsidiary, so therefore I consider this as a dividend received. Got it? Now the question is, in subsidiary's books, when subsidiary is recording that as dividend paid to the parent, where will it get money from? From retained earnings. Therefore, retained earnings will be debited. Now look at the subsidiary's books. Loan to parent, it's a financial asset because subsidiary expect the money to come back, obviously, and to bank, but this will be recorded at fair value, and to bank will be the transaction value. Obviously, there will be a difference, and that day one difference we're gonna call it as what? Dividend distribution. Dividend paid. Okay, and that money you'll get it from retained earnings. So therefore, in subsidiary books, retained earnings will be debited. Now coming on to parents books, naturally what will happen? I receive the money from the subsidiary, so bank account debit to loan from subsidiary. Obviously, it's a financial liability recorded at fair value, whereas the difference will be recorded as what? Dividend received from the subsidiary. That's all, which is kind of an income in parents books. Moving on to next one. Now coming on to the last part. What is the last part? Loan repayable when funds are available. Okay. Which means basically in this case what happens is that either the subsidiary or the parent gives loan to the counterparty, which means parent gives loan to subsidiary, subsidiary gives loan to parent. But the tricky part here is that the other party says that I'll repay you back whenever money is available with me, and the other party agrees to that as well. For example, parent gives loans to subsidiary. Parent will say, I have given you loan, when you will pay back. Subsidiary will say, I'll pay back whenever money is available with me. Are you able to understand? So this makes it very difficult for you to account it. You understand the point? So when will you account it? When you don't know when they are going to pay money. They say that I'll pay money when money is available with me, when funds are available. Now the question is when funds will be available. Okay, so the only solution for this is you have to expect when funds will be available. So have an expected date. Here we have specific date na, in second case scenario. So like that, in third case scenario, you expect that date, the so-called date when the other party will repay the money back, repay the loan back. And accordingly, you account it as if it is a second case scenario. Second case scenario means loan repayable on a specific date. Only case here, it is not 100% specific date. You are expecting that date. You will have an expected date and you'll account it the same way which we have discussed so far in the second case scenario. Are you able to get my point? A subsidiary gives loan to parent to be returned when parent has excess funds or available funds. Similarly, a parent supports a financially weak subsidiary and agrees to take repayment of the loan only when subsidiary can afford it, which means when funds are available with the subsidiary. So what you will do? Estimate should be made with respect to when the loan repayment will be made. 99% of the problems will be based on this only. Okay, even our ICA sums. So estimate the date of loan cash flow payments if there is a reliable evidence. Then once you know the date, it is similar to the second case scenario. Accounting will be done similar to case 2 and apply effective interest rate. You understand the point? Or market rate of interest. Either the case may be. Just like the second case. What is second case accounting? That's what we have seen here. Na? Loan repayable on specific date. Exactly the same kind of accounting you will do. But in exceptional cases, only 1% of the cases, even though you need not remember this as well, but anyway, I have to say, so I'm saying, if you cannot estimate the repayment timing, the date reliably, are you able to understand? Because the cash flows are irregular, unpredictable, so it is happening in a zigzag way. Whenever they find money, they're paying. You understand the point? So it's pretty unpredictable, unreliable. In that case, you treat it as a loan repayable on demand, which means you'll remove all the interest element, you'll remove all the discounting, you'll remove all the time value of money, you'll remove all the ACM method, and you'll just record it at transaction value. But this is an exceptional case scenario. Please try to understand. That's why I've written the probability as well. So whatever the problems that we're gonna solve when it comes to ICA sources will be based on this only. So you'll be, that estimation of a date will be given in the question itself, and you'll treat it as a second case scenario where loan will be repayable on specific date. Accordingly only you'll do the accounting. You got it? Typical ACM accounting will do. Chalo. Another important note here, this is very important. The above accounting, whatever we have learned so far, is only applicable in separate financial statements of parent and subsidiary, because only in that case, when the loans are happening within the group, you treat each of the company within the group as a separate entity. So in their separate financial statements, all the things that we have discussed, investment in subsidiary, capital contribution from parent, dividend paid or dividend distributed to the parent, dividend received from the subsidiary, all these things you will record when you treat parent as a separate company, subsidiary as a separate company, correct? What if you are preparing consolidated financial statements? In CFS, no accounting will be done for all these transactions because they cancelled out. Because ultimately loan did not go outside the group, it is within the group, correct? In that case, it does not have any meaning over there. So therefore, when it comes to intercompany transaction within the group, especially when you prepare consolidated financial statements, no accounting will be done for all these things, all these loans within the group. Accounting will be done only in separate financial statements. Keep this in mind. These things will be asked in the questions. Chalo, moving on to next one. Alright guys, now moving on to perpetual bonds. Now, you guys know pretty clearly that perpetual means what? Indefinite period of time. So obviously there will be no redemption whatsoever. Those kind of bonds are referred as perpetual bonds. These instruments do not have any redemption, but they pay interest for a lifetime, literally. Interest cash flows for indefinite period. Any investment in such instruments will be initially recognized at fair value. Now, the question is, how will you calculate fair value? See, usually if an instrument is for 5 years, how will you calculate your fair value? Year 1, 2, 3, 4, 5, whatever the cash flows that you are getting, okay, contractual cash flows, you will be discounting that at the market interest rate or EIR for that matter, and then you will find your fair value. Even if it is 10 years, you do the same. 15 years, you do the same. Array, indefinite life means what you will do? How many years you will go ahead and then you try to discount it? You understand the point? It's practically impossible. So therefore, what we do is that we just take the cash flows and we directly divide it with the so-called market interest rate. That's all. Now, there is a lot of logical thought process went behind this so-called formula, but because it's a revision session, I can't explain the logic with respect to this particular formula. But honestly speaking, in our EVO session, exam-oriented batch or regular batch, I've detailed explained this formula as well. What is the logic behind that with numbers? In fact, if I'm not wrong, I did calculate the numbers till 40 years, 40, 50 years, and then I've shown them how this eventually works, why this formula has come eventually. Are able to understand? But revision session, obviously you guys know, we try to teach this in 5 to 10% of the time of the actual class. For example, in real class, this entire chapter goes beyond 40 hours, right? So therefore, I don't have time. Sorry, I can't explain you the logic. Now, if the issuer here, the thing is, with respect to accounting point of view, why perpetual bonds are important? Very simple, Nana. Again, the fight is between equity as well as financial liability. Now, in perpetual bonds, anyway, there will be no redemption. Okay, wo to gaya. The only thing that is left over is what? Interest payment. Now, the question is whether you are committed to pay interest mandatorily every single year, irrespective of your profits, or you have a discretionary interest kind of a setup. So whenever there is enough profits, you will pay interest. Otherwise, you will not pay interest for a lifetime. Is the setup is like this, or mandatorily you have to pay the interest? Depending upon that, you will classify that as a equity or a financial liability. Depending upon that, your accounting will happen. Simple, isn't it? That's the whole point of discussion as of now, right? If the issuer is not obligated to repay principal or interest, it will be classified as equity naturally. If there is an obligation to pay cash, it is financial liability. That is if interest payment is mandatory. Let's look at the example. A Limited issues perpetual bonds of 100 crores. Okay, coupon interest rate is 8% per annum. Fine. There is no maturity, obviously. That's why it is called perpetual. There will be no maturity. A Limited has discretion to skip interest payment, non-cumulative. So when you have discretion to skip interest payment, it means you will pay interest only when sufficient funds are available. You feel like when sufficient profits are there. So in that case, obviously, you'll be classifying this as a equity. So what will be your entry? Initially, you get the money. When you issue those perpetual bonds, bank account will be debited, and it's a kind of equity. So therefore, two perpetual bonds, which will be classified as equity. Very, 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 very important. You will not be classifying this as a liability. Clear up? Then whenever interest you declare, there is no obligation. Whenever you declare, what will happen? Very simple. To bank account, because you're declaring interest, which means you're paying interest, and you'll be debiting perpetual bond coupon, which is nothing but interest expenses in the name of perpetual bond. Clear? Just like equity dividend. Just like equity dividend. Okay, because you have classified this as equity now, so this will have the flavor of equity dividend. So you're also declaring whenever you have sufficient profit. Otherwise, you don't declare. There is no mandatory payment of the so-called interest over here, isn't it? Right. Just like equity dividend, similar flavor. Now suppose issuer is contractually bound to pay 8% coupon regardless of profits. which means you have contractual obligation to pay interest. We call it as a financial liability naturally. Initial entry will be same, but when it comes to subsequent measurement, we'll be applying ACM. Why? Because here it is financial liability. I told you na, when it comes to financial liability, by default, 95% of the cases will be recognizing and measuring it at ACM only. Only in few special cases, we'll go for FVTPL. FVTOCI, anyway, it is out of picture when it comes to what? Financial liability. Correct? So therefore, interest expenses account debit to bank naturally. Got it? Yes. In case if the bonds are issued at discount or premium, then EIR will come into picture. Suppose your coupon rate is 10%. Are you able to understand? And there is no issuing the bonds at discount or nothing has happened, then your effective interest rate also will be same as coupon rate. But suppose you have issued either it at discount or premium, of course redemption will not happen. I'm talking about only issue because we are talking about perpetual bonds. Even in that case, if it happens at discount or premium, then your coupon rate will be different from EIR. And for calculating all this interest calculation, obviously we need to apply EIR. Keep that in mind. Okay. And for contractual cash flows, we'll be going with the coupon rate. I hope you know this because already we have solved enough sums, enough examples we have seen. Are we done with this? Chalo, fantastic. Now another example I just gave you from investor's point of view. Here all these concepts that we have seen right now is from company's point of view, issuer's point of view. Now let us see it from investor's point of view as well. So investor initially has paid 1,000 to the company for buying the perpetual bonds. Then every year it is getting interest, 10% interest in this case for infinite period of time, correct? So they'll discount it to find the fair value. Obviously it will be cash flow divided by market rate of interest. So cash flow 100 divided by market rate of interest, obviously you get 833. This is your fair value. Got the point? So fair value will be 833 and whereas I have paid how much? 1,000. And the difference will be transferred to P&L account in the books of investor. Suppose investor is a company, then this is how the accounting will happen. Day one difference will be transferred to P&L account. Got the point? Everybody? Sir, why is this transferred to P&L account, Nana? Very simple, Nana. A perpetual bond which is worth only 833, you have paid 1,000, that's all. You have paid more, therefore, this is a loss which has to be taken to P&L account. Logic is very simple. Nothing else here. You got the point? Chalo. So finally, this is the revision of the topics that we have seen so far. Loan to the employee. I'm talking about concessional loans, staff loans. You need to find out fair value of the loan. How will you do that? Future contractual cash flows will be discounted at market rate of interest or in some cases effective interest rate. Okay. Security deposit, same logic. Loans within the group, same logic. Okay. Of course, when I'm talking about loans within the group, I'm talking about loan repayment on a specific date. I'm not talking about loan based on a demand, loan repayment on demand, or a loan repayment on when funds are available. I'm not talking about these two scenarios. I'm specifically talking about loan repayment when there is a specific date. Got it? Right. Chalo. Now moving on to the next topic, regular way of purchase or sale of financial asset. All right, guys, let's continue. I've just changed the title of this, okay, so that it will be better for you to recognize, okay. Regular way of purchase or sale of financial assets in some special cases where ultimately the focus is going to be whether we will do trade date accounting or settlement date accounting, okay. So first of all, what is this concept, sir? Let me try to give you a little bit of background, okay, so that you'll be able to understand things better. See, usually you buy or sell a financial asset like shares or bonds, specifically bonds in this case, in a stock exchange. So if you do that in a stock exchange, basically what happens is that here, the conditions are predetermined, right? The rules are predetermined. So the contract basically requires a standard settlement period of T plus 2 days. For example, if you do the trade on Monday, which means you have bought something or you have sold something on Monday, eventually it will be settled trade day plus 2 days. Means say for example, I've done the trading on Monday plus 2 days, Tuesday, Wednesday. On Wednesday, it will be settled, okay? So on Wednesday, in your demat account, shares will be added or bonds will be added, whatever the case may be, and money will be deducted from the bank account on Wednesday itself. That is theoretically. Theoretically, that is the concept. But in real time, what happens is that brokers will collect money on Monday itself and shares will be delivered on what? Wednesday. That's what happens in India. Okay, but that's why I've written this in different color. But theoretically, you have to presume that you'll get money or you will pay money either way, depending upon whether you are buying or selling your financial asset on Wednesday only. For accounting purpose, on Wednesday only. Okay, right. So this is the backdrop, Nana. In this backdrop, what we need to do is that we need to decide how are we going to do the accounting. So we have two choices as per Ind AS 109, trade date accounting as well as settlement date accounting. Why this is important? Because depending upon what kind of accounting that you choose, it will influence how do you recognize your financial asset, how do you de-recognize your financial asset, which is really important. Why is this important from Ind AS 109 perspective? Because it determines when to recognize or de-recognize a financial asset, which I've already obviously told you. So standard gives you two choices. We know the two choices, but what is important is whatever the choice that you pick, you apply that consistently. That is what is important. Okay, you apply that consistently. Fantastic. Now we'll try to take an example, and then eventually we'll try to cover it up. Cover it up in the sense the concept. Okay, right. Now X Limited has purchased an investment in bonds for rupees 100 on 30th March. Okay. On 31st March, the fair value of these bonds is 101. You know that when your trade date is 30th March, you know that it's gonna take trade date plus 2 days for the settlement. So the above transaction was settled on 1st April and the fair value on that date is 103. So there are three changes: 100, and on reporting date 101, and on the settlement date 103. You get it? Right. Show the accounting in the books of X Limited, assuming the trade date accounting and settlement date accounting. Okay, fine. So we're gonna do accounting as per both the options given by your Ind AS 109. And when it comes to financial assets, you guys know that when it comes to measurement and recognition, we have three choices, right? We have ACM, we have FVTPL, we have FVTOCI. So we have to learn these two methods of accounting, I mean presentation over here, from three choices, that is ACM as well as FVTPL as well as FVTOCI. Let's say your investment is accounted at ACM. When you will do that, let's try to recollect. When your business model is what? Hold till maturity or hold to collect, plus your SPPI test is satisfied. In that case, you will be recognizing and measuring your financial asset at ACM. Let's say that is your case and you have purchased it through stock exchange, where this is what? Trade date plus 2 days of settlement. In that case, how will you do your accounting? That's what we're going to see over here, right? Suppose your financial asset is accounted at ACM. Okay, in that case, what happens first? This is your trade date. You have purchased your investment. Let's start with trade date accounting. Trade date accounting means that day only you will do the accounting. So what is your trade date? 30th March. Pretty simple. On that day you do the accounting. So what will be your accounting? You have purchased the financial asset. Okay, investment in bonds, your financial asset debit, obviously. And you have paid money. Is it? Did you pay money? No. I told you you'll be paying money on what? Settlement day only. Although in reality your broker will collect it on this day itself. But that's not how we do accounting. So therefore I cannot write to bank. Instead I need to write to payable to broker, based on the presumption that on settlement date only that guy will cut the money from my demat account. You understand the point? In reality that's not how it happens, but that's what we need to follow the theoretical purpose, because usually worldwide this is what happens. Now, do we do fair valuation? No. Why? Because we are following ACM method. In ACM, there is no question of fair valuation. So therefore, on reporting date, we'll completely ignore it. Whichever the method it is, whether it is trade date accounting or settlement date accounting, it doesn't matter. Ultimately, it is ACM method. So there is no question of fair valuation. So it's pretty easy. Now, coming on to the settlement date, what happens? On this date, theoretically, your money gets cut. Correct? So when your money gets cut, what will happen? This liability payable to broker will get cancelled. So you cancel the liability. How will you cancel the liability? You debit it, payable to broker. Now what will happen? Eventually your money goes out of your bank. Therefore you write to bank. If this sort of T plus 2 is not there, simply what will be your entry? Investment in bonds to bank account. That's all. If everything happens on a single day, my entry would have been much simpler. Investment in banks, which is a financial account. Investment in banks account debit to what? Bank. That's all. Sorry, investment in bonds account debit to what? Bank. That would have been my entry, but that's not the case over here because of T plus 2 settlement. So therefore, on your trade date, you will be writing investment in bonds to payable to broker. You will create a liability and that liability will be cancelled once you pay the money on settlement date. Okay. Right. That's it. Only two entries when it comes to what? Trade date accounting. Now, when it comes to settlement date accounting, it's obvious, right? You will do accounting on settlement date. That is the name itself. So therefore, on trade date, you will not put any entry. As simple as that. Because it is ACM method, you will not put any entry on reporting date as well. Fine. Then what about the settlement date? Everything will be done on settlement date itself. Now on settlement date only, you'll be recording your asset. On settlement date only, you'll be making the payment. So therefore, there is no creation of liability. The entry will be very simple. Investment in bonds, which is a financial account, to bank. That's all. You got it? 100 rupees, 100 rupees. Because that's the price that you have paid actually. So when it comes to ACM method, settlement date accounting is very, very simple. You will not do anything. You will neither do anything on the so-called trade date. You will not do anything on the fair valuation date, in the sense, so you don't do fair valuation as well, because eventually you are following ACM method. So obviously here also nothing will be there. Just on the settlement date, directly you'll be passing this particular entry where you'll be recognizing your asset, investment in bonds, obviously, and you'll be making the payment as well to bank. There ends the matter. So it's pretty simple when it comes to ACM method. Now let's come to FVTPL. Here things will be a little bit interesting. Now, let's start with trade date accounting. Now, coming on to trade date accounting, basically what happens, first you will purchase your investment on 30th March. What will be your entry? Investment in bonds, which is a financial asset which you recognize. 2, obviously payable to broker. Why? Because theoretically, you are not paying anything. You are actually paying on the settlement date. Okay, let's keep it like this. Now, because we are following FVTPL, on the reporting date or the balance sheet date, you have to do fair valuation, right? You have purchased the asset at 100 and the asset has got increased by 1 rupee. So therefore, you have to do the fair valuation and increase the asset value by 1 rupee. And because you are following FVTPL, the changes in the fair value will go to P&L. So what's your entry? Increase the asset, which means debit, investment in bonds debit to what? P&L, naturally. Then after that, coming on to the settlement date, obviously now you'll be making the payment. So therefore, the payable will cancel out. Payable to broker, it's a liability. So payable to broker, you will debit and this liability gets cancelled out. And to bank at what? At this 100 rupees only, not at the fair value. Because fair value, whatever the changes is there, that has already been transferred to P&L account. You understand the point? 1. And already that effect has been given by increasing your value of the asset as well, financial asset. What you are payable, that is the liability. To that extent only you will be making the bank payment. So it's pretty simple. Okay. Besides that, on the settlement date, further your fair valuation has happened, in the sense your investment in bonds has got further increased by 2 rupees. So what do you have to do? Increase it. So therefore again you will debit investment in bonds account and you will be taking that to P&L. Simple. As simple as that. So when it comes to FVTPL, okay, your trade date accounting is a lot more simpler, logically speaking. But look at the fun side. Come to settlement date accounting. You know that settlement date accounting means the name itself tells you that you will do the accounting only on the settlement date, correct? Therefore, on the purchase date, on the trade date, no entry. Fine. But because you are following FVTPL, unlike ACM, here you are following ACM, therefore here there is no entry on the trade date. There is no entry on the so-called reporting date or balance sheet date as well. Why? Because you are following ACM, correct? But here that's not the case. On the trade date, there is no entry because you are following settlement date accounting. On the so-called balance sheet date, yes, you have to do accounting. Why? Because you are following FVTPL. You have to recognize the fair valuation. But the thing is, in trade date accounting, the fair valuation recognition is very easy. Why? Because already you have recognized the asset. The financial asset is there in your books. So simply you'll increase the value of the asset or decrease the value of the asset, as the case may be, and the difference will be transferred to P&L account. So it's pretty easy and simple. However, when it comes to settlement date accounting, the actual twist here is, there is no asset in your books. There is no financial asset. Then what you will do by doing fair valuation? Which value will you increase? There is no investment in bonds here. You got the point. So therefore, I'll create a temporary account. That temporary account will be called as fair value change account. Here, ultimately, your so-called asset value has got increased, right? So therefore, you'll be creating your P&L. So you create the P&L and create a temporary account called fair value change account. The reason behind this creation, we do not have any asset recognized as of now when it comes to settlement date accounting. Clear? Now coming on to the settlement date, what will happen? You'll be making the payment of 100 to bank 100, and now you'll recognize the asset at 100 only. That's your first entry. Then at the same time, you know that today the value of the asset is 103. So your asset also should look at 103. So what you'll do, you'll again increase the asset value, investment in bonds, to 3 rupees. So now it looks at, it will be at 103. Its value will be looking at 103. But then entire 3 rupees I cannot take it to P&L because already 1 rupee has been taken to P&L, correct? So only 2 rupees should be taken to P&L. Then what about another 1 rupee that you have taken to P&L? At that time you have created a temporary fair value change account, that you can cancel it out now. You understand the point? So therefore here it has been created and here it gets cancelled out. So therefore no more fair value change account. So temporarily it's created only for 2 days. Got it? So this is the only area where you tend to get confused when you do this so-called trade date accounting as well as settlement date accounting. I hope I gave you clarity. Okay, you create a temporary fair value change account. Okay, and the difference will be taken to P&L. Then on the settlement date, usually normal entry you will pass at the price that you have committed to buy. Are you able to understand? And after that, what you will do is that you will be increasing your investment in bonds, that is financial asset in this case, because the fair valuation has got increased. If it is decreased, means you will be creating the asset. That also you will do. And the entire difference will not be taken to P&L account because already something has been recognized on the balance sheet date or reporting date, that is on 31st March. So therefore, when you have recognized that, You have created a fair value change account, na? Temporary account. That you cancel it out now and the balance will be taken to P&L account. This you keep it in mind. That's all. Next one is you have to do the same thing at FVTOCI. We need not do this. Why? Because the only difference is wherever you find P&L in these entries, in all those spaces, it will be, substituted by OCA. That's all. Everything else remains exactly the same. So therefore, that's it. We are done with this. Chalo, let's move on. All right, guys. Now coming on to the most important topic, one of the most important topics of your financial instruments, that is impairment of financial assets, or in other words, we can also call it as loss allowance of financial assets. See, this is nothing but kind of, you can compare it to like provision for doubtful debts, because financial assets basically means what? You have a contractual right to receive cash. Okay, so even receivables, debtors is also like that. You have a contractual right to receive cash. So where in some cases you are doubtful that you may not get your cash back, just like in case of debtors where you don't get your money back, which we call it as bad debts, for that we create a provision, right? So here also similar to that, the flavor is the same. We'll be creating some sort of a impairment allowance, loss allowance, which we call. Okay, it's a kind of provision for doubtful debts. The concept and the flavor remains the same. All right, now we know that when it comes to financial asset, we might recognize it and measure it as per any of these three: FVTPL, FVTOCI, and ACM. But the important point that you guys need to understand here is that impairment of financial asset, the so-called loss allowance, will not apply if you are following FVTPL method. It applies only for FVTOCA and ACM. Let us make it very clear. Sir, what is this, sir? Why is it? We'll understand the reason. Okay, right now just remember this. Now let's start an example. Start with an example. Now, let's say you have invested in bond of PK Limited, which means you have purchased it at 1000 and you are following FVTPL. Okay, right, because you have purchased it for speculation or trading purpose, and SPPI test is not satisfied. Let's put it that way. Now, when compared to the date on which you have purchased this particular bond, as of today, that is after 1 year, the credit risk of this particular company has got increased. Naturally, when credit risk increases for a particular company in the market, the expectation of the return from that particular company will increase. As a result, for existing interest rate, whatever the market price of the bond is there, it will fall. So market price of the bond undergoes a fall, right? So therefore, you have a fair value loss of 90 rupees. And if you are applying FVTPL method, then naturally what will happen? This fair value loss, which is nothing but change in fair value, will be transferred to P&L account. So therefore, is there a need of impairment provisions here? Impairment provisions means what? Eventually, you have a doubt that you will not get your money from that particular asset. Here anyway, you are recognizing the impairment indirectly, because always the change in the fair value anyway will be transferred to P&L account. So therefore, there is no problem here. Already it is getting reflected by way of recognizing the latest fair value. You understand the point? Therefore, impairment provisions will not apply when you are recognizing or measuring your financial asset by using FVTPL method. Clear? Okay. So with respect to ACM, it is very clear that since financial asset will be shown in the balance sheet at the fair value that you have recognized on the initial recognition date when you apply ACM, because you will not be doing fair value measurement on each reporting date, right? When you follow ACM method. So therefore, impairment principle should apply. Okay, that's fine, sir. So this is crystal clear case. When it comes to ACM, you will not at all apply fair value. Therefore, all the changes in the financial asset will not be reflected. Therefore, I have to apply impairment provisions. Logical, works out. It's crystal clear. In case of FVTPL also, it is crystal clear, because anyway it will be reflected and it will be transferred to P&L account. That's what we want. That is also crystal clear. Here, impairment provisions will not apply. Fine. What about this one, FVTOCI? This is in between the so-called FVTPL as well as what? ACM method, correct? Why is that, sir? See here. But it is interesting when it comes to FVTOCI, because if this method is applied, that is FVTOCI for measuring and recognizing your financial asset, anyway your asset is already at the fair value in the balance sheet. I'm talking about the latest fair value, just like FVTPL, correct? Because this is also fair value only. Only difference is in FVTPL, it will be going to P&L account. Here it will go to OCI. Then why do we need to apply impairment principles? Logical doubt. You would have got it already. Okay, the answer is fair value gain or loss is in OCA reserve, okay, and not in P&L if you apply FVTOCA. But in FVTPL, it directly goes to P&L account. So you have to calculate impairment loss by applying impairment principles even in case of FVTOCI, and then reduce the so-called impairment loss from the OCI reserve and then transfer it to P&L. You understand the point? So ultimate target here is whatever the loss or gain that you have got because of the changes in the fair value, indirectly reflecting the impairment loss as well. Just like in the case of FVTPL, in FVTOCI also it will be reflected, but instead of getting reflected in P&L, it will be reflected in OCI. Now that you are clear with the logic, okay, why only in case of FVTPL we don't do impairment loss, whereas even when it comes to FVTOCI, even though we are measuring it at fair value, all the changes in the value of the financial asset will be taken to OCI and not P&L. The ultimate target is to take it to P&L. So therefore, what we do is that we create the impairment loss, we calculate it, and then to that extent we reduce the amount from the OCI reserve and then take it back to P&L. Ultimately, our target is to recognize the so-called impairment loss in P&L account. I hope you got that logic. Now, imagine you're a bank. So now we are getting into the concept of impairment calculation. Okay, how to calculate the impairment loss, right? Don't by heart it, just try to understand the logic. Say for example, for a moment, imagine that you're a bank. You lend money to customers. Okay, now you want to make sure that if some customers don't pay you back, you are financially prepared. That's where impairment of financial asset comes into picture, because for bank, all these are contractual right to receive cash only, right? Earlier, under old rules, which means before the impairment loss have come into picture, you only accounted for losses after someone defaulted. But now under Ind AS 109, you must predict and prepare early for possible losses, which is nothing but kind of a proactive kind of a scenario. Okay, this concept is called expected credit loss model. This is what we're gonna learn right now. So what do you mean by this expected credit loss model? You will not wait for the actual loss to happen. Instead, you will predict and you will prepare yourself for these kind of possible losses. So there is no 100% clarity that this loss is going to happen, but then we use the word possible. Okay, there is a chance of this happening. There is a chance of this happening. Okay, so that concept we actually call it as expected credit loss model. Okay, right now. So how to calculate this ECL? How does it work? So for that we have certain steps. Let's apply these steps. So let's simplify the process into 5 easy steps. Now these steps are really important, Anna, especially when you get complicated problems. This step only will help you. Are you able to understand? So whatever I say, without any sort of diversion, just listen carefully and try to remember. Now let's look at this 5 steps, Nana. Okay, step 1 is what you got to understand when it comes to step 1. What kind of money are we talking about? See, money people owe you, right? That's what we call it as financial assets, contractual right to receive cash, which means people owe you basically, like loans, receivables. Okay, in other words, we are only talking about financial assets over here. We are not talking about shares, we are not talking about stocks. Indirectly, we are not talking about equity instruments. Clear? We are not talking about investment in equity. Make it very clear. So the so-called impairment loss is gonna be applicable only for these kind of assets where people owe you money and there is a chance of default. Am I clear? We are not going to apply this logic to equity instruments because it has got no relevance. First point. Next, step 2. You got to group your customers into 3 buckets, 3 stages we call. Let's call it as stages only. Okay, 3 stages. This is very important for problem solving. Don't think that this is a usual theory. Okay, this is very, very, very important for solving sums. Okay, there are 3 stages, and in each stage we try to understand what's happening and what you should do. Okay, let's say customer is absolutely fine. You don't have any signs, you don't have any clues. He is absolutely fine. There is no risk whatsoever. Risk means risk of what? Not paying you money, right? Then what you do, even in that case, keep aside small amount just for the next 12-month risk. We call this as 12-month ECL, which means 12-month expected credit loss. How to calculate all those things, we'll see later. We'll be following it up with a question as well. So just listen whatever I say. In stage 1, your customer is absolutely fine. There is no risk whatsoever. Even in that case, you will keep aside a small amount just for next 12 months. We call it as 12 months expected credit loss. Okay, now moving on to second stage. Risk is slowly growing. Okay, with respect to that particular asset, with respect to that particular company. Okay, warning signs are coming. But still asset is not credit impaired, which means They did not file for insolvency petition. You understand the point? There is no bankruptcy. There is no filing for bankruptcy, which means something wrong is happening. Something wrong has started, but still it is not out of control. You understand what I'm trying to say? Bankruptcy did not happen. Insolvency has not yet been filed. So which means your asset is not credit impaired, but you are getting warning signs. Then what you will do? Keep aside more. Keep aside means I'm talking about money. Okay. Cover entire life of the loan, and for that you have to create a provision indirectly. So we call it as lifetime ECL, lifetime expected credit loss. Clear? Okay. In the third stage, at the end of the day, here customer is in real trouble and your asset is credit impaired. Customer is your asset. I'm not saying customer is directly your asset. The amount that you have to receive from the customer is your financial asset, correct? When customer is in real trouble, it means that your asset is credit impaired, which means either the customer, he can be a company as well, he has filed for bankruptcy or insolvency or something like that, and thereby you know for sure that you are not going to get your money. When you know for sure, in case of a financial asset where there is a contractual right to receive cash and you know that you're not going to get the money for sure, in that scenario, we call it as asset being credit impaired. Now, in that case, you keep aside a lot. Again, cover full loan, not only loan, you cover for interest also. In case you have, say for example, invested in debentures in a company and then company filed for bankruptcy, you understand the point? Then you're not going to get your interest. You're not going to get your loan as well. You create lifetime ECL. You can also be a company. Please try to understand. Here we are dealing with two companies. One company has to give money to another company, or one organization, one financial institution has to give money to other financial institution or other company. It can be anything. You understand the point? Right. This is very important, Nana, for solving sums. I made it very simple. Once you start solving problems, you'll understand how simple this notes has been. Okay. All you need to do is that find out which stage they are in. Stage 1, you create 12-month ECL. Stage 2 and stage 3, you create lifetime ECL. As simple as that. That's all. Now you start solving sums, you'll understand that this made the problem solving very simple. Now moving on. Next to step 3 after this. Use your brain plus data. We are talking about the company. Don't just guess. Use past payment history of the so-called, customers who has to give you money. You understand the point? Or the companies where you have invested who has to give you money. Look at their current financial situation. Try to forecast their future. And you need to look into the economic perspectives as well, which means a recession is going to happen. Is there any risk in the job market? Inflation is going to happen. All these, we call it as forward-looking information. Do all these things. After doing this, you'll collect some data. Use that data. Here you'll be getting data. Na? Here I've written. Use that data and then calculate how much amount you may lose, which is nothing but ECL, expected credit loss. Now, how to calculate? Very simple. Ask yourself, how likely is that the customer won't pay, which means probability. How much will I use if they don't, which means amount. When might that happen, which means time. You understand the point? So probability, amount and time you need to calculate. How likely is that customer will not pay? That is nothing but probability. How much will I use if they don't? Amount. When might that happen? Time. So based on that, calculate expected credit loss, which is nothing but probability of default. That is the answer for the first question. Amount lost, which is nothing but cash flows, answer for the second question. Time value, which is nothing but answer for the third question. I hope you are able to get it. So don't buy hard things. Okay, just try to understand what's happening. So expected credit loss is equal to probability of default into amount lost, which is nothing but cash flows, the contractual cash flows which you have to receive, into time value. Got it? Fantastic. Now, let's look into an example and then we'll be able to understand things better. Ready? Now look at this example, Nana. Here, let's say there is a loan of 10 lakhs. Okay. And on this loan, the effective interest rate is 10%. Okay. So which means 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh for a period of 5 years, you need to get interest. And after that, you will get the principal repayment. That's the loan that you have given. So it's a financial asset for you. We are talking about the impairment of financial asset right now. So first, you need to identify the cash flows not expected to be collected, which is nothing but what we have seen here, right? How much will I lose if they don't? That is nothing but amount lost, which is cash flows. That you need to calculate first. Okay, amount that you're expecting to lose. Next, discount the above cash flows at original EIR. Here we were talking about time value, na? When might that happen? So based on that, you need to discount it by using original effective interest rate. Okay. Then finally, you'll be calculating ECL, which is expected credit loss, which is nothing but 3 3 is nothing but multiplied value of the discount rate, that is EIR, into cash flows that is not expected to be collected, and then you again multiply that with probability of default. Now coming on to multiplying with probability of default, why did I write this as 3 separate steps? Because here there are 2 different types of probability for you depending upon the data given in the question. One is 12-month probability, the other one is lifetime probability. When you have to create 12-month ECL, then you multiply with 12-month probability. When you have to create lifetime ECL, you multiply with lifetime probability. This is very important. Ultimately, what I've written here and this single formula, both are same. You see here? Okay, what did I write here? I said amount lost, cash flows, which is nothing but amount expected to lose. Cash flows not expected to be collected, same. Then I said you have to multiply with time value, which is discounting. That's what you're doing by discounting it at original EIR. Very important. The word original is also important. Original effective interest rate. Okay. Then after that, what you do, you multiply that with probability of default. That's what we have got in the formula. Okay. But here I've written this probability of default steps in a separate way. Why? Because there can be two different types of probability. One is 12-month ECL probability. The other one is lifetime ECL probability. Now again, the next question is, when should you multiply with 12-month ECL probability? When should you multiply with lifetime ECL probability? Very simple. When you have to create an ECL for 12 months, you will multiply with this probability. When you have to create an ECL for lifetime, you'll multiply with this probability, right? Now the question is, when you will create 12-month ECL, when you will create lifetime ECL. Indirectly, that we have seen already. In case of warning signs coming from your so-called financial asset and your financial asset is credit impaired, in both these cases, you will be creating lifetime ECL. Only when your customer is good and there is no risk, only in that case, you will be creating 12-month ECL. So that we have already discussed. Now let's see some specific cases based on your ICA problems. Concept is this. This is the concept. Here I have written these additional sentences based on your ICA sums which I have solved. You understand the point? So this is just like a reverse engineering. Right now, lease receivables. Okay. Lessor has a choice. In case of lease receivable, this is the only area where lessor has got a choice. Okay. He can go for 12-month ECL or lifetime ECL depending upon his thought process of how much lease rents he is going to receive. Financial asset which are credit impaired on acquisition date. Credit impaired means default has happened, bankruptcy has happened. You know that in that case, we need to prepare lifetime ECL, which we have already seen in the concept. Financial asset whose credit risk has increased since initial recognition. That is nothing but stage 2. Risk is growing, warning signs. But asset is not credit impaired. But even in that case, you have to prepare lifetime ECL. That's what we have got here. Next, amount is overdue for a period exceeding 30 days. This is a rebuttable assumption. What do you mean by rebuttable assumption? Which means by default, I'll assume that if any amount is overdue for a period exceeding 30 days, I'll feel that it is creating some sort of a warning sign and I'll try to create lifetime ECL for that particular asset. I'll come to a conclusion that mostly I'm not going to receive money. Although in some cases this may not be true because in some industries 45 days will be the right days. In some industries 19 days is common. So in that case you have to come and prove, are in this industry, in this kind of business, in this line of business, 30 days is not what usually happens. It has to be 60 days. It has to be 90 days. If you prove, then I'll change this. Then I'll keep it as 60 days. Only if it crosses 60 days, in that case I'll go for lifetime ECL. You understand the point? Rebuttable assumption means by default this is what I will think. If I'm wrong, you come and prove. Then I will change this. You got the point? Right. In any other case, go for 12-month ECL. So, specifically in these 3 cases, you will prepare lifetime ECL. First one is asset is credit impaired. Second one is warning signs have come, which is stage 2. And asset is not yet credit impaired, but you got all the warning signs. Okay. And the third case is where you did not get your amount for more than 30 days. That 30 days is not fixed. It is by default a rebuttable assumption. It can be 60, it can be 90 depending upon the data given in the question. Even in this case, you will be creating lifetime ECL. If you could understand, the essence of 3 and 4 both are same only. Na? Financial asset whose credit risk has got increased because of warning signs is nothing but this one. Na? Amount is overdue for period exceeding 30 days means you are getting a warning sign. This is stage 2. So when you are getting a warning sign, you will be preparing lifetime ECL. So in a way, the flavor of 3 and 4 both are same only. Are you able to understand? Only second one is different, where asset is credit impaired. That's it. Gaya, right? Khatam, tata, bye bye. Are you able to get this? All right. So I just gave an example for case 3. What do you mean by case 3? This one, example 3. Here I've given an example below. financial asset whose credit risk has got increased since initial recognition, for which you need to prepare lifetime ECL. So what do you mean by credit risk getting increased? For that, I gave you an example over here. Right, let's look at this example and then we will see how to do accounting, and after that we'll solve a problem. Okay, let's look at this example now. Look at this example now. Let's say you have purchased bonds of PK Limited Company. Okay, the fair value of the bond is 10,000. How did you calculate that? You have just taken future cash flows, contractual cash flows, and you have discounted that at 10%. It might be effective interest rate or it might be market interest rate, whatever the case may be, you got your fair value. Now, anybody, if you are trying to invest in bonds of any company, your return depends upon two factors. One is the risk of the company. What is a normal market interest rate? Okay. Now let's say there is a guy called Raju who is an investor. He requires 10% return for his risk perception from this particular company, PK Limited. Now issue price of PK Limited is 10,000. So in that case, he feels that, okay, fine, I'm actually getting 10%, whatever the return that I want. Therefore, Raju has purchased it because his risk appetite has been satisfied. After 1 month, the risk of the company whose bond he has purchased has got increased. Naturally, when risk of the company increases, his return expectation also will increase. Earlier, let's say it was 10%, he was happy with 10% at that particular point of time, at that risk of that particular company. Now that the company risk has got increased, his return expectation also will increase. So now Raju is expecting 14%. Now if he discounts the same contractual cash flows at 14%, the fair value of the bond is coming to around 9,070 only. Now you people tell me. Earlier, when his risk perception was 10%, which is equivalent to the risk of the company, on that particular day, the fair value was 10,000. The 10,000 was working out. But now, once the risk of the company increases, automatically your fair value drops because you discount at a higher rate. Why are you discounting at a higher rate? Because that is the expectation of the investors. What investors are expecting, at that price only you have to discount the contractual cash flows so that you will know at what price you need to purchase the bond. You understand the point? Now you account for the impairment loss. Okay. Now we know that there are only two options for you. Either your financial asset will be recorded or recognized following ACM method, or it will be FVTOCI. I told you FVTPL will not come. Why? Because in case of FVTPL there is no question of impairment loss. Okay, let's start with ACM. Now in ACM, what happens now? In this case, if you can see, there is an impairment loss of, this is not how you will calculate impairment loss, but just I'm giving a rough idea. You'll be having, let's say, 1,000 rupees of impairment loss. Suppose, okay, what you will do? You'll write 1,000 over here. To that extent, you'll be transferring to P&L account. As simple as that. You get it? Just focus on how to do accounting. Just follow the procedure. Don't focus on the numbers. I just gave you for example purpose that 1,000 is the number. Okay. After that, we'll be solving a problem. Once we start solving problems, you'll get 100% clarity. You understand the point? How to do the whole thing. Right now, just focus on what I'm trying to tell you. Now, this entry is very simple, Nana. You have loss, impairment loss. That's it. You debit your P&L account in case of ACM. As simple as that. Just like provision for bad debts. Okay. Then one more thing you will do. You'll go to the balance sheet. In balance sheet, when it comes to ACM method, your financial asset will be looking at the initial recognized fair value, which you have done years back. Okay, so you reduce this so-called loss allowance from that. Now that it will be looking at the correct value. Otherwise, you will have an inflated value for your financial asset. So you reduce this so-called loss allowance. Now you'll have a net financial asset value, which is a correct value. You got the point? Right. And another thing is for interest income calculation, because now that you are recognizing impairment loss, Nana, that doesn't mean that 100% impairment is going to happen. You will still be getting your interest payment. You understand the point? For that, for interest income calculation, which is our imaginary interest income calculation, you will multiply this so-called EIR percentage on what? If the bad debt is 100% certain, then you multiply this EIR percentage on net asset value. If the bad debt is not 100% certain, then you multiply that on gross asset value. That is this one. You got the point? Sir, what is this gross asset and net asset, sir? You'll understand when we start doing some. Okay? Right. This is just an additional point. Keep this in mind. So what you need to understand is that for interest income calculation, that is our imaginary interest, when the bad debt is 100% confirmed, then you'll multiply that EIR rate, whatever the original EIR rate you have got, you multiply that with the net asset value. Are you able to understand? If this so-called bad debt is not certain, then you multiply this EIR on net asset value. Got it? Chalo. Now, when it comes to financial asset which is being recorded at FVTOCI, here what is the thing? You got it? Because here already you would have been measuring it at fair value. So whatever the loss is there with respect to the financial asset, I'm talking about impairment loss, would have been taken to OCA reserve. Now only thing that you have to do is that from OCA reserve bring it to P&L. So therefore debit P&L and create your OCA reserve. You got the point? Because of fair valuation loss, because the fair valuation loss is already there in OCA reserve, just try to bring it to P&L, that's all. And also note that here you will not touch the balance sheet because your asset is already at the latest fair value in the balance sheet. Because that's what you do when it comes to FVTOCI, right? At each reporting date, at each balance sheet date, you will be remeasuring that at the latest fair value. So in the latest fair value, automatically impairment loss will be reflected. Then in that case, why would you touch it? So don't touch it when it comes to FVTOCI. But in ACM, your asset will be reflected at the original so-called fair value which you have recognized years back. Therefore, here there is a requirement to reduce the loss allowance and then show your asset at net fair value. You got the point? Net fair value, or you can call it as latest fair value, whatever the case may be. You got the point? So here a normal entry will pass. When it comes to FVTOCI, already the impairment loss is there in OCA reserve. From there you bring it and take it to P&L. So debit your P&L and credit your OCA reserve. What do you mean by crediting OCA reserve? Very simple, Nana. When there is impairment loss, it would have gone to OCA and reduced that OCA reserve. Correct? Are you able to understand? It would have reduced the OCA reserve. OCA reserve basically shows credit balance. You would have reduced it because of the impairment loss. Now you are taking it to P&L. So therefore the OCA reserve has to increase. How will you increase the OCA reserve? By crediting. Got the point? And you will debit the P&L because now that the loss is being transferred to P&L, the so-called impairment loss. Simple. But you will not touch the balance sheet because when it comes to FVTOCA, already in your balance sheet, the asset is at the latest fair value. Therefore, you need not touch it. In that, impairment loss is already reflected. Got it? Whereas when it comes to ACA, yes, your asset value also has to be disturbed. It has to be reduced to the extent of loss allowance. Right? Are we done with this? Now, let's look at this sum. San Fran is a company that has issued a public bond. Okay. It reports to its shareholders on a biannual basis, right? T Limited, a company which holds financial assets until maturity, which means they would have applied what? ACM method. That's what I've written here. So this is their business model. They hold asset until maturity. Is one of the many investors in San Fran's bond, which means T Limited basically purchased the bond of San Fran's. On purchase, T Limited deemed the bond to have low credit risk. So when they have purchased, they thought that the credit risk of the bond is going to be pretty low because the fundamentals, I think they're very strong. So San Fran's strong capacity to fulfill its short-term obligation means the liquidity is really good for that particular company, and that's at least that's how the talk in the market is. It was perceived, however, that adverse changes in the economic environment could have detrimental impact on San Fran's liquidity. Detrimental in the sense negative impact. At T Limited's reporting date, it has access to the following information about San Fran. So all of a sudden they got access to new information. So having access to the following information means this will come under what? Regarding the concept that we have learned, warning sign. Stage 2. Remember that? Stage 2, warning sign, where all of a sudden the risk increases significantly. So sales have declined 15% over the past 6 months. That's pretty bad. External agencies are reviewing its credit rating, but no changes have been yet made. Even though no changes have not yet been made, but still they are reviewing the credit rating. Although market bond prices have remained static, San Fran's bond price has fallen dramatically. Means what? The problem is that company specific, the entity specific. Okay, it has got nothing to do with the market. Got the point? Because ultimately the market bond prices have remained static, means it did not change. So which means outside the economic environment, we call it as microeconomic environment. That is fine. The microeconomic environment within the company, there is a problem. So in that case, company is doing something wrong. That's how it works. Or it's not doing something right. Okay. Discuss the accounting treatment of the bond in T Limited's financial statements at the reporting date. Sorry. Pretty simple, Nana. Anyway, on the reporting date, they'll be reassessing the credit worthiness. And already they've got access to these two things. So it's like a warning sign, which means from stage 1, it comes to stage 2. Once you have come to stage 2, it means you're getting a warning sign. Although the asset is not credit impaired. Right now, the financial asset is not credit impaired. That will happen in stage 3. In stage 2, you have a warning sign. All of a sudden, the risk has got increased. Then immediately what you'll do? You will calculate lifetime ECL. That's all. Now, how to calculate all those things? We don't have any numbers over here. So which means it's a kind of a theoretical question. So your answer will be what? Lifetime ECL has to be calculated eventually. How to calculate that? We know. That's all we need to write. See here. Using above information, T Limited needs to assess whether the credit risk on the bond has increased significantly since inception. Since beginning. It would seem that San Fran's performance has declined, and this may have an impact on its review of San Fran's credit rating by external agencies, is suggesting is suggestive of wider concerns about the performance and position of San Fran. Fine. The fact that the market bond prices are static, whereas there is a decline in San Fran's bond price, is entity specific, which means the problem is within the company, micro, not macro. Okay. This is likely to be response to San Fran's increased credit risk. Based on the above, it would seem that credit risk of the bond is no longer low. As a result, it can be concluded that credit risk has increased significantly since inception. It means the T limited should recognize loss equal to lifetime expected credit loss. That's all. So it's like a theory question where you need to apply the concept. Got it? Simple question only, nothing much. Once you know the concept, it's easy to solve, Nana. That's why at the beginning of this session also I told you, you revise it and then come, so that problem solving will be very easy. Otherwise, it will seem, very difficult. Chalo. So we should make things easier, not difficult. That's why we are spending so much of time on learning concepts. Moving on to question number 35. Now come to question number 35, everybody. Question number 35. This will solve it, okay? Now, don't come to a conclusion that how to decide when to solve, when not to solve. Depends upon the data in the question. Here you don't have any data. How much worth of bonds has been purchased? What is your EIR, effective interest rate? What is the probability? Do you have any information in this question to calculate ECL? Because we know how to calculate ECL. We have learned the concept. I don't have any information in the question. Therefore, I can clearly say that, okay, this is a kind of a conceptual theoretical question where you have to give answer in a theoretical way, right? Whereas if you look at this question, lot of numbers are given, correct? So therefore, I can understand that, okay, this is a problematic question. On 1st January 2001, let's presume this as 2001, okay? N Limited purchased a bond for 1 million, which is measured at amortized cost, which means ACM method. Okay, you know that all these problems will have either ACM method or FVTOCI method. There is no question of FVTPL because in FVTPL, there is no question of impairment. Got it? Of financial assets. So interest is 10%, is payable in arrears. Fine. Repayment is due on 31st December 2003. Fine, which means 2001, because it is January, 2001 is 1 year, 2 is second year, 3 is third year. Totally 3 years. The effective rate of interest is 10%. Okay, so the coupon rate and the effective rate both are same. If both are same, then your opening balance and closing balance in your assets table, financial assets table, the ledger account will be same. You remember the ledger account? Anyway, we'll discuss that. On 31st December 2001, N Limited received interest of 1 lakh. So first year interest has been received. It was estimated that the probability of default on the bond within the next 12 months will be 0.5%, 12 months ECL. That probability is given. 12 months ECL probability is given. If the default occurs within the first 12 months, then N Limited estimated that no further interest will be received and that only 50% of the capital will be repaid on 31st December 2003. The asset's credit risk at 31st December 2001 is low. So risk is low. So he is not saying that significantly the risk has got increased. In that case, shall we go for a lifetime ECL or 12 months ECL? We'll go for 12 months ECL, not lifetime ECL. Clear? Because clearly it has been given in the question that the credit is low. Suppose if he says the asset's credit risk has significantly increased, then we'll move from stage 1 to stage 2. Once you go to stage 2, even though the asset is not credit impaired, still we will go for lifetime ECL. Clear? Anyways, discuss the accounting treatment for the financial assets at 31st December 2001. Okay. I'll give you 30 seconds of time. Properly read the question. Every sentence is important. Okay. After that, you and me will solve it together. Read the question, Anna. Fatafat, read the question. Done with your reading, Nana? Chalo, let's start solving. This is question number 35. Okay. Fatafat will do. Will not be taking much of your time. Okay. Question number 35. You guys are ready? All right. Now, first of all, let's try to understand what is happening in this particular question. Okay. That would be easy for us to understand. So ultimately, it's all about 3 years, right? That bond. We have year 0, first year, second year, and then last year. Okay. First year, already you have received 1 lakh, isn't it? This much of money you have received. Second year, you are expecting that in case something wrong happens, hereafter you will not receive any interest. And even when it comes to principal also, you'll be receiving 50%. That's what has been given in the question. So which means, logically speaking, another 1 lakh you have to receive at the end of second year, which you won't be receiving it. Okay. Another 1 lakh also interest you have to receive at the end of third year, which you won't be receiving it. And also in addition to that, you should be receiving 10 lakhs principal repayment at the end of third year, which instead of 10 lakhs, you'll be getting only how much, Nana? 5 lakhs. Because 50% of it. This is what your expectation right now. If something goes wrong in the first year itself, first year ending, this is what your expectation is, correct? Now, tell me one thing. In the balance sheet of your company, okay, as on first year ending, what is the balance sheet rate? Balance sheet date 31st December 20x1. This is the first year ending, right? So just for understanding, I'm just preparing it in a T shape. Okay, you will be having your financial asset, which is investment in bond. And which method are you following? You are following ACM method. So when you are following ACM method, the initial recognition will be there. Na? That is the value at which it will be shown in the balance sheet. So what is the initial recognition value? Obviously, it's going to be 10 lakhs. That's what it is given in the question, right? Okay. Now, try to recollect the concept which I've taught you. Okay. You remember financial asset ledger, investment in bonds account. If you open up this account, what we used to do? This is financial asset for you. So financial asset means asset will show debit balance. So first what you have to do once you purchase the asset, what will be your entry? Investment in bonds account debit to bank. Okay, whatever the amount that you pay. So to bank, you'll be having your asset value over here. In this case, it is 10 lakhs. Then what you will do, you will increase the asset value, okay, to the extent of effective interest rate. This effective interest rate will be multiplied with this particular value. Mostly this will be fair value, correct? Fair value means your actual coupon rate and your effective interest rate. If it is different, then you'll be discounting your future contractual cash flows that you receive from this particular financial asset. That is nothing but future interest that you're going to receive, future principal repayment that you're going to receive. You're going to discount it at effective interest rate, and then you find out the fair value, correct? After finding out the fair value, what you will do with that effective interest rate, you multiply that with the fair value and you increase the asset value, recognizing interest income, correct? Then simultaneously what you will do, you will get the real cash flow, contractual cash flows you'll be getting. To the extent of contractual cash flows that you actually receive, that is the interest payment that you receive, sometimes interest plus principal repayment also you will receive, clear? To that extent, you will be reducing the asset value. Why? Because asset basically represents what? Future economic benefits. Here you're recognizing that in future I'm going to get interest. To that extent, you'll increase the asset value. But here you are realizing the benefit because you're receiving the contractual cash flows. Once you realize the benefit, the future economic benefits from that particular asset will be reduced. So therefore, to that extent, asset value has to be reduced. This is a logical understanding. Okay. In other words, we are doing unwinding of discount. After that, what will happen? You will be getting your closing balance over here. Correct? Right? Usually what will happen when compared to this so-called effective interest rate through which you will be recognizing your interest income, your contractual cash flows will be less. So to that extent, when compared to the opening balance fair value, your closing balance will increase slightly. Next year also same will happen. Next year also same will happen. Next year also same will happen. Ultimately, during the last year, how much redemption we are going to get, that is principal repayment, it will match and things will be done. That's what we have done so far. So many sums we have done. However, in this problem, this so-called EIR calculation, whatever the effective interest rate that you're using, and the contractual cash flows where you'll be getting the coupon rate. Contractual cash flows means you'll be receiving the coupon rate. Effective interest rate means our imaginary interest rate. Correct? Both of these are same in this question. When these two are equal, then your opening balance is equal to closing balance, isn't it? If these two are equal, your effective interest rate percentage and the coupon rate, if these two are equal, then obviously your opening balance should be equals to what, Nana? Closing balance. If these two are different, then only changes will happen. If these two are same, what is basically happening? If you're debiting, you're actually adding to the asset. If you're crediting, you're reducing from the asset. When both the percentages are exactly same, you're debiting X, you're crediting X. In that case, XX will get set off and ultimately your opening balance will be equals to the closing balance. This is the first important thing you need to understand, which means hereafter in any problem hereafter, if your effective interest rate is equal to the coupon rate, in that case, the opening and closing balance will match. Hereafter, all the other sums I'll not be explaining like this. Immediately, it should click for you. Okay, EIR and the coupon rate are same, which means opening and closing balance will be same. Then it's a matter. Clear? Okay. Sir, why is that you have taken so much time to discuss this? You will understand. Just wait. Okay. Did you understand the concept first of all? First understand the concept. Then how are we going to use it? That's a different perspective altogether. Clear? Right. Moving on. Now we need to calculate ECL, expected credit loss, or you can also call it as loss allowance. How much loss allowance are we going to calculate? 12 months or lifetime? 12 months loss allowance we're going to calculate. Clear? Now try to recollect the steps. To calculate this, what we need to do first? First, we need to find out how much cash flows we are not expecting to receive. Which means how much cash flows we are expecting to lose. Correct? Then you need to multiply that with the discount rate at original EIR. Then you'll bring it to the present value. So you'll have present value of loss. Once you get present value of loss, that has to be multiplied with probability, because there is no certainty that this will happen 100%, right? There is a probability of that happening. So you multiply with that probability. When you multiply with that probability, you have to decide whether you will multiply with 12 months probability or 12 months ECL probability or lifetime ECL probability. In this question, anyway, 12 months ECL probability is only given. So we'll be multiplying with 12 month ECL probability. We'll be getting the loss allowance. Once you get the loss allowance, what you'll do, because this is an ACM method, what will be your entry? P&L account debit to loss allowance. Correct? Because this is ACM method, we know the entry. And after that, what you will do, to that extent of loss allowance, you'll be reducing it from the asset value, financial asset value, that is investment in bonds in the balance sheet. And you'll be presenting it at a net value. That's all. Your total treatment is done. Clearly, we have learned the concept. So nothing new here. We are just going to have numbers. That's all. Clear? Now, what is the first step we need to calculate? Cash flows not expected to come. We need to find out cash flows not expected to come. Right. So first I'll have year as my first column, because already 1 year is done. We are already at 31st December 2001. Now you can ask me, how do you know that we are at 31st December 2001? Because we have already received 1 lakh, na? At 31st December 2001, we are anticipating what's going to happen in future. Now, these things are very important, Nana, to solve. Otherwise, you will by heart what you're doing. Okay. Where are we standing right now? At the end of first year. How do I know? Because first year cash flows of 1 lakh you have already received. If at all you have received second year also, then you'll be standing at the end of second year. And that sentence would have been given in the question, but that's not the case. In question, he clearly tells you that first year only I have received, which means you are virtually standing at the end of first year. That is 31st December 2001 you are standing. Okay. Now let's expect what's going to happen. When will be your next cash flow? We need to find out cash flows not expected to come. You are standing at the end of first year. Next cash flow you're expecting to come after 1 year. But if something wrong happens, you are expecting that hereafter no interest will be received. That's what we have done in the diagram here now. So which means here you are. You are here. You are here. And you are anticipating about the future. And you know that if something wrong happens hereafter, you will not be receiving next 1 lakh. You will not be receiving next 1 lakh. And you will also be receiving only 50% of what you should be receiving at the end of last year. So these are all, whatever the into that I've put, these are all the cash flows not expected. These are all the cash flows not expected. Okay. Right. In that case, 31st December 20x2. That is 1 year from now. You should be getting 1 lakh. But you're expecting that this 1 lakh will not come. I want numbers which will not come only. Okay. Next. 2 years from now. Another 1 lakh should come. But you're expecting that it's not going to come. Again 2 years from now. You should be getting your principal repayment. You are thinking that only 5 lakhs will come. Which means 5 lakhs will not come. Please understand here, this 5 lakhs what I have written is 5 lakhs that is not coming. Because both the numbers are same, don't get confused. 5 lakhs which is going to come, that I am not taking into consideration. I am taking that 5 lakh which is not going to come. Clear? Right. Now, you need to discount it at original EIR. What is original EIR in this question? 10%. This 10% is original effective interest rate. Clear? Which will be, so where are you right now? Where are you right now? You're standing at the end of year 1. You're standing at the end of year 1, which means year 2 ending will be 1 year from now. Year 3 ending will be 2 years from now. Don't do this mistake. Okay. Because by mistake, what you'll be thinking is, this is second year now. So you'll be taking second year discount rate of 10%. 1 divided by 1.10 equals to like that. Many students will do this mistake. That is the reason I've clearly mentioned in the diagram. You are not here. You are not here. You are here. So when you are at the end of first year, from here, second year will be 1 year discount rate. From here, third year will be 2 year discount rate. You understand the point? Suppose if you are at the end of year 0, then probably you'll be having 2 years and 3 years. You get it? Everybody. So because you're here, obviously from here, 1 year discount rate for second year, and from here, 2 years discount rate for third year. This is where you have to be careful. In that case, the discount rate for 1 year will be 0.9091. For 2 years will be 1 divided by 1.10 equals to 0.8264. This is also 0.8264 only, because both these things happen at the same point of time, right? Both interest and principal, because it is the last year. Now you find out discounted cash flows, which are not expected, You need cash flows that are not expected to find out the loss allowance. Okay, keep this in mind. So this will be 90,909. This will be, help me out with the numbers, Ray. It's easy only, 82,640. 5 lakhs into 0.8264, this one. 4,13,200. Thank you. Total, buddies. 5,86,750. All right. Okay, so now that we know what is this? Present value of loss. Present value of loss. Now we know that we need to find 12-month ECL. To find this 12-month ECL, what we should do? Present value of loss, that is nothing but cash flows not expected to come, should be multiplied with probability of default. What probability of default? 12 months probability of default. Why 12 months probability of default? Because it is clearly given that risk is low. Suppose if in a question, sometimes what he will do, he'll give you both the probabilities, 12 months probability and lifetime ECL probability as well. And then somewhere in the question, he'll tell you risk has got significantly increased. In that case, you have to ignore the 12-month ECL probability and take the lifetime ECL probability and then eventually multiply, you'll get your answer. You got the point? Chalo, that is equal to, this one is 5,86,000. See, if something wrong happens, ultimately this is the loss that I'll face. This much money will not come to me in present value terms. Okay. But the chance of this happening is how much? The chance of this happening is only 0.5%. If there is 100% chance of this happening, that is 5,86,750 will not come for sure, because the asset is credit impaired. And 100% this money I'm not going to receive. Then in that case, you should not be multiplying with 0.5%, you should be multiplying with 100%. Then entire 5,86,750 will be recognized and debited in P&L account. You understand the point? Which means instead of 0.5%, you'll be multiplying with 1 or 100%. Both are same. This happens when you reach stage 3, where asset is credit impaired. You understand the point? So try to understand how this thing works. Don't buy hard. If you buy hard, you'll not remember for a longer period of time. My target, always remember, your target is not to remember today, tomorrow, day after tomorrow for another 7 days. No, till the examination. Keep this in mind. And to remember for such a longer period of time, this is the only way. Don't try to buy hard. If you buy hard, even by buy harding also, there are people who are getting ranks as well. I know that, you know that. But what they do is that they do extreme hard work. They study for 10 hours, 12 hours. They revise 5 times, 6 times, 7 times, 8 times. You understand the point? In that case, you will get a rank for sure. It's not going to miss. But I'm talking about least effort, maximum result. You get it? I hope you guys are able to understand what I'm trying to say. Chalo. So 5,86,750 into 0.5%. How much, Ray? 2,934. Huh? All right. This much you will allow. So you will pass the entry. You will pass entry on which day? Today only. Today, where are you? 31st December 2001. This is where you are right now. Try to understand the time scale, and you are guessing about the future. Because the loss allowance is going to be proactive. Nana. Well in advance, you're going to recognize the loss. That's what Ind AS 109 says. Proactive recognition of impairment of financial asset. That is nothing but loss allowance. So today only you'll pass the entry. What is the entry? P&L account debit. Because this is ACM method, Nare. Isn't it, Nana? So ACM method, so P&L account debit to loss allowance. How much is that? 2,934. Alright, so what will be your balance sheet on 31st December 20x1? On the right side, you'll be having investment in bond. If it is T-shaped balance sheet, it will be at its original value on initial recognition, which is 10 lakhs. From that, you reduce loss allowance. You'll be doing this only if you are following ACM method. In FVTOCI, you will not touch the asset value. Keep that in mind. 2,934, you reduce it. Your asset will be showing at 9,97,066. Clear? And so this is your loss allowance. Besides this, you also need to recognize income, na? On the same date, 31st March 20x1, that is after 1 year, where you are standing right now, you need to recognize interest income. Interest income recognition. How will you recognize your interest income? Simple, routine stuff only. How much is the total value of the asset? 10 lakhs into 10% only, na? Coupon rate. You will be receiving 1 lakh. To the extent of 1 lakh, you will recognize the interest income, which means it will be created, obviously. Got it? Suppose if the default has happened and your asset is credit impaired, then we will not be multiplying the interest income on the gross value of the asset. Instead, we'll be multiplying this interest income on net asset value. Net asset value means after reducing all the loss allowance stuff. Okay, this also I've taught you. I don't know whether you remember that or not. Let me show. Here. For interest income calculation, if the bad debt default is certain, 100%. In our case, it is only 0.5%. If it is 100, certain means 100%. Let me write that also. Otherwise, you'll get doubt. If the bad debt default is 100%, where asset is credit impaired, stage 3. In that case, apply EIR on net asset value, not the gross value. Right now, 10 lakhs, what we have put is gross value. You need to apply this 10% on net asset value. But otherwise, apply EIR on gross value of the asset. Here, in our case, EIR is 10% only. Don't try to forget the concepts. Right? EIR recognition means it is what? Interest income recognition means EIR only, na? This is interest income recognition entry, EIR only. Contractual cash flows means coupon rate. Logically, in this sum, both of them are same. But there will be problems where both of them will be different. In that case, for interest income recognition, this is our imaginary entry. Na? This is how you'll increase the value of the asset. So many sums we have done so far, isn't it? For contractual cash flows, you'll go for coupon rate. For interest income recognition, we'll go for EIR only. Clear? Now, this EIR, should you multiply on the gross value of the asset or net value of the asset is the discussion right now. Got it? If your asset is not credit impaired and if your default is only lesser percentage, in this case it is 0.5%, then you put it on the gross. Suppose your default is certain. Okay. Then you should not be multiplying this EIR for interest recognition entry on gross value of the asset. Instead, you should go for net value of the asset. Right now, in this sum, you'll not know what this is. In the next sum, you'll understand. Clear? Are we done with this? Okay. Any doubts so far? We're done with this. Problem is solved. Any doubts? To the extent of interest income, your financial asset investment in bonds value will be increased. Investment in bonds account debit to interest income. That's what the entry that we have been doing now so far. Then to the extent of contractual cash flows, which will be based on coupon rate, will be reducing the value of the asset once you get those cash flows. So bank account debit to investment in bonds account, where asset value has to be reduced and you will receive money, therefore bank account will be debited. We have seen this so many times, isn't it? Done? Any doubts in this question before we move on to the next one? Well, fantastic. All right. Here you have your ICA answer. Okay, your ICA answer is cut short. You have our answer as well. You follow our answer only. Okay, this will be a lot more clearer for you. That's why our solutions book is very special, unlike the question banks that you find in the market. Got it? So that this revision, just imagine how our solution is how good when compared to your ICAs. But it is presented in the same way. But you'll understand this very easily. You'll not get doubts in future. Got it? Well. All right, guys. Question number 36 now. On 1st February 2006, let's call this as 2006 only, okay? E Limited makes a 4-year loan of rupees 10,000, right? The coupon rate on the loan is 6%, the same as the effective rate of interest. So we know that when coupon rate, which reflects the contractual cash flows, and the effective interest rate, which we actually use it for calculating the interest income, when both of them are same, then the opening and closing balance of financial asset will be same. Let me write that over here. Opening and closing balance of financial asset will be same. How? Should I explain this? Already we have seen this in the earlier sum, isn't it? So now that you guys should know about this, okay, don't ask me again. Chalo, next. On 1st February 2009. So 2006, 7, 1 year, 8, second year, 9, third year. Totally it is 4 years, but third year, what's happening? Fern tells E Limited that it is in significant financial difficulties. Question itself has told you very clear. The moment you see this word, what is the sign? You people tell me. The moment you see this word, what is the sign? Should we go for lifetime ECL or sorry, 12-month ECL? Lifetime ECL. Very good. The moment you see that, you need to understand. Okay, that's the first point. And at this time, the current market interest rate of 8%, E Limited estimates that it will receive no interest from Fern. Okay, it also estimates that only 6,000 of the capital will be repaid on the redemption date. How should this be accounted for? Okay. So in the question, it has been clearly given that this guy is facing significant financial difficulties. Okay. All right. Now, read the question. I'll give you just 20 seconds. Once you're done with reading, we'll start and solve it together. Okay. Ready? All right, Nana. Okay, I'll wait for a few more seconds, then we'll start. Okay. Now, the first and foremost important point, what you guys need to understand is that there is a difference between significant risk getting increased. Earlier, there was low risk, and then now the risk is getting increased significantly versus significant financial difficulties, which has already been established. Okay, you guys need to understand the difference basically. Okay, the basic difference is that normally you'll be in stage 1 where you'll be having low risk, and after that the risk significantly increases. That's where you come to stage 2, the other group of your financial assets. From there, once the asset is credit impaired, which means a default is going to happen or something like that, then you go to stage 3, right? What your ICA has done is that they have taken an interpretation that having a sentence in the question which says significant financial difficulties itself is a proof that asset is credit impaired. Although, honestly, I should say that I'm not 100% convinced with this conclusion that your ICA has arrived at. But then, as you know, in certain cases, we just need to follow what ICA says. So this is a JICA moment scenario. Okay. So hereafter, whenever in a question you see something called significant financial difficulties, now that is an evidence for you where you need to understand that the asset has been impaired, credit impaired. So when I say asset is credit impaired, it goes to stage 3. Once it comes to stage 3, there is no doubt that you have to apply lifetime ECL. And not only that, when we are talking about asset being credit impaired as a conclusion, then the probability of the default is 100%. It is certain. When the probability of default is certain, when you are calculating interest income by using effective interest rate, you should be calculating that on the net asset value, not on the gross asset value, which we have seen in the earlier sum. We have discussed this particular point. And even in conceptual material also, I gave you this one. Okay, so whatever that is relevant for this particular question, I already gave you an idea. Now let's start solving. Okay, hello, question number 36. Question number 36. You guys are ready? Okay. Original period of loan is how much, Nana? 4 years. Okay, loan period. That is the original loan period, correct? How many years are completed right now? Because this is very important, and otherwise there is always a probability of you doing mistakes. Okay, in examination also do like this, but you do it in the rough work. Okay, this is not forming part of your answer. Even in the earlier question also, these diagrams are not forming part of your answer. This is only for your understanding. I hope that much of common sense you've got to differentiate at least what you should write in the examination or what you should not write. You understand the point? Our ICA is not like UPSC, Nana. In fact, in UPSC exams, if you write something like this, if you use more and more diagrams, you get more marks actually. You get the point. So I have this habit that I've developed from there. You actually get more marks. You get so they appreciate you and they'll give you more marks. That's how I've got more marks actually, because I'm from science background, right? So I'm pretty decent in diagrams, at least creativity wise. But okay, execution maybe it might go sideways. That's okay. Chalo. Anyways, so but हमारा ICA तो very rigid. Okay, what is there in the, because the problem is in UPSC, the kind of people who are correcting your papers or professors of universities who have done PhDs, so by default their average intelligence level is much higher. Okay, because they're actively involved in the subject now. See, the people who are correcting our papers are also qualified CS only. So that doesn't mean that they have the knowledge with respect to all the subjects that they are correcting. Plus, moreover, our people doesn't give enough, remuneration. When this is not given, there is no motivation to correct, and he'll not have any sort of emotional attachment when he's correcting the paper. So you keep this in mind. Okay. So therefore, what we need to do to get good marks, as and when, I mean, in the sense, try as much as possible to match with your IC answer. At the same time, we can't by heart each and every answer in each and every subject, in each and every chapter. That's literally impossible task. So we'll try to match 80 to 90%. That's what our target is. Clear? Chalo. So 4 years. Now, where are you right now? I'm either here. Got the point? This is today. You are here. This is really important. Okay. Now, so 3 years got completed. So till here, the time got completed. And Fern, that company Fern has already informed that it cannot pay any further interest. And principal also, how much it can pay? 6,000 only out of 10,000. That is also clarity is given, which means anyway I'm not going to pay interest for the last year. I'm not going to pay 4,000 out of 10,000. So therefore I'm going to pay only 6,000. You got the point? This, you are knowing about this when? You are coming to know about this sort of information when? Third year. This is where you are, and now you are about to get this sort of information. Okay, now you are aware of this sort of an information. Okay, fine. This is what is going to happen in next 1 year. So all the things that you're going to do, your entry passing and stuff like that is going to happen in this timeline. This is the timeline. This is very important. Once you understand this, rest of the things will be easy. Clear? So what is the date according to this question? I think 1st February 2009. That is today. Okay. Next year will be 1st February 2010. Got it? 2010. Okay. Now, tell me one thing. What I have to do. So you know that here, let's look at our balance sheet. In our balance sheet, you'll have the asset loan to Fern, because we gave loan to Fern now, right? And he is following which method? ACM method. If it is FVTPL, sorry, if it is FVTOCI, it would have been clearly mentioned in the question. How much is the value of the asset in the balance sheet? 10,000. Why 10,000? Because in ACM, during the initial recognition on year 0, whatever the entry that you pass, the value that you pass, same value will be carried forward for all the years. If it is FVTOCI, then every single year, the fair value will be changing and the difference in the fair value, whether it is gain or loss, will be transferred to what? OCI. But here, that's not going to happen because we are implementing ACM method. Clear? Right. What else? Normally, what will be your interest calculation as of today? Normally, 10,000 is the loan that you have given. Out of that loan, he has to pay you how much? 6%. So you should be getting an interest of 600 for the last year, correct? Right. Yes. Okay. Principal, that is the financial asset loan amount, is how much? 10,000. And you also need to understand that in this question, effective interest rate is equal to coupon rate, correct? So when effective interest rate is equal to coupon rate, basically what happens, this is your asset, okay, loan to fund account. This is your asset, loan to fund account. And here initially you'll be having 2 bank because you would have paid money, right? You gave loan. So this is at fair value. Anyway, the fair value will be 10,000 only. Why? Because anyway, because both the percentages are same, na? EIR. See, how will you find fair value? You will discount at the market interest rate or EIR. Your coupon rate and market interest rate are same. So nothing is going to happen. Clear? Next, 2 interest income over here. This will be based on EIR, which will increase the value of your asset. By contractual cash flows. Usually this will be by bank. Contractual cash flows, correct? And this will be based on coupon rate. Now we know that in this question, this is 6%, this is also 6%. So eventually they'll cancel out and ultimately you'll be having by closing balance over here and both the opening balance and closing balance will be same. Keep that in mind. Because we need closing balance at the end of year 3, na? So what we are trying to say is that anyway that balance is 10,000 only. It's not going to change. That's what we are trying to say. Clear? Because first year also this is what will happen. 10,000, this will cancel out. First year ending, the closing balance of the asset account will be 10,000. Again, second year opening 10,000, 6% gets cancelled out. Again, closing balance is 10,000. Again 10,000, 6% cancelled out. Again 10,000. Right now we are standing here, third year ending. This is first year, second year, third year. So what's the value? 10,000. Clear? Okay, now, so we need to find basically ECL. Calculation of what ECL? Lifetime ECL. What are the steps? The first step is to calculate the cash flows not expected. So you guys remember the format that we have done in the previous sum. First column will be year, then cash flows not expected. Then you discount it at what discount rate? Original EIR, which is 6% in this question. Then you will be getting discounted cash flows not expected, obviously. So coming on to years, where are we standing right now? Hum kidhar hai? Right, third year ending. So which means here after how many years are pending? Only 1 year. So in this 1 year, what are all the cash flows that is going to happen? One is that you will get interest. The other one is principal repayment. That's all. So what is the date I should be taking? 1 year from now. 1 year from now means 1st February 2010. Sorry, 20x0. Right. So 1st February 20x0. How much is the interest you are expecting? Already we have calculated over here, 600. That much you are expecting not to come. You won't get confused. Sir, what is this, sir? It is given in the question that interest, no further interest will be there. Yes, my target is to calculate cash flows not expected to come. So there will be no further interest. Na? First of all, you need to identify interest who even write saying that this much is not expected to come, correct? So what you need to understand is that no further interest is expected to come. That I know. How much? To calculate the loss allowance. For that, at least I need to calculate the interest. So you think opposite. So if nothing has happened, how much interest I would have received? 600. That I'm not going to receive right now. Right, that's 600. Clear? Obviously 6% means 1 divided by 1.06 only for 1 year. Don't put the present value factor for 4th year. Even though it is 4th year ending right now. But you are standing at the end of 3rd year. When you are calculating all these things, you are standing at the end of 3rd year. So therefore 1 year will be the discount rate. So 1 divided by 1.06 is equal to how much? 0.9434. Okay. Another one, 1st February 20x0. What is the other cash flow that you are not expecting? You have to get principal repayment at the end of 4th year. Total you need to get 10,000, but you're not going to get 10,000. How much you're going to get? How much you are going to get? 6,000. Should I write 6,000 over here? 6,000 is what you're going to get. What is the heading here? Cash flows not expected. So you should not write 6,000. You should write 4,000. How much you are not expecting to get. You get the point, right? 6,000 you're expecting to receive. How much you are not expecting to receive? The rest 4,000. So you should write 4,000 over here. Same 0.9434. Multiply this and give me the number, Nana. 4340. You can do this calculation. This is present value of loss. Present value of cash flow loss. Okay. Now that we know present value of cash flow loss, to calculate ECL in the next step, what we need to do? Just what ECL this is? Lifetime ECL. Just take the present value of cash flow loss and multiply that with lifetime ECL probability of default. Lifetime ECL probability of default, because there are two different types of probability of defaults. 12 months, lifetime. So here we need to apply lifetime. That is equal to present value of cash flow loss. We have calculated 4340 into, tell me, what is the probability of this happening? Already asset is credit impaired because of significant financial difficulties. That's what your ICA has concluded. So when asset is 100% credit impaired, then it means that your so-called probability is what? 100%. So into 100%. Or you can also write 1 because the default is certain. Okay. In that case, your answer will be 4340. Now pass the entry. We are following ACM method only. ACM method means what is the entry? P&L account debit to loss allowance. How much is that? 4340. 4340. Clear? So what will be your value on the balance sheet on 1st December 2009? This is next year expectation, 1 year from now. That's why we are discounting. Today we are in 2009, February. Got it? So what will be your asset value? Loan to firm. 10,000. Should I show it at 10,000? No, this is 3 years before value during the initial recognition because we are following ACM method. Correct? Huh? So you have to reduce the loss allowance and show the asset value correctly. In FVTOCI, this problem will not happen because anyway, you'll be remeasuring at latest fair value, right? So how much is that? 4340. So what will be your asset value? This is net asset value. This is net asset value. Let me write here. Net asset value. This is gross asset value. Now, for last year, anyway, you need to calculate interest income, na? You got the point? Still, you need to calculate. Okay. How will you be calculating interest income? You'll be calculating on gross or net? I'll be calculating on net. That's what Ind AS 109 says. Okay. So, this will happen on 1st February. 1st February 20x0. That is the last year, 4th year ending. Okay. So, your interest income. Recognition. How will you recognize your interest income, Ray? Pretty simple. Exactly. This is our imaginary interest income, no? Obviously not the contractual cash flow. To that extent, your financial asset loan value has to be increased. So asset needs to be debited. So loan to earn account. This is financial asset account. Asset value has to be increased to interest income. Interest income will be calculated on what basis? On the net asset value. What is your net asset value? 5,660 into 6%. Not 10,000 into 6%. 5,660 into 6%. Okay. How much you get? 340 because the asset is credit impaired. That is the reason we are calculating the interest income on. Now, don't come with a stupid logic. I already see some people are asking doubts. Array, my dear, sweet students, this is imaginary entry. How many times I have to say? Not real one. Contractual cash flow entry is real one. Based on coupon rate. How many times I have to say? You should not even get that doubt. Sir, it is clearly given in the question that you are not expecting interest income. Interest income is not going to come. Here also you have done the calculation. That interest income, the company is not expecting to get it from firm. I also know that. What interest we are talking about? The real cash flow, which is contractual cash flow entry, where you'll write bank account debit. You remember that? Once you receive the actual contractual cash flow money, interest, coupon rate, you'll receive money. So bank account debit to loan to firm limited, where financial asset value will be reduced because you have realized money. That will not come. Did I pass that entry? That will not come. This entry you need to pass. This is income recognition entry, our imaginary entry na. We are doing unwinding of discount na. This is unwinding of discount entry. So why you guys are getting these kind of doubts? This is where you should have conceptual clarity. Okay. Chalo. Next, bank account debit. Why are you debiting bank account? 10,000 will not come principal redemption. 6,000 will come na. For that you have to recognize bank account debit to loan to firm. How much? 6,000. Got it? Okay. Now, asset balance will be how much? Loan to firm, that is financial asset balance, is equal to. Now, you people tell me, how much will be the balance? 10,000 was the initial balance, correct? Plus 340 you have added. Here you have increased the asset value, 340. And you have reduced 6,000. Correct? Therefore, how much will be your asset balance? 10,000 plus 340 minus 6,000. You people tell me. 4,340. Debit balance, obviously. Now what you will do, you have to close this asset account because this asset no more exists. Whatever you need to receive, you have already received. Correct? So how to close this asset account? This much of debit balance is there still. So you have to credit it to close the asset to loan to firm. Okay. 4,340. Now asset is completely zero. Clear? Yes? What you will be debiting? Already we have created loan allowance. Where is it? Sorry, not loan allowance, loss allowance. Already we have created exactly same amount. See, 4,340. That you debit. Loss allowance. How much? 4,340. With this entry, what has happened? Earlier, you have created loss allowance of 4,340. Again, here it is debited. It got cancelled out. Coming on to your loan to phone account, it was showing 10,000. You increased by 340. It became 10,340. And after that, you received how much? 6,000. To that extent, it got reduced and it became exactly 4,340. Therefore, loss allowance will be debited. And to that extent, loan to firm, that is financial asset, will be created. So therefore, asset is credited. To that extent, asset becomes zero. And this loss allowance also is gone. That's how you close. Got it? Chalo. Let's go through this once. So what did we discuss first of all? First, we need to understand that we stand at the end of year 3. Then after that, from the question, it was quite clear that because of significant financial difficulties, the asset is credit impaired. Once the asset is credit impaired, we obviously know that we have to create lifetime ECL. How to calculate lifetime ECL? First, we need to calculate the present value of cash flows that you are not expecting to receive. Then you need to multiply that with probability of default, which can be a 12-month probability of default, lifetime probability of default. In this question, it is lifetime probability of default. So the first step is to calculate present value of cash flows not expected to come. So for that, first we need to write cash flows not expected to come. You are at the end of 3rd year, so there is only 1 year pending. So 1 year interest you're not expecting to come. 1 year after, out of 10,000, 4,000 you're not expecting to come. So therefore, put those two numbers, and then you discount it at the original effective interest rate, which is nothing but coupon rate in this question. Both are same. Therefore, you'll be getting 0.9434, 0.9434. Why both the discount rates are like this? Because it is just 1 year from now. We are at the end of 3rd year. Therefore, you should be taking discount rate of 1 year only from here, 1 divided by 1.06. Then you get the present value of cash flow loss. You multiply that with lifetime ECL probability, which is 100% in this question, because it is certain that that guy is going to default. Then only your asset will be credit impaired, only when it is certain. So you know that for this much, you have to create the loss allowance. This is happening on which date? 1st February 20x9. On that date, all these things are happening. On this date, 1st February 20x9. That's where you have created loss allowance, and you have accordingly reduced your asset value, and you're showing your asset value at 5660 in the balance sheet. In the balance sheet. Clear? Right. Now, next what you will do, you will come to the last year. In the last year, what is happening? You will put an imaginary entry for income recognition. You are not receiving this. This is imaginary. Okay, contractual cash flows entry is the real one. So in imaginary interest income, what we'll do? We think that this much we need to receive. To that extent, we'll increase the asset value, because already we have discounted the asset value. Now again, we have to do unwinding of discount. For that, you need to multiply this 6% on the net asset value. That is this one, not on the gross asset value. If there is no certainty of default, then I'll be multiplying this 6% on 10,000. Because this is imaginary entry where you have to increase the asset value. So increase the asset value by 340. Already your asset will be showing in the account. In the account, which account? Not balance sheet. Account. Ledger account is there. In that ledger account, your asset will be showing at 10,000. Because I'll tell you in ledger account what will be happening. First year, 10,000. Then effective interest rate, that is interest income. And contractual cash flows, that is coupon rate. Both will cancel out. Closing balance of first year, 10,000. Again, next year opening balance, 10,000. This both EIR and contractual cash flows get cancelled out. Closing balance of second year, 10,000. Again, opening balance of 3rd year, 10,000. This and this will cancel out. Closing balance of 3rd year is also 10,000. Got the point? And then opening balance of 4th year, 10,000. EIR and contractual cash flows gets evened out. Here also you'll be having closing balance of 10,000. But here there is some trick that is happening where you will be adding 340 over here, and contractual cash flows entry you will not be passing only in the last year. Till third year it is like this, where it is getting cancelled out and your opening and closing are same. But once you have come to end of the third year, all of a sudden what is happening at the end of third year? You are recognizing that, okay fine, this guy is not going to pay me interest, and therefore contractual cash flow entry will not happen. And at the same time here you cannot pass 6% entry on the entire 10,000, because you know that your asset is impaired right now. So you have to multiply that on net assets value, because your asset is credit impaired and the default is certain. Therefore here you'll be getting 340 instead of 600. That is not 6% into 10,000, rather 5,660 into 6%. And here on this side, nothing will happen, because you are not receiving any real interest. You understand the point? Now you are able to understand. Therefore, now the closing balance will not match. Now the closing balance will become 10,340. That is where we have started. 10,340 was the closing balance. From there, you have to reduce this 6,000 by bank. In that only, by bank 6,000. 6,000 is not interest, principal repayment. So by bank 6,000. So now your asset value will show at 4,340 in the ledger. And then now you close it off by setting it off with loss allowance, which we have already created previous year, which is 4340. Now your asset becomes 0. How do you set it off? You credit the asset, it becomes 0. Debit, what you should do? Did you receive anything? No. Usually when you will credit the asset, when you receive money, here you did not receive money, because you are not going to receive money. Why you are not going to receive money? Because it's a loss. Therefore loss you debit and you credit the asset, thereby asset becomes 0. I hope this is clear. Now you should have complete clarity of what has happened, the entire story of what has happened. Clear? Right. I hope you guys have enjoyed the session. Chalo, right, Nana? Okay. Still, there are a few questions when it comes to impairment of financial assets. I think we are done with 36. 37 we have. But then immediately next question, we have derecognition as well. Still, we haven't covered all those concepts. So next class, what we'll do is that we will stop the sums here. Next class, we'll finish off all the remaining concepts of financial assets, and then we'll come back, we'll start solving sums, because modification of the asset, derecognition of the asset, all those things are there. Okay. So we need to finish off all those things. See, derecognition is also happening. Factoring also has come into picture. Factoring is part of derecognition of asset. That's also another good concept. Okay. So therefore, till 36 we have done. 37 onwards, we'll do it after finishing off all the other concepts of financial assets. Okay. Chalo. That's all for this particular session. Let's wind up. In the next session, we'll again start with concepts. So what concepts? We'll be starting with reclassification of financial asset. Then we'll go for derecognition of financial asset. We'll finish it off, and then we'll come back and we'll start doing sums. Okay, sure. All right, guys, let's get back to the session. Okay, confirm me everything. Audio is clear. Is there any lag? Great. Okay, awesome. Okay. All right, guys. So now, as I've told you in the last session, what we are going to do is that we're going to come back to the concepts, and we have a lot of concepts left. So we're going to finish off those concepts, especially financial assets, and after that, we're going to go back to the sums. Why? Because there are so many problems where there is a mix of things. For example, right now we are done with impairment, right? But then there are sums which includes both impairment concept application as well as derecognition of financial asset. Now, to go for derecognition, first we need to finish off reclassification of financial asset. After that, we will go for derecognition. So we have a lot of stuff to cover. So what we'll do is that let's finish off the concepts, not all the concepts, but financial assets first, and then we can go for sums, and then again we'll come back, we'll go with the remaining stuff, financial liabilities, and then compound financial instrument, and then so on. Okay. Now, let's start, guys. Reclassification of financial asset. So the first thing what you guys need to understand is that what do you mean by reclassification? Okay. Well, the answer is pretty simple. Initially, whenever you have a financial asset, you will decide a particular model, right? First, you will see what is your business model, whether you have hold till maturity or you have hold till maturity, but you may sell, or you have speculative intent or trading intent. So this is 3 types of business model. We'll see that. Depending upon that, we will choose either ACM method for recognition of financial asset, or we'll go for what? FVTOCI, or we'll go for FVTPL, correct? Now, when I say reclassification, we are talking about an asset, a financial asset, which is already following a particular methodology. For example, it can be ACM or FVTOCI or FVTPL, and you want to move from one to other. Why you would like to move from one method to other method? Because your business model purpose has got changed. Because the mindset will change, right? The purposes might change, the situations might change, the environmental conditions might change, the economic conditions might change. So initially, probably you would have bought a particular debenture with an intention that you will hold it till maturity. But then all of a sudden there was a financial crisis for you, or you see a good opportunity, you want to sell it, something like that. But you have been implementing ACM method. But when you have a business model where you have an intention to sell, you can't go with, or you can't continue with ACM method, right? So you have to change from ACM to FVTOCI, right? Or say, for example, you might have, purchased debentures with an intention that you will sell. But then after that, you have taken a decision that, okay, no, let me keep it with me till maturity. I would like to get the interest and the redemption at premium, say, for example, at the end of the life of that particular debenture. So what I'm trying to say is that nothing is consistent when it comes to business. Situations change because future is always uncertain, right? So when you purchase that particular financial asset at that particular point of time, probably your thought process would have been different. The challenges would have been different. The situations and circumstances would have been different. And now things will change after 1 year or 2 years or 3 years. That's where requirement of reclassification comes into picture. I hope this is clear first. Okay. So first we need to understand why do we need to reclassify a financial asset. For that only I gave you this much of explanation so far. Okay. Things changes. Situation changes, environmental changes. You got the point? Economic condition of a company changes. Your company might change, and the company who has given you debentures, that company's economic position might change, or the business that you are in, that entire sector might change. It might get better or it might get worse also, or your country might have gone into recession, or your particular state would have gone into recession, or there is a particular state where the boom has happened, so you want to sell it and you want to buy, debentures from that particular company. So we can't say infinite number of possibilities are there. Got it? Right. Okay. So financial asset, basically we will decide the method based on two tests. One is business model test and the other one is SPPI test. Solely payments of principal and interest, which is nothing but contractual cash flow test, CCFT. Both are nothing but same. Contractual cash flow test is nothing but SPPI test. Okay. One point that you guys need to understand here is the business model test is in control of the company, correct? See whether I want to hold this particular financial asset till maturity, or I would like to hold it and sell it whenever I want if I get a good opportunity, or if I have a liquidity crisis, or I'm going to do it for speculative purpose or trading purpose. It purely depends upon me, and that is innate. Correct? It's like my free will, a free will of the company, right? So therefore, business model test is within the control of the company. However, SPPI test is not within the control of the company. Why? Because the other guy has to pay you interest now. If his financial position goes down, you might not get interest. You understand the point? If he goes for bankruptcy, you might not get interest. See? So this one part based on which actually you decide which method to apply, whether it is ACM or FVTOCI or FVTPL, based on both these tests. Unfortunately, one of it or half of the test is within your control and the other half is outside your control. Got it? So based on these two tests, we decide whether we need to apply ACM method for recognition of a particular financial asset or FVTPL or FVTOCI. Let's try to recollect. You guys know that if it is hold to collect or hold till maturity plus SPPI test is passed, we'll go with ACM, right? If it is hold to collect or hold till maturity and you might sell plus SPPI test is passed, we go for FVTOCI, right? First of all, SPPI test is failed and you have a speculative intent or any other purpose, you go for FVTPL. This is what we know, correct? Right. Okay. How many possibilities for reclassification are there? Very easy, 6. Because there are 3 methods, right? So if you talk about ACM, you can shift from ACM to what? FVTPL or ACM to FVTOCI. So for each method, you have 2 more alternatives. So 3 methods, 2 alternatives. Totally how many alternatives? 6 alternatives. Pretty simple maths, right? So totally how many possibilities are there for reclassification? 6 possibilities. ACM, from that you can move to FVTPL or FVTOCI. FVTPL, obviously what is left over? ACM, FVTOCI. FVTOCI, ACM and FVTPL. Pretty easy to remember, okay? So totally how many possibilities are there for us for reclassification of financial asset? 6 possibilities. Fantastic. Right. One point that you need to apply here is that your so-called new method, suppose you're shifting from, say for example, ACM to FVTPL. Just like that, you can't shift this year itself. This year you're implementing ACM, you wanted to shift to what? FVTPL. For that, you are saying that, okay, my business model has got changed. Just like that, you can't shift. Obviously, it should be backed by evidence. What is that evidence? Your business model must have changed. Even in that case, you can't shift in the current year. It can be applied from next year, and also accounting will be prospective. Very, 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 very important. Accounting will not be retrospective. Accounting will be what? Prospective. For example, you have bought debentures. Total 5 years, tenure. Initially, you thought you will hold it till maturity. So naturally, you will apply ACM. So first year, second year, you have applied ACM. And second year ending, you have decided that, okay, I want, if at all I see any good opportunity in next 3 years, before maturity of the debentures, before redemption of the debentures, I might sell it. In that case, your intention is not just to hold till maturity and sell if at all any opportunity comes, or if there is any other challenge comes, like you need money and stuff like that. Okay. So therefore, you decide to change. Got it? And the change will apply from third year, that is from next year. Yes. And From third year onwards, you'll go with FVTOCI. Fourth year FVTOCI. Fifth year FVTOCI. First year ACM, second year ACM will still continue to exist. You understand the point? This is what we call prospective treatment. We are not thinking about retrospective treatment over here, which means, no, in third year, you are planning to go for FVTOCI, which means you go back and then correct your second year also from ACM to FVTOCI, first year also ACM to FVTOCI. No. Okay, just prospective, which means from that moment, there onwards, what we're going to do in future. That's all. We will not be disturbing the past. Past will remain untouched. Clear? This is what we call prospective accounting whenever there is a change in method of recognition of financial asset, which we call it as a reclassification. Okay, now the most important basic rule is you can reclassify a financial asset only if your business model changes. That is, from hold till maturity, you go for speculative intent, or from speculative intent, you go to hold till maturity, or hold till maturity to hold till maturity and sell, or hold till maturity and sell to hold till maturity. It can be anything, right? So ultimately, your business model must change. What is business model? The reason why you're holding that particular financial asset is nothing but the business model. It's not about market going up or down. It's about your purpose changing. Are you able to understand? Just because a market is going up, as a result, you wanted to sell all of a sudden, then it becomes a speculative intent. Na? Initially, you did not have speculative intent. That's the reason you went with ACM. Like that, it will not be allowed. The reclassification from one method to another method. Reclassification will be allowed only if and only if you prove that your business model has changed. Got the point? And that too, if you want to change this year, you can't change it from this year. It will be applicable from next year. Therefore, you can't take unfair advantage. Suddenly, you see a good opportunity. Okay, all of a sudden, the rates have got increased. You get it? And as a result, you can sell it at a really good price, the financial asset what you have got. But then initially you thought that you will hold it till maturity, you're applying ACM method, but that now you want to grab the opportunity, you want to sell. Can I do that? Okay, I want to sell, so therefore I'll change it from ACM to FVTOCI and let me do that. Can you do that? No. What the standard says? New method cannot be applied in current year. It can be applied from next year. Accounting also will be what? Prospective, but ultimately you can apply from next year. Got it? I hope this is clear. Right. So let's quickly revise the business models that we have seen so far. ACM method, hold to collect the cash flows. That's the total intention, right? And of course, SPPI test should be satisfied. And SPPI test. FVTOCI also hold to collect plus sell and SPPI test. Correct? FVTPL trade for profit, speculative intent trading and SPPI test failed. Okay. You got it? So this is the kind of situations. You can call it as logic or you can also call it as business model. I have just written logic so that it will be easy for you to understand. You can call it as logic or you can also call it as business model. Okay. I gave you real life examples. For example, in what kind of financial assets you would like to hold it till maturity? Fixed deposit. You would like to hold it till maturity, isn't it? FVTOCI, which means your intention is to hold it till maturity. But if there is any opportunity, you will sell. Bonds. Okay. You might earn interest, but then suddenly bond price increases as such, you might sell. Same happens with debentures as well. FVTPL, purely speculative instrument. Obviously, shares. Buy or sell frequently. Got the point? So this is just a flashback of what we have seen already. I've put it in the tabular column. I hope that this will be easy for you to recollect. I hope you guys have recollected. Yes? Confirm me. Now we'll get to the core concept. Till here it's clear. What did we learn so far? Ultimately, you can reclassify your business model. Okay. First of all, you should have an intention. Your business model must change. Only then you can reclassify. Once you reclassify, it will be prospective, the accounting, and you can show the effect from the next year, not from the current year. Second, there are 6 possibilities because there are 3 methods. Each method, there is a 2 alternative. Therefore, totally 6 methods. Got it? That's all we have seen so far. And of course, we have revised the basic business models, which means on what basis your financial asset is originally classified into either ACM or, FVTOCI or FVTPL. Because you should know that, na. If you don't know that, then you can't really understand how the accounting of classification happens. Okay, once you change it from ACM to FVTOCI, say for example, then you should know clearly about what ACM is. Then only you will know what you have done these many years. You should also have a clear idea of what FVTOCI is. Then only you can understand what kind of changes we need to do. So you should have crystal clear clarity with respect to all these methods. That's why what I've done is that I've written the content again so that it will be like a revision for you. Okay, so till here it's clear. Shall we start with the 6 possibilities, one after the other? Right. First, what I'll do is that I'll explain you the core concept. See how beautifully I've written the content over here. I hope you guys will love it. Okay, every single possibility I've written logic, what you have to think and what you have to do. Logic, think and action. Like that I've classified and accordingly I've written the entire content. So this is pure theory. Then I gave you summary, which will really come in handy for you the day before the exam. Okay. And after that, immediately you have an example where whatever that we have learned just now will be applied in a problem. You got it? And then you are done with the concept. See, this is how I don't think there is any better way than learning a concept than this. So you got the intro of the concept, and you have recollected whatever the concept that is necessary to understand this concept of reclassification of financial asset. Then we have got beautifully the concept. First, it has been written, pure theory, and after that, followed by what? Summary of the theory, and followed by example, where you will know A to Z. That's all. You got it? Once we are done with this, then we'll go to derecognition of financial asset. That's another important concept. Anyways, if you guys are ready, we'll start. Ready? All right, Nana. Let's continue. So, what are these 6 possibilities? Okay, first we'll start with ACM. We know that for ACM we have 2 possibilities. From ACM to FVTOCI or ACM to FVTPL. Then we'll go to FVTOCI. Again, 2 possibilities: FVTOCI to ACM, FVTOCI to FVTPL. Then we'll go to FVTPL, FVTPL to ACM, FVTPL to FVTOCI. Right? Chalo. We'll start with the first one. Nana, first listen the concept carefully. Okay, you will not have 100% clarity, because unless we solve the sums, unless you solve numbers, you'll never get 100% clarity anywhere. Okay, so therefore, whatever the logic that you can understand, try to understand the logic. I gave everything that is necessary to understand this in the most simplified way possible. Okay, so I've put in a lot of efforts for the same. I hope you guys appreciate. Chalo, let's start with the first one. If you want to reclassify or shift from ACM method to FVTOCI, okay, first of all, what is the logic? Why would you want to shift? Why any company would like to shift? You used to keep the asset just to collect cash. That's what we call holding till maturity. Your purpose of the financial asset is to collect the cash in the sense, collect the interest as well as the redemption at the end of the lifetime of that particular asset. End of the tenure also, you can say. Okay, correct. But now you want the flexibility to sell it too. You got it? You just don't want to hold it till maturity without an option to sell. But you are thinking that if at all I get a very good sale value in the market, I would like to have that advantage grabbed. I would like to encash it upon. So therefore, now you want the flexibility to sell it too. Therefore, so now think like this. From locked deposit or fixed deposit, you are going to bond that you may sell. See, when it comes to fixed deposit, what will be your thought process? Okay, I just need to hold the fixed deposit till maturity. And whatever the interest that I get, I'll get. And at the end of the maturity, I'll get the full amount which I've fixed. Which I've put in the fixed deposit, correct? So think like you are moving from fixed deposit to bond. So in fixed deposit, what will be your intention? Just to hold it till maturity. You get all the interest, and in the maturity, you'll get the money that you have deposited, correct? Whereas if you move to bond, what will happen? Here also you'll be getting interest. Here also you'll be getting redemption. But here you have an advantage of selling it, correct? In fixed deposit, you don't have that advantage. So this is like an example what I gave to understand this particular sentence. Okay. So earlier, you're just keeping the asset just to collect the cash. And from that, now you want the flexibility to sell it to. This is just like moving from a fixed deposit to a bond. Got it? Right. So what is the action? Which means what you have to do when you're shifting from this particular method to this particular method? Well, revalue at market price. Market price means I'm talking about fair value. Market price means I'm talking about fair value. Why? Because in ACM method, you would have valued it at the initial recognition years back, correct? After that, you would have never touched it. Correct? In ACM method, that's what we do. We don't remeasure the financial asset at each reporting date, at each balance sheet date, correct? But now you're shifting to FVTOCI. What does you do when it comes to FVTOCI? You obviously revalue. You do fair valuation at each reporting date, at each balance sheet date. So do that first. And then if at all there is any gain or loss, you put it in OCI. That's what you do in fair value, right? Because you do revaluation, because you start doing revaluation, there will be a gain or loss, correct? On the revaluation. And that will be taken to what? OCI. Clear? That's all. Only 2 changes. See how simple it is. Sir, what about any other changes? No other changes, Nana. Okay. The ACM table, all those things, the unwinding of discount and stuff like that in FVTOCI also, it will follow. You got the point? So that's all. Only 2 changes. Everything else, the rest of the things will follow as it is. Because in FVTOCI also, you are applying ACM method only, na? For recognition of interest income and contractual cash flows, all that stuff. You remember? I'll just take you back to the concept. Okay, we are in 75th page. Right, where is it? Okay, see. FVTOCI, initial recognition is done at fair value, adjusted with transaction cost. Even in ACM also, initial recognition is done at fair value, adjusted with transaction cost. Anyway, we need not discuss about initial recognition because, as you know, this reclassification is prospective. So why are we talking about initial recognition? We should be talking about today. Interest income, because FVTOCI is applicable only for financial assets. It's not applicable for, It applicable only for what? Financial asset. I told you this now already. Okay, interest income and not expense is measured using effective interest rate as if ACM method is applied. In ACM also you are using effective interest rate to measure the income or expense, because ACM method can be applicable even for financial asset as well as financial liability. But FVTOCI is applicable only for financial asset, not for financial liability. Got the point? And therefore, so literally it's exactly the same. In ACM also you're applying EIR, effective interest rate. In FVTOC also you're applying EIR. The only difference is there you are not doing fair value measurement. Here you have to start doing fair value measurement at each reporting date. Once you start doing fair value measurement, what will happen? Gain or loss will come. What do you have to do with the gain or loss? Take it to OCA. That's all. Simple. Simplified version. That's why I've restricted this to just 2 points. That's all. Anyway, we are going to solve the sum as well. Don't worry about that. Did you understand this first of all? The concept is clear. So you used to just keep the asset, financial asset, to just collect the cash, but now you want to have the flexibility of selling it whenever it's required. It is just like shifting from fixed deposit to bonds. Clear? So now what you're gonna do? Very simple. You're gonna revalue it at fair value, at the current fair value, and because of remeasuring at fair value, you'll be getting either gain or loss, and that gain or loss will be transferred to OCA. Simple. Now moving on to second one. What is second one? You are reclassifying from ACM to FVTPL. ACM means hold to collect till maturity. FVTPL means purely trading speculative intent. So what is the logic? You were holding it for long term to collect the cash, whereas now you want to trade it for profit. That's your change in business model, change in thought process. This is nothing but change in business model only, na? This is nothing but change in business model, isn't it? I'll not be writing in each and every case, but I'm just giving you an idea. Got it? Okay. So this is just like shifting from fixed deposit. Fixed deposit is similar to ACM to trading stock. For trading stock, you'll apply FVTPL, isn't it? Right. What is the action that you have to do? Very simple. For ACM to FVTOCI also, what was the change? You remeasure it at fair value. Here also you remeasure it at fair value, obviously, because it is fair value through P&L. Here any fair value gain or loss will be transferred to OCA. Here you'll be transferring that to P&L. Simple. That's all. As simple as that. Easy peasy. Got it? Shall we move on to next one? Right. Now we are done with ACM. Let's go to FVTOCI. FVTOCI, FVOCI is fine, Nana. Okay. If you're really specific about that, let me write them. FVTOCI. All right. Here also I have. Let me change. Anything else? That's it. Okay. Okay. ACM is done. Let's go with FVTOCI now. You guys are ready? Moving on to third one now. FVTOCI to ACM. Now, FVTOCI means what now? Obviously, you are keeping it to sell, which means hold till maturity plus sell if there is any opportunity or if you are facing any monetary crisis, liquidity crisis or something like that. Or collect interest. So, which means both the choices are there now when it comes to FVTOCI. Now, no more selling, just hold it till maturity. That is what your change in business model. So, when it comes to FVTOCI, you can hold it till maturity. If necessary, you will sell. Whereas when it comes to ACM, it's all about holding it till maturity. Okay. So, the example is from flexible bond to a locked deposit. Flexible bond means you'll be getting interest from that. If at all at any given point of time, you can close it and get your money back. But when it comes to locked deposit, you have to keep it till maturity. Okay. So, it is like this. You can just compare it that way. So, what is the action you have to do? Very simple. From fair value, you're going to non-fair value. So when you go to ACM, first of all, you need to know your cost, where you have to start with, because anyway, this reclassification change is going to happen in a prospective way, correct? So let's not think about what happened earlier. Now you're going to shift from FVTOCI to ACM. Now, once you shift to ACM, anyway, the so-called ACM table will still continue, because in FVTOCI also, you'll be preparing ACM table. You'll be using effective interest rate, isn't it? To calculate the interest income on all those stuff. The same thing will continue here as well. So that change is not there. Only thing is that here you'll be doing frequently revaluing your asset based on fair value at the reporting date or the balance sheet date, and the change in the fair value, whether it is gain or loss, will be transferred to OCI. Hereafter, you won't be doing that. So to do that, first you should have cost, na? Because here you will not be doing any fair value. New cost, which means whatever the latest fair value that you have got, that will be considered as the cost. Again and again at each reporting date. Okay. And what about gain or loss that is already present in OCA? Say, for example, if a particular debenture is supposed for 5 years, in the third year, you are making this shift, which means till that particular point of time, till 3 years, you would have measured your financial asset at least 2 times. And as a result, the gain or loss would have gone to OCI. What you will do with that OCI? Will you take it back to P&L? No, 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 no. From there, it will go to reserves, not P&L. From there, it will go to reserves. From where? From OCA reserve. Which means it will go to SOCI, from SOCI it will go to balance sheet. It will not touch P&L again. That's what I'm trying to say. Clear? Moving on. Now, FVTOCI to FVTPL. Here, what's going to happen? Okay, your initial intention is to hold it till maturity or sell. whenever it is favorable for you. But now you're gonna completely transform into trading or speculation side. Okay, right, which means from semi trading to what? Full trading. Now when it comes to FVTOCI to FVTPL, tell me one thing. In both the cases, what is common? Fair value is common. Anyway, you'll be doing fair valuation of your financial asset at each reporting date. That is not going to change. But what will change is whenever there is a change in the fair value, that is gain or loss, earlier you will be transferring that to OCI reserve. Now you will be transferring that to P&L. Correct. The next question is, okay, let's say here also the shift is happening on third year. Then till 3 years, anyway, a lot of changes in fair value that you have measured has been transferred to OCI. So OCI reserve will be showing some sort of a balance. It can be a debit balance or credit balance depending upon whether there is gain or loss. Correct. What you will do with that balance? See here, move any OCI to what, Nana? P&L. You will be moving it back to P&L because you're shifting to FVTPL. Now hereafter any changes that has to go to P&L, right? That's how it is. Got it? You'll have 100% clarity once we start solving sums. Till that time, little bit of clarity might miss. Okay. Just wait, just be patient, okay? Just wait for another 15 minutes, that's all. Right, next one. FVTPL to ACM. Now we are done with FVTOCI as well. Now we have FVTPL. So FVTPL means you guys know it's all about trading or speculation. From there, you're going to change it to what? ACM. First of all, the first change is here you have fair valuation. Here you don't have fair valuation, which means the latest fair value will be taken as cost. That is the first change. The second change is hereafter you will not be remeasuring on each reporting date at fair value, and the changes or the gain or loss in fair value will not be taken to P&L. All those things will not happen. Apart from that, one more change that's going to happen is in FVTPL, here it has not been discussed. In FVTPL, we are not preparing ACM table. We are not recognizing interest income based on what? Effective interest rate. You understand the point? Whereas when it comes to ACM, you have to do that. In ACM and FVTOCI, we'll be doing what? ACM table. We'll be taking effective interest rate. And with that, we'll be recognizing the interest income. You understand the point? In FVTPL, we don't do that actually. Okay. But that you have to do. That point anyway, it is not discussed here. No worries. Anyway, we're going to solve sums now. You'll be able to understand once we do that example. Okay. Last one, FVTPL to FVTOCI. From trading to what? Holding till maturity or selling if it is beneficial. Okay. Now in this case, what is the thing that's going to happen? Pretty simple. In both the cases, there is fair value. So that's not a problem. But here, all the fair value changes will be taken to P&L. Now, all the fair value changes will be taken to OCI. So future fair value changes will go to OCI. Whatever till here, whatever has gone to P&L, keep it like that. Got it? Chalo, that's it. Okay. Now, this is the summary, Nana. When it comes to ACM method, AC means here I'm talking about ACM. Okay. ACM method. Right? Now see here. From ACM method to ACM method, reclassification is not possible. So the only reclassification that is possible is from ACM to FVOCI. So what will happen in this case? ACM to FVTOCI. You will start, fair valuation, right? And all the changes of fair valuation will go to OCI reserve. That's what is going to happen. You will also, of course, revalue your asset because when you're following ACM method, you would have never revalued. So now in this table, what you have to understand is from ACM, when you're doing the shifting, the first thing that you have to do is revalue your asset. Easy. Why? Because so far you did not do revaluation in ACM. During initial recognition, at that time, whatever the cost is there, at that price only, at that value only, your asset will be reflecting in the balance sheet. What asset? Financial asset. Okay. So therefore, the moment you shift from ACM to FVTOCI or ACM to FVTPL, one point is common. First, you have to do revaluation. Then, if it is FVTOCI, hereafter you'll be anyway doing frequent revaluation, fair valuation will be doing. In FVTOCI, the changes in fair value gain or loss will go to OCI. In FVTPL, the changes in fair value gain or loss will go to P&L. Simple, easy to understand. Next, FVTOCI. Now, from FVTOCI to ACM, one thing is the latest fair value that you have got, already you would have measured it because you're following FVTOCI. That will be taken as a base cost. Hereafter, at that value only, asset will be shown in the balance sheet. Got the point? That's it. Apart from that, there is nothing else. Okay, right. In FVTOCI also, we'll be calculating effective interest rate for recognizing interest income by preparing ACM table. In ACM method also, we'll be preparing ACM table. That anyway will be same. But when you shift from FVTOCI to FVTPL, then here there is a problem. Whatever already the gain or loss you have in OCI reserve, that has to be transferred to P&L. And revaluation here I've written, there's no need of revaluation, logically speaking, because anyway you'll be at fair value only, right? Next, FVTPL to ACM, same stuff. FVTOCI to ACM, same stuff. FVTPL to OCI, same stuff. Your whatever the fair value that you've got right now, at that fair value you'll be remeasuring. That will be taken as a new cost. Hereafter you'll not be doing any fair valuation. Of course, you have to apply that ACM table as well, applying EIR rate for recognizing interest, which you will do it under ACM method and FVTOCI, but FVTPL you will not do it. That point is there. Got it? FVTPL to FVTOCI, what's going to happen? Simple. Anyway, fair valuation you'll be doing, right? And fair value changes, now it will go to what? OCI. Fair value changes will go to OCI. Chalo. Are we done with this? Okay. Now, whatever the little bit of doubts that you have got, automatically it will be cleared once we do this example. Okay. So wait till this example. After that, I'll take the doubts. Okay. After doing this example, still if you have doubts, I'll clarify it. Okay. Till that time, have some patience. Okay. Shall we go with this example? Not doubts, example. Okay, right. Fantastic. All right, guys, let's read the question. A Limited has purchased 10% debentures of face value 10,000, which are issued at 20% discount and are redeemable after 4 years at par value. Original effective interest rate in the financial asset is 17.3%. That is given in the question itself. During year 2, there is a change in the business model of the entity. Okay. The fair value of the financial asset is as follows. At the end of year 1, 8,500. At the end of year 2, 9,500, which is nothing but at the beginning of year 3 as well. Show the accounting for reclassification in all the 6 possible cases. So we're going to cover all the 6 possible cases. So don't worry. Whatever the concepts that we have seen here, everything will be covered. Ready? Chalo. But before we start doing that, first we need to prepare ACM table, because 2 out of 3 methods need ACM table. What are the 2 out of 3 methods that need ACM table? One is FVTOCI, the other one is ACM method, correct? Only in case of FVTPL, we don't want this particular table. So in that case, definitely we need to prepare. Okay, so we already know how to prepare this table. First, take the opening balance of financial asset. At what price you have purchased? Face value is 10,000, but you have purchased at 20% discount, which means ultimately how much you have paid? 8,000. Yes? Hello? All right. Now, yeah. Okay, we have a doubt here. The doubt is, they are talking about why did we not calculate the fair value? You forgot the basic concept, Nana. See, if the coupon rate, say for example in this case is 10%, and suppose for the similar kind of a debentures of similar risk profile in the market, if the market rate of interest is say for example 14%, in that case what you will do, you'll discount it at the market rate and then you'll find out the fair value, which will be less than the issue price, that is 20% discount, which means 8,000 is what you paid eventually to buy that particular financial asset. Your fair value will be less than that, and then we'll be doing unwinding of discount, correct? That is a different case scenario. Here what is happening, you have 10% debentures, he did not give you any market rate, which means on an average your market rate is also what? Market rate of interest is also 10%. So that difference does not exist. But what is happening here is that you gave it at a 20% discount, which means logically speaking you purchased 10,000 worth at 8,000 itself. You understand the point? So which means even though the coupon interest rate is 10%, even though as a financial asset you feel that you'll be getting only 10% interest, but actually you're getting much more than 10% because you have purchased the debentures at 8,000. You did not purchase the debentures at 10,000. If you would have purchased the debentures on 10,000 and then you are getting 10% interest, then in that case your actual return is 10%. Correct? But here you purchased the debentures at 8,000 itself because of 20% discount, and of course redemption is only at par. If the redemption is at premium, then that will be different. So therefore 100% you are earning more than 10%. That's where effective interest rate kicks in. Correct? We have already seen how to calculate this. So how to calculate effective interest rate? Anyways, I'll give you an idea. See here, you have contractual cash flows, which means how many years? 4 years. So 1, 2, 3, 4. Every year you'll be getting 1,000, 1,000, 1,000, 1,000. Correct? Okay. On 4th year you'll be having the redemption, which is at par, which is 10,000. Correct? Okay. These are all cash inflows for you because you have purchased the debentures. You have not issued the debentures. For company, it's a financial liability. For us, it's a asset. We are talking about financial asset. Still, we did not get into financial liability. Okay. That accounting part we'll see later. So this cash inflow has to be discounted at a particular rate, which we don't know, such that after discounting the present value of cash inflows or the discounted cash inflow, that rate I don't know, but it should be a particular rate at which once you have discounted all these cash flows, the discounted cash inflow should be equals to discounted cash outflow. Now what is discounted cash outflow? Obviously today the cash outflow was 8,000. Do you need to discount 8,000? No, because today 8,000 is 8,000 only. So therefore you try to find out a rate at which this 1,000 at the end of first year, 1,000 at the end of second year, 1,000 at the end of third year, 1,000 at the end of fourth year, plus 10,000 at the end of fourth year, you discount it at a particular rate such that after discounting, that resultant discounted cash inflow must be matching with 8,000. So this is nothing but IRR concept in your CA internal rate of return. You find out a particular rate. That's how we find that rate based on trial and error. But that much headache is not necessary. Why? Because when it comes to your financial instruments, always that will be given in the question. Here also like that only it is given in the question. That's why. So even though the coupon rate is 10%, even though you are actually getting an interest of 10%, you are actually earning much more than that because you have purchased it at a 20% discount. So on 8,000 investment only, you are getting 1,000 interest every year, not on 10,000 investment. Are you able to get that point? So ultimately, one thing is for sure, you're actually earning more than 10%. How much you're earning more than 10%? That is nothing but EIR. What is that EIR? It is given in the question. Okay, if it is not given in the question, how to calculate? Just now I've shown you. Trial and error method only. So what we'll do is that you will write this 1,000, 1,000, 1,000, 1,000, 10,000. Clear? and then 8,000 is the discounted cash flow. So this has to be discounted at a rate which we don't know, such that after discounting it should become 8,000. So what we'll do, trial and error method. Initially we'll think about some 15%. We'll take 15% as discount rate. You discount it, find out the discounted cash, inflow. Let's say it is 8,500. Then we know that we need to go for a higher rate so that it goes below what? 8,000. You understand the point? Let's say we have taken some 18%. Next, it came somewhere around 7,800. Then I know that between 8,500 and 7,800, we have this 8,000. Such that if 8,000 is required to be your answer, then your answer should be in between 15 and 18%. That's how you'll calculate 17.3%. This is not new. Don't try to comment saying that, sir, what is this, sir? Just like that, fat you have explained. We have done an example in Ind AS 16, not Ind AS 16, borrowing cost, sorry. In borrowing cost, we have done an example with numbers. We have done trial and error and then we have solved it. You want me to show? Okay, see here, Nana. It took me time to search. See here. This is your borrowing cost chapter, power notes. It's there with you, na? Open it up and see. EIR, effective interest rate. I gave you an example, 1 lakh, 1 lakh, 1 lakh interest, and 10 lakh is the redemption. Today, 1 lakh is the loan that you have received, but processing fee was 50,000. So actually, you have received 95,000. Okay, here you have received money. In the example that we are discussing right now in financial instruments, we have purchased the debenture. So there is a difference. Okay, now see here, present value of cash flows, you discount at a particular rate such that it will be equal to 9,50,000. Exactly IRR concept, correct? So how do we calculate this? Trial and error method. So first we went for 11%. We discounted these cash flows. We got 9,75,470. Actually, we should be getting exactly 9,50,000. Then we increased the discount rate. We went to 12%. Still, we have got 9,51,980. I need 9,50,000. Then we again increased it to 12.5%. We got it below the target, which is 9,50,000. So I know that between these two, my 9,50,000 should be there, correct? Between 9,51,980 and 9,40,430, which means between these two, my answer should be there, 12% and 12.5%. You apply interpolation technique, which means for a difference of 0.5%, there is a difference of this much in amount. So I need a difference of how much? 9,51,980 should become 9,50,000. That's all. So for that difference, how much percentage should be the change? You apply that, you get the answer as 12.09% between these two, between 12% and 12.5%. That's your effective interest rate. So we have calculated this. So this is not something new for us. Okay. Got it? Anyways, so that one is clear. So here what you guys need to understand is that, one more thing that I would like to tell you is, suppose there is no discount here and you have issued at par, which means you have purchased by paying 10,000. Then your effective interest rate will be equals to coupon rate only. You purchased at 10,000. You are getting 10%, 10%, 10% interest, and then 10,000 is going to be your redemption. How much did you earn on this? 10% only. The 10,000 worth debentures, if you buy it at a 20% discount, in that case, you have just invested 8,000. Still, you are getting 10% of 10,000. You understand the point? Therefore, the percentage on 8,000 will vary. That's where the effective interest rate comes into picture. Correct? Are you able to understand? I hope this is clear. So, 3 things I've clarified over here. I've got those doubts also. Anyway, 3 things I've clarified. First thing is, sir, in so many problems that we have done, we have seen market interest rate being different from the coupon rate. Mostly it will be higher, let's say 14%. And then we have discounted at 14%. And then we calculated the fair value of the debentures. Do we need to do that in this question? No. Why? Because market interest rate is not given. When it is not given, we presume that coupon interest rate and market interest rate are same. Clear? Okay. Apart from that, because the issue is happening at a discount, you're actually earning more than 10%. What you're actually earning more than 10% is nothing but effective interest rate. How to calculate that? Right now, we have had a long discussion. But mostly, that's not a headache for us because it will be given in the question. Here it is given in the question. Clear? Till here, it's clear now. So everything I've revised. Now, let's focus on the ACM table. You take the opening balance of financial asset. What is opening balance of financial asset? Simple logic. Your purchase debentures. So debentures is a financial asset for you. It's an asset. So therefore debit to what? Bank. How much you have paid? 8,000. Why 8,000? Because 20% discount. So opening balance of the asset will be how much? 8,000. That's what we have got here. Now, what you have to do is that obviously, even though you're actually getting an interest of 10%, this is contractual cash flows. But your actual imaginary interest is more than this 10%, that is 17.3%. So we will recognize 17.3% only. Are you able to get me? Everybody? Even though you are actually receiving contractual cash flows, the real cash flows that you're receiving is only 10%. But because I did not invest 10,000, I've invested only 8,000 and still I'm getting 10% of 10,000. My actual interest income is much more than 10,000. Much more than 10%. How much is that? I've calculated 17.3%. See, therefore, according to me, the interest income is 17.3%. Always understand, interest income is imaginary. Imaginary means the real number it will be, not the actual cash flows that you get. Okay, right. So according to me, the interest percentage is 17.3% from this particular transaction. According to you, the coupon rate what you're giving is the interest income, which is 10%. That's the real cash I'll be receiving. So therefore, 17.3% is the actual interest that I'm expecting out of this, because my investment is only 8,000, not 10,000. Okay. Therefore, you add 17.3% to that. Got it? That's your interest income. So interest income will always increase your financial asset now, because I told you asset represents future economic benefits. So you feel that this much interest, now there is a accrual stuff, which means I have to receive this much of interest. To that extent, your future economic benefits of your asset will increase. Therefore, asset value has to be increased. Correct? So we will add. Then once you receive the actual contractual cash flow, that is the coupon rate, which is 10%, you have received the benefits. Once you have realized the benefits, then your future economic benefits will be reducing. Therefore, asset value has to be reduced. So therefore, once you receive the actual 10% interest, that is contractual cash flow, you will be reducing it from your asset value. That's why cash flows are reduced, which is 10%. That is 1,000, obviously. 10% of 10,000. To get your closing balance of financial asset at the end of first year, that will become opening balance. Again, you add our imaginary interest, which is 17.3%, and then you reduce the contractual cash flows received. You get 8834. 8834 is your carrying amount of the value of the asset in your books. Simultaneously, in these 2 years, fair value is also given, which is 8,500 and 9,500, which is available in the market. Clear? Right. So now, in case if you are following FVTPL or FVTOCI, what you will do? You will be doing fair valuation at these values. If you are following ACM method, then probably your initial recognition will be there. After that, you won't touch it. You will not be doing fair valuation, right? When it comes to ACM method. Anyways, so this is your ACM table. This table is clear. First of all, you tell me. Forget about everything else. Table clear. Did you understand why did we add the interest percentage and why did we reduce the cash flows, contractual cash flows? This one is clear. So interest income basically increases your asset value. Once you realize the contractual cash flows from the asset, the benefits is getting realized. Once the benefits are realized, which means future economic benefits is going to get reduced. Therefore, asset value has to be reduced. Therefore, this will be reduced. This is the actual technical concept. Clear? Otherwise, if you want to buy hard, you can buy hard. That's a different thing. Are we done with this? If ACM table is clear, then I'll move on. Clear? All right. Now, case 1. You are already following ACM. We are shifting to FVTPL. Let's try to understand this first case. If you guys are ready, I'll start. Now, moving on from ACM to FVTPL. So basically, you tell me one thing. ACM to FVTPL means what basically happens? First of all, in ACM, you would have valued your asset at the beginning, right? Whatever the value of the asset is. It just continues like that. You will not be doing fair valuation at each reporting date, correct? Whereas, once you move on to FVTPL, right now you have to do fair valuation. Now, once you do fair valuation, you can see that 9,500 is the fair value of the asset as of today when we are dealing with this reclassification, and the carrying amount of the asset is 8834, correct? Which means there is a fair value gain of how much? 666. Now, once you are moving from ACM to FVTPL, you have to fair value your asset right now, financial asset. So once you do fair valuation, you will be getting a gain of 666. And you know that because you are shifting to FVTPL, once the asset gains this value, first thing you have to do is increase the value of the asset. Second thing that you have to do is where this gain will go. Because this is FVTPL, it will go to what, Nana? P&L account. Therefore, entry will be investment in bond to P&L account. Got it? Okay, this is one way of presentation, easiest way of presentation, okay, simplest way of presentation. There is other way of presentation that your ICA does in its answers. That is the reason I gave you another entry also. What is this entry? What your ICA feels is that you are moving from ACM to FVTPL, na? So just feel as if this is a major shift. So you cancel ACM and establish FVTPL. What do you mean by cancelling ACM? As per ACM, your asset value is 8834, na? You cancel the whole asset. How to cancel a whole asset? How to make asset zero? You credit it. Asset is showing debit balance. You credit it becomes zero, right? Now again you create a new asset at 9,500. Ultimately the net effect is 666 only, na? Ultimately asset value increases by 666 only. That's what we have done here. But your ICA does like this in some of the problems. Therefore, I've shown you the alternative entry where your ACM asset ka value 8834 is credited and it is made zero. And then a new asset is debited at a new value of 9,500. Now the net effect of these two is nothing but 666. So therefore, ultimately to P&L 666 is taken. Why? Because we are shifting to FVTPL. This one is clear. Everybody, right? So we need to do fair valuation of the financial asset and remaining gain or loss goes to P&L. You have to stop EIR. Very, 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 very important. Because effective interest rate will be applicable only in two methods. One is ACM, the other one is FVTOCI. This is where we'll be preparing ACM table, correct? Whereas now we are talking about FVTPL. So in FVTPL, we'll not be preparing ACM table. We'll not be doing effective interest rate, EIR calculation for interest income. You got the point? Therefore, stop EIR. Because in ACM, you would have been doing EIR. So stop that. Which means this ACM table stop. At second year itself, you stop. Do not prepare it for third year. Do not prepare it for fourth year. Clear? Are we done with this? ACM to FVTPL with numbers. आगे चलेंगे. Right. Now, case 2. ACM to FVTOCI. Now tell me one thing, whether it is FVTPL or FVTOCI, ultimately it's a fair value based method, correct? So definitely we will do fair valuation of the asset. Definitely there will be a fair value gain. So definitely the asset value has to be increased. So here also you have to debit the asset value to increase it. Here also you have to debit the asset value to increase it. The only difference is here the so-called gain in the asset value goes to P&L because it is FVTPL. Here it will go to OCA. Therefore to OCA reserve. That's all. R means reserve. Clear? Okay. Here I said you have to stop effective interest rate calculation and ACM table because we are talking about FVTPL shift. But here we are talking about FVTOCI, and you know that in FVTOCI we also will do ACM. So actually we'll be following EIR methodology for calculating interest income. That is nothing but what we do in ACM. You got the point? Right. So EIR calculation will continue as it was in ACM. Got it? Okay. So which means interest income will be continue to be measured at 17.3%. That's what we have done here. Imaginary interest income measured at 17.3% and the real contractual cash flows which we received at 10%. This decreases the value of the asset. This increases the value of the asset. That's what we have done. Right. So interest income will continue to be measured at 17.3%. So we need to do fair valuation every single reporting date because it is FVTOCI and the gain or loss will go to OCA. That you know, I know, everybody knows, so many times we have discussed. On every balance sheet date, the fair value, the financial asset is to be fair valued and gain or loss will be transferred to OCA reserve. Simple. As simple as that. Got it? Any doubts? So far we are done with 2 cases. Till here it's clear. Shall I move to case 3? Chalo. Now we are done with ACM. Okay, now let's come to FVTPL. So FVTPL means we have 2 possibilities. FVTPL to ACM, FVTPL to FVTOCI. Now this case 3 is very important, so listen carefully. Case 3 is very important, so listen carefully. Now, FVTPL to ACM. First of all, tell me one thing. If you are following FVTPL, automatically your asset will be at 9,500 value at the end of second year, correct? Already your asset is appearing at fair value, which is 9,500, right? Now, do not change this because already it is at the correct value. However, because you're shifting to ACM, this 9,500 will be treated as a cost to start with. This is your starting point. You understand the point? Which means you have to feel as if you're about to start new by applying ACM method, where 9,500 fair value is a new cost. Here, when you applied ACM method, how did you begin with? You thought 8,000 is the new cost, and then you have prepared all the ACM table where you have added effective interest rate. With that only you recognized interest income, and then contractual cash flows, you have reduced the value of the asset. You did all these things. You started with this first year where the cost of the asset has been 8,000, which you have actually paid. Now, just like how did you start with this 8,000, now you're gonna start with this 9,500. This will be your new carrying amount. Hereafter, you will stop doing fair valuation because you have shifted to ACM. Then what you will do hereafter? You will be preparing ACM table. When you will start from this year, I'll start. But to prepare ACM table, we should know EIR, right? Can I go with this EIR, 17.3%? No, this EIR is for the entire, how many years over here? How many years we have got? 4 years. But now the 2 years have passed now. Now you have only 2 years left. For balance 2 years, how can you say 17.3% is the EIR? Now you have to calculate new EIR. So only 2 years is left hereafter because you are at the end of second year. So third year you will be getting 1,000. Fourth year you will be getting 1,000, and fourth year you will be getting the redemption at par value, which is 10,000. Now discount these cash flows such that after discounting this at a particular rate, the discounted cash inflow should be equals to the 9,500, which is discounted cash outflow today. Because today you are at the end of second year. So because you are at the end of second year, third year will be 1 year from now, fourth year will be 2 years from now. That's why I've written 1 year and 2 years over here. You are at the end of second year, therefore third year will be 1 year from now, fourth year will be 2 years from now. Am I clear? So you again try to find out a particular rate where these cash inflows will be discounted such that after discounting, the discounted cash inflow should be exactly equals to 9,500. What is that rate? If you calculate, that rate comes around 13%. And then do fresh ACM accounting, which means now you should feel that today the new carrying amount of the asset debentures is 9,500. You add interest income at 12.997% or 13%, and you reduce the contractual cash flows, which you'll get at 10%. You'll get closing balance, and that will be opening balance of last year. Again, you add 13%, you reduce 10%, because 13% is the imaginary interest income, which is EIR, and 10% is the contractual cash flows, which is the coupon rate, which you'll be actually receiving. Clear? So I've written here, it is as good as you have purchased new asset today at a cost of 9,500, and the life of the asset is 2 years. Like that, you have to imagine and do the accounting. This case 3 is very important because once you have understood this, rest of the things are pretty easy. Now tell me, did you have clarity with respect to case 3? Everybody. So again, I'll repeat one more time because this is important. FVTPL to ACM. One thing is quite clear. In FVTPL, you'll be remeasuring at each reporting date at fair value. That will not happen. So whatever the latest fair value that you measured, in this example, it is 9,500 because we are standing at the end of year 2. That will be the new cost. Clear? Okay, so this is where you will start with. Because you're shifting to ACM, and while you were following FVTPL, you would have never recognized your interest income for your asset based on effective interest rate. Now, because you have come to year 2, you cannot use the original effective interest rate because that is for 4 years put together. So now what you have to do, you have to calculate a new effective interest rate. Now the question is how to calculate new effective interest rate. Very simple, same philosophy, right? I mean, philosophy in the sense, same way of working out. You have 2 years from now, 3rd year and 4th year, you see how much cash flows you are going to get, you discount it at a particular rate such that it should be equals to the new fair value, which is nothing but the new carrying amount from hereafter. So once it matches, if you find out that particular discount rate at which you discount these cash flows, such that after discounting, it should be equals to 9,500. Then that will be your new effective interest rate. So now you prepare ACM table for 4th year and 5th year, for 3rd year and 4th year, which will be effectively called as 1st year and 2nd year, correct? So what you will do, you will start with 9,500. You will add interest income based on effective interest rate, which is 13%. You will reduce contractual cash flows, that is nothing but coupon interest rate that you receive, which is nothing but 10%. You will get your closing carrying amount, closing balance, and that will become opening balance for year 2, which is technically 4th year. And again, you will add 13%, you will be reducing 10%, and so on. Last year, whatever the balance that is left over, anyway, you will be getting the 10,000 back as well. You got it? Are we done with this? Chalo, fantastic. Now, case 4. FVTPL to FVTOCI. Now, one thing is quite clear. In both the cases, you have fair value. So, no need to debate about that as well. Only difference is earlier, the changes in fair value would have gone to P&L. Now, we can't do anything. Already it has gone to P&L. Hereafter, it will go to OCI. That's all. So, it is similar to case 3. But in addition to that, every year you need to do fair valuation. In case 3, you will not be doing fair valuation. Why? Because you're shifting to ACM, right? So, in ACM, there is no need of fair valuation. Therefore, you don't do it. But here, you have to do fair valuation. Whatever you're already doing, you just continue that. Nothing special you're going to do new. Because this is fair value, this is fair value as well. First point. But the point that you guys need to understand here is that once you shift from FVTPL to FVTOCI, you have to implement effective interest rate method. You will use EIR to calculate your interest income just like ACM. Just like ACM. So which means whatever we have discussed so far here, exactly same thing will be copy pasted here. So here also interest income will be recognized using effective interest rate, which we have calculated here at 13% as if ACM methodology is applied. Got it? But of course, on every balance sheet date, you'll be fair valuing your financial asset and the gain or loss will be taken to OCI reserve. Got it? Because it is FVTOCI naturally. You got the point? Chalo. Moving on to case 5. FVTOCI to FVTPL. Now here also things are pretty simple. In FVTOCI, you would have been doing fair valuation at each reporting date. In FVTPL also, you'll be doing fair valuation at each reporting date. However, in FVTOCI, all the changes in fair value would have been transferred to OCI reserve. Now, once you are making this shift, that OCI reserve will be there, whatever the gain or loss that you've got inside the OCI reserve, what you'll do with that, reclassify that back to P&L. Because now you're shifting to FVTPL. Because from OCI, you can reclassify to P&L. Here, you can't do that because here already it would have gone to P&L. From P&L, you can't reclassify back to OCI. That is not at all possible. There is no concept like that. You understand the point? That's why from FVTPL to FVTOCI, what we do is that whatever the changes in fair value so far, which has already been transferred to P&L, we will not touch it. Because anyway, this is prospective in nature, right? Are you able to understand? So therefore, what we basically do is that hereafter, whatever the fair value changes that we get, that will be transferred to OCI. Whereas here in case 5, whatever already you have done, you would have transferred it to OCI. It is there in OCI reserve. Now, from OCI reserve, can I take it back to P&L? Yes, that possibility is there. So take it back. So financial asset is already appearing at a fair value of 9,500. Don't touch that because anyway, fair value to fair value only change is happening. However, from OCI, the change is happening to P&L. Therefore, whatever you have in OCI, which is 666, because as of now, that is a gain, that is a gain for 2 years. That will be transferred to P&L. So therefore, in OCI, if it is gain means it would have been showing credit balance. So you debit it, therefore it becomes 0 to P&L. Anyway, because it's a gain, P&L also has to be credited. So to P&L obviously. So OCI reserve to P&L. Clear? Hereafter, whatever the gain, already whatever the gain or loss is there for last 2 years all itself is transferred to P&L. Hereafter in future, whatever the gain or loss is there, that also will be transferred to P&L only. Simple. Are we done with this? However, there is an exception. Very important exception. That is, what if it is equity shares investment? Investment in equity shares is also financial asset. You remember when we were discussing the accounting of financial asset, equity shares investment is discussed separately, then other assets was discussed separately. For other assets, we had this business model test, SPPI test and all those things. We had ACM method, FVTPL and FVTOCI, all this discussion were there. But for investment in equity shares, what did I say? By default, we will follow FVTPL unless you choose an irrevocable option to go for FVTOCI. But once you choose an irrevocable option to go for FVTOCI, then you can't reclassify it back to P&L. In this case, you can't reclassify it back to P&L, whatever that is there in the OCI reserve. So suppose here you are doing reclassification from FVTOCI to FVTPL for equity shares asset, because investment in equity shares is also a financial asset. So for investment in equity shares financial asset, if we are doing this reclassification from FVTOCI to FVTPL, you guys know that FVTOCI to FVTPL is not possible, because once you opt for FVTOCI, it is irrevocable. So this classification itself, Ind AS 109 says, is not permitted if it is equity instrument. Because we are talking about FVTOCI to FVTPL, which means definitely that guy would have gone for irrevocable option of choosing voluntarily FVTOCI. You understand the point? Once you have done that, now if you say no, tuch, I'll go back to FVTPL, no. Standard doesn't allow. So therefore, this is an exception. This is an exception. Keep this in mind. Very important. Okay, chalo. Moving on to the last case. Now, FVTOCI to ACM. Okay, the good thing is, in both the cases, you are applying effective interest rate. So whatever the effective interest rate methodology, that ACM table, what you have prepared, you will continue. Already you have prepared ACM table for 2 years now. In FVTOCI also, this table will be there. In FVTOCI also, this table will be there. You will just continue that for 3rd year and 4th year, because anyway, you're going to ACM. So in both the cases, ACM table will be there. You'll just continue. Okay, however, here you'll be doing fair valuation. Here you will not be doing fair valuation, correct? That is one thing. So hereafter, every reporting date, you will not be doing fair valuation again and again. But so far in 2 years, whatever the fair valuation that you have done, there is a gain of 666, which is already present in OCI reserve. What will you do with that? If it is FVTOCI to FVTPL, from that OCI reserve, that 666 will be transferred to P&L. TK. What about in this case from FVTOCI to ACM? Now also anyway that fair value gain of 666 is there in OCI reserve. Na? What you will do with that? That is the next question. Well, we will take that OCI reserve and we'll set it off with the asset value. We'll reduce it from the asset value. How much is that? 666 is the gain, right? So we'll set it off and the asset value will become 8,834. Now you remember, in ACM method, actually the carrying amount of the asset is 8,834 only. So which means it's as if you have started applying ACM method right from the beginning. Like that, the situation is getting created. So now see here. What about existing OCI reserve? Set it off against investment in bonds. So therefore, OCI reserve will be debited and the asset value will be credited. To that extent, your asset value will be reduced. Got the point, everybody? Because earlier you would have increased the asset value, na? Therefore, now you are reducing. So you are actually doing as if you have not implemented FVTOCI method. No. Initially, your asset value will be at 8834 only, Nana. Because as per FVTOCI, because you do fair valuation, and because of doing fair valuation, there is a gain in fair value of 660. What is that? 666. And therefore, your asset value has increased to 9500. Now, what you're doing, because you're shifting to ACM, you're just reversing what you have done earlier. That's all. You bring it back to the original value, which is 8834. Am I clear? Now, investment in bonds would be appearing at 8834. Investment in bonds is nothing but financial asset. In the balance sheet will be appearing at 8834 as if ACM method is applied from the beginning. Because you look at the ACM method, ACM table. If you have applied ACM from the beginning, your asset will be at 8834 only. That's a good thing, na? Right? So you continue. In FVTOCI also you have ACM table. You understand the point? In ACM also you'll be having ACM table. So just continue. No need to revise any EIR as well. That original EIR is there, na? Right from the beginning, 17.3%. You will continue with that only. You will not be calculating new EIR. Not necessary. Because in FVTOCI also anyway you have ACM table. Now also you'll have ACM table. Just continue that. So initially, what was the percentage that you have used? 17.3% effective interest rate to calculate the interest income. Continue with that. No need to change anything. Are we done with this? Okay. Now there was one student doubt which I have specifically noted here. Sir, you are saying that the so-called reclassification of financial assets is prospective in nature. But if I look at your calculations that you're doing over here, the OCI reserve reducing it from the value of the asset over here, and here also transferring the OCI reserve in first 2 years to P&L, I feel like it is retrospective. Well, first of all, you are not changing prior period P&L or balance sheet. Last year's P&L and balance sheet I'm not touching. In this case also, I'm transferring from OCI reserve where here to P&L this year. I mean to say, once I decide to change the classification, anyway, I'll be doing it from next year. Now, so in next year, this will be getting reflected. You understand the point? Same stuff will be happening over here as well. I'm not going to previous year, and previous year P&L, I'm not touching. So therefore, it is not retrospective. You are simply reversing the unrealized fair value gain. That's all. Okay, that was never booked in P&L account. Aligning the carrying amount with AMC model going forward. So technically, it is not retrospective. It is prospective cleanup. That's all. I'm trying to show my asset at a correct value. That's all. I'm not going back and then trying to rectify what I've done in the previous years. That is called retrospective effect. Retrospective effect means going back and changing the previous year's statements and numbers. Prospective means from hereafter, what are the changes that I'm going to do? Am I clear? So that is not a valid doubt actually, but most of the students get this doubt. Therefore, I've put it over here. So it is not retrospective, it is prospective cleanup. That's all. I'm just trying to change the numbers hereafter. Asset value I'm trying to change, and P&L value also hereafter I can change. I cannot go to previous year's P&L, I cannot touch it. That's what we call retrospective. This year and next year P&L I can do that now. Previous year I should not touch it. That's how it works. Are we done with this? Okay, Nana. So today is a heavy session, I know that. So what I want you guys is that, first of all, if you have any doubts right now, you ask me. Before we go to next session, I want you guys to revise this and come. All these 6 methods, okay? Revise this and come. Got it? Okay. Now you guys can ask me doubts. Any doubts? Everybody respond. If there are no doubts, then give me confirmation message. Yes sir, no doubts like that. Interesting. You guys are surprising me. Are you guys lazy enough to ask doubts, or really you don't have any doubts? Because I thought that you people will be getting good doubts, because this is not that easy topic. That's why I started with conceptual explanation first, and then I went with the example, with the numbers. Chalo, okay. Surprising, okay, no doubts, fantastic. Now, okay, now let me tell to the other people who are going to watch the lectures in future, the video classes, okay? Guys, listen one thing carefully, listen. If any of you has got any issue with respect to the discussion that we have done right now, you should not be having an issue. If at all you are having an issue, then you do not have clarity with respect to how ACM method works, how FVTPL works, how FVTOCI works. Only if you know the basics of how these 3 methods work, then only when I say shift from one method to another method, you will be able to understand the shift, the changes, because you should know this method, you should know this method also. Then only you'll understand when I'm going from this method to this method, what I have done already, what I'm going to do now, and how this change is going to happen. Are you able to get me? That is the only reason why some of you might have faced a little bit of discomfort. That's all. Otherwise, you should have got 100% clarity. So, if in case, if you guys are having any doubts, my advice would be, first go back and learn what is ACM method, okay? What is FVTPL, what is FVTOCI. Already we have done sums also, now just look at it once. Then come back and then straight away go through this example, okay? Right? And then try to go through this explanation what I've given. Despite that, if you have any doubts, you have the WhatsApp number over here, 9059109990. You WhatsApp this, I'll clarify, no worries. I'm here to do that only. You got it here in live class. It's a surprise also, Nana, because I was expecting doubts, but it's a surprise. That's okay. Sometimes it happens. Okay, we expect something, and sometimes things happen in a different way. Right? That's good actually. Right. Anyways, chalo. So that's it, guys, from me. In the next session, we'll go with derecognition of FA, financial asset. After that, we'll be finishing off the financial asset, all the concepts. Then we'll go back to solving sums. Okay. Chalo. Thank you, guys. Bye bye. All right, guys. Welcome back. Welcome back to the another session. So in this session, we'll be going with derecognition of financial asset. Okay, this is also important concept, Nana. Okay, I can't say very important, but it is important. But impairment is a lot more important than this one. Okay, I hope that is clear. See, some of the students are already asking me that, sir, we need important questions. We need, I call it as master questions. Or right now, if you look at the market, they're using the words super 150, super 60, super 50, super 80, whatever it is. So what will I do is that I'll rather call it as comprehensive questions, or some of them they call it as master questions, or whatever it is. The so-called questions which are really important, which we are expecting in the examination to come, or that particular master question, if you solve, you'll be learning a lot of concepts in that particular chapter or in that particular index. So these kind of questions, what I'll do is that I'll try to give you, probably once we are done with the whole session, once this FR batch is done, once we are done with the whole session, then definitely I'll try to give you that questions. Okay. So whatever, see, let me tell you one thing, Nana, whether I'm for it or against it, I don't want to, give my judgment. So what I've honestly decided is that whatever the students are demanding as of now, especially the Gen Z, I'm just going to provide it, as simple as that. Although it will come with my opinion, but whether to follow my opinion or not, it's your personal choice. Okay. So it's like a free will for you guys. Okay. So based on our experience, we'll tell you that this works and this doesn't work, because I would have at least seen some 10,000 plus students so far in my career. So apart from that, what will I say is that, like, okay, see, at the end of the day, this is what my opinion is, but at the end of the day, you want it, you take it. There ends the matter. Okay. I'll be doing ABC analysis as well. I'll be providing it. So everything will be available in our YouTube channel. So the YouTube channel is with the name this one, CA Prasanna Kumar. That will be the name of the YouTube channel. So that's where it will be available. And you guys can also follow me on Instagram. Okay, in Instagram again, CA Prasanna Kumar is the name, where I'll be sharing you a lot of other tips as well. For example, recently I've shared a video where I told that there should be 3 movies which should be permanently downloaded and kept in your mobile. Okay, so that whenever you're down, whenever you're upset, whenever you feel that you have a depression or something like that, that lonely feeling and stuff like that, where the studying is difficult, you're not able to concentrate, you're not able to continue, okay, you're not getting that motivation to do the work, you can just watch those videos. It really works because it helped me many times. So like this, so many videos also I'll try to put it, so that way you can follow my Insta, and also you can join my Telegram channel, BestCAClasses. Although right now it is not active, it was not active for a period of 2 years. Prior to that, it was active 2.5 years. Okay, when SCMP was there, CA Final Costing subject. When that was there, when I was at my peak, at the time it was active. After that, the subject was removed. Okay, so you can search with the name BestCAClasses. That's our Telegram group. Okay, I'll try to revive all these things. Okay, anyway, we started with a new website and we are reviving everything, new phone number and stuff like that. Anyways, okay. Right. So I'm going to provide you everything. You want ABC analysis, you'll get it. You want Super 50 or master questions, you'll get it. Okay. Although I'll see whether we can fix it in Super 50 or 60 or whatever it is. I'll do that as well. And that will be from your material as well. You want MTPs, RTPs, previous year questions, everything. That also I'll be doing. Now, many of the students are asking me, for every attempt, will you do it? Yeah, I have to do it. It will be there in my YouTube channel. That's obvious. Okay. You need not ask me. And some of the students are asking me, so when is your AFM batch is going to get launched? Pretty simple. As and when this batch is going to get finished, immediately I'll launch. I'll take a break of 3 days and immediately I'll launch. In fact, I've already taken one SFM batch, I think 2 years back in Kerala, right? In Thrissur, I've taken one particular batch. After that, I did not take any other batch because I was completely into stock market. Okay. Literally, I gave my 2 years of my life to the stock market and I've cracked it. That's a good thing. Anyway, so that flavor and all, you will see it in AFM. Financial reporting, you are already enjoying. I know that. I've been receiving messages from students. They're loving the logic and stuff like that. I'm really happy for the same. But at the same time, you will see AFM at another level. Okay. Anyways, right now let's continue with this. So, what is the next topic that we're gonna see? Derecognition of financial asset. Okay. Derecognition means what? First of all, that's the first question, basic question. So, what is this? What does this mean? Removing your financial asset, that's all, from your books. Removing your financial asset means what? Where? From your books. It's not a physical thing where it's not like a machinery or a land or something like that where you can physically take it, and then of course land physically also you can't remove. But it's not like an equipment, or a plant, or like for example where you can dismantle or you can physically throw it off. That's not possible. So what we are trying to talk about is that removing from your books. That's what we are talking about. Okay. Derecognition simply means removing a financial asset, which can be a loan given. Loan given is a financial asset, which can be a bond, which can be a receivable from your balance sheet because it is no longer yours. You get it? Just a second, guys. All right, Anna, let's continue. So the thing is, you will derecognize. Derecognize means obviously removing the asset from your balance sheet. Now, that one is clear. So we understood what is derecognition is, right? Now let's try to understand when will we do derecognition. That's pretty important. The logical conditions for derecognition. Okay. Let's look at that in steps. Let's start with step 1. The first question is you need to ask yourself, has the asset been transferred? When I'm talking about asset, I'm talking about financial asset. Has it been transferred? That's the first question. Now, one question is, sir, what do you understand by transfer? We are not physically transferring anything, right? So, for example, let's say you purchased debentures and that is a financial asset. And nowadays, at least probably in like 20 years back, you used to have at least a piece of paper. So we can logically say a paper has been transferred or something like that. Now we can't even say that because everything is electronical, right? So now what do you mean by asset getting transferred over here? The logical transfer means, did you transfer the contractual rights to the cash flows? Get it? So what do you mean by transferring contractual rights to cash flows? For example, you have purchased debentures. You have a contractual right because financial asset is that only, contractual right to receive cash flows. So you have a contractual right between you and the company whose debentures you have purchased, that company will pay you interest every single year, and that's a cash flow for you, cash inflow. And after a particular period of time, it will redeem it, which means you will get your principal back at a premium or at par, whatever it is, depending upon the situation. But ultimately, you have a contractual right to receive those cash flows, and that is nothing but your asset, correct? So if you transfer that contractual rights of what? Of receiving those cash flows to somebody else, it means that you've actually transferred the asset. This is the basic idea. Now, moment, okay, fine. That doesn't mean that you have to de-recognize the asset. Please try to understand. So we're going to go in multiple steps. After step 3 only, we'll try to take a decision, okay? So straight away, you cannot say that, okay, asset has been transferred, which means, did you transfer the contractual rights to receive the cash flows? Okay, fine. I've transferred, so let me de-recognize the asset. No. Wait till you get the complete understanding. So we're going to go step by step. Is that clear? Everybody? Now, one thing you guys need to understand is that, that's why I've clearly written here, has the asset been transferred? If you say the answer is no, which means even the contractual cash flows, that rights also has not been transferred. Is that clear? In that case, straight away, the answer is do not recognize. There is no question of de-recognizing your asset. Do not de-recognize. Clear? However, if you say that yes, the so-called financial assets contractual cash flow rights has been transferred, then straight away you cannot come to a conclusion that let's de-recognize the asset, let's remove it from the balance sheet. No, you have to go to step 2. Still, there are a lot more other things that we have to consider before we take a decision to remove the financial asset from our balance sheet. Okay, right. Now, I gave an example also. What do you mean by no transfer of contractual rights? For example, you have given your receivables or debtors as a pledge, as collateral, but still you are the one who is collecting the cash flows. So here you can't say that I have transferred the right to collect the contractual cash flows, because you did not transfer. You just gave that asset as a collateral in case if you don't pay the money, then your so-called guy who gave you money, he will take the debtors or receivables as a collateral. He will start collecting the money. As of now, you are the one who has the right to collect the cash flows, and you are receiving. In fact, unless otherwise in future something wrong happens. See, collateral means that only, na. For example, you try to give your land as a collateral and you take some personal loan. As long as you're paying the interest, nothing will happen to your land. Suppose you don't pay anything in future and some sort of a bankruptcy comes from your side, then only your bank will probably take the land, it will take that particular collateral and it will try to sell it and get some money out of it, thereby recover the money that it gave to you, correct? Same logic applies here as well. So, if I gave the so-called receivables, which is a financial asset, as a collateral, but still if I am the ones who are collecting the contractual cash flows out of it, then it means that I did not transfer the contractual rights to somebody else. So therefore, there is no question of de-recognition of this so-called receivables, which is a financial asset, in my books. Clear? So did you understand step 1? So what are we trying to do right now? De-recognition of financial asset. What do you mean by de-recognition? Removing the financial asset from the balance sheet of your company. How to do that? When to do that? For that, we are trying to go with step-by-step procedure. In that, the first question that you need to ask yourself is, did you transfer the contractual rights of collecting the cash flows to somebody else? If the answer is yes, then we'll go to step 2. If the answer is no, then there is no question of de-recognition. What do you mean by not transferring contractual cash flows? Means I gave an example of no transfer where you gave the so-called financial asset, that is debtors or receivables, as a collateral to somebody else. In that case, ultimately you are the one who is still receiving the contractual cash flows, which verifies the fact that you did not transfer the contractual rights to somebody else. Therefore, there is no question of de-recognition, which means step 1 itself has got failed. If step 1 is passed, which means yes, I did transfer contractual rights to collect the cash flows of my receivables to somebody else, then we will go to step 2. Straight away, we will not come to a conclusion and say that let's de-recognize the financial asset. No, we will go to step 2. Clear? In step 2, the next question is, did you transfer all the risk and rewards of this particular financial asset? Say, for example, you will have multiple scenarios. Okay. Yes, all the risk and rewards has been transferred. Fine, de-recognize. De-recognize. You got the point? None of the risk and rewards are transferred. No question of de-recognition. Sir, partially some risk and rewards I have transferred, some I have kept it with myself. Then you go to step 3. Now, what do you mean by these things, sir? We did not understand. Okay, I gave you examples for everything. This particular thing, I called it as A. For A, there is an example. Let's try to look into the example, okay? If you look at the first scenario, all risk and rewards are transferred, then you can de-recognize. For that, the example is, suppose you have sold your trade receivables, which is a financial asset, without recourse. Without recourse means, generally, we will see this further. Right now, I just gave you an example. Sometimes you will try to sell your receivables to factors. Now, you would have seen this in your CA Inter or CM Inter as well. Factors are just like a third-party organization where they are experts in collecting the money from debtors. You got the point? So when I say you sold trade receivables, which means it reflects all your risk and rewards has been transferred without recourse. Without recourse, what is the importance of this particular sentence is that tomorrow, once the factor starts recovering the money from the trade receivables or debtors, if somebody doesn't pay and if there are bad debts, then that loss has to be borne by the factor himself. It will not come and haunt us back. That's what it means, without recourse. You got the point? So which means, did I transfer all the risk of bad debts also to factor? Yes. So which means, did I transfer all the risk and rewards of my financial assets, that is trade receivables, to the factor? Yes. In that case, you can de-recognize the so-called financial asset, that is trade receivables, from your books, which means you can remove it from your balance sheet and your books as a whole. Got it? None of the risk and rewards has been transferred. Do not de-recognize. For example, same thing you have done, you have sold it with recourse, where you bear the credit risk, you bear the bad debts. Without recourse means the risk is transferred to the factor. With recourse means tomorrow anything happens, say for example 10 lakhs worth of receivables you have sold to the factor, but with recourse. With recourse means anybody does not pay tomorrow in future, I'll be responsible, I'll make up for it. Tomorrow suddenly half the people, 50%, 5 lakhs, they did not pay. Just imagine. Then who will bear the burden? I will bear the burden. Then how can you de-recognize the entire 10 lakhs asset in your books? You understand the logic over here? Because at any given point of time in future, once the factor is not able to collect, then that will come and haunt you back. In that case, you have to pay money. From where will you pay? You understand what I'm trying to say, right? So therefore, you cannot say that I'll de-recognize the entire financial asset from my books. It's not correct. That's why none of the risk and rewards are transferred. Do not de-recognize. Third case scenario is a very unique scenario where some has been transferred, some has not been transferred. Then in that case, it is what we call it as a partial transfer of risk and rewards. Then your answer is go to step 3. Let's go to step 3. In step 3, what we see is that, did you assess the control? In whose hands the control is? Your hands or somebody else? If partial risk and rewards are transferred, now ask, do you retain the control of the asset? No, I did not retain the control. I have transferred the control as well of the asset. Then de-recognize. No, I have retained the control. Then continue to show the asset to the extent of continuing involvement, which means how much involvement is there, to that extent you will show. What is this continuing involvement? Just now we'll see it. Just wait. Okay. Now, what do you mean by control lost? Because you no longer direct who collects or sells the asset. Okay. You no longer do that. That's what you mean by losing the control. Say for example, if you have sold your receivables to factor, factor will direct when to collect the money from debtors. You understand the point? Or factor may sell those debtors to somebody else as well. You understand the point? That's what you mean by giving the control to somebody else, which means you lost the control. Have you lost the control? Then fine, de-recognize. No, I have retained the control, which means what? You still have significant say and benefit from the asset. I still say no, don't collect from this guy. No, I gave another 30 days extra time to this fella, so you collect after 30 days. Like that, you are still saying you have a significant say in the asset, which means still the control is with you. In that case, do not de-recognize. You got the money, you show the asset. Got it? Right. Okay. Now in this, there is an extra angle, which is continuing involvement. Let's try to understand that now. After that, we will solve an example as usual so that you'll get 100% clarity. Okay. What did we discuss so far? De-recognition of financial asset. What do you mean by de-recognition? Simply removing the asset from the balance sheet. When will you do that? First, try to find out whether all the contractual cash flows has been transferred. This contractual cash flow is nothing but rewards, Nana. Rewards from a financial asset is nothing but the benefits that you receive. So when I say contractual cash flows has been transferred or not, did you transfer the reward? Okay. No, I did not transfer the reward. Straight away, do not de-recognize. No, I have transferred the reward. Then did you transfer the risk as well? Yes, I have transferred. Then de-recognize. No, I did not transfer. Then do not de-recognize. Some I have transferred, some I kept it myself. Then go to step 3. Okay. Did you transfer the control? Risk and rewards are different. Control is different. It's like who is administering that financial asset? Who is deciding? Who is saying? You understand the point? Yeah, I've transferred the control. Then de-recognized. I've transferred the control means I've lost. I have transferred the control means to other person. I have lost the control. So de-recognize. No, I did not transfer the control. Then do not de-recognize. There ends the matter. So ultimately, what are all the words that you have got? Risk, reward, control. Risk should be transferred. Risk of bad debts, for example. Reward should be transferred. Contractual cash flows, the interest payment that you received. Control also should be transferred. You got the point? First of all, if risk and rewards are transferred, straight away you can de-recognize the asset. You need not ask about control because logically control also should have been transferred. Are you able to get that point? Why we are talking about control only in case of partial transfer is, use your common sense. Risk and reward is transferred means control is also transferred now. Bad debts, I have sold it without recourse. In that case, what do you mean by without recourse? Tomorrow some bad debts is going to happen. He has to take care of it. I will not take care of it. Which means I did transfer the risk. Once I did transfer the risk of bad debts to the other guy, indirectly control is also transferred now. Because now risk is with that guy, reward is also with that guy. He will only decide when to collect, when not to collect, whom to collect, whether to give more time or not. Everything he will decide. So when I say risk and rewards are transferred, it is an implied understanding that control is also transferred. You understand the point? When specific question of whether control is transferred or not will arise only when you did not transfer risk and rewards fully. Are you able to understand the concept over here? That's why I try to explain the concept in step-by-step procedure. Many people, they are not able to understand this. Okay, they get confused with respect to this area. Sometimes control will come, sometimes control will not come. In some problems, we'll consider control. In some problems, we'll not consider control. Means this is the logic. When risk and rewards are fully transferred, you don't have a problem. De-recognize. Automatically, it implies that control is also transferred. When risk and rewards are partially transferred, then the next doubt comes. Partially transferred. So, which means should I recognize or should I de-recognize? Recognize means already the asset is there in your books. Should I de-recognize or not? Then you will ask, okay, let's see where the control is. That is transferred. Then de-recognize. No, control is not transferred. Then keep it in your books. Simple. Did you get clarity right now? Everybody? Crystal clear. Okay, right. Clear now? So what are the keywords that you have to remember? Risk and reward. Okay. In this, if there is any problem, then you search for control. You will get your answer. Done? Okay. In this, there's a small twist. What is that? There is a concept called continuing involvement. What do you mean by that? Let's try to understand that. Okay. After that, we'll solve this particular example. Once this example is done, as usual, you'll get crystal clear clarity. Right now, we're just focusing on the concept as of now. Okay. Is that clear, guys? Now, coming on to this continuing involvement, even if derecognition occurs, because sometimes you will derecognize the asset, still you will guarantee that to some extent, to this extent of risk, I'll be responsible. For example, let's say you sold 10 lakhs worth of receivables, okay? And in that there is one big debtor, 2 lakhs is the amount he has to pay. You sell this to factor. Now, factor says remaining 8 lakhs is from all the small debtors. If any of them does not pay, it will affect them little. Like, for example, 10,000 debtor, 15,000 debtor, 20,000 debtor, like that. But during the agreement, factor says that there is one debtor who is worth 2 lakhs. If this guy goes bankrupt and if this guy becomes a bad debt, then that's going to hurt me real bad. So, I can't take this. Then you as a company, you say that, okay, to this extent of 2 lakhs, I'll give you guarantee. Which means you're continuing to involve. Are you able to get my point? Why the word is called continuing involvement? Despite selling your receivables to the factor. This is what we call continuing involvement. Tomorrow, if this guy doesn't pay up, then the burden will come to you. Of course. If he pays up, then no problem for you. You can just enjoy. Okay. Even if derecognition occurs, if you still have some exposure, like you gave financial guarantee, the example that I told you is a financial guarantee or repurchase option, for example, or servicing issue, you may need to recognize new asset or liability, which means we'll be recognizing both. You'll understand how it is. What do you mean by new asset and liability recognition, sir? Only liability only will come. No. I'll tell you. For presentation purpose, we'll do some stupid things. You'll understand that. Okay, stupid things, sir. Yes, stupid things only. Measure it at maximum exposure to loss. Actually, we'll measure it at fair value. Okay, we'll see that. I just gave you a simple example over here. Sale of receivables with a guarantee. ABC Limited sells 1 lakh receivables to what? 10 lakh receivables to factor. The sale is without recourse. Without recourse means obviously you keep the bad debts with you. I'm not at all responsible. For most customers, risk is transferred. Without recourse means risk is transferred. Automatically control also will be transferred. But ABC guarantees that only one large customer defaults, then ABC will compensate the factor up to 2 lakhs. I gave you exactly the same example. So which means ABC derecognize the receivables, that financial asset will be derecognized, which means it will be removed from your balance sheet, but has continuing involvement for what? 2 lakhs due to the financial guarantee that you have given. Clear? This is what we call continuing guarantee. First, understand what do you mean by continuing guarantee or continuing involvement. Then we will understand how to account this. For that, anyway, we have an example. Forget about the accounting aspect, Nana. Right now, what did we study so far? We have just learned the concept. That's all. We did not learn the accounting part. To learn the accounting part, anyway, we have the example. We'll see the example and we'll try to learn the accounting part. Till here, what you have to learn is only the concept. Okay. What did we learn so far? If we simplify, first of all, we were talking about derecognition of financial asset. To derecognize that means removing from the balance sheet. When to derecognize that? First ask yourself, did you transfer the contractual cash flows? No. Talk about derecognition, forget about it. There is no question of derecognition. Straight away, that's the answer. No, I have transferred the contractual cash flows, which is nothing but reward. Okay, did you transfer the risk also? Completely risk and reward has been transferred. Yes, derecognized. No, do not derecognize. Partially I have transferred. Okay, partially transferred. Then let's check the control also. Did you transfer the control? Yes, derecognized. Did not transfer the control. No question of derecognition. Clear? I transferred the control also, but there is a little bit of financial guarantee that I've given. This is a continuing involvement. Then to that extent, you have to recognize an asset as well as liability. What is that? How to account that? All those things we'll see now. Okay, right. Let's look at this example. Just a second, Nana. Now, let's look at this example. A Limited has trade receivables worth 10 lakhs. Okay, it has sold the right to receive cash flows. You always, when you read the example, don't just go through the example, connect it with the concepts that we have learned. For example, it has sold the right to receive cash flows. So, which means it is the first point. Has the asset been transferred? Did you transfer contractual rights to cash flows? The answer is what? Yes. Yes. Got it? Chalo. To a factor X Limited for a lump sum consideration of 9 lakhs. Now, they'll show the accounting in the books of A Limited in the following cases. Okay. Now, all we know is only step 1 has been satisfied. We don't know step 2 whether it has been satisfied or not, because I told you one is reward, that is step 1. And in step 2, you need to also look into risk and reward put together in step 2, correct? Reward already it is done, it has been transferred. Now, what about risk? We don't know. Let's look at case 1. The transfer of X Limited is on non-recourse basis. Risk of bad debts is transferred. Non-recourse, risk of bad debts is transferred. Means what? He's clearly saying that without recourse is nothing but non-recourse. So which means you have transferred the risk as well. Tomorrow any bad debts is going to happen. It's not there to bite you back. Which means, is the risk completely transferred? Yes. Reward already transferred? Yes. First step only it has been transferred. Risk is also transferred. So all risk and rewards transferred, which means we can derecognize. Derecognize means what? Financial asset will have an asset debit balance. Obviously, you have to credit it. So 2 debtors, you derecognize, because once you put 2 debtors, it has become eventually 0. So it is removed from the balance sheet. And what you will debit? You have received 9 lakhs cash. So debit 9 lakhs. Asset worth 10 lakhs, but you have received a cash of only 9 lakhs. So the balance of 1 lakh will go to what? P&L account, because it is a loss. That's it. See how easy it is, right? All right. Now, are we done with this, everybody? Yeah. Clear. Moving on to next one. Case 2. The transfer of X Limited is on recourse basis. That is, risk of bad debts is not transferred to X Limited. That is retained by what? A Limited. Now you tell me one thing. Did you transfer the risk in this case? Nope. Sale with recourse, where you bear the credit risk, which means it has not been transferred. So when risk is not transferred, will you derecognize the financial asset? What did we write here? What did we learn? No, we will not derecognize, even though the contractual cash flows has been transferred. Reward has been transferred, but risk has not been transferred. Once, that's the reason we say once reward is transferred, go to step 2. So straight away, there is no question of do not recognize. Okay, do not derecognize. Once rewards has been transferred, then you go to step 2. In step 2, you check whether risk has been transferred or not. Yes, risk has been transferred, derecognize. No, risk has not been transferred, then do not derecognize. Do not derecognize means you will not credit the asset. You will not write 2 financial asset or 2 debtors or 2 receivables. Then what you will do? But at the same time, you have received 9 lakhs. Now, okay, I've received 9 lakhs, debit bank account. Okay. Will you write 2 debtors? No, you should not do that, because risk has not been transferred. So I cannot write 2 debtors. If I write 2 debtors, then I'll be derecognizing the asset. I'll be removing it from the balance sheet. You cannot do that. Then what I have to do? Recognize a liability. Why liability? Because without transferring the risk, which means risk is still with you, na? You have transferred debtors, na? You understand the point? Which means whatever the cash that you have received is not 100% yours. At any given point of time, whatever the debtors that you have transferred, if those guys does not pay money to the factor, he will take the money from you. So therefore, I cannot recognize this bank cash. one point. And because there is this risk where in case if debtors does not pay to factor, I have to pay money. To what extent the maximum risk covers the entire debtors? You understand the point? That's the whole thing over here. But I did not receive the entire 10 lakhs from that fella. I received only 9 lakhs. To that extent, I may have to pay back. You understand the point? That's the maximum risk. Although it will not happen 99.9% of the times. But to that extent, you have a risk now. Therefore, recognize a financial liability. So, which means in your balance sheet, already financial asset will be there. You did not de-recognize that, right? It stands at 10 lakhs. Are you able to get me? Which is nothing but debtors. On the other side, you will also recognize financial liability to the extent of 9 lakhs. So, carrying amount of 10 lakh debtors should not be de-recognized, which means it will stay like that in the balance sheet. However, 9 lakhs is the maximum that the company receives from the factor. Therefore, to that extent, you might have a liability in future, right? But the point is, because you have received 9 lakhs, okay, it means that the value of your 10 lakh asset has been revalued as 9 lakhs only today. That's the reason you received only 9 lakhs from the factor, correct? You understand the point? All right. In that case, it means that your asset value has fallen down. Once your asset value has fallen down, you need to recognize that falling in the value of the asset is nothing but impairment loss. Just now we have covered, na? So therefore, recognize impairment loss to debtors to the extent of what? 1 lakh. This is what you will do in case 2. Now, once you put this entry, now what will happen to your balance sheet? Now your financial asset also will look at 9 lakhs. It will be looking at 9 lakhs, the balance, and financial liability also will be showing 9 lakh balance. Because now your financial asset is worth that much only, which is 9 lakhs. That's the reason factor paid you only 9 lakhs. You got the point? Chalo. Are we done with this? Okay, so what is the difference between case 1 and case 2? Pretty simple. It's a plain vanilla case. In case 1, risk has been transferred, reward has been transferred, de-recognize the asset. In case 2, reward has been transferred, but risk has not been transferred. Therefore, you cannot de-recognize the asset, which means you can't credit the asset. You keep the asset like that. Only you will create financial liability to the extent of cash that you have received. I have received 9 lakhs. To that extent, you create a financial liability. Now, because 10 lakhs worth of an asset in the market, once you have put it for sale, you received only 9 lakhs. The worth of the asset is only 9 lakhs right now. To that extent of 1 lakh, you recognize the impairment loss. Done. Okay. Right. First 2 cases is relatively rather simple. It's not complicated. However, we're going to have case 3. What about case 3? That's the fun part. Now look at case 3. A Limited has transferred the right to collect all trade receivables, which means reward has been transferred. What about the risk? And also has given guarantee to the factor to the extent of 2 lakhs. Which means what? Presuming that, because here the question is not clear, but we need to presume that rest of the risk has been transferred. Only to the extent of 2 lakhs, the risk has been retained. Rest of the risk has been transferred. Only to the extent of 2 lakhs, the risk has been retained. You understand the point? Which means this belongs to what category? Let's apply the concept. Step number 1. Contractual cash flows. Right to receive, right to collect contractual cash flows. Has it been transferred? Reward has been transferred? Yes. Once it is yes, what you should do? Go to step 2. Come to step 2. All risk and rewards has been transferred? No. None has been transferred? No. Some risk and rewards has been transferred. So it does not fall into this category or this category. Partial risk has been transferred. Then it has fallen into this category. Go to step 3. Now coming on to step 3, now you tell me, did you transfer the control? Logically speaking, yes, control has been completely transferred, then you will de-recognize. Because now factor only will take care of everything. Factor only will take care of everything. He will only decide when to collect, whom to collect, for which debtor, how much extra time has to be given. In addition to the time that has already been given, everything will be decided by the factor. If that is the case, control has been transferred or not, yes, in that case, de-recognized. However, there is a continuing involvement because there is a financial guarantee. To that extent, you have to keep it in mind. So first of all, can I de-recognize in case 3? Yes. Why to de-recognize in case 3? Rewards has been transferred. Risk has been transferred, except to the extent of financial guarantee. You understand? But risk is not 100% transferred. Therefore, we check the control. Is control is transferred completely? Yes, it is transferred. In that case, yes, you can de-recognize. However, to the extent of financial guarantee, that is continuing involvement that you have done, to that extent, you have to recognize that as well. So let's see how this works. Okay. First time, it will be a little bit pinchy. Why? Because your ICA has done little bit of idhar udhar ka kaam. So we'll try to understand. First of all, tell me one thing. Did you receive 9 lakhs cash? Obviously, bank account will be debited. Can I de-recognize the asset right now? Yes, I can. Why? First step, reward has been transferred. Second step, risk has been transferred, but not completely, partially. So you go to third step, control has been transferred. Yes, but with continuing involvement. But at the end of the day, control has been transferred. Okay, de-recognize. So therefore, 2 debtors, 10 lakhs. You got to derecognize. So credit the asset. Asset is removed from the balance sheet. Because 10 lakhs worth of an asset, you received only 9 lakhs. Obviously, 1 lakh is a kind of a loss that eventually gets to P&L account. This one is clear. Fantastic. Now, this is the problematic entry. Sir, what is this entry, sir? Try to understand one thing. What did I write here? Dummy entry just for show off or presentation purpose. I need to pass entries in such a way that the entry basically communicates what I'm doing. That is the purpose of an entry always. So when I know that I have a continuing involvement because I gave a financial guarantee to the extent of 2 lakhs, then that has to be shown. Okay. So for that, basically what I do is that I create an associated liability because I know that I have a liability to the extent of 2 lakhs, but that is maximum. Simultaneously, I'll create continuing involvement financial asset as well. Now you can ask me, where is the need of asset over here? What asset? I don't have any asset because I already received 9 lakhs. Hereafter, I don't expect anything, not even 1 rupee to receive. Then why did you pass this entry? At least liability to some extent I can understand. Right. Actually, this is purely dummy entry purpose. It has got no meaning. Then why did you pass the entry? Only to show you that this transaction has happened. There is a continuing involvement to the extent of 2 lakhs. Only to pass that. Once in next year, you will understand. Once you complete the entire journey, automatically you will understand what will happen to this particular entry. But as of now, understand that it's a dummy entry. So don't come up with an argument saying that where is financial asset, where is, to that extent, if you go with that logic, 2 lakhs associated liability is also wrong. Because 2 lakhs is your maximum coverage. What is the probability of that happening? That's where fair value of the guarantee is given, 30,000. So 30,000 only is your liability, not 2 lakhs. So this liability is wrong. This asset is also wrong. Then why are you passing? Only to communicate that this setup has been arranged. Once I look at this entry, I'll understand. Okay, all right. So he has given, guarantee to the extent of 2 lakhs. That's all. But if I don't create an asset over here and fake liability, because both are fake actually, to be very honest, that's why I call it as a dummy entry. Dummy asset, dummy liability. Dummy asset, dummy liability. Let me write that over here. Otherwise, tomorrow you'll get doubt. This is purely for presentation purpose. This is purely for presentation purpose. Clear? Right. Okay. Now just wait for some time. Automatically, this will get, you'll get clarified with respect to this particular doubt. Okay. Now you tell me one thing. You gave a guarantee to the extent of 2 lakhs, but then 2 lakhs, what is the probability of that happening? Okay. So therefore, the fair value of the guarantee that you gave is 30,000, which means actual liability is 30,000 only. So therefore, your financial guarantee is a liability. How much it is? 30,000. In case tomorrow you have to pay for that liability, where will you get money from? From P&L account only. Therefore, P&L account debit. Clear? Now, the only doubt that you might be having is with respect to this one. You wait for another 5 or 10 minutes. Automatically, it will get cleared. So how much time I have to wait? 5 to 10 minutes. That's all. Nothing more than that. That's all I want. Clear this one? Now you have understood how these three has come into picture, because in your ICA directly this entry is there. That is the reason students keep scratching their head, because the moment they see their entry, they'll not understand anything. You got the point? That is the reason first I gave you 3 separate entries, then I'll convert them into another entry, then I'll convert them into your ICA entry. You got the point? Then only you'll understand this entry. Straight away you'll not understand. So first of all, are we done with this? In this there is any doubt? This doubt is there. Apart from this, any other doubt is there? Nothing? Shall I move on to the next entry? Yeah. Same entry only. We'll be doing different presentation. That's all. Now, Nana, look at this compound entry. Pretty simple. Did I receive 9 lakhs? So bank account debit 9 lakhs. Coming on to P&L account, you know that 10 lakhs worth of a financial asset, I've sold it for 9 lakhs because literally I've received only 9 lakhs. So therefore, there is a loss of 1 lakh. Therefore, you have transferred to the P&L account to the extent of 1 lakh. But tell me one thing, honestly, is your loss is 1 lakh, Nana? No. Because you also gave a financial guarantee whose fair value is 30,000, which means your loss is 1 lakh plus 30,000. Therefore, we have debited 1 lakh 30,000, which means here we have debited 1 lakh, here we have debited 30,000, which have combined in the compound entry. Clear? Then we know that there is a dummy asset that we have created. Continuing involvement, only to communicate that we have done something like this. 2 lakhs, that will come. Dummy liability we have created, associated liability to the extent of 2 lakhs, that will also come. And because the conditions are satisfied, step 1, rewards, contractual cash flows has been transferred. Step 2, risk, not completely transferred, partially transferred. Step 3, we check the control has been transferred. Therefore, asset has been derecognized. Therefore, 2 debtors. Okay, we have written 2 debtors. Got the point? And of course, we have a financial liability new liability that has got created because of financial guarantee. Okay, and that is to the extent of how much, Nana? 30,000. Therefore, financial guarantee, which is a liability, obviously 30,000. This is your component entry, which means we have just combined these three entries. Now, the problem with ICA is at least this entry is fine. If you look at the ICA entry, bank account debit, fine. P&L total debit, fine. 1 lakh plus 30,000, that is also fine. Continuing involvement, 2 lakhs, fine. Dummy asset. 2 debtors, 10 lakhs, you have to de-recognize it, fine. So you are creating the asset, fine. Associated liability, directly he has written 2 lakh 30,000. That's why students will not understand what it is. Because students will be looking at this. So maximum, your liability expectation is 2 lakhs only, na? But the fair value of that guarantee is 30,000. So actual liability is only 30,000. Then why is that ICA is crediting 2 lakh 30,000? What you need to, this is where students get confused. What you need to understand is that in this 2 lakh 30,000 of your ICA entry, there is a 2 lakh dummy liability. So the actual liability is 30,000 only. Now you see, you feel right now that the actual liability is 30,000. Then everything is clear. You understand the point? There's a dummy liability of 2 lakhs over here. There's a dummy asset of 2 lakhs over here. Now, if I just said there is a dummy liability of 2 lakhs, that also you will not get convinced. Why is that somebody will create a dummy liability of 2 lakhs? There is a dummy asset of 2 lakhs. Oh, now it will get cancelled out. It is like I slapped you on one face. You said that how can you slap me on one face? You see here it has become a little bit red. Then I slap you on the other side also. And now it has got evened out. Bad joke, na? Okay. Let's put it this way. I slapped somebody on the face. Eye has become blur. Only half eye is blur. So they are complaining in return. So I slap on the other side also. Now complete blur. Problem solved. Sir, it sounds so stupid. Exactly. That's what your ICA has done. That also sounds equally stupid. But anyway, see, in one way we can't call it as stupid also. Why? Because they are trying to communicate what is happening. So that is a better thing only. Okay. So continuing involvement to associated liability is a kind of dummy asset and dummy liability kind of entry. That's fine. Okay. That's fine. They want to what? Communicate what's happening. All right. Now that we know how this entry has been created, now let's see what happens in future. Let's see what's going to happen. For example, will the factor collect the entire 10 lakhs or he will face any sort of a problem? Will there be any bad debts in future? And if the bad debts are going to happen, then what's the treatment that we're going to do? Because at the end of the day, these two has to be cancelled out, correct? They should not exist. Once this transaction is about to be completed, these two should not exist. They should get cancelled out. How will you cancel out? Very simple. You will debit associated liability. You will credit continuing involvement. You will pass the reverse entry. There ends the matter. For this entry, reverse entry will pass. Okay, they'll be removed from the books. But then when you will do that, in what scenario you will do that, how will you do that? That's what we're going to see right now. Okay. Now let's see what happens next year. Let's see what happens next year. Two possibilities. No bad debts. There is bad debts. No bad debts is very easy. Entire 10 lakhs has been collected. Okay. Bad debt 0, which means amount also payable from our side will be 0. No liability for us. Already we have created a financial guarantee liability of 30,000. Now you reverse it out. You will credit the P&L account. There ends the matter. Entry. That's it. That's all. Simple. You got the point? In addition to this, of course, we created this dummy asset and dummy liability. That entry, you have to reverse it. And that also has to be cancelled. That's what I've written. Same copy paste here also entry. Which entry? This entry. What entry? That dummy liability will be cancelled out by debiting. Dummy asset will be cancelled out by crediting. Got it? Hello. If there is a bad debt, then what's going to happen? Now, this is interesting. So here, entire amount has been collected. So therefore, the financial guarantee will be cancelled out. You got it? But here, only 9,50,000 has been collected. So which means there is a bad debt of 50,000. So when there is a bad debt of 50,000, who has to pay to whom? I have to pay to the factor because this is with recourse. I gave that guarantee, sir. It's not with recourse, sorry. I gave guarantee to that extent, right? In fact, I gave guarantee to the extent of 2 lakhs. Although I have to pay a bad debts of 50,000 only. You understand the point? I gave guarantee to the extent of 2 lakhs. That is my exposure, maximum exposure. You got the point, which involves probability as well. That's the reason fair value was only 30,000, even though your exposure was 2 lakhs, because you always multiply that with probability to find out the fair value. Anyways, now the point is amount payable is how much? 50,000. Already I created a liability called financial guarantee only to the extent of how much? 30,000. Is that 30,000 liability is enough to pay 50,000? No. So increase the liability. So again, you credit financial liability guarantee. How much? 20,000. With that 50,000 you pay now. Did you understand? Simple. So total bad debts is 50,000. I already created a financial liability for only 30,000 over here. That 30,000 is not sufficient to pay 50,000. So now you increase your liability to 50,000 by creating the liability for 20,000. So now the liability is 50,000. Now you debit it and then pay the cash. 50,000. There ends the matter. And this dummy asset and liability has to be cancelled out because your job is done. Your purpose is served. Therefore, you pass the reverse entry. Here, what is the entry? Continuing involvement financial asset to associated liability. Now, here it will be associated liability to continuing involvement. There ends the matter. That's it. It's like a contra entry, Nana. That's what. Till here, it's clear. Everybody. Okay, now this is how your ICA entry is gonna be. Now you should understand that. Okay, fine. 30,000 is the fair value. Actually, my financial liability guarantee is only 30,000. Then why did I show 2,30,000? Because 2 lakhs is a dummy liability that I have created, for which dummy asset of 2 lakhs continuing involvement also has been created. Clear? Fantastic. All right. Chalo. Okay, still we did not complete. Still we are in the derecognition of financial asset topic only. Now let's expand our learning further. So we're gonna go a little bit deeper. We're gonna dig a little bit deeper. Okay. Sorry. Now we're gonna expand our learning further, which means, what do you mean by expanding over here? Same topic only. We're gonna dig a little bit deeper. Okay, we're gonna dig deeper. So we're gonna go full-fledged into the concept. Okay, first of all, let's start with a basic question. When will you derecognize? Suppose your financial asset is sold completely. Okay, literally sold. Okay, which means you gave all the risk rewards, with respect to that financial asset to the other party. You will fully derecognized. Or your cash flows are expired, collected completely. What do you mean by that? Suppose you purchased a debentures, it's a 5-year debenture. So 5 years you will get interest. 5th year the principal repayment has been done, which means what? The entire purpose of the financial asset is served. You received all the interest, you received all the principal repayment, which means the entire cash flows, the so-called contractual cash flows with respect to that particular financial asset is done. Is done with, it's finished, right? Then automatically you'll derecognize. Okay, these two are basic things, right? So a financial asset is sold means, by default, what you need to understand, risk and reward transferred. Risk and reward transferred. That is a basic understanding. Okay, now these two are rather very simple, plain vanilla cases. Okay, this is plain vanilla. Okay, there's no twist and turns over here. But look at this one. Suppose right to collect cash flows are transferred, which means step 1. Or right to collect cash flows is retained, but whatever you collect, you have to pay. That is, an obligation is created to collect and repay the cash flows as it is. Did you understand what I'm trying to say? Means either you transferred the entire rights, which is nothing but step 1. Of course, after that, we need to see whether risk has been transferred or not. Or you are only correcting the cash flows, but you entered into an obligation with other party saying that how much cash flows that I collect from my financial asset, as and when I collect, I'll be transferring that to you. You understand the point? It means, say for example, on a funny side, on lighter side, let's say you're getting 1 lakh salary and the entire salary goes to EMI. You understand the point? Many people, they feel like they're living their life only to pay EMIs. That's how the society has got created right now. Anyways, so the point that I would like to tell you guys is that it's like, I'm only collecting the cash flows, contractual cash flows from the financial asset, because I'll have right to collect now. But as and when I get it collected, I transfer it to somebody else. Now, in this kind of scenario, there is a confusion for us whether we should be going for full derecognition or partial derecognition. This is what we're gonna understand. Okay, now let's understand the concept with examples. Now, this is very important, Nana. Based on this, there are sums where people tend to get confused quite a bit often. Okay, so therefore, I want you guys to fully focus on this. Ready? Full focus. Ready? Now, first example. PK Limited has a financial asset of 10 lakhs. There is a financial asset which is worth 10 lakhs. Effective interest rate is 10%. That has been already calculated. Okay. It is a financial asset of how many years? 5 years. Debenture or whatever it is. You purchase debentures. Okay. Every year you're getting 1 lakh of interest, which means 10%. 5th year you are going to get interest plus principal repayment. Basic thing. Okay. Now what this company has done is, PK Limited, it has sold the right to all cash flows. This. Okay. From the beginning till the maturity to some other company for 9,50,000. Got it? Now, when I say all the rights has been transferred, you need to understand that risk also has been transferred. Okay. Why to create a doubt? Rights of all the cash flows from the asset. Let me put it this way, and risk as well. A second. Otherwise, tomorrow when you are revising, you'll get doubt for sure. And risk as well. Okay. So hereafter you need to understand by default that is the logic. Okay. Cash flows right has been transferred, risk also has been transferred to what? AK Limited for how much, Nana? 9,50,000. What you guys need to do? Step 2, step 1 is satisfied. Therefore, you have to derecognize. Derecognize means what you will do? You will credit the financial asset because it will be showing debit balance. You credit it, it's gone, it's removed from the balance sheet. And what you will debit? You received 9,50,000 cash. So bank account debit 9,50,000. There is a loss of 50,000. Obviously, it will go to P&L account. This you already know. We have discussed here. Correct? Chalo, fantastic. Okay. So this example is quite a bit simple. Now look at the second example. PK Limited sold specific cash flows from financial asset, not all. Not all cash flows. In the first example, it was quite plain vanilla. All cash flows has been sold. The rights has been transferred. That's not the case in example 2. Specific cash flows from financial asset, not all the cash flows. Or a proportion of specific cash flows from financial asset has been transferred, which means either you will say, I'll transfer only interest. Rights of interest collection transferred. Principal repayment stays with me. Or 50% of the interest collection rights transferred to you. 30% of the principal repayment rights transferred to you. 70% of the principal repayment stays with me. 50% of the interest payment stays with me. This is what we call proportion of specific cash flows. Why I'm saying specific? When I say 50% of interest is transferred, interest is specific cash flow over there. 30% of principal repayment is transferred. Principal is specific cash flow over there. You are specifically mentioning what cash flow, out of that how much percentage is being transferred. Clear? Like, say for example, PK Limited sold right to collect all interest related cash flows to AK Limited for how much? 4 lakhs. But retained the right of the principal amount. Got it? Or PK Limited sold right to collect 50% of interest cash flows and 30% of principal amount for 6 lakhs and retained 50% of interest cash flows with himself and 70% of the principal amount with himself. Got the point? This is what we call partial transfer of cash flows. In this case, what we need to do? Obviously, you have to do partial derecognition. You can't do full derecognition, but you can do partial. So, how to do partial derecognition? That is the biggest question. Very simple. Divide the financial asset of 10 lakhs into 2 parts. The retained part, how much you have retained, and the transferred part. Got it? Transferred part obviously will be derecognized. Retained part, you'll keep it like that. Naturally. Got it? Okay. But how will you do the split of carrying amount of financial asset, that is 10 lakhs? C.A means carrying amount. Carrying amount means right now, whatever the value it is showing in my books, in my balance sheet. Got it? That we call it as a carrying amount. So how will you split that? Because only if you split, the carrying amount of the transferred financial asset will be derecognized and the carrying amount of the retained financial asset will stay. This will be removed from the books. It will stay put. This will stay put in your books. This will be removed, derecognized from your books. Got it? How to do that? Simple. Now see here. Now, as I've clearly written here that you will split it based on the ratio of fair value. Correct? Now, how to find fair value? We already know. We find the market interest rate. Using that, we'll discount. We'll get the fair value. So once you get fair value, take the ratio of that fair value. Say, for example, the ratio of the fair value is in X is to Y. That particular ratio. You can imagine it is 1:2 or 2:3 or whatever it is. Let's say 1:2 or whatever it is. Okay. So X and Y is the ratio. In that ratio, you split the entire asset value. So what is the financial asset carrying amount? 10 lakhs. This 10 lakhs, you will split in the ratio of X is to Y. Once you split this 10 lakhs in the ratio of X is to Y, you get 5,50,000 for retained strip and 4,50,000 for transferred strip. Got the point? Again, I'll repeat. You have to do accounting when you do partial transfer of cash flows, specific cash flows or proportion of cash flows to the other company. To do that, you will have to split your financial asset into 2 parts. Retained strip, transferred strip. A retained strip will be retained in our books. Transferred strip will be derecognized from our books, which means it will be removed. Now, how to split that? For that, you need to find fair value of your total financial asset. And once you find fair value, you find fair value of the retained strip as well as transferred strip, and then take that ratio. In that ratio, you split the carrying amount of the financial asset. Then you'll get carrying amount of retained strip and carrying amount of transferred strip, which in this example, just imagine that the carrying amount of the retained strip is 5,50,000, carrying amount of the transferred strip is 4,50,000, which means this transferred strip is what I have sold. Let's say I've sold it for 6 lakhs, which means I will get 6 lakhs money. Therefore, my bank account will be debited. And this is sold, na? So this has to be de-recognized, the transferred strip. So it will be de-recognized at carrying amount. Okay. So to transferred strip, carrying amount of transferred strip. How much? 4,50,000. So 4,50,000 worth of a strip. I've sold it for how much? 6 lakhs. Naturally, I'll have a profit of 1,50,000 that will be transferred to P&L account. Okay. This is the entry that I have passed. Easy. But you know what your ICA has done? Your ICA says, see, this portion only, na, you transferred. Therefore, directly if you de-recognize this portion, it is simple. But your ICA did not do like that. What your ICA has done is, you de-recognize the entire financial asset. Sir, why should I de-recognize the entire financial asset, sir? I have only partially transferred, na. I did not fully transfer. Then why should I de-recognize fully? No. ICA says, you listen. You de-recognize fully. And then again, you recognize the carrying amount of the retained strip. You understand the point? It's like if you eat this much of biryani, it's fine for your body, daily needs. But what you do is that you eat this much and then you walk for 10 minutes or 15 minutes. Why to eat extra? Why to walk? You could have kept it at simple. I know it's a lame joke, lame comparison, but it's okay. Ultimately, are you getting the point first of all? Now, so if you look at your ICA entry, completely de-recognize the complete financial asset. Remove the 10 lakhs out of your books. Now, how much did you retain? 5,50,000, sir. Debit 5,50,000 because it's an asset, na? So, carrying amount of the retained strip will be debit. The net effect is what? What is the net effect? 10 lakhs minus 5,50,000. The net effect is credit of 4,50,000. That's what I've done here. It's exactly the same. Correct? Rest of the things are same. You receive 6 lakhs, therefore you debit bank account, and there is a gain of 1,50,000. You credit P&L. But ICA entry will be like this. So always they will de-recognize the full financial asset, even though it is a partial de-recognition, and then they will recognize the retained strip carrying amount. Clear? Done. Okay. So with this, we are done with 2 examples. Let's go to example number 3. Third example. PK Limited has transferred right to collect 80% of the cash flows for last 3 years without any identification as to interest and principal transferred. What did I say? Let's say totally 5 years is the financial asset, Nana. I said after 2 years, in the last 3 years, whatever the cash flows that I get, obviously in the last 3 years means what kind of cash flows you'll get? Plus you'll be getting principal remembered as well. But I did not mention anything specifically. In example number 2, I specifically mentioned, you see here, 50% of interest cash flows, 30% of principal amount. Okay, otherwise in this example, all interest. I specifically mentioned what I am transferring. Here, I said 80% of the cash flows, that's all. What cash flows? Interest cash flows? I don't know. Principal cash flows? I don't know. Whatever the cash flows that you receive in the last 3 years, 80% of it all. So, there is no identification of specificity of cash flows. Because there is no specification, in this case, how can you split cash flows? Here, there is specification, so I have split them by finding out the fair value. In the ratio of fair value, I have split the carrying amount. And then accordingly, I have passed the entry for recognition and de-recognition. Correct? Here, how will you split? It's difficult to split, obviously, because there is no specification. We just said 80% of the cash flows transferred. That's all. 80% of what? So what Ind AS 109 says is that since it is not specific, partial de-recognition not permitted. Okay. Partial de-recognition not permitted, which means you can't de-recognize your financial asset. Which means a financial asset whose 80% of the cash flows has been transferred. If Ind AS 109 says that de-recognition is not permitted, which means can you show it in my balance sheet? If I show it in my balance sheet, which means I'm showing an asset which basically represents future economic benefits. In reality, I'm showing it like 10 lakhs, but 80% of it goes to somebody else. So that 10 lakhs is not showing true and fair view in the balance sheet, na? Because you're showing 10 lakhs, what the user of the financial statement will think, 10 lakhs worth of something is going to come in future. What you're going to get in future? Nothing. Because out of the 10 lakhs, 88 lakhs will go out. So which means you should be logically showing only 2 lakhs, na? At least first of all, you should not show 10 lakhs. That's one thing is clear. So 109 says partial de-recognition is not permitted. Do full. You get it? Remove the entire 10 lakhs. There ends the matter. How? Let's try to understand. See here. Okay. Now that also will be wrong in one case, because how can you do full de-recognition? Because anyway, you're still getting 20%. That's why. Now see here. So it goes like this. You receive, because ultimately you have sold 80% of the cash flows. For that you'll receive money. Whatever the money that you receive, bank account debit. This is clear. Next, your India 109 said full derecognition. Full derecognition. To what extent? Full carrying amount. Sir, in my balance sheet, the carrying amount of the financial asset is 10 lakhs. 10 lakhs. Remove. Okay. 2 financial asset 10 lakhs. Gone. But I did not say sell 100% of the cash flows. 80% only. Nah, still 20% is with me. Then what you'll do? That whatever is left over, you know how much cash flows you're going to get, na? Whatever is left over, see, you know how much cash flows are transferred in terms of money. I'm not talking in terms of specificity. Whether you're going to get that cash flows from interest or by way of principal, I'm not talking about that specificity. I'm talking about the number. You know the number at least, na? Ultimately, this much number I'm going to get. Let's say 10 lakhs, I'm going to get cash flows. 80%, 8 lakhs has been transferred. 2 lakhs I'll come, na? Now this 2 lakhs, you discount at market interest rate and find out the fair value. At that fair value, you recognize the asset. Now, many students, what they do mistake is, they could not understand the difference between this entry, where there is no specificity with respect to the cash flows that has been transferred, and this entry. Many people, they feel that both these entries are same. They are not same. Sir, what are you talking, sir? Sir, bank account debit, sir, to the extent of whatever that you have sold, sir, cash flows. Here also bank account debit, sir. Correct, sir. Sir, full financial asset at carrying amount has been derecognized, sir. Here also full carrying amount of the asset has been derecognized, sir. Right. Here whatever that we have retained has been recognized, sir. Debited. Here also whatever you have retained has been recognized, sir. Correct only, but one point you missed. Here you have recognized the retained strip at its carrying amount. Here you have recognized the retained strip at its fair value. Now that's not a small difference. In case of specific transfer, you recognize the retained strip at carrying amount because you ultimately identify the carrying amount. Here also you calculate fair value, but not to represent at fair value, but to find a ratio through which you will split the carrying amount of the total financial asset into retained strip and transferred strip. Keep that in mind. You find fair value here to find ratio, that's all. You understand the point? Ultimately here you will be recognizing your retained strip at carrying amount only. Then there is specificity of transfer of partial recognition of cash flows. You understand the point? Whereas here you recognize the retained at fair value. The above entry looks similar to the previous entry, but they are not same. Why? Because earlier financial asset retained is debited at carrying amount. Now financial asset retained is debited at fair value. Got the point? Don't do these kind of mistakes. I hope this is clear. Okay. Right. This anyway we know this already. Transferring the financial asset means transferring the right to collect cash flows, and the risk and reward should be transferred. If risk and reward are not transferred, you will not derecognize. This we know already. Okay. And I think this point also we have already learned now. I think it's a little bit of repetition. Anyways, telling my financial asset debtors to factor. If it is non-recourse means you will be bearing the risk. Then do not derecognize. Okay. Sorry. Non-recourse means you will not be bearing the risk. Risk will be transferred. Then derecognize. With recourse means it's going to come back. It will come and bite you back. So therefore risk and reward not transferred completely. Therefore do not derecognize. In that case, you'll be showing financial asset as well as financial liability. This already I've told you, na. Whatever the money that you receive from the factor, you'll debit the bank account because you have received money to financial liability, because at any given point of time you have to pay this money back because you are not risk free. Okay, because in very faint statements you have to pay that. Therefore, financial asset will not be derecognized. So that will also show in your balance sheet. Got it. This anyway we have learned. There's nothing new over here. Okay, let's come to this example. This is important example. Still we have not yet done with derecognition of financial asset. This is the last topic. Okay, with this we'll be done with completely the so-called derecognition. Okay, I want you guys to focus. Ready? Yeah? Chalo. X Limited has a loan receivable of 10 lakhs at interest rate of 10% per annum for another 5 years. Okay, he has a financial asset. It has today transferred the complete rights of interest and 30% of principal cash flows to B Limited. Tell me, specific or non-specific? Specific. For how much he has transferred? 5 lakhs. To that extent, you will debit the bank. The market interest rate today is 12%. Why this is given? To find out the fair value. It says that you will find out the ratio. In that ratio, you will split the carrying amount of the financial asset into carrying amount of the transferred strip, carrying amount of the retained strip, and carrying amount of the transferred strip will be derecognized, carrying amount of the retained strip will be recognized. Should we do a partial derecognition or full derecognition? Show the accounting. We will do partial derecognition because there is clearly specific mention of transfer of cash flows. If it is There is no specific mention of transfer of cash flows. If blindly he says 50%, 60%, in that case, we'll do full derecognition and then we'll recognize the retained amount at fair value. But here you'll be doing partial derecognition. So this belongs to example 2. Okay, now let's solve it fully, because in this example we did not solve it fully. Although I gave you numbers, I told you that there are these imaginary numbers. You find out the fair value. You know how to find fair value. You need to discount it using market rate. Then you find the ratio. In that ratio, you divide this carrying amount, divide them into retained strip and transferred strip carrying amount, and then accordingly you put the entry. But now we're gonna do the same with the help of numbers. Okay, the cash flows transferred are representing interest cash flows specifically identified. Okay, completely transferred interest. Okay, and the principal 30% has been transferred. So what we need to do is partial derecognition, not full derecognition. If it is there is no specificity involved, then we will do full derecognition like this. Okay, anyways, so first what we have to do is that we need to find fair value. Okay, because we need to find the ratio. Fair value of the transferred strip, fair value of the retained strip. First, transferred strip is how much? Entire interest is transferred. How much is the interest? 10% out of 10 lakhs, which means 1 lakh for 5 years. So 1 lakh for 5 years. You will get 1 lakh after 1 year, 1 lakh after second year, 1 lakh after third year, 1 lakh after fourth year, 1 lakh after fifth year. So take that 1 lakh, you multiply with first year discount rate, second year discount rate, third, fourth, fifth, instead of that, total of the 5 years discount rate. So 1 divided by 1.12 equals to first year discount rate, again equals to second year, again equals to third year, again equals to fourth year, again equals to fifth year. Grand total will give you cumulative discount rate of 5 years, which we call it as present value annuity factor. That is 3.608, which is nothing but total of 5 years discount rates. Okay, right. Then what did you transfer? 30% of the principal. How much principal you are going to get? 10 lakhs. So 10 lakhs into 30%. This you will be getting after fifth year. Therefore, fifth year discount rate. 1 divided by 1.12. First year, second year, third year, fourth year, fifth year. You will get this number. 0.5674. So you got the fair value of the transfer strip. Got it? So what is fair value of the retained strip? Very simple. How much you are getting? You are not getting any interest. You are getting only principal repayment. That too, in principal repayment is getting how much? 70%. So 70% of 10 lakh is 7 lakhs into same fifth year discount rate. You will also be getting after fifth year. So multiply that, you get the fair value of the retained strip. Now, carrying amount of the loan receivable, which is 10 lakh, should be divided into carrying amount of the transferred strip and retained strip in the ratio of fair value. So what is the fair value? 5,30,700, 3,97,180. In that ratio, you will divide it for transferred strip and retained strip. This I hope it's easy for you to understand. 10 lakhs into 5,37,00 divided by 5,37,00 plus 3,97,180. Got it? Chalo, you got the carrying amount. Now you know that carrying amount of the transferred strip will be removed, derecognized. Carrying amount of the retained strip will be held. But how do we pass the entry? As per ICA, derecognize the entire financial asset. Logically, we don't do that, but that's how your ICA passes the entry. Okay. So, to loan receivable 10 lakhs. You derecognize the entire 10 lakhs and then you recognize the retained portion. How much is the retained portion? 4,28,51. To this extent, you debit. You debit. Got it? Hello? Yes? Right. Now, that's it. This is a different way of presentation. Chalta hai. That's not an issue. Okay. I think this entry is not necessary also. Directly you can pass on this entry. Okay. Bank account debit. Okay. To transferred strip which has to be derecognized, and the difference between these two will be P&L account. In this case it is loss. So P&L account is debited. I think your ICA will not pass entry like this. Okay. Array. I know I've seen the sums. So first it will be, okay, let's imagine that this entry does not exist. Okay. So to loan receivable, first they'll derecognize the entire financial asset, 10 lakhs. Why did I not pass this entry means, because if I pass this entry as per your ICA, you'll get confused that here specifically we have mentioned that we should not be doing full derecognition. Nah? But actually because of passing the entry, if you look, it seems as if you're doing full derecognition. That's why this entry is only correct. But your ICA is doing like that. What can we do? So to loan receivable, then you debit the retained strip portion. Retained strip. 4,28,51. You got the point. And then you received money, na? So bank account, 5 lakhs. Got the point? So obviously there is a difference in loss. So P&L account, 71,941. Usually your ICA entries will be like this. So basically you just derecognize the entire financial asset and then you recognize only the retained portion, and then you have received 5 lakhs bank account, na? You put that as well. So totally you'll be getting 5 lakhs plus 4,28,9,28, and here it is 10 lakhs. So obviously the difference of 72,000 approximately is loss. This is how your ICA will pass the entry. But honestly speaking, this is the right entry because you should not be doing full derecognition. That's the concept, na. When there is specific cash flow transfer, you will not do full derecognition. If there is non-specific cash flow transfer like this, in this case, you will do full derecognition. Here, full carrying amount of financial asset getting credited, thereby derecognizing is correct actually. But then your ICA is ICA at the end of the day. This is how they do actually. That's okay. I hope you have understood. Now, moving on to the last example. PK Limited has advanced various housing loans and whose installments are receivable over the next 10 years. Okay. PK Limited today has sold to B Limited right to collect all the cash flows from house loan receivables in the next 4 years. Okay. Next 10 years he is getting, but only to the extent of next 4 years he has sold the right to collect all cash flows. So rewards has been transferred, risk transferred. Cash flows are specific. Okay, we presume that risk is also transferred. Cash flows are specifically identified, obviously, because next 4 years, whatever the cash flows that you're going to get, you're going to transfer. But what cash flows are you going to get? Interest cash flows or any principal repayment, partial any principal repayment is going to happen, because that happens. Always don't come to a conclusion that principal repayment will happen only at the end of the year. Sometimes they'll have, principal repayments also, especially we are talking about house loans over here. So one thing is clear, cash flows are not specifically identified. Fine. Which means partial derecognition is not allowed. Correct? Full derecognition has to be done. So what we'll do, the portion of cash flows belonging to PK Limited is to be recognized separately at fair value. We know that. So do the full derecognition at carrying amount and do the fair value of the retained strip cash flows. What is there? How to find fair value? Just now we have calculated. Na? How to find fair value? Find out the future cash flows that you have retained. You multiply that with the discount rate. That's all. You will be getting the fair value. As simple as that. If you discount at market interest rate, you get your fair value. As simple as that. So hereafter, don't ask me how to calculate the fair value. Got it? This is just an example I just wanted to show. Okay, that's it. We are done with derecognition of financial asset. Okay. Any doubts? In problems, you will see, Nana, okay, which entry I need to pass between these two. We will see that once we start solving sums, you yourself will get clarity. But most of your ICA sum, this is the entry that they have passed. But according to the concept, as I told you, that when there is specific transfer of cash flows, you should not be doing full derecognition, which means this entry only will hold good. Okay, it matches with the concept. Okay, this entry will hold good provided if there is a situation like this where your cash flows are not specifically identified. Okay, if you pass this entry, then if you can see that here, that is the reason earlier you guys have confused. Na? You were thinking that this entry and this entry in two different scenarios, you're thinking that they are same, but they are not same, because here only you should do full derecognition. Here you should not be doing full derecognition. You should be passing an entry like this where you can be clear that full derecognition is not happening, but your ICA passes entry like this. What to do? Got it? JICA, that's all. Yes, JICA. Okay, right, that's it for today. What you guys do is that go home, you try to revise all these things and then come back. Oh, we have okay, all right, chalo. Right, guys, that's it for today. Let's wind up. So with this, we are done with complete derecognition of financial asset. वो topic तो गया. So now we have a small topic, that is financial liability. Financial asset only will take a lot of time, Nana. Financial liability, when it comes to measurement, it's very easy. See, hardly we have 4 pages. And after that, we eventually go to what? Compound financial instrument. Okay. All right. Now, let's start with financial liability accounting. You guys are ready? All right, guys. Now, let's start with accounting of financial liability. Okay. Chalo. Now, see, if you could recollect when we were discussing about different methods. For financial assets, there are 3 choices: FVTPL, FVTOCI, ACM. But for financial liability, there are only 2 choices: FVTPL and ACM. FVTOCI does not exist. First point. Even in those two, 95% of the cases will be using ACM only. Only in some special cases, in some special circumstances, we'll be using FVTPL. That we will see it in future. Okay, not now. Okay, we have a lot of time for that. I think where are those special circumstances? Let me show. Yeah. Just a second, guys. Yeah, here it is. Can you see this? Financial liability measured using FVTPL. Special cases. Special cases that are exceptions to the general rule of. Why did I write ACM? Or AMC? ACM, right? What is? I've written AMC. Okay, it's okay. So the general rule is ACM only. Okay, but you'll have some exceptions. We have case 1. case 2, 3, 4, 5, 6, 7, and then you have summary. Okay, so there are 7 special cases, scenarios where you will be measuring your financial liability with, under FVTPL. Got the point? Chalo, anyways. So which means, why did I show you this? You guys need to understand that in general, we'll be going with ACM method, mostly by default. Are we gonna discuss certain special cases? Only if that special cases comes in your question, you'll be going for FVTPL method to recognize your financial liability. Otherwise, strictly, you will stick with ACM method, amortized cost method. That's all. Okay, right. Okay. We know what is amortized cost method. Your initial recognition will happen at fair value. And what will happen to the transaction cost? It will be set. You will be setting it off, right? So fair value, net transaction cost, obviously. In FVTOCI also, you'll do the same. Transaction cost will be adjusted. That's what we call setting off anyways. But in case of FVTPL only, that transaction cost will be transferred to P&L account, which we already know. Okay. Now, financial liability, which is payable on demand, or there is insignificant time value of money, which has got no value, which means time has got no value. In that case, it will be recorded at transaction value. Transaction value is the real value. Okay, fair value is nothing but you try to discount it at a market rate or something like that because of influence of time value of money and stuff like that. Okay, right. Anyways, this we already know. So ACM method means always initial recognition will happen at fair value adjusted with transaction cost. In some cases, if there is no time value of money involved, then transaction value is also fine. Okay, moving on. Let's try to solve a question, okay, to understand how to account financial liability. Okay, you guys already know the accounting of financial asset, correct? As per ACM method, same stuff only. There we have liability, there we have asset, here we have liability. That's the only difference. Okay, so let's go with the question. A Limited issued 10% debentures, that is face value 1 lakh at 94,000. So you have issued it at a discount rate. Interest is paid annually and it will be redeemed at the end of third year at face value. Redemption at par. Past journal entries for first year. Okay, present value factors at 13%, 12% and 13% is given. Okay, you need to understand one thing. The coupon rate is 10%. Is it the effective interest rate? No. Why? Because if at all he would have issued these debentures at 1 lakh, which means exactly at the face value. And after 3 years also he'll be redeeming at 1 lakh, which is exactly the face value. And only thing that he's doing is that paying interest every single year. In that case, your coupon rate of interest will be nothing but effective rate of interest. Both will be 10%. However, here that's not the case. You have issued debentures. Obviously, you have an obligation to pay cash. It's a financial liability for you. But you think that your cost of giving these debentures, you have to effectively pay 10%, but that's not reality, because 10% would have been the case provided you would have received 1 lakh at the beginning. You did not receive 1 lakh, you received only 94,000 because you have issued debentures at a discount. So therefore, this 6,000 cost also who has to bear? You only has to bear in addition to 10% that you're paying every single year, correct? Which means your total percentage of cost is more than 10%. That's what we call EIR. In this question, anyway, EIR is not given directly, so we will calculate. How to calculate trial and error method? What is trial and error method? Already 12%, 13% is given in the question only. So use 12%, discount it. Discount the cash flows, that is interest. Interest will be 10,000 for 3 years. Last year it will be, you'll have 10,000 plus the repayment of 1 lakh, obviously, right? So discount it at 12%. See how much is the discounted cash flow. It should match with the initial discounted cash outflow, which is 94,000, correct? So the rate at which you will discount cash inflows, okay, here we are talking about financial liability. So this is inflow and this is outflow, okay. The rate at which you will discount your cash outflows such that after discounting, it should tally with the initial cash inflow, which is 94,000. That rate is nothing but effective interest rate. Got it? So you discount it, you get 95,220 at 12%. Then you increase the interest rate because I want it below 95,000. At 13%, you get 92,910. So we know that in between 95,220 and 92,910, we have 94,000, which we want, right? Because it has to tally with 94,000. Okay. So which means between 12% and 13%, I should have my effective interest rate. Apply interpolation technique, you'll get your answer as 12.53%. This is your effective interest rate. Got it? Hello. Now, once you know effective interest rate, after that things are routine only. You'll prepare ACM table first. In ACM table, what you will do, obviously, opening balance. Okay, opening balance. And this is your liability, opening balance of your liability. So in first year, you'll recognize your liability at fair value. And you have here it at 94,000. And once you have 94,000, what you will do? You have to pay interest now because it's a financial liability. You have to pay interest. To that extent, your financial liability will increase. Got it? Because it's an obligation to pay, right? So add that interest. And once you actually make payment, that's once you pay this 10%, that is 10,000, then you are actually paying. So therefore, your financial liability reduces. So reduce this actual payment. This is nothing but contractual cash flows. This is nothing but contractual cash flows. This is nothing but interest expense. In financial asset, we will call it as interest income. Here we call it as interest expense. Now here in this example, it has been done in a different way, but usually what we do is that we can do it like that. First year, second year, third year, opening balance, 94,000 is the liability. Add interest expense, because interest expense will increase your liability value. That is 94,000 into 12.53%. At effective interest rate only, you have to multiply. Then minus contractual cash flows, where you'll be paying interest. So paying interest cash flows will reduce your liability. Got it? So which will be 10,000. And then you'll be having your closing balance. Next year, this will become opening balance for second year. And then calculate. Like this also you can do, where years will be columns. And opening balance, interest expense, contractual cash flows, and closing balance will be your rows. Here it has been done in a different way. Either way, it's same, Nana. Whatever we have followed for financial asset, ACM method, it's same here with minor differences. That's all. Okay. Are we done with this? Let's look at the entries. Initial entry, you guys know, you have to recognize the financial liability. So obviously, two financial liability, right? This is 10% debentures over here. And you'll be receiving money initially. So bank account debit, how much? 94,000, 94,000. Then your financial liability should be increased to the extent of effective interest rate, which is imaginary interest, correct? So that 12 point, how much percentage? 53%, you will add and increase the liability. In reality, once you pay the actual cash flow, the contractual cash flow, which is the coupon rate, that is 10%. Once you have paid the interest, your liability reduces naturally. So reduce it, that 10,000. You will be repeating this for second year. You will be repeating this for third year. Same entries only. Got the point? Numbers will change. That's all. Because you have prepared ACM table, all the numbers are ready for you. So you can easily pass entries for all the 3 years. So nothing much to discuss over here. It's a cut copy paste of what we have learned in financial assets. That's all. Cut copy paste. Nothing much. Are we clear with this? Right. Now let's look into another example. Example 2. Moving on to next example. B Limited has issued 10% debentures of face value 1 lakh, redeemable after 3 years. The initial issue expenses is 5,000 again. So because of these expenses, you will not be receiving 1 lakh, you will be receiving 95,000. So obviously your cost is not just 10% interest that you pay every year, but this 5,000 loss as well. Show the accounting in books of B Limited if the effective interest rate is 12.1%. Obviously, he himself gave you effective interest rate. So which means your actual interest expense is not 10%, it is 12.1%, including this expenditure of 5,000 as well. Got it? Right. Okay. Initial recognition entry is very easy. You have to recognize the liability. At what value? How much money you have received? How much money you have received? 95,000. Why? Because that's what your ACM method says. By default, we are applying ACM method. So ACM method means whatever the value that you have got, you have to adjust it with transaction cost. How much is the value? 1 lakh minus transaction cost 95,000. 95,000 is what you will recognize. How much money you have received? 95,000. So debit the bank account. There ends the matter. This is your initial recognition entry. At the end of each year, what I'll do, I'll be preparing obviously ACM table, and then I'll pass the entries. Here what I've done is that both of these has been clubbed together, ACM table as well as the entries, so that it will be saving time and space for us. That's all, because all these are examples only, not your real ICA questions. Okay, so first year what will happen? Obviously you will have your opening balance, which is 95,000. And for that opening balance, we need to add interest expenditure at effective interest rate. So effective interest rate is how much? 12.1%. So 95,000 into 12.1%, 11,495. To that extent, your financial liability will increase. So the entry will be very simple. Interest expenditure debit to financial liability. Because if you want to increase the financial liability, it has to be credited, because it shows credit balance. So the more you credit, more it will increase, right? Ultimately, you know that it has to be increased. Therefore, you credit the financial liability, debit the interest expense. Okay. After that, once you pay the actual contractual cash flow, where you pay the actual interest of 10%, because you paid the money, your liability has got reduced to that extent. Therefore, what you will do, debit the financial liability and credit the bank, because once you have made the payment, money goes out. So you credit the bank, debit the financial liability, because financial liability balance has to be reduced. That's it. You'll get your closing balance. Second year and third year, same stuff. Got it? Easy peasy. Right. Moving on to example 3. Now come to example 3, Nana. After that, we'll go to compound financial statement. After that also, we'll see some special cases of financial liability where we have to recognize it using FVTPL and not ACM. So for all the examples that we are seeing, we are applying by default ACM, because by default, when it comes to financial liability, you'll apply ACM only. Got the point? Right. A Limited has issued 0 coupon bonds for 7 lakhs, which will be redeemed after years at their nominal value of 10 lakhs. 0 coupon bonds means no interest whatsoever. So you'll issue the bonds at deep discount and you'll redeem it at a very good amount, so that this difference will be the return for the investors. Okay. So you have issued 0 coupon bonds, which means you have received 7 lakhs, and you said that after years, I'll be redeeming 10 lakhs. So that 3 lakhs will be the profit for the investor. Okay. The initial expenses incurred for issuing the bonds is 20,000. Show the accounting in books of A Limited. Very simple. This expense also you have to consider, which means ultimately you have received how much in your bank account? 6,80,000. After years, I don't know how many years I've written here. Okay, I've considered 4 years over here. So let's write 4 years. After 4 years, let's put it this way. It in same ink. Okay. Now after 4 years, you have to pay how much? 10 lakhs. Correct? After 4 years, you have to pay 10 lakhs. Pretty simple. Now this 10 lakh should be discounted at a particular rate such that after discounting, it should be equal to 6,80,000. Got it? So 10 lakhs is the future value, 6,80,000 is the present value. So future value is equal to present value into 1 plus r whole to the power of number of years, right? All right, Nana. So we know that future value is equal to present value into 1 plus r whole to the power of 4. We need to find this r. So obviously what 1 plus r whole to the power of 4 is equal to 10 lakhs divided by 6,80,000. 1 plus r is equal to, this whole to the power of 4 goes the other side. It becomes 4th root or 1 divided by 4 whole to the power, right? And r is equal to, this 1 goes this side, it will become minus 1. Whole to the power of 1 by 4 means you can put square root both the times, okay? So which means 10 lakhs divided by 6,80,000, that will be equal to 1.4705 square root 2 times 1.1012 minus 1, you get your effective interest rate, which is 10.12%. Hereafter, you know what to do when it comes to ACM table. You take the opening balance, which is the amount that you received, 6,80,000. To the extent of 10.12%, which is effective interest rate, we will increase the liability. Add 10.12%. Normally, what we'll do when we make the actual contractual cash flow, that is the interest payment, that is the coupon rate of interest, to that extent, we'll try to reduce the liability value, correct? But here it's a zero coupon bond, therefore we are not making any contractual payments till the redemption. You got the point? Finally, in the redemption, we'll pay back 10 lakhs. So therefore, no need to reduce anything because no contractual cash flows are paid. Simply add this effective interest rate every single year such that you take the 6,80,000 all the way to how much? 10 lakhs. Finally, it will become 10 lakhs. You reduce 10 lakhs because you'll make a contractual cash flow of 10 lakhs in the last year. Finally, it becomes nil. That's all. Got the point, Nana? Everybody? Yes. That's it. Financial liability is very easy, Nana. It's just a rip off, or I can say copy paste of your financial asset. Nothing special for us to discuss over here. Once we go to solving sums, there you guys will understand. Okay, it's pretty much the same. Especially ACM method, nothing new for us to discuss over here. But of course, in financial asset, in most of the cases, what we used to do is that we used to have situations where staff loans and all these cases where they'll be going with low interest rate. The market interest rate will be different. Therefore, we used to discount at market interest rate to find out the fair value, and then we used to put ACM table. Here, that is not the case. Mostly in financial liability, we'll be talking about effective interest rate. And 90% of the cases, effective interest rate will be given in the question itself. So that headache is also not there for us. So it's easy peasy. Got it? Chalo, Nana. Let's wind up the session. In the next session, we'll continue with compound financial instruments. Okay, chalo. All right, guys. Hi, Nana. How are you? Right. So welcome to another session. I hope this session will be a fantastic session. Okay, we're gonna learn a lot of new concepts, and I hope you guys are excited. Even I am excited. Hello, hi, Nana. Right. Okay, let's straight away get into the concepts. Okay, so now we're gonna get into a very important concept, Nana, that is compound financial instruments. Now, why I'm telling you this is very important, because just look at here. What did I write here? Every 2 attempts, you will have a 1 question from this particular area in exam. At least that has been the trend so far. Sometimes it might skip. So whatever I say, it's not 100%. Okay. So don't ask me if something, goes off one particular attempt. Okay. Usually this is what it is. So from that perspective, this is very important. Why? Because once we go through the concept, there's a lot of depth in this particular concept. Okay. Especially when it comes to buyback of compound financial instruments and all that stuff, and embedded derivatives also. These are all the kind of concepts where you need a lot of depth to understand to solve the sums as well. So that is one of the reason why ICA keeps testing. Okay. Because you just think from ICA's perspective. Obviously, they'll be like, we just test those areas which can trouble students. It's a bare minimum expectation, right? That we can expect from our ICA. So anyways, right. So shall we start with the concept now? Is it important? Yes, it is. Chalo. So we already do have a basic idea of what is compound financial instrument. Okay. So it is one single financial instrument that is made up of 2 parts. It has liability in it. It has equity in it. Correct? Right. Now, please try to understand one thing. We are going to learn this concept from whose point of view? Issuer's point of view. Now, this should be there in your mind. Otherwise, you will understand the concepts in a wrong way. Okay, so issuer's point of view means the one who has issued these financial statements. From his point of view, we are going to learn the whole concept. So keep this in your mind. Clear? Because Here we're gonna talk about liability and equity, Nana. So there is no question of asset here. Clear? So somebody who buys a debenture, for example, for him in his books it's gonna be an asset. So we are not gonna learn this particular concept from his point of view, isn't it? It's a pure common sense, right? So when I'm talking about purely liability and equity, if it is not liability, then obviously it's gonna be equity, but it's never gonna be an asset, right? So therefore, purely we're gonna talk about this particular concept, the accounting and stuff, everything, okay, from issuer's point of view, not from receiver's point of view. These are all very basics, Nana, but this is very important because many a times people miss this particular point, especially students, and as a result, they tend to get confused because many a times their mind will keep on fluctuating. Okay, issuer's point of view or the one who has bought the debentures, his point of view. You know, holder's point of view, issuer's point of view, holder's point of view, issuer's point of view. Okay, don't get to this confusion. Let it be very clear. If it is issuer's point of view, only then you'll be getting liability. Clear? If it is from holder's point of view, naturally it's gonna be asset, and that's outside the purview of our discussion. Okay. So we're gonna do everything from issuer's point of course. From issuer's point of view, to do some accounting, we'll also think from holder's point of view when we give an option to him. There are certain cases where you'll have a convertible debenture. So when it's a convertible debenture, what does it mean? You have a liability part where you have to pay interest. At the same time, you give the option to the holder. See, when it comes to convertible debentures, there are two choices now. Either the conversion can be at the option of the holder or the conversion can be at the option of the issuer. In that case, when the conversion is at the option of the holder, which means holder can exercise the conversion option. Either he wants, he can ask you to convert that into equity shares, or he can ask you to just redeem. You understand the point? In that case, when we are doing accounting from issuer's point of view, we have to think what he's gonna do as well. That is the only area where we will consider holder, but we never look into holder's point of view. You understand the point? Which means there is no question of learning this concept from holder's book's point of view. Am I clear? I hope this is very clear. This is the first important thing. Okay, that's one of the major reason why students tend to get confused. Okay, anyways, having said that, so this is your highlight point over here. Issuer's point of view. Clear. Now, so we have liability part as well as equity part. So liability part means you guys know it's a liability. So something that company has to pay back. Equity part, something that gives the holder ownership right like shares. So therefore, from company's point of view, there is nothing for us to pay back when it comes to equity, right? Only when it comes to liability part, yes, we have an obligation to pay. That's why it's called liability naturally, right? Now, so the logic behind compound financial instruments is even though you see it like one single contract of a financial instrument, inside it are actually two things. One is a loan, which is nothing but liability, and the other one is a right to become owner, which is nothing but equity. So to give it a different simple perspective, it is just like a pizza combination. You know, think of it like this. Imagine you're selling pizza combo. Here also imagine you are selling pizza combo. Issuer's point of view, who is issuing that pizza combo. You get it, right? So pizza plus Coke combo, and we say that the combo price is 500. But if bought separately, pizza cost 400 and Coke cost 100. So Ind AS says that you split and record pizza and Coke separately because they are not the same. One is a solid food, the other one is a liquid food. You understand the point? So even though you sell it as a combo, Ind AS says that, array yaar, you split that because both of them are not same. Okay, one is a solid food, the other one is a liquid food. So let's try to account this separately. Same logic applies to compound financial instrument as well. So here what's going to happen is that even though you issue that as a one single instrument, Ind AS says that a liability component has got different characteristics. There is an obligation on your part. Equity component has got different characteristics. There is no obligation on your part. So therefore, one affects the P&L account, the other does not. So therefore, in that case, you have to account this separately. That is where the demand arises to split them. Now that's where all the complications enter into picture. So if I have to split, how to split? Got it? So what is a major contention for us right now when it comes to accounting of compound financial instruments? How to split? Clear? How to split? Perfect. Right. Now, why do we need to split a compound financial instrument? Just now I told you, to show true financial position of the company. Because debt and equity are very different, just like pizza and Coke. Debt needs repayment, so it is an obligation. Of course, interest also you're going to repay. Equity is like an ownership, so there is no question of repayment obligation. So if you don't split it, then the company's financial statement will not reflect the reality. In the sense, not true and fair view. So Ind AS says split the bond into debt part as well as equity part at the beginning itself. Key point. I could have used the word at the inception, but anyway, I just wanted to keep things simple. At the beginning means the moment you issue a compound financial instrument, at that particular point itself, you have to split. You're not going to split that later point of time. So point of time is also important over here. At the beginning itself, we're going to split. Got it? Right? That's how we're going to do accounting. I hope this is clear. Everybody, just confirm me. Hello? Yes? Now, so we know that we have to do the split between the liability and the equity component at the beginning itself. Okay. Now the next question is, how do we split it? Okay, 3 simple steps. So just focus. Step number 1. So what do you do? Why do you do it? So I gave you the reason as well. Okay. Calculate how much the debt alone would be worth without any conversion option. Sir, what do you mean by that, sir? Very simple, Nana. Suppose you gave 10% debentures. Listen carefully, I'm giving you the logic, okay? Suppose you gave 10% debentures, gave in the sense you have issued as a company, okay? Which has got a conversion option, right? Let's not discuss about whether the conversion option is at the option of the holder or at the option of the company. That is another discussion. We'll see that later. Let's say you have given 10% debentures, which are convertible, right? Now, in this 10% debentures, when I say which are convertible, definitely it has got a equity portion as well, because convertible means it is convertible into equity shares, obviously. Now in this, we need to split them into liability and equity portion, and we need to find out how much is the liability portion. Now how to do that? Now you need to compare this with a similar debenture option in the market where everything is same. Okay, the risk of the company also should match, but the only thing that different is there is no conversion option. One thing is for sure, definitely the interest rate will be more than this. I told you this so many times. So whenever you have a conversion option, definitely the interest rate will be less. The difference is nothing but the equity component. We have seen this already. Okay, this is not something new. I'm trying to teach you for the first time. Okay, we have already seen this in the earlier discussion. Okay, so definitely there will be a non-convertible debenture which does not have a conversion option, obviously, and definitely that interest rate will be much higher. So what the Ind AS 109 says is that calculate how much the debt alone would be worth without any conversion option, which means you need to take that interest rate. Okay, we'll see the steps as well. You need to take that interest rate and then try to discount it to find out the real value of the debt. I mean, the liability component of the total compound financial instrument. Okay. So why do you do it? Because that's a borrowing. So borrowing is completely different from what? Equity portion. Simple logic. Now, then what you do in step 2, reduce that debt value from the total amount received. Total amount what you have received is for the entire compound financial instrument. Now that you have calculated what is the debt value, how did you calculate that? By taking a comparative debt where there is no conversion option. That is a real debt value, na? Because if there is a conversion option, the interest amount in the debt is already manipulated. You understand the point? So therefore, I need to take that debt where the interest amount is non-manipulated so that I'll really find out what is my value of the debt. You understand what I'm trying to say, right? So naturally, see, use your common sense, Nana. When you take a higher interest rate and then try to discount it, automatically the value will come down when compared to the amount that you have received. Then automatically the balance becomes what? Equity component. I hope you are able to get it. If you're not able to get it, don't worry. Anyway, we're going to solve example. Immediately we have an example here and we're going to look at the numbers. You will get clarity, obviously. Okay. So subtract this so-called debt value from the total amount, total consideration that you received for the compound financial instrument. Automatically, the remaining value will be equity part. Record both separately. Okay. 2 compound financial instrument within brackets financial liability part, 2 compound financial instrument, obviously equity part. There ends the matter. On the other side, what you will debit? You would have received money, so bank account you will debit naturally. So liability for loan, equity for ownership, right? Simple. So how do we split it? Step 1, calculate how much the debt alone would be worth without having any conversion option. So obviously you'll have a higher interest rate. With that you discount it. So the value will be less. Take that value, reduce it from the total consideration that you have received for the compound financial instrument. And the balance will be equity. Record both there. It's a matter, that's all. Okay. This should be there in your mind, Nana. That's why I gave you clear steps. Why? Because you need to have this what do I call? I call this as a skeletal structure of the answer. First, you should have the procedure in your mind. Then once you substitute that with the numbers, answers will come in a natural flow. You understand that? Right. Anyways, now let's do the example. You'll get 100% clarity. Geo Limited had issued 10% debentures of rupees 25,000 redeemable or convertible after 4 years at par. Got the point? Fantastic. The market interest rate on similar debentures without conversion is 14% naturally. Just now I told you. Got it? When you don't have a conversion option, definitely you have to pay more interest. When you have conversion option, you pay less interest because the remaining whatever the interest that they are losing over here between these two will be compensated by the equity part. You get the point? So 14% debentures will be converted into equity shares having a face value of 10,000. Very, very, very important. Sir, why this sentence is important, sir? Will be converted into equity shares having a face value of 10,000 means face value is given. So indirectly your number of shares is fixed. Got the point? Because whatever the redemption value you have, you will have an amount. So that amount divided by that amount is also fixed. Divided by the face value will give you number of equity shares. In that case, that is also fixed. Once it is fixed, obviously you have satisfied what? Fixed to fixed test. Only if you have satisfied fixed to fixed test, then only there is equity component. Then only it becomes compound financial instrument. Please try to understand. If fixed to fixed test is not satisfied, then that will also become a liability part. Then interest is also liability part. Redemption also becomes liability part. Then both liability, it is not a compound financial instrument. First of all, please try to understand. This is very important again. If an instrument has to be defined as a compound financial instrument, it should have a liability part and equity part. Now, to have an equity part, it has to satisfy fixed to fixed test. That's why we have checked that first. Clear? Right. Okay. Now, we're going to solve this example in two ways. So, what do you mean by two ways? First one is option to convert or redeem is in the hands of the holder. We will solve the entire sum. Then, second option is option to convert or redeem is with the issuer, with the company itself. That way also will solve. So this is like a master example for you. You do this example, your entire compound financial instrument accounting is done and dusted. That's all. You need not do anything else. Got it? Chalo. So show the accounting in following cases. Case 1, the option to convert or redeem is with the holder. Case 2, the option to convert or redeem is with the entity. We'll be seeing both. First of all, before we start solving, first we need to verify whether this is a compound financial instrument. Now, how to verify? To verify, by looking at the question itself, we know that obviously there is a debt part. Liability part is there. That is, सीधा हमको, right? We can just understand that. The only doubt is that whether there is an equity part or not. Only then it becomes a CFI. Now, to verify whether there is an equity part or not, you need to test fixed to fixed, right? That fixed to fixed test should happen. Did it happen? Yes. Did it pass? Yes. Which means there is a equity portion? Yes. So equity portion and liability portion both are there, which means this becomes a CFI. Once it is confirmed that it has become a CFI, then we have to do our accounting where we need to split into the liability component and the equity component. Got it? While we are doing that split, we need to have a clarity whether this conversion option is in the hands of the holder or in the hands of the issuer, because the accounting will change. The value, the calculation will change depending upon that. Okay. Now, first, let us solve this example, presuming that the conversion option is with the holder, is in the hands of the holder. Let's see how does that work. Ready? Now, coming on to this accounting part, we already have the steps. What is step 1, Anna? How to split this compound financial instrument? Calculate how much debt alone would be worth without any conversion option. We know that in this question, debt alone would be nearly what? 14% if there is no conversion option, which means what you have to do is that find out the contractual cash flows from this particular question. How much is the contractual cash flows? It is a 25,000 debenture with 10% interest, right? So 25,000 into 10%, obviously it's going to be 2,500 every single year. That is the contractual cash flows. Contractual cash flows means where there will be a real cash flow, okay? And that needs to be discounted at what? 14%, which is a discount rate, or in other words, which is a market rate, market interest rate without the conversion option. So you discount it with that. And in the last year, obviously, you'll be redeeming this 25,000. That is also a financial liability for you. So take that as well. Got the point? Right. Why? Because the conversion or redemption option is with the holder. If it is with the issuer, it's a different thing. If it is with me as a company, I will choose whether I will be redeeming or I'll not be redeeming. In that case, it is in my control. If it is in my control, then probably I'll not be considering this as a liability. Because it is in my control. Now, I'll say that, okay, I'll not redeem. I'll just convert that into equity shares. In that case, there is no liability option for you. There is no obligation. See, liability means not the chance of happening. Liability means there is an obligation for sure, per se. Now, because it is in the control of the holder, what can happen is that definitely if he asks for redemption, then tomorrow you have to pay the money back. This 25,000 has to be repaid. You understand the point? Therefore, you consider this as well as a financial liability in this case, where the redemption option, I mean, the conversion option is in the hands of the holder, right? So take this contractual cash flows, interest, as well as the principal redemption, and you discount it at the market rate, where you compare it with the debenture, where there is no conversion option, which is 14% and not 10%. So once you take a higher interest rate, use your common sense, Nana. You take higher interest rate and then you discount the cash flows. Naturally, what will happen? Your resultant value will be less. Got it? So how much is your resultant value? 22,087. Whereas how much is the consideration that you have received? 25,000. Then that difference will be the equity portion. Got it? That's what we have discussed over here. Calculate the debt alone, right? Without the conversion option, which is 14% in our example, right? And subtract this debt value from the total amount received. Total amount received is 25,000. From that, we have subtracted the debt value, which is 22,087 in this case. We got the equity component. Simple and easy, right? Now that we know how much is the debt component, how much is the equity component, just pass the initial recognition entry. What is the initial recognition entry? Naturally, you got the amount 25,000 into your bank account. So bank account debit 2. Both of them show credit balance because one is liability, the other one is equity. So 2 compound financial instrument within brackets financial liability 22,087 and 2 compound financial instrument within brackets equity component 2,913. Done. Now comes the twist. How will you do accounting for the liability portion? Apply ACM. Because I told you, except for special cases, 90, see, first of all, when it comes to liability accounting, we have already discussed that FVTOCI is out of picture. So you're only left with 2. One is ACM, the other one is FVTPL. Even in that case, 95% of the cases, we're gonna go by default with ACM, except for some special cases where we'll be implementing FVTPL. So as of now, if we haven't discussed those special cases so far, but we know that it's gonna be ACM as of now. Got it? So it's ACM for liability part. For equity part, you just stay put. Stay put in the sense you just be calm. Don't do anything. Okay, we'll discuss that, right? So only for liability part, you apply ACM. Now you guys know what is ACM, amortized cost method. So what do you have to do? Immediately prepare ACM table. How to prepare ACM table, we already know. So how many years? 4 years in this question. You start with the opening balance of financial liability. Do I know that? Yes, fair value has been calculated. How much is that? 22,087. You start with that. You increase the liability when there is an obligation for you to pay the interest. What interest? Imaginary interest according to us. How much is that? 14%. Market interest rate. Got it? To that extent, you increase the liability because that much interest according to you, you have to pay. You are liable to pay. To that extent, your liability will increase. On the other hand, you're really paying how much? That is contractual cash flows, the real payment. The real payment. Real payment is how much? 10%. Once you have paid, naturally your liability will reduce, correct? So you reduce that. You get your closing balance. This again becomes opening balance. 14% increase, 10% decrease, 14% increase, 10% decrease. And finally, what's going to happen? This will match with 25,000. Got it? However, the problem is, I've written a specific sentence over here. See, usually what we'll do, this will match with 25,000 and we'll be repaying 25,000, right? I'm talking about when there is no conversion option. When there is no conversion option, obviously you have to repay for sure. When you have to repay for sure, when we are preparing ACM table, what we'll be doing is that here we'll make this 0 because we are of the opinion that 100% I have to make the redemption. So therefore, I'll come to a conclusion that 100% I have to do the redemption. Therefore, I'll be reducing the 25,000 and eventually here it will become 0. But here that's not the case. Why? Because you should not make it 0 because you don't know whether the other guy, the holder, will choose the redemption option or convertible option because it depends upon the holder's decision, which you don't know right now. Without knowing, how can you come to a conclusion that definitely he'll ask for redemption option? Only if you're sure that he's going to ask for redemption option, then only you'll be coming to a conclusion that here anyway I have to pay 25,000. Therefore, let me make it 0 because I'll be paying 25,000. Then only it becomes 0. Without paying, how the liability will become 0? Simple logic, right? Is that clear? So this is one specific point that you have to remember, especially when the redemption option is in the hands of the, when the conversion option is in the hands of the holder. Got it? Ye to clear hai? Right. So in year 4, let us see how the balance sheet looks like. Your equity portion of your compound financial instrument, which we have already calculated, 2,913, it will stay put like that only because I asked it to stay put. It will stay like that. What about the financial liability part? Now it's going to be 25,000 at the end of year 4. At the beginning, it was 22,087. Then you were adding 14%, reducing 10%, adding 14%, reducing 10%, adding 14%, reducing 10%. Then definitely the net addition will happen, the difference of 4%. So from 28,000, from 22,087, it started increasing. From there, it became 23,000. From 23,000, it became 24,000. From 24,000, it became 25,000. So now it will be showing a 25K because we only increase the value. You got it? That's what we call unwinding of discount. Now we already know this. Okay. Till here clear? So which means we are done with the accounting part till the last year. That is year 4. So to put it simple, what did we do so far? We just took the compound financial instrument. We try to see in the market what is the interest rate for a similar kind of a debenture or a bond where there is no conversion option. And we found out that it is 14%. We took that 14% and discounted all the contractual cash flows at 14, right? And then we got the value of the debt. We reduced it from the total consideration of 25,000 that we have received. We found the equity portion. Equity portion, we said, keep it like that. Debt portion, we have accounted based on ACM. Got it? Now in ACM, you know what you'll do. You'll take the opening value, which is nothing but fair value in this particular case, opening balance. We will add the imaginary interest that we got, which is 14%. We'll reduce the contractual cash flows interest, which is 10%. And then we'll slowly increase the value from 22,000 till it matches with 25,000. At the end of 4th year, the financial liability balance in your books, in your balance sheet is 25K. And your equity, whatever during the initial recognition that we have calculated, same thing will be there. And this is what the situation is right now. Okay, this 25,000 should not be made zero because we don't know whether the holder will choose a conversion option into equity shares or will choose a redemption option. Without knowing that, there is no question of making this zero. That's why this is the situation right now. Now, there are two possibilities. The holder may choose the conversion option or the holder may choose what, Nana? Redemption option. Got it? If he chooses redemption in cash, then let us see how the accounting has to be done. If he chooses conversion option, then let us see how the accounting has to be done. You guys are ready? Right. Possibility number 1. If holder chooses the redemption option. Okay, what's going to happen? Pretty simple. This is a liability. If he chooses redemption option, you have to pay 25,000. That's it, na? You have to pay 25,000 means what you will do? 2 bank 25,000. That's all. And the liability what you have created so far 25,000 will become 0. How to zero the liability? It will be showing credit balance. You debit it, it becomes 0. So you debit compound financial liability, right? Sorry, compound financial instrument, which is a financial liability, obviously. The financial liability part, you debit it, it becomes 0. 2 bank because you have to make payment, gone. Then what about this, sir? The equity portion, which we have created and it is there in my balance sheet since 4 years. Very simple, transfer it to retained earnings, that's all. It will not go back to P&L. Okay, so it will also be showing credit balance, na? CFI equity, compound financial instrument equity. Now you debit it, it becomes 0 and that amount will be transferred to retained earnings. It goes to other equity basically. Got it? So this is just like, the conversion option which we have studied in India is 102. You remember that? ESOPs with cash alternative. Yeah, there we do accounting. Yeah, I know. I'm happy that you guys are remembering. There we do accounting keeping SARs in mind. Okay, that is cash option in mind. And then if he chooses the cash option, we are very happy because we did accounting based on that logic only. Only when he chooses the equity alternative, then there is a problem for us. We need to shift the balance from cash option to the equity option, and then we have to issue the equity shares and the balance will go to securities premium. You remember that? Right? I hope you remember. If you don't remember, means I can't do anything because we have discussed that. Same logic here also. You see this, my entire money is there in the liability option. So therefore, if this guy chooses the redemption option, I'm really happy. Money is ready with me, 25,000. I'll just debit it. I'll pay it through the bank. So CFI FL debit 25,000. This becomes 0. It will be removed from the balance sheet. And to bank because you are making cash payment. There ends the matter. That's all. And what I'll do with the equity portion? Transfer it to retained earnings. It will never go back to P&L. Obviously, there is no question of recycling here. Got it? So easy and simple when the holder, the good guy in this case, if he chooses what? The liability option. But if this guy chooses conversion option, then we have a problem. Same treatment what we have done in India is 102, ESOPs with a cash alternative. Same treatment. Because if he chooses the conversion option, in fact, we have to issue shares. But then where is our money parked? Our money is parked inside the so-called liability. So what I have to do naturally? Transfer from where to where? From the liability part to the equity part. So CFI financial liability debit. Because there is no more liability for me now. See, again, use your common sense, Nana. Why did I create this? Thinking that that guy will ask for redemption. Keeping that in mind only, I've created this. Now, that guy did not ask me any redemption. He said that, no, I'm going to go for conversion option. The moment he chooses conversion option, automatically this liability is exhausted. It's extinguished. It's gone. There is no more liability for me because he said that I don't want your redemption portion. I want conversion option. Therefore, this liability is no more. When liability is no more, what you have to do in your books? Remove it. How to remove it? Debit it. Then he has asked for conversion portion. Na? I have to issue equity shares. That is not there with me. Only 2,913 is there. So shift it to equity. So CFI financial liability debit. This becomes 0 and create a new equity because he has chosen for conversion option. So CFI equity 25,000. Same thing we used to do in ESOPs with cash alternative in Ind AS 102. Got it? Okay, now your equity portion shows how much. Already 2,913 is there plus 25,000. It will be 27,913. From there, issue the equity shares. Obviously, 2 equity share capital to the extent of face value, 2 securities premium, the balancing figure. That's it. Done. Till here, it's clear. Nothing new. If at all you remember Ind AS 102, otherwise everything is new. Okay, right. Chalo, are we done with this? Moving on to next one. Option to convert or redeem with the issuer. With the issuer means us. Okay, simple. First, we need to find fair value of financial liability and equity. That's how we'll split now. As usual, take the contractual cash flow, discount it at the market rate of interest without the conversion option, correct? But here comes the twist. When you are doing this, do not take the redemption number over here, 25,000. Earlier, when the option of redemption, when the option of conversion is in the hands of the holder, we did consider the possibility of redemption. Redemption is a liability for me, right? When the conversion option is in the hands of the holder, I don't know what he will choose. And I told you at the beginning of the financial instrument chapter itself, I told you that there is a single mantra for this entire chapter. What is that? What has got highest probability to happen? That is not important for me. What can happen? That can happen even if it has got 1% probability also. I need to consider that. So here, let's say in the market, people are talking that no, your company equity shares has got very good demand in the market. So we are pretty sure that the holder will definitely go for conversion option. However, even if that is the case, I can't go with the probability. That's not what Ind AS 109 says. Ind AS 109 says that hell with your probability. I don't want what's the probability, sir. 90% probability, 95% probability of conversion option only getting chosen by what? The holder? No, I'm not interested in that. Okay. Is there a possibility, 1% also, of him going for a redemption option? Yes, sir. Can it happen? Yes, sir. Then you recognize the obligation. What if it happens tomorrow? You understand the point? So therefore, recognize the liability. That's why we have recognized the redemption liability as well here, because the option is in the hands of the holder, that is outside the control of the company. Clear? Whereas here, in the second case, the option to convert or redeem is with the hands of the company. Now, in that case, it is in my control. Therefore, if I don't want obligation. So I don't want liability. It's in my hands. So therefore, you can't recognize this obligation because it is in your hands and company has chosen not to go for obligation. Therefore, there is no obligation for you. Obligation means there should be certainty of definitely you have to pay money. Only in that case, you'll recognize something as a liability. Otherwise, you will not do that. Okay, therefore, this 25,000 should not be taken into consideration while calculating the fair value of liability during the initial recognition of compound financial instrument. You discount it at 14% only because that's the market interest rate without the conversion option. You get your cash flows and the fair value of financial liability is much lesser when the conversion option is in the hands of the issuer. Got it? So how much is that in this case? 7285. Whereas when the conversion option is in the hands of the holder, you see the fair value of the liability 22,087. Got it? Whereas here it is just 7,285. The consideration that you received is 25,000. Obviously, the balancing figure is equity. Here, the equity value is much higher. Got it? Hello. So, what will be your initial recognition? You received money. How much money you have received? 25,000. Debit the bank 25,000 to CFI financial liability, which is 7285. CFI equity, which is 17,715. Obviously, for financial liability, we'll apply ACM. And when it comes to equity, again stay put. What are we going to do that? You will understand. So for as long as this so-called liability portion is considered, we need to apply ACM. You know what is ACM? Take the opening balance, that is nothing but fair value, discounted at the market interest rate. You take that, increase it with our imaginary interest rate. That's what we call it as unwinding of discount, because you discounted that with 14%. Now again you add back 14%. That's what we call unwinding of discount, reversing what you have done, isn't it? So add 14%, reduce the contractual cash flows where you're really paying 10%. Once you pay, your liability obviously reduces, so therefore reduce it. Add 14%, reduce 10%. Slowly, what is happening? Your closing balance of the financial liability is 5,805. And then here, if you see, over a period of time, your closing balance is reducing. Unlike most of the cases where normally when it comes to liability, especially when we are doing unwinding of discount, it will increase. You understand the point? It will increase because of the redemption basically. Now, because this redemption has not been considered, because the option to convert into equity shares or redemption is within the hands of the company, therefore here the treatment of liability is totally different. Here what is happening? You're adding 14%, you're reducing 10%, but the funny part here is ultimately your closing balance of financial liability will be reduced. Why? Because you're adding 14% only on 7,000, whereas you're paying 10% interest on 25,000. You see the difference? Don't get deceived by the fact that I'm adding 14%, I'm adding 10%. How can this value get reduced? It can get reduced because you're adding 14% on this low value and you're reducing 10% on higher value of 25,000. Are you able to get it? So slowly this value will reduce and eventually it will become zero by the end of fourth year. Why it will become zero? Because there is no 25,000 redemption option over here. Got it? Right. Now, coming onto the balance sheet of Geo Limited at year 4, only your equity will show up and your financial liability will be nil. Got it? Now, so let's look at both the possibilities. Even in this case also, even see from the terms of from the point of view of the issuer, the company also, there are two possibilities. You can issue equity shares or you can redeem. If you issue equity shares, why did I go with this possibility? Because the probability of this happening is much higher. Therefore, I started with this because I'm the company. I don't want any obligation. Got it? So already I have 17,715, which has been created, the equity. So you debit that because now you're going to issue equity shares. So 2 equity shares with respect to the face value, and the balance will go to securities premium. Easy peasy, because that's how you have done your accounting. So what you have to understand is that when you do compound financial instrument accounting, with respect to conversion option is in the hands of the issuer, is in the hands of the holder, then the accounting will be dominated by liability portion. When you do accounting with respect to the so-called convertible debentures, where the conversion is in the hands of the issuer, the accounting will be dominated by the equity part. Clear? This is the ultimate conclusion. Okay. Now, so this is quite a bit easy. Why? Because your entire accounting is done based on the perception that you are never going to redeem. You are going to what? Issue the equity shares, which means you will choose the conversion option. That's the reason here also we did the same thing. That's the reason we did not take the 25,000. Okay. However, suppose there is some sort of a problem for entity. There is a restriction from a government organization or something like that, or there is some other problem where they are in a situation where they can't issue equity shares. In that rare cases only, company will go for redemption obligation. Now, if the company goes for redemption obligation, you know that it has to pay 25,000. So to bank 25,000, there is no doubt in that, because that's what you promised to redeem. Whereas how much I've got only 17,715 saved, kept aside. Then where the balance money will come from? Bring it from retained earnings. Do not touch the P&L, because you did not do accounting from that perspective. Do not touch the P&L. You bring it from retained earnings. Treat it like a buyback. Treat it like a buyback. You got the point? You are buying back the shares. If you are issuing equity shares, that's a different thing. You're increasing your equity share capital. Here, indirectly, you're trying to reduce the equity shares capital. That's why you have chosen an option to go for cash payment. So treat it like a buyback. So when you're doing buyback, you know that you will get money from retained earnings. So that's what we are doing here. The balance money, whatever that is there, bring it from retained earnings and then make the payment. Got it? Till here it's clear. Now, so now that you know what is accounting treatment, so the summary is if the conversion option is in the hands of the holder, then your entire accounting will be dominated by the liability portion. And if the conversion option is in the hands of the issuer, your entire accounting will be dominated by the equity portion. Okay, so that's the summary. Keep this in mind. Automatically, the probability of you getting confused will be a lot less. Now, the next question is, what about the transaction cost? Because we know how to deal with transaction cost with respect to financial asset and financial liability, right? It depends upon the method basically, whether it is ACM method or FVTPL or FVTOCI. So when it comes to financial asset, if it is ACM method or FVTOCI, we try to adjust it with the initial recognition. Whatever the initial value is there, we'll adjust the transaction cost. In case of FVTPL, we try to take it to P&L account. Whereas when it comes to financial liability, so far we have gone through only ACM. So we know that when it comes to ACM, anyway, it has to be adjusted, right? The transaction cost will be adjusted. With respect to compound finance instrument, how things has to be, because it is, we can't say it is a financial liability, right? Neither it's a financial asset, obviously. It is a combination of liability and equity. So here, what's the situation? Let's try to understand, okay? Let's say we have a compound finance instrument, which is like 5 years, okay? And usually what we'll do, we'll take the market interest rate and we'll discount it, and then we'll try to find out the fair value of the financial liability, correct? Which is 80,000. Let's imagine that 80,000 is the number. And how to find out fair value of the equity? You'll take the total consideration received. From that, you'll reduce the fair value of the liability part. You'll get the fair value of the equity part, which is kind of a balancing figure, okay? Now, let's say your transaction cost is 5,000. Imagine this 5,000 transaction cost, you will be apportioning in the ratio of 80,000 is to 20,000. Now, where did you get this 80,000 and 20,000? 80,000 is the fair value of the liability part. 20,000 is the fair value of the equity part. So, the transaction cost will be split in the ratio of fair value of the liability and fair value of the equity. Got it? So, here obviously it is in the ratio of like, I think 4:1. In that case, 4:1, this 5,000 will be, apportioned. So 4,000 goes to financial liability, 1,000 goes to equity. So split it in the ratio of fair value of financial liability and equity. So this 4,000 will be adjusted against initial recognition of financial liability, and 1,000 will be adjusted into CFI, that is equity. Simple. Now you put the adjustment entry. So what you'll be doing? 4,000 will be adjusted against the financial liability, and 1,000 will be adjusted against the equity to bank 5,000. Got it? Now the entry logic is very simple. You just paid 5,000. Why did you pay 5,000 transaction cost? Because 4,000 belongs to financial liability, 1,000 belongs to equity. To that extent, obviously, because you have paid the money, you feel that the liability value has got increased. Therefore, you are debiting the liability portion as well as the equity portion. That's the whole logic behind this adjustment entry. But because of this adjustment entry, we have a side effect. It is like there is a problem. You take a drug, and that drug creates a new problem. I don't know whether you are able to get this logic or not. If you don't understand what did I say right now, you will not understand what is happening over here. And eventually, there is only one alternative for you, is to buy hard things. Okay. Again, I'll repeat, try to get this logic synced in. Okay. The logic is, you have a problem, a health problem. Okay. You take a drug. That drug treats the health problem. Whatever the problem that you have got, it is solved. But then it gives a side effect. So now you got a new problem. Now again, you have to find out a way to solve this. Are you getting me? Similarly, that health problem is the treatment of this transaction cost, primary health problem. You have got this entry to solve it, just like a drug that we have taken. And this solving the drug we have taken creates another problem, a side effect, and that side effect is this. What is that side effect, sir? Listen. But after the entry, the CFI financial liability portion balance right now is 76,000. Why? Because initial balance is 80,000. Na? You'll pass an initial entry, obviously. Bank account debit to CFI financial liability 80, CFI equity 20. That's what you would have done. Now you have debited both. CFI financial liability has been debited to the extent of 4,000. So from 80,000, the net effect will come down to 76,000 now. Because earlier you have created for 80,000, that is the initial recognition entry. And now you have debited to the extent of 4,000. So your liability has been reduced to 76,000 and not 80,000. But the problem is your 76,000 is wrong. That's why initially you have recognized it at 80,000. Na? Because 76,000 does not represent the present value of future cash flows discounted at 10%. Presuming that 10% is the market interest rate of a non-convertible, debt or debenture. You understand the point? So actually it should reflect at 80,000, not 76,000. But why did it become 76,000? Because of the adjustment entry regarding the transaction cost. So which means now you are in a situation where you have to revise your effective interest rate. Got it? So that you have to do. Anyways, you will understand that once we start solving sums. Right now, just keep it in mind that whenever there is a transaction cost, we will be recognizing it through this entry. How? We'll find the fair value of financial liability and the equity part, which we'll be doing for initial recognition purpose. Immediately take the transaction cost, split it in the ratio of fair value and pass this entry. After this entry, it will create a new problem where your liability will not be reflected at its correct value. So then to reflect it at the correct value, you have to revise your EIR, effective interest rate, such that it actually reflects the present value of the future cash flows. You got the point? That's what we have to do. Anyways, right now you don't understand this. I also know that, but just wait. At a later point of time, you'll understand. So just wait for that. Got it? All right, guys. Now let's continue with compound financial instruments buyback. Now, some of the students are asking me with respect to example, with respect to the transaction cost, how to deal with that. That is this part which we have discussed. Honestly speaking, majority of the sums that I've seen so far with respect to compound financial instruments, the accounting part especially, they don't have transaction cost. Okay, therefore I did not give you an immediate example right now, but we will solve problems. I'll try to figure out, and then I'll try to see, give you an example where how to deal it, so that how to revise that effective interest rate, that we'll see. Right now, just remember the concept in your mind. We'll solve a sum, so don't worry about that. Okay, chalo, let's move on to the another important part. Still CFI is not yet done. We are still in CFI only. Now we need to discuss about buyback. Okay, you guys are ready? Now this is a little bit complicated, so I want you guys to focus. Of course, once we do the example, you'll have 100% clarity, but this is a little bit complicated, Nana. After that, we'll go for derecognition, and then we'll go for debt restructuring as well. Now let's start focusing on this CFI buyback. If you guys are ready, we'll start. All right, guys. Now let's start with the buyback concept. Now, first of all, don't look at this. This is like a summary. Okay, you'll not understand this. So let's discuss the whole concept. After that, you guys will understand the summary of buyback. Okay, right. So let's get to the rest of the concept, and then we'll come back. You'll understand what is this. So this is just like a 2-line summary of the entire buyback. That's all. Okay, right. Let's have a look into this. When a CFI is bought back, okay, what do you mean by buying back? It is redeemed before maturity, right? So you buy back that in the middle itself. So you don't wait for the entire redemption to happen. Then basically once you buy back, two parts are affected. Obviously, because it's a CFI, so it has got two parts. One is the liability part and the other one is equity part. So when liability part is getting affected, once you buy back, eventually what will happen to the liability part? It will get extinguished. Extinguished means it's gone. Boom, it's gone. Okay. And the equity part will be treated as a transaction with the owners. Get it? Right. Because equity means obviously you're dealing with the owner, then only it is called equity. Right? That's the point. Now, so let's see how this works out. Right now, this is just a basic idea. CFI buyback. Let me write here. Basic idea. Or let me write this way. Basic bird's eye view. So what do you mean by bird's eye view? Before we try to go a lot deeper with the help of an example, this is just an overall idea of what's going to happen. So let's say when it comes to CFI, what will happen? Initially, we'll do recognition. So when we do recognition, what is the entry we pass? Bank account debit to the extent of money that we receive, to CFI financial liability to the extent of fair value of liability, to CFI equity to the extent of balancing figure, which is nothing but the fair value of the equity. To that extent, it will be showing in the balance sheet. Okay. Now, all of a sudden, you're doing buyback. Once you do buyback, what you basically do is that you pay the money to the so-called CFI instrument holders, and then you buy back your CFI instrument. Let's say this is what the balance sheet balance it is showing at that particular point of time when you're about to buy back. Okay. And you paid 1,200, which means logically speaking, it is worth 1,000 over here. You paid 1,200, which means you paid 200 more. So basically what happens is your CFI financial liability will get extinguished to the extent of 600. So 600 credit, 600 debit balance, it will become 0. Same goes with equity as well. That will also become 0. But this excess payment of 200, what will happen is that it will be split between the liability portion and the equity portion. How that will happen, we'll see it in the example. But whatever the portion that goes to the liability, that will be adjusted against P&L account. Whatever the portion that goes to equity, that will be adjusted against retained earnings. This is the only thing that you have to remember concept wise. So what you have to understand is, okay, fine. Basically, I do buyback of a CFI. Buyback means basically I'm canceling the instrument. When I cancel, liability portion gets cancelled, equity portion gets cancelled. Liability portion gets cancelled, it will become 0. Equity portion also gets cancelled, that's also done with. When I'm cancelling, if I'm paying anything more, so there is a chance of, in this example, I paid more. There is always a chance of loss as well. There is no rule that always it has to be a gain. So whether it is loss or gain, whatever it is, the difference, when it comes to liability, it will go to P&L. When it comes to equity, it will go to retained earnings. That's all you have to remember. Once we start solving numbers, it can be a gain, it can be a loss. There is no rule that always it has to be a gain. It can be a loss as well. In fact, most of the times it will be loss as well. So that loss or gain with respect to liability part will go to P&L. With respect to equity part will go to retained earnings. This is what you need to remember. Okay. Why do we need to split like this? Because liability affects your P&L and equity does not affect your P&L. So that's a fundamental accounting rule. Therefore, we have to do the split, obviously. Now, before we go for how do we do the accounting when it comes to buyback of CFI, that anyway we're gonna do over here in this example. First, let's try to understand why anybody does a buyback, because otherwise you are just by-hearting the concept. This is the problem with right now many of the students, because your entire target is to just pass the exam. That's important, but at the same time you need to understand why are we doing a buyback. Why would any company do a buyback? I gave a CFI instrument. Say for example, I gave an instrument called convertible debentures for a period of 5 years. Initially I've planned like that only, na? I wanted it to be for 5 years. I wanted that money for 5 years. After 5 years only, if the conversion option is within the hands of the issuer, then maybe most probably I'll try to redeem or I'll try to issue equity shares. That was the planning initially. So you plan in detail, then only you go for an issue. Every company does that. That's what we call financial planning, right? But why would suddenly any company in the middle of it, in the middle of the period, let's say the convertible debentures period is for 5 years, in the middle of it or at the end of third year or whatever it is, why would suddenly you change your mindset? You wanted to buy back. There is a reason for that. I'll give you a real life example also. It will be very interesting. So see here. There are 4 different reasons, Nana, why would any company go for buyback. The first reason is they want to lower their debt. Now you please try to understand, whenever you have a convertible debentures, basically it is debt dominated, especially when the option of conversion is in the hands of the holder. So in that case, you want to lower your debt. So you go for buyback. You have money, you go for buyback. There are falling interest rates or market fears that interest rate is gonna fall. You understand the point? In that case, naturally, you can buy back cheaply. So therefore, you go for buyback. If you don't buy back, naturally, what will happen? On the other hand, your market interest rate are falling. You are paying more interest over here. So therefore, you don't want to pay more interest for the remaining years as well, because the interest rate are falling down. So right now, you'll try to buy it back. You understand that, right? 2 reasons. You don't want to pay higher interest for the remaining years. Second, you will buy back at a cheaper rate. I gave you an example as well. 100 worth, you'll buy back at 90 itself. That's a smart financial decision, right? Market signaling to boost investor confidence. You see, I'm buying back. It means that I'm having very good cash. I'm cash rich. So therefore, investor confidence in the market will get boosted and your equity share prices will rise up. Getting it? Prevent dilution of ownership, especially in kind of situations where you know that you want to convert that into equity shares. You don't want that to happen, especially in Tesla case. That's what has happened. You want to prevent the dilution of ownership, in the sense you don't want to issue more equity shares. Issuing more equity shares will dilute your ownership. It gets spread over. The base will increase. You understand that? To prevent that also, you will go for a buyback. So this again depends upon a situation whether this conversion option of the compound financial instrument is in the hands of the issuer or is in the hands of the holder. It depends upon that as well, whether your intention is to lower the debt or your intention is to prevent the dilution of ownership. Anyways, but these are all the reasons why any company would buy back. Okay, beyond this, further discussion is not necessary from your examination point of view. So let's go with real life example. In 2019, Tesla offered to repurchase a set of convertible bonds. It's a compound financial instrument, convertible bonds only. So Tesla offered to repurchase. What is the reason? Conversion date is approaching. So before that, they wanted to buy back. They want to avoid dilution because they know that mostly they have to issue Tesla shares. Tesla has raised enough cash via other means, so prefer to retire the debt early. Take the advantage out of it. Got the point? This much is enough. Don't try to dig deeper, Because anyway, your ICA will not ask questions with respect to why would any company buy back, give me reasons. Like that question will never be asked. This is for your own understanding so that you tend to not by heart, just like that, okay, buyback is happening, it's happening, that's all. And moreover, in interviews, these things will come really handy. And who knows, your ICA also might ask all of a sudden. If it wants a particular paper in a particular examination, he wants it to be difficult, he wants to reduce the pass percentage, he might ask. Okay, anyways, it's our logic to know the logic. I mean, get it? It's our logic. It's our duty to know the logic. Okay, anyways, that should be fine. Are we done with this? Now let's move on. So how to do this buyback accounting of compound financial instrument? Now this is a tad bit tough, Nana. So I want you guys to focus 100% over here. Okay. If you guys are ready, we will start. On 1/1/2000, entity has issued 7% convertible debentures with a face value of 1000. Okay. Maturity on 31st December 2008. So which means literally 8 years. Right? Next. The debenture or convertible into ordinary equity shares. All right. Of the entity at a conversion price of 50 per share. Okay. Next, interest is payable yearly in cash. At the date of the issue, the entity could have issued a non-convertible debenture at a rate of 10%. Obviously, it should be high. With this only, we'll discount to find out the fair value of the financial liability. Next, liability portion in that compound financial instrument. On 1/1/2005, which means exactly 2001, 2, 3, 4. This is beginning of 5. So which means 5 years are done with. The convertible debentures has a fair value of 1450. Okay. The entity made an offer to the holder of the debenture to purchase the debenture for 1450. At fair value only he is trying to purchase, to which the holder accepts as well. On the date of repurchase of the company, that is buyback, the company could have issued a non-convertible debentures with 4 years life. The balance is 4 years. Okay, total is 9 years. 2000 also we need to count. 8 plus 1, 9. The balance 4 years at a coupon rate of 6%. On that date. Okay, why is this information necessary? You'll understand once we do the accounting part. Show the accounting for initial recognition and also on the date of early redemption. Fine. The most important part in this question is the option to convert into equity shares or the redemption is in whose hands? That information is not there in the question. The question is silent. In that case, let's go for an assumption and then we do the accounting. The assumption is that holder has the option to redeem at par or convert that into equity shares, which means the option to convert into equity shares or redeem is in the hands of the holder. It is not in the hands of the company, which means here we need to do this accounting based on what? Based on this first part. Option to convert or redeem is with the, sorry, not the issuer. Where is this? Is with the holder. If it is with the holder, then definitely your accounting will be dominated by liability. Your accounting will be dominated by liability. Your equity portion will be small. If it is with the issuer, then the accounting will be dominated by the equity portion. This already we have seen, right? Anyways. So now our assumption is that the option to convert is in the hands of the holder. So naturally the accounting will be dominated by the liability part. Keeping that in mind, let's start solving this. You guys are ready? Now, so first what we have to do is that we obviously on 1/1/2000 the entity has issued the so-called 7% convertible debentures. So naturally what you have to do? Initial recognition. To do initial recognition, what you have to do, because this is a CFI. So obviously I need to find fair value of liability part as well as fair value of equity part. First of all, if you find fair value of the liability part, automatically fair value of the equity part will be the balancing figure. Now, the next question is how to find out fair value of the liability part. Pretty simple. Find out the market rate of interest of non-convertible debt, 10%. Find out the contractual cash flows, which will be 7% into 1000, which will be 70. And the redemption will be face value, right? No, issued with face value. What about the redemption? Okay, that also will be at face value. So which means it will be 1000. So therefore 70 for how many years? 9 years, including 2000. Okay, earlier I said 8 years. It is actually 9 years. So 70, you need present value annuity factor for 9 years at 10%, because we need to discount it at market rate of interest to find out the fair value. Okay, and plus this 1000 you will be redeeming at the end of 9th year. So 1000 into, I need to find the discount rate of 9th year. So 1 divided by 1.10. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. You multiply that, you get your fair value of financial liability part of the compound financial instrument, which is 827. How much is the consideration you have received? 1000. You reduce that 827, you get your fair value of equity, which is 173. What will be your entry? Total you have received 1000. So bank account debit 1000 to CFI liability part. How much is that? 827. And the balancing figure will be your equity part, which is 173. Naturally. So this one is pretty damn easy, which we already know. Nothing much to discuss over here. So we need to focus on which part? The so-called buyback part. So which happened after 2001, 2, 3, 4, after 5 years, right? That's where we need to focus upon. Okay, chalo. So first what we have to do is that on this so-called 1st January 2005, exactly after 5 years, once you have issued your CFI instrument, we need to identify the carrying amount of equity portion as well as the financial liability on the date of buyback. You can call it as buyback or you can also call it as early redemption. Either way, it's the same. Okay. On that date of buyback, we need to find out what will be the carrying amount. See? Right. First point that you have to understand, very important, carrying amount of the equity part will remain unchanged. That's why if you remember earlier when I was teaching the concept, what did I say? I will write the entry and I'll say liability portion will be accounted using ACM method. And with respect to equity portion, what was the word I've told you? Stay put. It will stay put in the sense it will stay like that. There will be no changes whatsoever. Got it? So after 5 years also, liability will change. Right? Because you'll be applying ACM method and you'll be doing unwinding of discount. So therefore, liability value will change. In fact, it will increase. It will increase provided if the conversion option is in the hands of the holder. If the conversion option is in the hands of the holder, then you will be doing your accounting of your CFI instrument, which will be dominated by the liability part. If the conversion option is in the hands of the issuer, then I'll be doing my accounting of the CFI instrument, which will be dominated by the equity part. This we have already discussed. Right now, already we have assumed that the conversion option is in the hands of the holder. So obviously, we'll be doing the accounting where the liability part will be dominating, correct? Chalo. So therefore, this 827 will keep on increasing. Got it? Whereas this 173, I told you it will stay put, which means the carrying amount after 5 years of the equity portion will be exactly the same. Okay, then what about the liability part? That will not be the same, obviously. It was 827 5 years back. Definitely it will change. How much it will change? We need to prepare ACM table. That's why we are preparing ACM table. For how many years? Sir, total CFI instrument is for 9 years, sir. Do I need to prepare ACM table for 9 years? Nope. Because I'm doing buyback in 5th year itself, right? I mean 5th year ending, to be honest, because 2000 full year. 1, 2, 3, 4. 4 itself is the 5th year. We are doing it at the beginning of 2005, which means it is 6th year beginning. So 5 years are already done. So 5 years are already done in the sense for 5 years we need to prepare ACM table. That's enough. Why would I need it for 6th year, 7th year, 8th year, 9th year? Because anyway I'm doing buyback in the middle. You get it? All right. Anyways, now just a second, guys. Okay. Chalo. Right. Now let's find out the carrying amount of the liability part. Equity part anyway we know. Okay. Chalo. First year, second year, third year, fourth year, fifth year. We know how the ACM table works, obviously, because this here we need to do in such a way that where the conversion option is in the hands of the holder, right? So we'll start with the opening balance. That is the fair value during initial recognition 827. We will add the interest. It is a liability. So obviously interest expense you need to add because expenditure will increase the liability. So which is how much? 10%. And you will reduce the contractual cash flows that you pay, which is nothing but 7%. So you add 10%, reduce 7%. Naturally, 827 will become 839.7. Again, for 839.7 in the second year, you add 10%, reduce 7%, add 10%, reduce 7%, add 10%, reduce 7%, add 10%, reduce 7%. You will be getting 904.53. This is the carrying amount that I need, which is nothing but closing balance at the end of 5th year. Carrying amount is nothing but closing balance of the liability part by applying ACM table at the end of 5th year. Or there is another way of doing this as well. In financial assets, when I was talking about the accounting of financial assets, there I taught you this concept. What is that? The carrying amount of the 5th year, whether it is financial liability or financial asset, if you are applying ACM table, should be equals to present value of the future cash flows. In staff loans, we did this part. Okay, when there was modification of the staff loans, whether that guy does prepayment, sometimes the employee, you get it, one installment he does the prepayment. In those kind of situations, we did this. The carrying amount will calculate usually, and then we'll check it with another carrying amount, which is nothing but present value of the future cash flows. From that prepayment date or the modification date, we'll see in future how many cash flows are going to be there, and then we'll discount it and we'll find out the carrying amount. We'll compare both the carrying amount, accordingly we'll adjust, and then we'll solve the sum. I don't know whether you remember this or not. Here also we are going to do the same thing. So there are two ways for you to calculate the carrying amount at the end of year 5. Traditional way is prepare the ACM table, but there is a catch over here. Here it is okay. It's a 9-year kind of an instrument, therefore 5 years only. After 5 years, the so-called buyback is happening, or we can also call it as early redemption is happening. So you can just prepare the ACM table for 5 years, chalta hai, it works out. But what if this is 15 years and the buyback is happening in the 12th year? Will you prepare ACM table for 12 years? Suppose what if the instrument is for 20 years and buyback is happening after 15th year? Will you prepare ACM table for 15 years? That doesn't work. So therefore, you have to use the alternative strategy in that kind of a scenario, where if you want to find out carrying amount on 15th year, if the instrument is for 20 years, instead of going from 1 to 15, to find out the carrying amount on 15th year or the closing balance of the liability on 15th year, what you can do is that after 15 years, see 5 years cash flows. Okay, discount it, find out the present value of the contractual cash flows, obviously at the market rate of interest, that's obvious. Okay, or original EIR. Here that is nothing but market rate of interest in this particular question, which is 10%, or original effective interest rate. Got it? Right. And that will be your closing balance. So 5 years is done. You have 6th year, 7th year, 8th year, 9th year. So which means how many years of interest you have got? 4 years. So every year 70 will be the interest. Discount rate will be 10%, 4 years. So 1 divided by 1.10, 1, 2, 3, 4 GT. Because 70, you're going to get it for 4 years. I mean, you're going to pay it for 4 years. Every year, you'll pay 70, 70, 70, 70. Therefore, every year discount rate, you total it up. We call it as cumulative discount rate or present value annuity factor, which is nothing but discount rate of the 6th year plus 7th year plus 8th year plus 9th year total. Clear? But we are counting it from year 0. Therefore, it is 6th year, 7th year, 8th year, 9th year. Right now, when you are doing this buyback, where are you right now? You moved to 5th year. 5th year ending you are in. So therefore, from 5th year end, 6th year will be 1 year, 7th year will be 2 years, 8th year will be 3 years, 9th year will be 4 years. So therefore, I have to take discount rate of 4 years only from here, because right now I am not present at year 0. I am on 1/1/2005. This is the timeline, this is the day I am in right now, not on 1/1/2000. You get it? Yes, Nana, exactly. Are you able to get me? Right. So discount it, interest and the principal redemption, obviously 10th year. 10th year in the sense logically we are at the 9th year in the sense logically we are at the 6th year beginning. Therefore 6th year, 7th year, 8th year, 9th year, 4 years only. So 4th year. Okay, you get exactly the same. See, approximately both of them are equal, 905, 905. But remember, in this sum, the so-called discount rate is nothing but market interest rate. In few sums, it will be effective interest rate. That too, what effective interest rate? Original effective interest rate. What do you mean by original effective interest rate? The rate that we use at the beginning. The rate that we use at the beginning. You'll understand what is the importance of the word original EIR. See, if we are specifically saying something as original EIR, that then you need to understand using common sense that at some point of time there will be one more EIR. As a result, there will be confusion between two EIRs, and therefore to differentiate one from the other, we use the name original. Clear? What is that? When that's gonna come, that we'll see later. Okay, still we have derecognition of financial liability. After that we have a lot of other stuff, especially there is an important topic called debt restructuring. Okay, there we'll see all this multiple EIR stuff. Anyways, now that you know the closing balance or the carrying amount of financial liability, carrying amount of equity, nothing, it remains the same because it stays put, right? The only problem is with respect to find out the carrying amount of the financial liability, which we did in 2 ways. So depending upon the sum, you can either go in the traditional way by going with the ACM table, or you can go with this way. Why did I tell you both these ways? Is because some of your ICA answers, he has followed this one in some sums, In few problems, he followed this method. You should not get confused over there. Why did he solve it in a different way? That's the reason I gave you both the alternatives. So you should be comfortable with. Anyways, now, what is the next thing we have to do? Whatever the buyback price that we have got, which is 1450, correct? That needs to be split, isn't it? All right. Yes, because I already taught you the concept here. The so-called buyback price, it has to be split into what? Financial liability and equity portion. Accordingly, you'll have a gain or loss. Eventually, whatever the gain or loss related to financial liability will go to P&L, and whatever the gain or loss related to equity will go to retained earnings. Concept we know already. Let's apply. So, how do you split it? Pretty simple. Find out the fair value of financial liability on today. Today means where are we right now? 1/1/2005. That's where we are. So today means 1/1/2005. Sir, already I know fair value, sir. You know on what date? You know on what date? 1/1/2000 fair value, you know. That is 827. Do you know the fair value of the debt portion or the liability portion as on 1/1/2005? No, I don't know. This 827 is the fair value on 1/1/2000. Sir, I know this, na sir, 905. That is carrying amount. It is not fair value. Get the point? Sir, I discounted this using original EIR, sir, on 1/1/2005, which means this should be fair value. No, 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 no. That's why this is called original EIR. Now, the interest rate has got changed. The market interest rate of non-convertible debt, when you were calculating the fair value on 1/1/2000, it is 10%. Today, on the date of repurchase of the company, which is 1/1/2005, you could have issued non-convertible debentures without the conversion option at 6% itself. So today the EIR has got changed, which is 6%. Now you have understood why we have used the word original EIR. Because if I don't use the word, then what you will do is that you'll be using the current EIR, which is 6%, and then you will discount it. Your answer will be wrong. Your carrying amount will not tally with this. This carrying amount and this carrying amount will not tally. You get it? Therefore, I've used the word original EIR, which is 10% in this case. So now, as of today, I need to find fair value. When I have to find fair value on 1/1/2005, as of today, if I issue non-convertible debentures, what is the interest rate in the market? The interest rate is 6% and not 10%. Lot had changed in last 5 years. As usual, take 6%. How do we find fair value? Future cash flows will be discounted at the market interest rate or EIR. In this case, it is market interest rate. So take the future cash flows 70. Discount it at 6% for 4 years because it is 6, 7, 8, 9, 4 years. Same goes with redemption 1000 as well. You get your fair value of the liability as 1035. What is the total consideration you have received for the buyback? I mean, you have actually paid in this case to the holders. Obviously, how much you have paid? 1450. What's the value of the liability? 1035. Obviously, the balancing figure will be the value of the equity. What value? Fair value. As on. So don't get confused with the word fair value. Fair value on what date? Fair value on 1/1/2005. Date is important. Got it? Fantastic. Now compare the fair value of the liability part, which is this one, fair value of the equity part, which is this one, with the carrying amounts. Do I know the carrying amounts? Yes. Carrying amount of equity is how much? 173. Carrying amount the debt is how much? 904. So carrying amount of the equity is 905 and carrying amount of carrying amount of equity is 173. Carrying amount of the liability is 905. So for this much of worth liability, you paid this much, 1035. Get it? Because you bought CFI back naturally. For this much of carrying amount worth equity, you paid this much. So naturally, in both the cases, you are not having any sort of a profit because you paid more, obviously, because you buy, right? Therefore, 130 went to P&L and 242 went to retained earnings, naturally. So because this is a loss, P&L will be debited naturally. And retained earnings also will be debited because it's a loss. Because this much worth, you have paid this much, na. Therefore, it's a loss. Let me correct one point. While I was teaching you this particular concept here, did I tell you that this is profit in this case? No, this is not profit because we are actually buying it back. So therefore, this is loss. I don't remember exactly, but I think I told you that this is profit. If that's the case, sorry for that. So this is what? Loss. Okay, because 1000 rupees worth, you are paying 1200 and you are buying it back. So therefore, it is loss. Anyways, if I told you their profit, it stands corrected right now. Anyways, let's come to this particular point. So 905 worth, you paid 1035, so it's a loss. And because it's a liability portion loss, it has to be transferred to P&L, which I've already taught you. Same case with equity, 173 worth you have purchased at 415. So it's a loss again, and that will be transferred to retained earnings, which is a concept which we have already learned. Now, how do you close this? Because you have actually bought back, so therefore no longer the instrument exists, which means the liability has to be debited, then it will be cancelled out. Equity also has to be debited, it will be cancelled out. So therefore you'll debit it at what amount? Carrying amount. The liability will be debited at 905, right? And how much you have paid for this? 1035. Therefore to bank 1035, and because that's what you have paid, you paid to purchase it, and you will be debiting 905. Obviously it's a loss, so you'll be debiting P&L account. Okay. Similarly, coming on to CFI equity portion, you will be debiting 173, and for this how much you have paid? 415. So to bank 415, you'll debiting 173. So equity is also cancelled out, but of course there's a loss where you'll be debiting retained earnings. That's it. Easy peasy. Got it, guys? Are we done with this? Chalo, fantastic. That's it. So with this, we are done with compound financial instruments completely. Okay, we're done with the accounting part. We are also done with the buyback part as well. Are we done with this? Chalo, fantastic. With the example also. We have covered the example and everything is done. That one small thing stands corrected. I don't exactly remember what I've told you, but here you need to understand that we are buying it back. So obviously it's gonna be loss. Anyways, are we done with this? Chalo. Alright guys, welcome to another session. So in this session, we're gonna go with derecognition of financial liability and lots of other concepts to cover. Especially we need to cover the most important one, that is debt restructuring, or we can also call it as loan modification. Okay, derecognition of financial liability, a little bit we'll discuss right now, and then straight away we'll move on to the most important topic, that is debt restructuring. And this is challenging topic as well. Okay, so I want you guys to have 100% concentration over here. So if you guys are ready, we're gonna start. Give me confirmation. Ready? All right then. So what do you mean by derecognition? See, so many times we have already studied this because we have also covered the concept of derecognition of financial asset as well, right? So obviously one thing is quite clear for us. Derecognition means we have to eventually remove that so-called asset or a liability from the balance sheet. That's what the concept literally means. Okay. So derecognition of financial liability means removing a previously recognized financial liability from what on a balance sheet. That's obvious. Okay. We are even aware of it, that particular concept. That's okay. Now, Ind AS 109 says an entity should derecognize a financial liability when it is extinguished. Remember this word. This very important word. When we are writing answers, we have to repeat this word. These are all keywords. So whenever I say keywords, you guys mark this and keep that in mind and eventually write the answer. You'll be getting very good marks. Okay. Because I know how the correction happens, how the evaluation of your papers happens. So all they look at is the keywords and the correct number. So your answer has to tally, the number has to tally, and then the keywords has to tally. Once you do this, rest of the things you can just write in your own sentences, your construction, that, this, and all those things. You are flexible, to do anything that you want. But where you are not allowed to do anything that you want is keywords and the answers. That is the numbers, because this is obviously a kind of semi-theoretical paper where half the paper is all about solving sums and stuff like that. Therefore, the numbers also has to tally over there. I hope you guys have got it. Anyways, so Ind AS 109 says you can derecognize a financial liability, which means eventually you can remove it from the balance sheet if and only if that liability is extinguished. Now, the next question obviously comes naturally. What do you mean by extinguished? What do you mean by a liability getting extinguished? I gave you explanation immediately. When an obligation, liability is an obligation obviously, when an obligation is discharged or cancelled or expires, got it? Then the liability is said to be extinguished. Then you can derecognize the liability, which means eventually you can remove it from the balance sheet, which means it goes this way. Liability is basically an obligation. Okay, you check whether that obligation is discharged, which means you paid it off, or cancelled. Something has happened, you got into an understanding and eventually it got cancelled. You understand it? Or you cancel the existing liability and then you went for another liability. So we don't know. Ultimately, the existing liability cancelled. Okay, expires. The time limit is gone. The time limit is gone. The contractual, there is a clause in the contract, and eventually the entire liability got expired. After that, there is no contractual obligation on your part because the contract itself is expired. You understand the point? I'll give you examples for all that. But right now, just try to understand the basic idea what I'm trying to tell you. Okay. So if any of these three happens, discharged or cancelled or expired, then your so-called obligation is said to be done with, which means your liability is extinguished, which means you can de-recognize your financial liability, which means you can remove it from your balance sheet. Clear? Okay, sir. Now let's try to focus on these words. Sir, discharged means what, sir? Cancelled means exactly what, sir? Expires means what, sir? Already I gave you a basic idea. Let's try to learn a little bit further. Discharge means you pay the lender or creditor either in cash or in the form of assets or by issuing new equity shares. Ultimately, you pay him off. That's what I told you. Discharge means you pay him off. That's all. Done. Easy peasy, right? You have a loan of 10 lakhs. What do you mean by discharge? Pay off 10 lakhs. When I say pay off 10 lakhs, it doesn't mean that it has to be in cash. It can be in kind as well. Cash or in kind. Paid off, done with. Discharged, which means your liability is extinguished, which means you can de-recognize, which means you can remove it from the balance sheet. Sir, why are you repeating this entire connection many times? Means this is important. Otherwise, you'll do mistakes while solving sums. Okay. You need to understand the whole travel. Okay. Anyways, what do you mean by cancelled, sir? Mutual agreement to cancel the liability without payment. That's what I told you. You just entered into a compromise. Why would somebody do like that, sir? It does. It does happen in real life. Many of the bada business wallahs, they do that with banks and financial institutions. It happens quite frequently. Just you guys don't know, that's all. You get it? It happens in real life quite frequently. You guys don't know, that's all. Okay, so don't get surprised. It does happen. That's what you mean by cancelled. So it's cancelled. Mutual agreement done. So now there is no more obligation, which means your financial liability has got extinguished, which means you can de-recognize, which means you can remove it from the balance sheet. That's all. Finally, expired. Expired means the financial liability automatically lapses by passage of time or by operation of law. Actually, I told you, just most of the cases it will be passage of time. That's why the word used is expired. Whenever we use the word expired, it is related to time only, na? No more obligation, financial liability is extinguished, de-recognize it, which means remove it from the balance sheet. You got this? Here I just gave you one more point that only live obligations or current obligations or present obligations should stay on the balance sheet. Anything that is discharged or cancelled or expired, which in other words extinguished, should not stay in your balance sheet. Therefore, you have to de-recognize it, which means remove it from your balance sheet. As simple as that. Are we done with this? Right. Now, let's look into one special situation. Now, you can ask me, sir, why did you start financial, de-recognition of financial liability here, sir? You may get this doubt because, sir, prior to that, what did we cover? We covered CFI buyback, exactly followed by CFI concept. Correct? Eh? So we have gone through CFI concept. Immediately we covered the buyback as well. But sir, you have covered financial liability earlier, the accounting part. Once you have covered the accounting part, logically speaking, here itself you should be covering the de-recognition part as well, right? But you did not do that. Instead, you went for compound financial instruments. Okay, and instead you went to buyback as well. And after that, you came back. And then now you're saying you're going to cover de-recognition. There is a reason for that. Because a special case of de-recognition is nothing but debt restructuring. And debt restructuring is little bit complicated. To know that I have to finish off CFI. And I also need to finish off buyback of CFI. After that only this placement is right. That is the reason I kept it over here. So all the doubts that you are getting, obviously I also think, yes, so much of work I've done. Anyways, right. So let's try to understand what is this special situation. So we are still in de-recognition of financial liability. We have just covered the basics. Okay. Now, in terms of liability, there is a special situation where we are discussing the topic of de-recognition of financial liability. Okay. We are continuing with that. If they are substantially modified, which are substantially modified? Terms. I'm talking about the terms and conditions. Probably interest rate is modified, the number of years is modified, or maybe some other condition, the principal repayment is modified. Maybe they have given haircut in the principal repayment or something like that. So some sort of terms are substantially modified. In that case, Ind AS 109 treats it as extinguishment of the old liability. So when whatever the kind of liability that you are in, if in that liability, whatever the terms and conditions that you have got, if they are substantially modified, look at the word. This word is very important. I'm not saying just modified. There is a difference between saying terms of the loan are modified. Terms of the loan are substantially modified. I'm using the term substantially modified. So when I say substantially modified, something too much has happened. Okay. So what Ind AS 109 says is that, okay, too much change has happened. Let's treat it as a new financial liability. And I'll extinguish the old liability. And hereafter, the day on which the too much of modification has happened, the substantial modification has happened, from that day, I'll treat this as a new liability and the old liability is extinguished. Already you guys know the meaning of the word extinguished. Extinguished means that liability no more exists and therefore it will be removed from your books, from your balance sheet. You got the point? Right. Now, the next question naturally is, what do you mean by substantial modification? First of all, modification means, okay, something has got changed, interest rate has got changed, or repayment period has got changed, or principal amount has been reduced. That's what I said, haircut. Okay, collateral has been changed, or you're converting debt into equity, whatever it is, some sort of changes has happened. When do you call it as a substantial? When do you call it as a non-substantial? That is the next question, right? Usually, net present value of any cash flows, if they change by 10% or more, people call it as substantial. When the cash flows in itself, when they change by 10% or more, we call it as substantial. If it is less than 10%, we generally call it as not so substantial, normal changes or normal modification. Okay. So the concept that you need to understand here is that if it is substantial, only then Ind AS 109 says you extinguish the existing liability, and then hereafter, after whatever the so-called modifications has happened, I'll treat this as a new liability. But if the changes are not substantial, then it will be treated in a different way. You got it? So how is that, sir? That so-called modification is nothing but we call it as debt restructuring. So indirectly, this is part and parcel of derecognition of financial liability only, but this is a special case. And in fact, your derecognition of financial liability is a lot more simpler if at all this concept does not exist. So this is the one that makes it really complicated. Okay. So therefore, and it is important from examination perspective. Got it? Just like impairment of financial assets. So I want you guys to have 100% focus over here. Right. So what are we going to learn right now? Debt restructuring or loan modification. It comes under derecognition of financial liability itself. It comes as a special case where there is a substantial loan modification. If that happens, Ind AS 109 says that you have to extinguish the existing liability, and from that day onwards, whatever the changes that you made will be treated as a new liability. Now the next question arises, what do you mean by substantial? I already told you, anything more than 10% of the cash flows have got changed, we call it as substantial, otherwise we call it as a normal modification. Now, in case of substantial modification, we already have an idea of what the accounting is going to be as per Ind AS 109, where you have to extinguish or cancel out the existing liability and treat the loan after substantial modification as a new loan, new liability. Okay, and then you'll do the accounting part. What if the modification is not substantial? In that case, how you're going to do the accounting? So like that, there are so many questions. That's what we're gonna answer under the topic debt restructuring or loan modification. Okay. So what do you mean by modification? We know that it means that changing the original terms of the liability agreement, right? Original terms of the loan or any other financial liability. What kind of changes? I just gave you an example. It can be interest rate change. It can be tenure change, which means your loan is exactly for 5 years. Because of the modification, you're making it 7 years or 8 years, something like that. Changing the tenure, reducing the principal amount. Okay, you have to pay me 10 lakhs. Okay, you just pay me 8 lakhs. That's okay for me, right? Like that, the other party is saying it's a financial liability in your books. You have to pay. So probably other party is trying to give you a cut. Reducing principal amount means he's saying, okay, fine, you have to pay me 10 lakhs now. That's okay. I'll compromise for 8 lakhs or something like that. So that's a modification, right? Changing security or collateral. Get it? You gave a collateral. Maybe after that, whatever the collateral that you have given, its value has got increased. These many shares you have given, or this much of land you have given. You ask them that a little bit of land I wanted to sell. The later part of the land is enough for you as a collateral. Let's try to get into this agreement. Only then it will help me to run the business. Only in that case, I'll be able to make your interest payments and the principal repayment on time. So in both the interest, this is what we need to do. Then probably they'll be entering into what? A loan modification where they'll be changing the security or collateral. You understand the point? Anything can happen. This is a real life, right? Converting debt into equity is also a modification. So all these are examples of how a debt restructuring or a loan modification will happen. This frequently happens in real world, especially with respect to the corporate loans, the transactions between the corporates and the financial institution, which includes banks. Frequently this happens. Which one? The so-called debt restructuring. You get it? In our case, in retail cases, these things you will not see that frequently, but in corporates, it happens very frequently. That's why this is very important, because in real life, you got to do once you get inside the company tomorrow. You understand the point? And that is the reason ICA also knows this. There's a lot of real life application, and that's why this topic is important from examination perspective. I hope you're getting the logic. Right, now, let's talk about the modification now. Ready? Obviously, we already know what kind of modification, substantial, not substantial. Got it? If it is substantial, you need to go for extinguish accounting. This we have already discussed. Not substantial means you have two choices. What not substantial? The so-called modification. You can either revise the effective interest rate for new cash flows after the loan modification, or you can revise carrying amount of the financial liability by sticking with the existing EIR, which means ultimately you have two things, Ray. When you go for not so called substantial modification, which means it's not substantial modification. In that case, either you can revise the EIR or you can revise the carrying amount. It's pretty simple to remember. How to do that we'll discuss anyway. Don't worry. We have an example as well. We're going to solve it. Right now, just remember the concept. Sir, Loan modification, sir. Okay, next question. Substantial or not substantial? Sir, substantial, sir. Okay. To extinguish accounting. Sir, what do you mean by that, sir? Presume that your existing loan is gone. It's cancelled. So you try to de-recognize that. Whatever the existing loan that you've got, how much is ever is the carrying amount and stuff like that. And then whatever from here, whatever is going to happen for next few years, treat this as a new financial liability and then do the accounting. Okay. Sir, no, sir. Loan modification is not substantial, sir. It's not greater than 10%, sir. It is just less than 10%. Okay. In that case, you have two choices. Either you can modify the EIR, effective interest rate, or you can modify the carrying amount. Got it? Because there are two elements now. One is carrying amount, the other one is EIR. There are two things with you. You can change this and keep this same. Or you can change EIR and keep carrying amount same. You understand the point? Whichever way you want, you can do it. Got the point? Sir, how to do this, sir? Give us some clarity. You'll get it. Right now, just remember, okay, not substantial means I have two choices of accounting. Either I can change the EIR or I can change the carrying amount. Got it? Anyone. Right. Okay. First, let's try to understand what is this extinguish accounting, which we do in case of substantial loan modification or substantial debt restructuring. Then we will go for not so substantial. In fact, substantial accounting is very easy. The so-called not substantial itself is a tad bit confusing. Okay. So let's try to understand this first. Easy peasy. When it comes to extinguish accounting, the first step is present value of revised cash flows discounted at original EIR. Original EIR means whatever the EIR that you have right now. Right from the beginning you are doing, whatever the existing financial liability that you've got, you will already have a EIR that is nothing but original effective interest rate. Got it? With that, you discount the revised cash flows. Because after loan modification, if it is substantial, your cash flows will change, right? And that so-called changed cash flows or revised cash flows, you're going to discount it at the original EIR, which you have done at the beginning. Okay, you'll have some value over here. You add all the legal or modification expenses, which will be given in the question. So don't worry about this. You just add it. After that, you'll have some number. We call it as A. From that, you compare it with carrying amount of financial liability. Okay. Once you do that, you will know whether the so-called modification is substantial or not, whether it is greater than 10% or not. If it is greater than 10%, then you will do substantial modification, which means extinguish accounting. If it is not greater than 10%, then we will do not substantial modification accounting. Clear? Right. Again, I'll repeat. See here. First of all, to do loan modification, you need to figure out whether it is substantial or not. That I already taught you the concept. If there is a variation of greater than 10% of the cash flows, then obviously you'll be doing what? Substantial accounting only, which we have discussed over here. Now, how to do that step by step is what we are discussing right now. Step 1, you find out the present value of revised cash flows discounted at original EIR. You will know what are the new cash flows because you have done the loan modification. You multiply that with the original effective interest rate. Multiply that in the sense I'm asking you to discount. Then you will get a value. Okay. You add all the legal or modification expenses to that. Indirectly, this is nothing but your new carrying amount, Nana. Pretty simple. After the modification, it's just like that. Okay. Or you can also call it as a fair value, whatever it is. You compare this number with the existing carrying amount of the financial liability, whatever it is there in the books before the modification. Which means if the modification did not happen, if the loan would have continued same, then what would have been the carrying amount as of today? You compare with that. And you see how much the modification has changed. If the difference between these two, indirectly it's carrying amounts only. If it is greater than 10%, okay, then obviously you have to go for substantial modification, which means you'll go for extinguish accounting. If it is not greater than 10%, then chalo, not so substantial modification. Got it? Now the next question is, sir, what do you mean by extinguish accounting? Let's try to understand that. Okay. Now, so once you know that it is substantial modification, you know that you have to do extinguishment accounting, right? This is easy, Nana. Not at all complicated. Okay. How to do this, sir? First of all, when you do modification, there will be legal modification expenses. Correct? This we have already seen over here. Legal or modification expenses. What you'll do with that expenses? Put it in P&L account. Bare minimum treatment. Correct? Next, what you have to do in extinguishment accounting? We have already seen the concept over here. You have to extinguish the old liability and recognize the new liability. Extinguish the old liability. Old liability is a financial liability. Obviously, it will be showing a credit balance, and that too, what will be its value? Carrying amount. Correct? So what you will do, cancel the existing financial liability at its carrying amount. Carrying amount is nothing but book value, na. So it will be at its book value. Some value will be there in the books, na. You cancel. How will you cancel it? It will be showing credit balance, na, because it's a liability. You debit it, it gets cancelled. So existing financial liability at its carrying amount will be debited. Did I debit? Yes. Then what you have to do? Recognize the new liability. Now the question is, existing liability, I anyway know it will be there in my books at its carrying amount. So I'll take that number, I'll debit it, it's gone. It's gone. What about the new liability? I should recognize it at what value? Fair value. What is fair value? Present value of future contractual cash flows discounted at market interest rate. Even your existing liability also during the initial recognition, that's what you would have done. Na? So there is nothing surprising over here, right? So even for new liability, I have to discount the future contractual cash flows. That is the so-called revised cash flows after modification, after substantial modification, and discount it at market interest rate. That's all. Okay, recognize new financial liability discounted at market interest rate, which is nothing but finding out present value of revised cash flows. Got it? So that will be your fair value of the new liability. So new liability has to be created. So you will credit it to new financial liability, and the existing liability will be debited. If at all you find any difference, that will be transferred to P&L. If at all. Get it? Obviously there will be difference, na? Right? They'll not match. So you take it to P&L account. Got it? So two things you will be taking it to a P&L account over here. One is the so-called legal modification expenses. The other one is any difference between the existing financial liability and the new financial liability will be taken to P&L account. So ultimately, if your loan modification is substantial, the treatment is rather simple. Got it? There is no hoo-ha here, right? It's a lot more simpler. But the twists and turns will be there when it comes to what? Not substantial modification accounting. When there is no substantial modification, where the so-called carrying amount of your existing liability, that is this number, and the present value of revised cash flows discounted at original EIR. You have to be very careful here. See, but deciding whether it is substantial modification or not, you're discounting your revised cash flows after loan modification at original EIR, and you're adding legal modification expenses and comparing that with the current, carrying amount of the current liability, right? And then you're deciding whether it is greater than 10% or not. Here, the so-called discounting of revised cash flows is being done at original EIR. Whereas here, you're recognizing new financial liability where you're discounting your revised cash flows here also. See, present value of revised cash flows, present value of revised cash flows. Here you're discounting, here you're discounting. But for deciding whether it is substantial or not, you're discounting at original EIR. After decision of whether it is substantial or not, once you know it is substantial, you will be discounting this at market interest rate, not your original EIR. So please try to note this particular difference and don't get confused in future. So while deciding whether something is substantial or not, you will be discounting your revised cash flows after modification at original EIR. Then you will add the legal modification expenses and you will compare with the carrying amount of the existing financial liability. That is before modification. You understand the point? And then you will decide based on whether it is more than 10% or not, whether it is substantial or not substantial. But once you have decided that it is substantial, after that you need to cancel your existing liability, which is nothing but carrying amount, which is nothing but book value. You'll straight away take it from the book value, debit it, it's cancelled, gone. That's easy. What about then recognition of the new liability? You will be taking the revised cash flows and you'll discount it at market interest rate. Discount it at market interest rate. That's what we call it as a fair value. But here, that's not you're doing. You're discounting the revised cash flows at original EIR. This, keep it in your mind. Don't forget it. Of course, we'll be solving sums as well. You'll get clarity. But right now, this much should be there in your mind. This confusion should not come. Okay, next. Because I've seen so many students getting confused with this. That's why I gave you clear-cut clarity now itself. Okay, sir. This is easy only, sir. Yeah, substantial modification accounting is easy, which we call it as extinguishment accounting. These are all keywords. Keep this in mind. Sir, if it is not substantial modification, where the difference between A and B number here is less than 10%, it's not greater than or equals to 10%, it is less than 10%, then it is not substantial modification. In that case, what I have to do? How should be the accounting? Well, we call it as simple modification. Not substantial means let's call it as simple modification. In that we have two alternatives. One is we'll change the EIR. The other one is we will change the carrying amount. Okay. One is you change EIR, effective interest rate. The other one is you change the carrying amount. Okay. How? We'll do that now. Got it? Right. Now, moving on with alternative one. So let's learn this first. After that, anyway, we'll do a sum to understand the concept. Alternative one is you will do legal modification expenses in P&L. You'll do in the sense you'll put it in P&L. Okay. And then you will revise the carrying amount of the financial liability. Okay, the existing financial liability, because in simple modification, you will not be doing extinguishment accounting. So existing liability still stays. It still stays in the books. But the carrying amount of the financial liability, that is existing liability, what you have got, you will change that. You got it? Because this carrying amount no more is valid because you have done the changes. So how will you change is the first question. You will change in such a way that it reflects present value of revised future cash flows. Why it is called revised? Because of the modification. Okay. Discounted at original EIR. Because in this alternative, we will not be touching EIR. EIR stays like that. Carrying amount we will change. Got the point? So discounted at original EIR and corresponding adjustment should be done in the P&L. Okay. Whereas here, the legal or modification expenses will be adjusted to the existing carrying amount of financial liability. Here, we will not touch the carrying amount. The existing carrying amount will stay like that, but we will revise EIR. Here, we will not touch EIR. Here, we will revise EIR. Okay. Revise EIR based on carrying amount of loan after the above adjustment and revised future cash flows. Now, the question is, sir, how will I revise EIR? That we will see. Anyway, we're going to solve the sum, na? That we will see. Right now, what I want you guys from this is just remember what you have to do. Once you know what you have to do, once we, substitute that with numbers in a question, you'll be doing it automatically. Okay. First of all, you should know what you have to do. Na? That is important. Okay. Right. Now, tell me one thing. In simple modification, how many alternatives we have got? Sir, 2 alternatives. Okay. What are they? Sir, one alternative, sir, where we'll be revising the carrying amount. We will not touch the EIR. Original EIR will be there. In the other alternative, we'll be revising the EIR. We will not touch the carrying amount. Of course, for carrying amount, we'll do small adjustments. Legal or modification expenses will be adjusted. Got it? This is what you need to remember. Okay. So again, I'll repeat. Alternative 1, revise the carrying amount of financial liability. Alternative 2, revise the effective interest rate. This is the first thing you have to remember. Okay. Besides that, what you have to remember, in alternative 1, the modification or legal expenses will be taken to P&L account. Okay. In alternative 2, the legal or modification expenses will be adjusted with the carrying amount of the existing financial liability. Okay. All right, fine. So do we have sums where we can solve these two and we can get much more clarity? Yes, immediately we'll be doing. Right. All right, Anna, clear? Okay, now I'll just give you a imaginary skeletal structure of the solution. Let me see how far you can understand. After that, we'll go and solve the sum. Okay, the example problem. Anna, first, let's understand the simple modification treatment into two parts. One is legal expenses, how to treat them under both the alternatives. The other one is the main change. That is, in one case, you'll change the carrying amount. In another case, you'll change the EIR. Now, let's start with the first alternative. Easy peasy. Okay, the first thing is legal modification expenses. What are we going to do in alternative 1? We'll put it in P&L. Okay, simple. Next, in alternative 1, when we put the legal expenses in the P&L, we are going to revise the carrying amount. Okay. How are we going to revise the carrying amount? The future revised cash flows after modification will be discounted at original EIR. Whatever the EIR that we had in the initial recognition. So will be discounted at original EIR, and accordingly your cash, your carrying amount will be revised. As simple as that. That's all. After that, you will continue with the existing accounting with the revised carrying amount. Okay. Whereas when it comes to alternative 2, what we are going to do is that you are going to take the legal or modification expenses and adjust it with the existing carrying amount. This is the first step. Second step, now that your carrying amount is changed a little bit, because earlier the carrying amount is different, now that legal or modification expenses are adjusted with the existing carrying amount. So the carrying amount has got changed. Now keep this carrying amount on one side. Look at your future revised cash flows. And you should discount these revised cash flows at a particular rate, which we don't know, such that after discounting, these cash flows should match with this carrying amount. That's what you call EIR, right? So this is nothing but your new EIR, which you need to find out. I hope you have understood a little bit of what needs to be done. Okay. Now let's straight away go ahead and start solving some. So first what we'll do, we'll solve a problem based on substantial modification, that is extinguish accounting. This is easy only. After that, we'll solve a sum where we'll be covering both alternative 1 as well as alternative 2. Ready? Chalo. Let's go to our solutions book. Okay, first we'll start with question number 54 where we'll be doing extinguishment accounting. And then we'll go to question number 55 where we'll be doing modification accounting. This is not extinguishment. So you have alternative 1, you have alternative 2 as well. Both of them I've done. Ready? Yeah? Okay, now this is the example for which one? Extinguishment accounting. When will we do extinguishment accounting? When there is substantial modification. How do you know that we have substantial modification? For that, we'll do some steps, right? What are those steps? Let me revise one more time. We'll be calculating present value of revised cash flows discounted at what? Original EIR. We'll adjust the legal or modification expenses. Then we'll be comparing that with the carrying amount of the existing financial liability. If the difference is greater than 10%, it's substantial modification. Then we'll go for extinguishment accounting, which we are right now. Got it? Right. Right, guys. Some of the students have asked me to at least briefly explain the logic of how this so-called modification accounting is happening. So therefore, what I'll do is that I'll just give you a brief idea regarding the logic. If you can catch it, if you can get it, it's fine. Otherwise, anyway, we're going to solve a sum. Okay, one problem will be solved based on substantial, extinguishment accounting where there will be substantial modification. Other problem will be solved based on simple modification, which is not substantial. Of course, we'll be covering both alternative 1 and 2 with respect to that particular problem. So it's not an issue for you. But anyways, let me try to explain you the logic. How far you can catch it, you can just catch it. If you're not able to catch it, it's okay. Anyway, we know the steps. It's your choice at the end of the day. Now, first step is we need to identify whether it is a substantial modification or not. To do that, what we do is that we take the carrying amount of the financial liability, the existing carrying amount, whatever the financial liability that we have got. Okay. Then we will try to take the revised cash flows, because after modification, what all the changes has happened, usually what will happen is that your interest amount will change. Mostly it will be reduced, or sometimes it will be completely eliminated as well. So interest amount will change. The other one is the final redemption amount will be there. That will increase usually. So these two will be the revised cash flows. Now you take those revised cash flows, and why should you discount it at original EIR? Well, the logic is very simple, Nana. To understand it in a simple way, just feel that this particular existing financial liability is in what flavor? This is also discounted at original EIR only, na? And then you are doing unwinding of discount. I hope you guys know by this time what do you mean by unwinding. Okay. So even your existing financial liability during the initial recognition, you would have used EIR only. That's why it is called original EIR. Right now, if there is a different EIR, I will not use the term original EIR, correct? So original EIR in the sense, whatever that you have used for this particular existing financial liability, it's the same EIR. You understand the point? So only if I use same EIR, in other words, only if I use same discount rate to discount the cash flows, along with legal or modification expenses adjusted, I will exactly know how much change has happened. Because if I discount this at a different rate, let's say if I discount this at 14%, already my existing financial liability at the beginning, the original EIR was, say for example 10%. Then what will happen if you do something like this? Even though today, let's say the current market interest rate is like this only, but if you try to discount both of these things, that is EIR, at a different discount rate, then eventually what will happen? These revised cash flows will be discounted at a higher rate in this case, and therefore even though there is a substantial modification, you might not find it. You understand the point? So to really understand, okay, how much change has happened, both the cash flows must be discounted at same discount rate. So this is the first thing. That is the reason when we are deciding whether it's a substantial modification or not. Why should we decide whether it's a substantial modification or not? Because based on that only the accounting is going to be dependent on, correct? If it is substantial modification, we'll go for extinguishment accounting. If it is not so substantial modification or simple modification, we go for what? Normal kind of an accounting. You understand the point? So therefore, because of that, this is important. So here, if you try to use a different effective interest rate, then your analysis of substantial modification itself will go wrong. Then automatically your accounting also will go wrong. So that is the logic. So therefore, to put it in a very simple way, you used a particular flavor while calculating the financial liability, existing financial liability. For modification also use same flavor. That's all. Got the point? In other words, whatever the discount rate you have used here also same discount rate you got to use. Simple. All right. Coming on to the extinguishment accounting, when it is confirmed that it is substantial modification. Here, once you recognize a new financial liability, we are saying here you need to discount it using market interest rate. Why? Because that is the interest rate today. Extinguishment accounting means what? You're gonna totally delete the current liability, whatever that is existing. You're gonna eliminate that, and then you're gonna treat this modification as a new liability. So when you treat this as a new liability, you see in the market today, if there is a new liability getting created, at what interest rate it is getting created, right? Suppose today you issue new debentures, at what interest rate you are allowed to issue new debentures, correct? And that is the right, discount rate to discount, because today your accounting itself is that you are treating this as a new liability, which starts from today. And the right way to treat it is to discount it at today's interest rate only. That is why you take market interest rate. You will not take the interest rate few years back when the so-called original financial liability got created for the first time. Okay, now that modification only is happening. Are you able to get me? Right. Coming on to simple modification accounting, we have two alternatives. In one alternative, we try to put the legal or modification expenses in P&L. In another alternative, we'll try to adjust that with the carrying amount. In this alternative, we'll revise the carrying amount of the financial liability such that it will reflect present value of revised future cash flow discounted at original EIR. This is exactly same as this step. Here also, while checking whether there is substantial modification or not, what are you doing? Revised cash flows, all the changes in the cash flows after the modification are discounted at original EIR. In alternative one also, in simple modification, you're doing that. Why are you doing like that? Because it is simple modification. If it is substantial modification, if I have to do extinguishment accounting, if I have to treat as if from today onwards I've got a new liability, then I'll take today's market interest rate and discount. Here anyway, I'm not doing that. Here I'm not doing extinguishment accounting. Therefore, whatever the original EIR that I've got, still it is valid because the modification is very simple. Therefore, I'll try to discount it at original EIR itself. Only thing that I'll consider is that all the changes in the cash flows. I'll discount it at original EIR. Then obviously the current carrying amount will change. Because whatever the carrying amount that you have got right now is based on the previous cash flows. Now that the modification has happened, your interest cash flows in future has got changed. Your redemption cash flows in future has got changed. Then you need to discount it because the cash flows has got changed. Therefore, it is reflected in the current carrying amount. That's the only thing you do when it comes to alternative one. In alternative two, what you do is that you will not be touching the carrying amount. Instead, you will be revising your EIR such that the changed carrying amount will be reflected. You got the point? How will you calculate EIR? You will take all the future contractual cash flows. You will try to discount it at a particular rate such that it should be equals to today's carrying amount. Correct? That's how you find EIR. You understand the point? Today's carrying amount or today's fair value. In this case, it is carrying amount. Here also you'll be doing the same stuff. Only thing is that the carrying amount will change a little. Why it will change a little? Because your legal or modification expenses will be adjusted and the future cash flows are also changed. Two changes has happened. Your legal or modification expenses are adjusted, therefore your existing carrying amount will change. Plus at the same time, your future interest as well as the future redemption payment, that will also change. Even under simple modification also it will change. Only it will change a little bit. Therefore, you have to discount it at a particular rate such that after discounting, it should be equals to the existing changed, revised, carrying amount of the financial liability. Got the point? Okay. So far, whatever that we have learned is just the steps, and the logics I've told you is like building steps in the air. You understand the point? Some of you, if you're really smart enough, you should be able to understand it. Okay. Actually, it is difficult to understand. I'm not saying it's easy, but anyway, now we're going to solve an example. Here, I did not put the example. Usually, I'll put the example in Power Notes only, but the problem is, students has got this mindset. Once the number of pages that runs is too much, then they feel that it is a tad bit lengthy. It's not lengthy actually because it's handwritten naturally. If you take the same page from here to here, and then if you type this, in a real book, it will come only half a page. If you type this, okay, which means 2 pages in this material, which is handwritten, is equal to 1 page if you officially type it, So therefore, I hope you guys are able to understand. So that's one of the reasons why if you start reading our Power Notes, the pages will move faster. Anyways, having said that, now let's try solving examples. Okay, this is the first example where we'll be doing extinguishment accounting. And in the next example, we'll be doing simple modification accounting. Okay, extinguishment accounting means obviously it is substantial modification, correct? Hello? Right. Now, so on 1st January, this is 20x0, Nana. So obviously what we'll be doing is that we'll try to what? You can fill up any number over here. So we'll just try to put it as 2010. Okay, 2010. Let's put it that way. Okay. XYZ Limited issues 10-year bonds for rupees 10 lakhs. All right. Bearing interest at 10% payable annually on 31st December each year. The bonds are redeemable on 31st December 2019. Okay, we have substituted X with 1. Okay. For rupees 10 lakhs. So literally 1st January. So 2000 also will be counted as 1 year. In that case, till 2019 means 10 years it is. No cost or fee or incurred. This is an important point, Nana. No cost or fee or incurred. So what is indirectly trying to say is that when there is no cost, which means there is no transaction cost, there is no fee, nothing doing, and it is issued at par and redeemed at par, in that case, your interest rate, the coupon rate which you are paying itself will become effective interest rate. Normally, your coupon rate will be different, your effective interest rate will be different, correct? Why? Because you'll be issuing at a discount, you'll be redeeming at premium, there will be certain fee, there will be certain transaction cost, stuff like that. And as a result, your effective interest rate will be different from the coupon rate. But here, that's not the case. Nothing is there, so obviously both of them are same. To keep them same only, he has given information like that. The effective interest rate is therefore 10%. See, he himself has told you the same thing. Is therefore means because of this reason, your effective interest rate is also same as your coupon rate, okay? On 1st January 2005, after 5 years, XYZ Limited and the bondholders agree to a modification in accordance with which the term is extended to 31st December 20Y1. Y1 means here you substitute this with 2. Okay. So this is our ICA talent, so we can't do anything. So 2021, which means it is extended by 2 years. Interest payments reduced to 5% per annum, that is expected from 10% to 5%. The bonds are redeemable on 31st December 2021 for 15 lakhs. Earlier, the redemption being 10 lakhs, now they have increased it because they gave this facility. They've reduced the interest rate. They have to get compensated. Therefore, they're asking you to pay more money. Legal and other fee of rupees 1 lakh are incurred. This is legal or modification fee, which we have already discussed. Okay. XYZ Limited determines that the market interest rate on 1st January 2005, when the modification is happening for borrowings on similar terms is 11%. So that is the market interest rate at that time of modification, which is on 1st January 2005. See, 1st January 2005 means how many years have passed away basically? So 2001, 2, 3, 4. 5 years is done with. So 5 years is done and 6th year beginning the modification has happened. Okay. So that is the example. Quite a bit easy, Nana. It is issued at par, redemption at par, no transaction cost. So interest rate is obviously equals to effective interest rate, which is clearly given in the question. You need not apply your brain over here. Now, let's look at the modification date. The modification date is 1st January 2015. So what are the modification terms? First of all, repayment date has been changed from 31st December 2019 to 31st December 2021, which means total it is 10 years. After 5 years, the modification is happening. Logically speaking, if there is no modification, it should have been 5 years balance. But then because of this modification, 2 years it has been extended. Therefore, now the remaining years after modification is going to be 7. Because from 2019, it is extended by 2 years. So the remaining life of the loan is 7 years from today. From today means what is today? 1st January 2015. Coupon payment each year is 50,000. Why it is 50,000? Because normally it is 10 lakhs into 10%, it will be 1 lakh. But then now the interest rate has been reduced to 5%. Therefore, 10 lakhs into 5%, it will be 50,000. And after that, redemption payment is going to be 15 lakhs and not 10 lakhs because that has been increased because of the modification. Now, what do we need to do? First, we need to identify whether this is substantial modification or not. To identify whether this is substantial modification or not, what we have to do? First, we need to discount all the revised cash flows at original EIR. Then adjust the legal or modification cost. Then take that number and compare it with existing carrying amount of the financial liability. And you see the difference and you see whether the difference is greater than 10% or less than 10%. Accordingly, we'll decide whether it is substantial modification or not. Okay. So first we need to find out revised cash flows. So what are the revised cash flows? We already know 50,000 is the interest that's going to happen for 7 years, and 15 lakhs is going to be your principal repayment, which is going to happen at the end of the 7th year. Because right now we are on 1st January 2015. We are not on 1st January 2000. Am I clear? Where are we right now? 1st January 2015. So from today, how many years are pending? 7 years. So keep that in mind. Which means 7 years you're going to receive an interest income of how much? You're going to make an interest payment of how much? 50,000. It is financial liability. So you're going to make an interest payment of 50,000, right? So 50,000 every year. So what you'll do? 1 divided by, the discount rate will be original EIR. Original EIR is nothing but coupon rate, which is nothing but 10%. So 1 divided by 1.10, 1 first year, second, third, fourth, fifth, sixth, seventh. Grand total. Because 7 years, you're going to get 50,000 every single year. So once you press grand total, you'll be getting cumulative discount rate, which can also be called as present value annuity factor. So you multiply with that, which is 4.8684. Then after 7 years, you're going to repay 15 lakhs. So 15 lakhs into 7th year discount rate. 1 divided by 1.10, which is original EIR. 1, 2, 3, 4, 5, 6, 7. That's it. Leave it. Don't press grand total because we need the discount rate of 7th year, which we get it as 0.5132. You multiply with 15 lakhs. You get this one. 10 lakh 13,220. After that, what is the next step we need to do? Add legal or modification expenses, which is said to be 1 lakh in this particular question. So if you add that, you will get the A number, 11 lakh 13,220. That's what we have seen in the concept now. A number. That 11 lakh something that we have got right now, isn't it? That is this number. Okay. Next, we need to find B. What is B? Carrying amount of the financial liability right now. Carrying amount is nothing but the book value. Now, how to find out book value? Very easy. Your initial recognition will be what? It's a financial liability. So obviously you'll be getting money. So bank account debit to financial liability. Correct? In this case, it is bonds. So bank account debit to bonds. Financial liability. How much? 10 lakhs. Sir, why 10 lakhs, sir? Because there is nothing else. There is no fees. There is no cost. There is nothing doing. Okay. Issued at par, redeemed at par. Everything is fine. So therefore, 10 lakhs you have received. As simple as that. Got it? So therefore, your financial liability bonds will be looking in your balance sheet at 10 lakhs. Suppose this is financial liability account. A liability account. So you should be getting on the credit side. Let me put it this way. Bank account to financial liability. So financial liability by bank. How much? 10 lakhs. Correct? Then what will happen? You will be doing unwinding of discount, which is nothing but you will be adding interest expenditure. Interest expenditure at what? Effective interest rate, which is 10%. Then you will be making actual interest payment, which will reduce this particular financial liability. Correct? Your actual interest payment is nothing but contractual payment, contractual cash flows. That is also 10%. So which means plus 10% interest expenditure that you will be adding, which is nothing but unwinding of discount, and minus is also 10%, which means your closing balance also will be 10 lakhs. This will happen in the first year. Second year also same will happen. Closing balance is 10 lakhs. Third year also same will happen. Closing balance is 10 lakhs. Fourth year also same will happen. Fifth year also same will happen. Basically, the closing balance is how much? 10 lakhs. As coupon rate and effective interest rate are same, every year opening and closing balance will be same. Therefore, as of now, the carrying amount or the book value of the so-called existing financial liability, which is bonds, is how much? Same as the opening balance, which is how much? 10 lakhs. Got it? Right, fantastic. Now let's try to find out the difference. Okay, so the difference is 1,13,220 divided by 10 lakhs. Because 10 lakhs is the existing carrying amount of the original bond. So you get percentage as 11.32%. Is it greater than 10%? Obviously. So which means, is it a substantial modification? Yes. Which means, should I go for extinguishment accounting? Yes. When it comes to extinguishment accounting, what is the things that we do first? We'll transfer those legal or modification expense straight away to P&L. Put it to P&L. So debit it in P&L. You'll be making payment, therefore to bank. Then after that, what we'll do? We will be de-recognizing existing financial liability at carrying amount, and we'll be recognizing the new liability where the revised future cash flows after substantial modification will be discounted at market interest rate. So what's your market interest rate? 11%. Discounted at 11%, which means same, this numbers only. 50,000 present value, 11%, 7 years. 15 lakhs present value, 11%, 7th year. Got it? And you'll get 9,58,160. This is the value of the new liability. So therefore, new liability has to be created. So that should be created too. Financial liability, which is new, which is nothing but bond, 9,58,160. And existing liability value is how much? 10 lakhs. So that should be debited. Any difference between these two will be taken to P&L account. In this case, it is gain on modification. Got it? Because before modification, your liability was 10 lakhs. After modification, your liability is 9,58,160. Your liability has got reduced. So is it a good thing or bad thing? It's a good thing. So obviously, it will increase your profit indirectly because your liability has got increased. So that gain on modification will go to P&L account. That's it. Simple. Is this clear, everybody? Clear? Any doubts before we go to the next example? In next example, we'll be covering the simple modification. Okay. Now, moving on to the next question. So in this question, we're going to cover the so-called simple modification, which is not a substantial modification accounting. Okay. On 1st January 2000, XYZ Limited issues 10-year bonds for rupees 10 lakhs, obviously. All right. Okay. Bearing interest at 10% payable annually on 31st December each year. The bonds are redeemable on 31st December 2009. So again, this seems like 10 years for rupees 10 lakhs. So that is again at par. No cost or fee or incurred. Therefore, effective interest rate is therefore 10%. It's pretty much similar. It's a steady metal example. Okay. On 1st January 2005, exactly after 5 years. So it's pretty much the same, Nana. Just like the earlier example. Okay. Right. The only difference is with respect to modification, no further interest payments are made. Okay. The bonds are redeemable on the original date itself. There is no extension for 16 lakhs. Okay, so prior to that, for a period of 5 years, almost there is no need of any interest. Legal and other fees is 50,000. This is also changed. The repayment schedule for the original date till the date of renegotiation is as below. Okay, that's not necessary for us to actually, because it's an example. Straight away we can do that. Okay, now see here. Because anyway, we know how this repayment schedule works. So no need of it. On 1st January 2015, learn terms are modified as under. So what is the modification? First of all, earlier we used to have 10% interest. Now that 10% interest does not there. First of all, there is no interest, right? Second, the principal amount of 16 lakhs. Earlier it used to be 10 lakhs, but now you need to pay 16 lakhs on the last date, that is 31st December 2019, that is after 5 years. Where are we right now? Again, we are on 1/1/2015. We are on 1st January 2015. Okay. Right. So what is the first step we have to do? We need to find out whether it is a substantial modification or it is a simple modification. For that, we need to find out the carrying amount of the existing financial liability and compare that with the revised cash flows, which are discounted at original EIR, and then it is adjusted with legal or modification expenses, and see whether the difference is greater than or equals to 10%. If yes, it's a substantial modification, we'll go for extinguishment accounting. If no, then it is a simple modification. We can go for alternative 1 or alternative 2. In examination, any one you have to do. Here in class, for learning purpose, we'll be learning both. Clear? Right. So step 1. Present value of revised cash flows discounted at original EIR. Do I know revised cash flows? Yes. There are no interest. There are no interest payments. Just unlike the previous example that we have seen, only 16 lakhs, which will be repaid after 5 years. Where are we right now? 1/1/2015. So from here, it's going to be 5 years, right? So 5th year, what's going to be your discount rate? Obviously, original EIR is 10%, which is equal to the coupon rate. 1 divided by 1.1. 1, 2, 3, 4, 5. That's it. How much you'll be getting? 0.6209. And this will be your value. Right, and this should be adjusted with legal or modification expenses. Did I adjust? Yes, I've added that. And I've got the A value as 10,43,440. This should be compared with existing book value or carrying amount of the financial liability. Here, again, the same stuff. Usually what we'll do with financial liability, we start with the opening balance. Then we will add the interest expenditure at EIR. And then we'll reduce the contractual cash flows, which is nothing but coupon rate interest, which is 10%. Here EIR is also 10%. So you'll add 10%, you'll less 10%. So closing balance also will be same. This is for first year. Same thing will happen for 5 years. So which means even after 5 years, the closing balance will be the same as initial recognition, which is how much? 10 lakhs. We got it? Okay. Now take the difference, 10,43,440 minus 10 lakhs. How much you get? 4.34%, which is less than 10% obviously. So it is not a substantial modification. Then it is a normal simple modification. Now, if it is normal simple modification, we have two choices with us, alternative 1 and alternative 2. First, let's start with alternative 1, where what we'll be doing? We'll be revising EIR or we'll be revising the carrying amount. In alternative 1, exactly, we will revise the carrying amount. Okay, that's your alternative 1. There is no rules for alternative 1 or 2, Nana. In one case, we will revise the carrying amount. In another case, we'll revise the EIR. That's all. Okay. When you revise the carrying amount, you need to understand that in that particular alternative, the legal or modification expenses will be transferred to P&L. Correct? In the alternative where you'll be revising your carrying amount, your legal or modification expenses will be transferred to P&L. Clear? Right. So it is transferred to P&L obviously. So P&L account is debited to bank because you'll be making the payment. So to bank, and that is an expense, legal or modification expense, which will be transferred to P&L account. Clear? After that, you have to revise the carrying amount of the financial liability to reflect the present value of revised cash flows. And you'll be discounting that at what? Original EIR or the market interest rate? Original EIR. Why? This is not extinguishment accounting. In extinguishment accounting, your existing liability is gone and new liability gets created. When new liability gets created from today in the market, as of now, what is the market interest rate? At that interest rate, you'll discount. But in this case, when it comes to simple modification, you're not doing extinguishment accounting. Your existing liability is not going away. It is staying. When it is staying, the original EIR still applies. Now, what is original EIR? 10%. With 10%, you have to discount the modified cash flows. What is the modified cash flows? For next 5 years, there are going to be no interest rates whatsoever. Only after 5 years, you're going to repay 16 lakhs instead of 10 lakhs. That 16 lakhs has to be discounted at original EIR, which is already we have done. Correct? While checking whether it is substantial modification or not, we have already done it. 9,93,440 before adjusting legal expenses. So 9,93,440. Okay. So this is your revised carrying amount of financial liability. What is the existing book value? 10 lakhs. Here also we have calculated existing book value or existing carrying amount of the financial liability is 10 lakhs. So your revised carrying amount is 9,93,000. Existing carrying amount is 10 lakhs, which means you need to reduce the value of your financial liability by 6560. If your liability value reduces, you tell me, is it gonna be good thing or bad thing? It's a good thing. Obviously in P&L it will be credited. So credit P&L and reduce your financial liability. How to reduce your financial liability is basically it shows credit balance. You debit it, your financial liability balance gets reduced. By how much? By the difference between these two. Easy peasy. Are we done? Now, moving on to alternative 2. In alternative 2, what happens is that we'll be revising EIR. So when we are revising EIR, we should not be transferring the so-called legal or modification expenses to P&L. Instead, we'll be adjusting that with the carrying amount. So what was your existing carrying amount? 10 lakhs. With that, you'll be adjusting your so-called legal or modification expenses. So what is the entry for legal or modification expenses? Pretty simple. To bank, because you'll be making payment. If you're transferring to P&L account, the entry will be P&L account debit to bank. If you're not transferring to P&L account, you're going to set it off with the financial liability. Then obviously the financial liability has to be reduced to the extent of money that you have paid. So to bank 50,000, financial liability will be debited. The financial liability value will be reduced by 50,000. Clear? Now your revised carrying amount is 9,50,000 after this adjustment. Now what you have to do, you are standing on 1/1/2015. From here after you have 5 years. On 1/1/2015, your carrying amount is 9,50,000 of the financial liability. After in these 5 years, there is going to be no coupon payment in this particular question. After 5 years, you're going to get 16 lakhs. Now that 16 lakhs should be discounted at a particular rate such that after discounting, this 16 lakhs should become 9,50,000. You understand the point? Right. Now what is the rate? Very simple. Future value is 16 lakhs. Present value is 9,40,000. So future value is equal to present value into 1 plus r whole to the power of number of years. 16 lakhs is equal to 9,50,000. 9,50,000 only, na? It should become equal to present value into 1 plus r. Number of years we know, which is 5. So 1 plus r is equal to 16 lakh divided by 9,50,000 whole to the power of 5. If it goes the other side, it will become 1 by 5, right? Okay. So 1 by 5 minus 1. Now 16 lakhs divided by 9,50,000, you'll get some number. This becomes a to the power of b. You got it? And that's a over here, whatever the number that you get. Press square root 15 times, then you reduce minus 1 into b, the power you multiply, plus 1 into equals to 15 times. So this is how you can find square root of anything. 1 divided by 5 means it's fifth root basically, right? Anyways, so what you guys need to understand is that this in detail we will learn in SFM or AFM for that matter. Here, that much of requirement is not there. But anyway, it's an example. I gave you the steps over here. So this is A and this is B. Okay. So first you start with A. If you divide this, you'll get a number. I hope how much, I don't know. That number, press square root 15 times, and after that you press minus 1. Then you multiply that with b, which is the power, and then plus 1, and then into equals to 15 times. Okay, you get your answer 1.1099. You reduce minus 1, you get your r, which is equal to 0.1099, which is nothing but you have to multiply with 100 to get the percentage, which is 10.99%. This is your new effective interest rate. So with this effective interest rate, what you'll be doing? You'll be doing unwinding of discount. Unwinding of discount means you'll do ACM stuff hereafter. So no entry for this. Hereafter ACM accounting will happen at 10.99%, which means your actual interest payment, anyway it's not there. Coupon interest payment, anyway it's not there. Instead, what you'll be doing? Whatever the existing value you have got, which is 9,50,000. For 9,50,000, you'll be adding 10.99%. First year, again you'll get some number. Again 10.99%. Second year, again you'll get some number. I hope you're getting it. If you're not getting it, I'll teach you in a different way. Now see here. This is your financial liability bond. Okay. Here, your financial liability value is looking at 9,50,000 as of now. You'll be adding the interest expense. This is imaginary interest expense, which is nothing but EIR, which is 10.99%. Normally, you'll be reducing the coupon rate, which is 10%. But right now, there is no coupon rate because interest has been waived. So therefore, you'll add this 10.99%. This will become closing balance. Again, that closing balance will become opening balance. Again, you will add 10.99% second year closing balance. Again, 10.99% third year closing balance. And then eventually, slowly, you will increase this 9,50,000. At the end of fifth year, it will become 16 lakhs. And then you pay 16 lakhs. You're done with your financial liability. Gone. Is this clear? Everybody? Everybody, come on. Right. Chalo. So I think I gave you the necessary examples that are necessary. Okay. Right. To understand this particular concept. Till here it's clear. So with this, we are done with a very important concept with problems. What is that? Debt restructuring or loan modification. I just gave you the concepts with whatever the sums that are necessary. Okay. All right. Any doubts so far? Clear? Right.